successful. I want you to get to the next level, and I want you to win. Okay, and I want you to win. And best way to win on the charts, okay, is you have to have your setup. Okay, follow your heart. Okay, if God put it in you to trade, trade. Don't let anyone stop you. Don't let anyone stop you. You have to trade. Okay, whatever's inside of your heart, you got to go with that. You got to do that. It's going to be times you're going to be feeling doubt. It's going to be times you're going to feel like, oh, it's not for me. I don't know. But God put it inside of you for a reason. So go hard. Okay, follow your heart and follow your setup. Okay, you tell yourself, I'm only going to play break and retest. Okay, if you're a break and retest trader, why are you trading anything else other than break and retest? Why? If you're a mirror trader, okay, someone who trades resistance or support mirrors, okay, why are you playing anything else other than mirrors? You need to, if you're a trend line trader, okay, why are you playing anything else other than trend lines? Okay, that's the things. You have to follow your heart and follow your setup, and most importantly, follow God. Okay, you can get successful. Investing, it's important in this world. Okay, the more shares that we buy, the more companies that we can help, the more that we can help each other on this earth. Okay, faster healthcare products, more communication so we can communicate with our parents, grandparents around the world, etc. Okay, investing in the stock market is crucial. It's important, and don't let anyone else stop you guys from doing it. Very, very passionate about teaching this, and if you want to learn more about it, and if you want to get a free stock watch list, should see you at stackmode.net. Stay prayed up to God, keep grinding. Catch you in the next one. Peace. Class, let's get into stack mode. Let's talk about 401ks and Roth IRAs. Let's put that money to the side and let our money grow into more money. Inshallah. Let's jump into it. Let's talk about how. So we're going to be understanding the fundamentals of retirement accounts and how they function. And we're going to talk about the difference between a 401k and a Roth IRA, the difference between their rules, the benefits of them, and the tax implications. And we're going to talk about some real-world strategies to maximize returns and employer benefits, and develop a step-by-step plan to begin investment for retirement with confidence. So what is a 401k in general? Okay. So a 401k is an employer-sponsored plan that allows employees to invest a portion of their paycheck before taxes. So say you're about to get paid $1,000, right, to your bank account. Instead, a portion of that, let's say $200 of it, would go into the 401k, okay, which is going to be a place where your money can turn into more money, okay? So again, a 401k is an employee-sponsored plan that allows employees to invest a portion of their paycheck before taxes, and is designed to grow your wealth until retirement, helping you build financial independence over time. Imagine you earn $50,000 a year and decide to contribute 6% of your income. That's $3,000 annually going towards your future. If an employee matches 50% of that, you're getting an extra $1,500 for free. So understanding the Roth IRA in general. The Roth IRA is a personal retirement account funded with after-tax money, and it gives you the gift of a tax-free growth and tax-free withdrawals and retirement, extreme advantage. So instead of losing, let's say you had, so taxes go by brackets, right? So taxes go by brackets. So the more money you make, the more you're going to get taxed, okay? So let's say you're about to withdraw, let's say you have 500,000, right? In your 401k, say you have a really good paying job, right? Say you've been putting a really, really good chunk of your percentage income into the Roth IRA, right? Let's just say hypothetically, okay? Then, and I know certain things are capped at 8K a year, okay? So a lot of them, you can only deposit 8K a year and stuff like that for certain of them. But let's just say, for example, for $500,000, let's say you're about to withdraw that, okay? Then you would have to pay 40% on that normally, okay? And that's just 30, I'll say 37%, around 37% of that if you are about to withdraw like 500K, for example. Okay. So, but if you make a lower amount and you withdraw a lower amount, then you're going to pay like taxes. But still, you don't want to pay any taxes at all if possible. You want to try and get as much money as possible, especially if it's from your work check. So, yeah. So, you can withdraw contributions, not earnings, anytime without penalty. Okay. Because, you know, from our job, we already lose taxes or money from taxes anyways. So, building a solid retirement plan. So, focus on clarity. Okay. Small, consistent actions lead to major outcomes. Keep stacking up cash. It's the whole reason why I'm Stackmode Chris. I want to teach you guys, one, how to keep God first. Make sure you guys are praying. Make sure you guys are staying humble. And make sure you guys understand that you don't need too much, okay? Especially not right now, okay? There's going to be times where you're going to have time to pop it, okay? If you want to know what popping it is, there's going to be times where you're going to be able to buy the cars you want, okay? You can buy the houses you want, okay? You can get the clothes you want, okay? Inshallah, if God wills. But we got to make sure that we're investing first. Put that money to the side. Don't go buy the Jordans and the cars, the houses, and the clothes now. Invest into something that's going to make your money turn into more money, okay? So put some money to the side, okay? Instead of getting the whole check from your job, put some more into your 401k, okay? Put some to your Roth IRA. Put some aside. Stack it up. Let your money turn into more money. Money's a tool. I cannot stress that enough. Money's a tool. Don't be too attached to it. Even if you go flat zero, God got you. All right, keep praying, stay consistent, you can run it back up again, and don't give up. Promise you, I've gone flat zero plenty of times. Okay, trusted God, stuck to the process, and ran it up. Okay, gone flat broke, in debt, was managed to clear it. Okay, and just keep grinding. Okay, wake up, keep praying to God. Wake up, keep stacking up that cash. Okay, and I've learned from those lessons. Okay, learned to live way below my needs. Only groceries. I don't eat out anymore. I don't buy clothes every day anymore. Okay, I'm not buying steaks like that anymore. Okay, I'm in stack mode. Okay, I'm praying to God. I'm working out. Okay, I'm not going outside if I don't have to, and I'm working hard. I'm mastering my craft. When I'm getting paid, I'm putting most of the money away. I'm investing. Okay, being grateful for the opportunity that God gave us. Okay, and our body can only take so much. So let your money turn into more money so you can enjoy life. All right, take care of your mental health, enjoy a trip with your family, enjoy a trip with your wife, your husband, and do what you need to do. Stay consistent and stay praying up to God and just keep grinding. I'm telling you guys, it's gonna pay off. When you save the money, you put it away, act like you're broke, okay, but have it all invested. Okay, I'm telling you, if you act like you're broke and you just invest, it's gonna be amazing for your mental health. It's gonna make you stay consistent. It's gonna keep you hungry. It's gonna make you a dog, okay? You're going to keep going hard at your craft. You're going to want it bad. You're going to be asking God for help in each and every scenario. Okay? Stay consistent. Put the money away, invest it, act like it doesn't even exist. And I promise you, you're going to be able to run up that big bag. Inshallah, you're going to be able to take care of your whole family. Inshallah. Stay consistent. Okay? Stay out the bar. Stay out the club. Okay? Don't be doing things you don't need to be doing. Stay away from people who aren't being consistent. And keep going. You got people to take care of. I promise you. You're going to be feeling like the one when it's all said and done. Stay down. It's going to all make sense. Whatever you're doing, stay down with it. And it's going to make sense. And then I promise you it's going to make sense in the end. Stay down with it. So I don't care if you guys have $50 right now. Okay. Put 25 of it away and stay down. Okay. Live off the other $25. Stop spending the whole check. When you get paid, put it away. If you make $1,000, right, a check, pay your bills, okay? Take care of your groceries. Take care of who needs to be taken care of. Your kids, your people, husband, wife, whatever. Do what you need to do, okay? After that, right, make sure it's straight things you guys need to be taken care of. Nothing but bills. If it's not bills, forget it. If it's not bills, you don't need to be spending money on it. Take care of your bills, take care of your groceries, and then invest. You gotta act like you're broke. Stay down, okay? Invest right now. If you got $5, invest $4 and stay down with that $1 until you run it back up. Okay? It's the mentality. And even once you start touching 6 figures, 7 figures, 8 figures, 9 figures, you're going to be in that stack mode mentality. You're going to wake up, pray, go work out, put that money in the stash. Even if you make 50 grand, you're going to go ahead and put 45 of it away. Live off the 5 grand. Okay? Stay in stack mode. It's going to make you guys stay consistent. And it's fun because you can go to the stash and go pull an M out at any time. Stay down. You could wear the same fit every single day. You could drive a beater car if you want. But you know what you have in the stash. Don't let anyone break you guys down. You guys are good. Okay? Wake up, pray to God, and stay humble. Stay humble. Keep grinding. If you're not where you want to be, understand it's a marathon. You're not going to get it overnight. It's not going to happen overnight. There's plenty of times I've been grinding 18-hour days thinking things weren't going to work out. And I'm telling you guys, if you pray to God and you keep going, there's a great chance that you're going to get what you want. Inshallah. It's good for you. All right? God's the best of planners. Just keep going. Keep going hard. Stay down. Even if you see your portfolio on the reds right now, stay down. Okay? Ask yourself, if this is a good investment, okay? If this is something I want to be invested in, okay? And just don't give up. Okay? Don't give up. Stay consistent. I don't care if it's your 401k, your Roth IRA, or individual portfolio. Stay prayed to God. Keep grinding. Review your portfolio and just don't give up. I'm telling you, it's all going to play out in the end. Stay consistent. Peace.
Quantitative tightening has officially ended, and trust me, this changes everything for investors. For the past few years, the Fed has been draining money out of the system, shrinking its balance sheet and putting pressure on stocks, real estate, and even crypto. But now, that pressure valve just opened, liquidity is flowing back in, and whenever liquidity comes back, asset prices don't just react, they move. But here's the truth that nobody tells you. The end of quantitative tightening doesn't automatically mean a bull run. It does mean volatility though. It means opportunity, and it means that the smart money is already positioning while everyone else is still confused about what quantitative tightening even is. So what does this shift actually signal for you? Expect easier borrowing, potentially higher stock valuations, stronger risk-on sentiment, and most importantly, a window of time where early positioning matters more than ever. So let's figure out how we can plant our seeds, what quantitative tightening even is, and how we can learn how to invest. Inshallah. Let's go. Quantitative tightening has ended. All right, let's go on this breakdown how it's going to affect investors and the future of everything. So what was quantitative tightening in the first place? So quantitative tightening is the reverse money printer. Okay, so you know quantitative easing, right? QE. And that's when the Fed prints money to buy bonds. Quantitative tightening is going to be the exact opposite of that. Okay, for the last few years, the Federal Reserve has been destroying money to fight inflation. Okay, printing more constantly over and over and over and over and over again. Okay, and the mechanism. Okay, so it's when they let bonds that they own expire and don't replace them. Okay, and the result of that is cash disappearing from the economy. Okay, and the goal of it all is to slow the economy down to stop prices from rising. Okay, so quantitative easing is turning the water hose on to fill the pool. Okay, and quantitative tightening is sticking a vacuum in the pool and sucking the water out. Okay, so let's head over to the next slide. So the Fed cannot suck money out forever, or the system would go ahead and just break completely. Okay, so they're stopping or tapering quantitative tightening because inflation is cooling. Okay, the job is pretty much mostly done. And let's talk about the liquidity risk too. If reserves get too low, then banks will start to fail. Okay, and that cannot happen. The whole United States economy and infrastructure is based off of banks, companies, and money flowing through business owners. Okay, an economic slowdown, okay, they don't want to cause a massive recession for pretty much no reason. Okay, so the danger zone. So imagine braking a car too slow it down. Okay, and if you keep holding the brake after the car stops, you don't move. Okay, but if you brake too hard, you skid and crash. Okay, so right now, the Fed is releasing the brake. Okay, that's all it is. So imagine braking a car to slow it down. Okay, if you keep holding the brake after the car stops, you don't move. Okay, and if you brake too hard, you skid and crash. So right now, all the Fed is doing is releasing the brake. Okay, that's it. All right, into the market. Okay, because money's no longer being deleted pretty much. Okay, so liquidity is the lifeblood of the market. It's easily how money moves around. Okay, and risk on. So historically, the end of tightening is a green light for risk assets, okay, letting us know that there's going to be more money circulating in the economy, giving us a higher chance for our assets to head in an upwards direction, since A, more people will be investing into something with value, okay, or B, people will have more money to purchase things with value. So valuations. So with less pressure rates on PE ratios, okay, stock prices can expand and head in an upwards direction, okay? And tech and growth. High growth companies like tech or AI companies usually benefit the most when money becomes easier, okay? Because then they're going to have more money to invest back into their company and circulating instead of having to be tight and restrictive with the advancements and innovations, especially tech and AI companies, because the whole point of tech and AI companies is to profit off of future innovation and psychology involved into it, right? Investors then stop fearing the Fed and start fearing missing out. Okay, they're like, hold on, quantitative tightening is, hold on, it's pause. What we got to do is put some risk on, put some money down on the table before market heads up to all-time highs without us. Okay, so when the Fed was selling, okay, you sold. Okay, so now the Fed is stopping. Okay, so the headwind is gone. Okay, the headwind is gone. Make your decisions. Plant your seeds for your asset classes. Okay, so you don't have to struggle in the future. Okay, the market can do two things: go up and go down. It goes up and it goes down. That's it. Okay, you're not playing an intricate math problem that you have to solve every day. All you have to do, for the most part, is invest in something that has future value and hold and be disciplined with your money. Okay, fight your flesh. You can't be indulging in things that you want to buy every single other day. Okay, stay down. So you're putting majority of your money away into asset classes. Okay, I'm not saying don't enjoy life. We are here only once. You know what I'm saying? Enjoy life. Do your little thing. Okay, get you some little food, buy you some little clothes, live your life, do your thing. But it can't be that week after week after week after week after week. A lot of the time, you should just be staying down, planting your seeds for your family. All right. So over to the next slide. Supply and demand. So during quantitative tightening, the Fed was a massive seller or non-buyer of bonds. Okay, and this forced interest rates up. So quantitative tightening ending leads to less supply of bonds flooding the market. Okay, and bond prices should stabilize or go in an upwards direction. Okay, and yields should stabilize or go down. Okay, so the real world effect of everything is that mortgage rates are tied to bond yields. Okay, if quantitative tightening ends and yields drop, then mortgage rates could finally come down, making real estate and real life a lot more affordable. Okay, so the fact that quantitative tightening is being ended is a really, really good sign for the future of the economy. Okay, and this is really going to help the housing market, get a lot of people off the streets, okay, and really just help a lot of people out in the world, making life more affordable again. Okay, because we shouldn't be stressed out every single day, you know, just trying to live our life, especially when we're already grinding hard. So let's go over to the next slide. Okay, the biggest risk of stopping quantitative tightening too early is that inflation has a chance to creep and come back up, God forbid. Okay, so the mistake that happened in the 1970s, for example, right? The Fed stopped fighting inflation too soon, and it came back double the strength, ready to bite everything in the tail. Okay, banks crashed, companies crashed, CEOs crashed. A lot of CEOs and a lot of companies ended up selling their companies to other major companies to make up for the fact that they couldn't keep up with that recession crash. Okay, and the market bubble. So if market ends up going up too fast, okay, it creates a bubble that might pop later. Okay, it might pop later super duper hard, and the economy will face its consequences for that. So the currency risk. Okay, the dollar might weaken if they print too much. Okay, if it's too much of something, it's no longer valuable. Okay, if something is everywhere, it's not valuable. Okay, so just think of it logically. If something is everywhere, it's not valuable. Okay, but if something is scarce, it's rare. Okay, it's valuable. Okay, so though we aren't printing, okay, just stop the shredding. Okay, so watch the CPI, Consumer Price Index reports. That's going to be one of the most important reports that come out. That's going to determine how cryptocurrency and the stock market wants to move. Okay, and if inflation ticks up, the Fed might have to restart quantitative tightening, and that would be super duper bad for stocks. So cash yields might peak. Okay, try to lock in rates or move your cash to assets. Okay, keeping your cash in that asset river, especially if the dollar weakens, then that means assets are going to become more valuable. okay? Because people have to have some type of value in something, okay? So once again, if cash gets weaker, then assets become more valuable, okay? And the quality growth of everything. So look for companies with low debt that grow regardless of the economy, okay? And it might be a good time to buy bonds before yields drop as well too, if you'd like, okay? So review your cash position too, okay? See how much cash you have and see what you can plant within your asset classes, okay? Don't be scared of the market anymore, and keep an eye on inflation data is ending, okay? Money is back, okay? It's trying to get healthier. It's trying to flow back into the markets properly, okay? And liquidity stabilizes, which is really, really good for the market, letting us know that there's going to be more money available, which means more money could be flowing into asset classes such as the stock market or the crypto market, okay? And this gives us a chance for rates to likely stabilize or drop, okay? And risk shifts from the Fed fear to inflation watch, okay? So stay invested, stay alert, keep up with the reports, stay prayed up to God, keep grinding. Make sure you guys aren't buying any assets at all-time highs, okay? I don't even care if it's real estate, okay? Even if it has nothing to do with the charts. Don't buy any assets at all-time highs, okay? Wait for the dip, buy, and catch the V sweep up, okay? Stay prayed up to God, keep grinding, and head over to stackmode.net if you guys want to learn how to invest. Peace.
Bitcoin mining is the network's backbone, and it's not just about earning crypto, it's how Bitcoin is created in the first place. Miners use powerful computers to solve the puzzles. They secure the blockchain with an immutable new block each time, and this process is the global security system that prevents double spending and fraud, and it verifies all transactions across thousands of independent computers, replacing a central authority. Without miners, Bitcoin wouldn't even exist, and it would collapse. But with them, it's become one of the most secure financial systems on Earth, powering the trust and transparency of decentralized money. Let's go and let's talk about how Bitcoins are created and why the government owns it. Inshallah, if God wills. Let's go. So, class, welcome. Let's go and let's talk about how Bitcoin is created in the first place. So Bitcoin is generated by mining it. Okay, Bitcoins don't just spawn out of thin air. And as you know, Bitcoin is also a limited cryptocurrency. So other cryptocurrencies for the most part are going to be infinite, but Bitcoin is actually going to have a limited amount of currency. Okay, there's only 21 million Bitcoins that exist. Okay, and each one of them is created by getting mined. So what happens is a computer, okay, and the computer is obviously powered by resources. Okay, so certain countries take more power than others to create certain Bitcoins. Okay, so if you're in a country that charges a lot for power, then you'd be paying more on your electricity bill in order to mine the cryptocurrency. Okay, and what you would need is a super powerful computer with a graphics card that can handle the Bitcoin mining. Okay, so what a graphics card is, it's a piece of the computer that's external. Not all computers have external graphics cards. Some have inbuilt graphics cards, which is why they're slower than others. But what you need is a really powerful computer, and then from there you'll be able to load up the Bitcoin mining software, and it can go ahead and get created. We're going to talk into the technicals, exactly how everything works. Bitcoin mining is super duper cool. You might even want to do it and see if this is a good way that you guys might want to generate some income, depending on what country you're in as well too. You'll be able to save a lot of money on power, and you could potentially mine yourself or create yourself a Bitcoin for way less than buying it. So let's jump into it, class. So what is mining even in the first place? Mining is not digging dirt. Bitcoin miners aren't digging into the ground with actual pickaxes, digging into the dirt, looking for resources. No. Okay, so what it is computers mining Bitcoin via a software. Okay, and the job is to secure the network and process transactions. Okay, so it secures the network by making everything decentralized. So in a traditional bank system, let's say you wanted to send a wire transfer, for example, right? The bank would be able to decide whether yes or no if the transaction wanted to go ahead and get approved or declined. Within a decentralized network, such as sending Bitcoin, things like that don't occur. Since everything is done by smart contracts, okay, everything is autonomous and automatic, done by computers, okay? And that's what Bitcoin mining comes into place too. Even creating Bitcoin, instead of just clicking print on the dollar like they do with fiat currency, Bitcoin actually has to go through a whole process in order for a Satoshi to be created in the first place. Okay, so Bitcoin mining helps keep Bitcoin decentralized. The reason why the US dollar fails is because they just go up to the printer and click print. Okay, there's no real strategical process that goes from start to finish for the most part, that keeps its base value cooked in. Yes, you can just print more dollars, but that would inflate the other ones. Since there's a finite amount of cryptocurrency, there has to be a secure process in place in order for it to be created, for it to be fair for everybody. And mining is the way it's done. Let's keep going. So think of the blockchain network as a public notebook. So you might have heard of what the blockchain network is. So the blockchain network is pretty much a public copy of everything that's been done. Every transaction that's been created, every Bitcoin that's been mined, and every transaction that's happened. Okay. So the blockchain is pretty much going to be a verifiable place to where you can see if your transactions were even completed as well. Okay. So within the blockchain, you'll be able to put in your, let's say, address. Let's say you did a transaction. You could copy that transaction address, put it onto the blockchain or some type of blockchain checker, and you could see if there were any confirmations. Okay. Confirmations are pretty much going to go ahead and let you know when your transaction is ready to be completed. Okay. Either the money has been sent over and it's about to hit somebody's wallet. Okay. Or it's on the way to hit your wallet. Okay. Depending on the situation. So the blockchain is a public notebook that everyone has a copy of. And mining is the process of adding a new page, okay, which is a new block to this notebook. So page 1, right? Let's say Alice sent some money to Bob. Okay, let's say they sent 5 Bitcoin. You're going to be able to see that. Okay, you'll be able to see the Bitcoin addresses, etc. And you'll be able to see when the transaction was sent, how much Bitcoin or how much cryptocurrency was sent. And you'll be able to see the miners working on certain things as well too. Okay, you'll be able to see when Bitcoin transactions have been implemented and grounded into the blockchain. Whether a big whale is buying or selling, the blockchain shows us everything. Okay, keeping cryptocurrency really, really safe. So proof of work. So once again, Bitcoin, it's not created like the dollar. You don't just go up to the printer and click on print over and over and over again. It's created by POWs, also known as proof of work. So to add a page to the notebook, computers must solve a super hard math puzzle that requires a pretty powerful computer as well too. So make sure you guys have a good graphics card inside of your computer before you think of doing anything like that. Okay. So to add a page to the notebook, you got to have a super powerful computer, and then the computer has to do calculations and try to guess the number. Okay. So imagine guessing a number between 1 and 1 trillion. Okay. You have to guess randomly. So computers then make trillions of guesses per second to find the random number. Okay. Which is going to be the hash. Okay. So that's how the proof of work works. And that's pretty much all the work that the computer is doing. The computer is constantly running calculations, trying to find and guess the correct numbers in order to generate a Bitcoin. Okay. And that takes a lot of power, a lot of resources. So make sure you guys are watching your energy bill before you think about getting into this. So this is exactly what I mean. You need a powerful computer. Okay. Your computer has to be good. It can't be a weak computer. Okay, so understand that you cannot mine Bitcoin from your laptop. Okay, you cannot mine Bitcoin on a laptop anymore. Okay, so these with, you know, saying with the screen, a little keyboard, not cutting it if you want to mine Bitcoin. Okay, get yourself a real strong desktop with a real graphics card before mining Bitcoin even crosses into your brain. Okay, so you need specialized machines called ASICs. An ASIC stands for an application specific integrated circuit, and they do one thing: guess numbers for Bitcoin. Okay, they're loud, hot, and they use a lot of electricity. Okay, so before you guys think about just putting it into your room, keep all of this into play. Okay, keep all of this into play. Same for Airbnb owners as well too. If you guys have Airbnbs, what people are doing is signing up for Airbnbs and mining Bitcoin at Airbnbs in order to save money on power bills and stuff like that. Or people are also even moving to other countries in order to save on power bills too, so they can mine Bitcoin for a lot cheaper. So keep all of these things into play and understand that the future is really changing a lot. People are starting to get a lot more equipped and doing a lot more strategical moves to mine all the Bitcoin as possible before it goes away. So what's the point of this? Like, why do it in the first place? So the reward, right? The winner who solves the puzzle first gets paid in brand new Bitcoin. Okay, a brand new Bitcoin. So Bitcoin is created by whoever has the best computer, right, and is solving the most problems. Okay, the more computers you have solving more problems, okay, the more Bitcoin that you're going to accumulate in the first place. Okay, so it's going to be either one computer or a whole room full of computers. Okay, and what they're doing is they're doing math. Okay, 2 plus 2 equals, okay, and then whichever one of the computers can find the hidden number, okay, goes ahead and generates the Bitcoin. Okay, after you find the random number, or one of the computers generates it and finds the right calculations, then a hash is going to go ahead and get created. Okay, then from there, you're going to go ahead and get paid within your Bitcoin. And you keep doing that, keep doing that. Now, the computers do have a high chance, once again, to consume a lot of power, which means that the resources inside of the computer, processor, graphics card, RAM, etc., have a high chance to go out and combust. So before you think about doing this, make sure you guys have some money to the side to pay your bills, maintain everything. So I don't want you guys going broke to do this. But this is how Bitcoin is created by computers solving complex math, looking for a specific number. And once again, the more you have, the more Bitcoin you'll be able to generate. Since the more computers you have, inshallah, if God wills, the quicker you'll be able to look for hash codes, and the quicker those computers will be able to solve different types of calculations. So what's the point of this? Why is it essential for security in the first place? So it's costly to cheat, right? So to fake a transaction, you need more computer power than all other miners combined, making it pretty much obsolete, not even worth it, and not even, yeah, once again, not even worth the while. So immutable. So once a block is buried under other blocks, it's mathematically impossible to change it, because the way that Bitcoin works is that the computer is hunting for hidden numbers. Okay, it's hunting for random numbers and it's trying to guess the correct numbers. So the chances of it being faked or created within a false context would pretty much be almost impossible. Okay, since there's so many numbers and it's looking to guess the correct one, and it's decentralized. So no single boss controls the ledger. So no people can just be like, you know what, we're going to decline this transaction. We're going to approve this transaction. Oh, you want to send $10,000 to somebody in another country? You know what, we're going to go ahead and decline this and shut down your bank. Okay, that's happened to people. Okay, and that's not fair. It's not fair. There might be money you might need to send to somebody in another country to help send your family some money, to help pay your employees or whatever. Cryptocurrency is such a beautiful blessing on this earth. God is the greatest, you know? Is being able to send $1 million to somebody the next day, boom, just like that, snap of a finger, and nothing is even remotely concerning. Okay, it's beautiful. We want to be focusing on buying as much cryptocurrency as possible, guys. Focus on it. Okay, focus on it. So no single boss controls the ledger, guys. It's decentralized. We're all in this together as a family, and thousands of miners protect it together. Okay, the cryptocurrency community, it's really a family. They just want people to send money and collect their money freely, without any restraints, without any cringe blockages or anything like that, without any 3 a.m. shutdowns. They just want people to send their money borderless all around the world and spend their money all around the world. God is the greatest. You know, to be able to live in this type of time period where we can have this type of decentralization, it's really a blessing. Okay, take advantage of this time period, guys, and let's keep learning about cryptocurrency. So let's talk about the wall of energy. What is this? Okay, so it's a feature, not a bug. So people complain about energy use, but that energy is a wall protecting the money. So you have to understand that the printers, okay, if they just keep printing the dollars, inflation is going to continue to increase. Okay, which is why the US government, for example, is running to cryptocurrency to kind of save its tail. So energy equals real world cost. Okay, you can't really fake that. When that mean power bill gets sent over to you, you got to pay that. It just is what it is. Okay, it's kind of hard to dodge that because it costs real actual money, electricity to mine, and you need an actual account too. You can't just be like a fake person. You got to actually go sign up for the power account, put your card on there, etc. So because it costs real money, electricity to mine, you're incentivized to play by the rules, keeping it safe and free though for everybody. Okay, free for everybody to jump in, I'll say. Okay, because some things are going to be gate kept through certain other things, but as far as just the freedom to start, anybody can start. Okay, you might just need the ASICs computer, pay for the energy, but as far as just the freedom to start, anybody can start. So if you cheat, you waste electricity and you lose money. Okay, so it's pretty much not going to be worth it at all, because the point of this is to gain some Bitcoin. So inshallah, you can maybe see some profit. So keep everything stable and keep everything well-rounded. Make sure you have everything planned before you just start trying to do anything. Okay, so let's talk about the life cycle, right? So a broadcast. So if you send one Bitcoin to a friend, the network is going to hear it. Okay, the blockchain is going to see it. You could see if the transactions were completed via what's called confirmations. Okay,
So compete. Miners then race to solve the math puzzle, the hash, to box up transactions, okay? And then verify. The winner shows their proof and everyone checks it instantly. And this keeps it secure, okay? This page is glued to the notebook forever, also called the blockchain, and then the miner decides to go ahead and get paid. So that is the full 1, 2, 3, 4 cycle of how Bitcoin mining actually occurs, okay? So the computers are looking to solve the hash puzzle, okay? After the computer solves the hash puzzle, then the miner will go ahead and get paid in Bitcoin, inshallah, if God wills. So keep it simple. All right, y'all. Happy Bitcoin mining. I pray you guys do well. If you want to go set up a rig or set up your own basement, do it, okay? Be ready to pay that electricity bill, but I believe in you guys. If you're interested in Bitcoin mining, head over to stackmode.net for all trading education, and I'll teach you guys and we can talk about absolutely whatever. Stay prayed up to God, keep grinding, and I'll catch you in the next one. Peace.
Let's go and let's jump straight into the lesson. This is going to be the differences between stocks, shares, and options. Let's go. And at their core, stocks and shares refer to the same thing, a unit of ownership in a corporation or a company. And the terms are often used interchangeably, and though shares typically refers to the number of individual units held by an investor, and while stock is more of a general term used for the entire collection of shares. Okay, so for example, I own 10 shares. 10 shares is going to be the amount, the percentage of the company that you want to be a hold of. Okay, the amount of shares equals the amount of percentage ownership that you have in the company. Okay, so if you want to own 10 shares of Apple stock, okay, and Apple is going to be the primary stock. Okay, shares is the percentage amount that you own, and the stock is going to be the name. And here's what they represent. Owning a share means that you're a partial owner of a company, and as an owner, you have to represent, okay? And you also have a claim on a portion of the company's assets and earnings. And this ownership gives you a right to the company's profits, and it's distributed as what's called dividends, okay? And dividends, especially if you have enough shares invested into, then dividends will go ahead and be paid out to you. And this way you can be able to make money just by being an investor. And say in the corporate matters though, it's also going to give you some voting rights depending on the amount of share that you have. And for every share that you own, you typically get 1 vote. Okay, so the more shares that you have, the more votes that you're going to have. Okay, so you're going to have 1 vote per share, for example. Okay, and that allows you to influence key decisions like electing the board of directors and who's going to be controlling the future of the company's growth. And why do companies issue them in the first place? Companies sell shares to the public to raise capital, and this money can be used for expansion. So whenever you guys see millionaires, billionaires, stuff like that, and they're company owners, a lot of the time it's not in raw dollar currency, okay, sitting in a bank account. A lot of the time they're rich through the company they own, and a lot of times it's on the stock market, okay? And then that company generates money. And since they're associated with it, or the leader, they get the money associated with the tag, so then they get to be a billionaire. For example, any creator of like say company.com, okay, say they have $500 a share worth, okay, the owner of it, let's say the company does $10 million a year, okay, the owner of it would be classified as a billionaire because he's the owner of it. So that's normally how that works. So they sell shares to the public to raise capital and raise money, and this money can be used for future building expansion on the company, research, paying off your debt, and other business goals. And this process is known as an initial public offering, also known as an IPO. And this transforms a private company into a public one. And this is when shareholders can invest like me and you, if we wanted to. And for a company like Google, for example, a public offering allows them to raise billions of dollars to fund new ventures. And when you buy shares directly from a company during an IPO, you're participating in the primary market. And after the IPO, shares are bought and sold among investors on exchanges like the New York Stock Exchange or NASDAQ, then that's going to be the secondary market, okay? So when you're buying shares directly from the company from IPO, okay, that's a primary market. And after the IPO shares are bought and sold among the investors, okay, on exchanges like your New York Stock Exchange, that is the secondary market. So let's talk about equities. The broader view is ownership. So the term equities is a broader financial concept, and it encompasses all ownership interests in a business, which includes common stock, preferred stock, and retained earnings. And it represents the value that would be returned to a company's shareholders if all assets were liquidated and all debts were paid off. And on a company's balance sheet, it's often referred to as shareholders' equity or owner's equity. Let's talk about shareholders' equity. This is a fundamental metric used by analysts to assess a company's financial health. Okay. So, and it calculates it by calculating the assets minus the liabilities. Okay, so what assets are things that a company needs. Let's say like the light bill. Okay, a company might need a light bill in order to run a factory, for example. That's assets, something that's needed. And a liability is something that's not needed. Okay, any business expenses that's just going to be extra. Okay, like giving all your employees a vacation or something like that, for example. Okay, and then that's going to equal shareholders' equity. Okay. So, common versus preferred stock. Common stock. This is what most people mean by stock, and it comes with voting rights in corporate matters, but it's secondary to preferred stock in claims on a company's assets during liquidation. When you're a true owner, sharing in both the upsides and the risk. And let's talk about preferred stock. These shares typically do not come with voting rights, but have a higher claim on a company's assets and earnings than a common stock. And holders of preferred stock receive dividends before common shareholders, and this makes them a hybrid security. And it's often seen as less risky than common stock, but without the same growth potential. Okay. So, stock options, my favorite. Okay. One of my favorite things I like to trade, and it's pretty much when you get paid based off of the direction of a stock. Okay. If you think the stock is going to go up, then ideally you would purchase what's called a call contract, which we'll talk about here. Okay. And if you think the stock is going to go in a downwards direction, okay, then you would buy a puts contract. You can also have expiration dates on your contracts too, to choose how long you want to hold the trade for. And when the contract expires, it's going to automatically close on its own. So you either sell the contract before it expires, or it'll go ahead and just close on its own. Okay. So stock option is a contract that gives the holders the right, but not the obligation to buy or sell an underlying stock at a predetermined price. Okay. And that's also going to be known as the strike price. So let's say a stock is at $32 a share currently. Okay. Let's say a stock is at $32 a share. You think it's going to go to $34 a share. Okay. Then you could buy a strike price contract of $34. Okay. Or even $33, since that's above $32. Okay. So you could buy any number above your prediction, but below your take profit. Okay. And that's going to be a good strike price in order to purchase, inshallah. Okay. So when you do that, you're going to go ahead and get paid based off of your prediction. Okay, say for a put example, let's say share price is going to be at 20, for example, right? And you think price is going to go down to 15. Okay, so if price goes down to 15, you could buy a 19, 18, 16, or $15 strike price contract. Okay, because you're going to get paid based off of your prediction. So just focus on what you're doing. All right. Just focus on what you're doing. You're going to get paid based off your prediction. Okay. And it's also going to be within a specified time frame that you purchase. Okay. And the higher the expiration date that you go, the more expensive that it's going to be. And it's a derivative instrument, meaning that its value is derived from the performance of the underlying asset. And they're a popular form of compensation for employees and a powerful tool for investors to leverage their positions. So a call option, it's the right to buy stock at the strike price. Okay. Which is going to be the pretty much price that you're wanting price to go to. And an investor would buy a call option if they believe the stock price is going to rise above the strike price and you're betting on the stock's upward movement. Let's talk about a put option. And it's the right to sell a stock at the strike price, and an investor would buy a put option if they believe the stock's price will fall below the strike price. And this is betting on the stock's downward movement, often used for hedging. Yeah. And also sometimes companies often grant stock options to employees as a form of non-cash compensation. Okay. So incentivizing them to work towards the company's increasing value, because as the company keeps innovating, putting smiles on people's faces, okay, creating more product, generating more revenue, then inshallah the share price is going to increase, making their options worth more. And most of the time, inshallah, they're going to be getting paid on like some long-term cost contracts, I assume. So risk, reward, or purpose. So while all these terms are related to company ownership, they serve different purposes. Okay, so stocks. Okay, stocks are going to be the name. Okay, stocks are going to equal the name. Okay, stocks are the name. So let's say I open Stackmode. Okay, let's say I open Stackmode on the market. Okay, if I put Stackmode network on the market, okay, inshallah will happen one day. If I put Stackmode network on the stock market, that's going to be the name. So if you just hear the term stocks, that's going to be talking about the name. Shares, the term shares is going to be talking about the percentage ownership that you're trying to purchase within the company. So you can own 1 share, okay, or you can own 50 shares. And the share price is going to be determined on the current price. So if the current price of a stock, okay, remember the stock is the name. So if the current price of Stackmode is $32 a share, for example, okay, and I think it's going to go to $600 a share, okay, or $700 a share, okay, then whatever the current price is going to determine what the share cost is. So if price is at $32 a share, 1 share will cost $32. If price is at $700 a share, 1 share will cost $700. Okay. So inshallah, try your best to get in at a dip or a low and then catch the sweep up. And that's how money is made. Okay. That's how growth equity is created, by trading shares. Okay. And stocks and equities. Okay. The primary goal of these are going to be long investment. Okay. There's going to be also a lot of tax benefits when you hold your trades for over a year. And the primary goal is going to be long-term investments when it comes to shares and equities as well too. And the reward comes from dividends as well too, which is going to be quarterly money that's going to be spread out to everyone who has a decent amount of shares. Okay, so you'll get paid by dividends and capital appreciation. And the risk is that the company's value could decline, leading to a loss of your initial investment. But no risk, no reward. We're only here one life. Okay, just trust God, take a risk, keep going. Let's talk about some options. The primary purpose is speculation or compensation, and the reward can be much higher due to the leverage they provide, and it makes you control a large number of shares for a small upfront cost. And this risk is that if the stock price does not move in your direction that you purchase, then the stock price could tank on the contract. Okay, but it's going to be fine. If it expires worthless, you just try again. Don't lose hope. Trust God. Keep going. Okay, and you could potentially lose your entire investment, but you could also play into that. Okay, whatever your stock option cost is, you could use that as your stop loss. So if it costs you $70 to open a contract, that could be your stop loss. Okay, instead of buying a $500 contract trying to play with a $70 stop loss, that might not always work in stock options as cleanly as you might want. Let's explain leverage. And with the call option, you might only pay a few dollars for the right to control 100 shares with leverage and the time expiration. And if the stock price goes up by just $1, you've made a significant percentage gain on your small initial investment, far greater than you would have buying the shares outright. Okay, but it also has time expirations on it. Okay, so this is why the longer the time you're going to buy on a certain play, it's going to be the better. Okay, give your trade time to work out. Okay, but the longer that you go trying to buy out, the more expensive that the contract is going to be. Okay, so for practicality, for example, if an investor wants to build a retirement portfolio, okay, you could buy stocks. Okay, so you'd be buying shares of those stocks for long-term growth, for long-term tax benefits, and just holding trades year after year, keeping money in the stash, keeping stack mode, okay, implemented into your portfolio. Staying down, not touching the bread, okay, staying down. And if a trader is looking to profit from a short-term market movement, then stock options would be able to amplify your return. So you can use the stock options profit to buy some more shares, but stock options in general is just going to be better to go ahead and generate some more income. Okay, so it's going to be time to just start going harder, get more education, and really understand what we're doing before we put money into the market. All right. Market capitalization, valuation, how a company is priced in general. So understanding that a company's market cap, okay, also known as the market capitalization, is pretty much how much a company is worth. And the valuation is crucial for making informed investment decisions. Now, market cap's not going to be everything. You could do your research and catch a good trade at the low, and then the market cap turns huge later. Okay, but market cap is just going to be a good decision to see if something's going to be a strong value play. And market cap is going to be the total value of all the company's shares, and it's a key metric used to determine a company's size. So here's the market cap formula. The calculation is pretty simple, but does a lot. It's quite advanced. So market cap, okay, the calculation concurs of it's the current stock price, okay, so Stackmode is worth $700 a share, okay, then it's worth $700 a share, okay, so you take the current stock price, $700 a share, times the number of total outstanding shares, so whatever that would be, and that's going to give you the market capitalization, okay. So this tells you what the market currently values the entire company, and it changes every minute as the stock price fluctuates. People are always going to be putting in orders, selling and buying, and especially something that has a high market cap, there's always going to be more orders flowing in due to the fact that it's popular. So there's some different market cap categories. Companies are often categorized by the market cap, which influences their risk growth and their potential. Once again, it's not going to be everything, but something to look for. So a mega cap, it's going to be something worth over 200 billion in market cap. So for example, big giants at the time, like Apple, Microsoft, for example, they're generally seen as stable, mature companies. And let's talk about large caps. It's going to be 10 billion to 200 billion. Okay. And they're established leaders in their industries. You got mid caps, 2 billion to 10 billion. That's companies with solid growth prospects. And small caps, 300 million to 200 billion market cap. There could be a bit higher risk if they don't decide to grow and have some future innovation, but with the potential, they have a bunch of high expectations, certain companies, and they could explode super duper hard. Okay, like for example, Palantir, and microcap and nanocap, and below $300 million. And they're the riskiest category once again, because it's fresh, new startups, new ventures. Sometimes it could be people with a bunch of money investing into it, and then it doesn't go anywhere. So make sure it has some future value. So let's talk about valuation versus price. So it's important to distinguish between a company's price and its market cap and its intrinsic valuation. Valuation is a more complex process that attempts to determine a company's true worth based on its assets, earnings, future cash flows, and growth prospects. And a savvy investor is going to be looking for stocks where the price is lower than the company's estimated intrinsic value in the first place. So we'll talk about valuation methods. There are many methods for valuation, including the discounted cash flow, the DCF model, and a company's price to earnings ratio. Comparing that to its others ratios of other companies is going to be a good way to determine if what company is making more money than others. Okay. And these are essential tools for a fundamental analyst if you want to be an investor. So let's say, for example, let's say company A has 10 million shares outstanding. Okay. Let's say Stackmode has 10 million shares outstanding. Okay. And its stock is trading at $50 a share. Okay. And its market cap is going to be $50, okay, because that would be the current price. Okay, you're going to be multiplying the current price times the number of outstanding shares. So let's say Stackmode has 10 million outstanding shares. You're going to multiply that by the amount of outstanding shares. So 10 million. So $50, the current share price times the number of outstanding shares, 10 million. And that's going to equal 500 million. Okay, and that's how the math is done. That's how you find out market cap. Let's say company B, for example, let's say it has 5 million shares outstanding and its stock is trading at $150 a share and its market cap is 750 million. And even though company B's stock price is higher, company A might have a higher intrinsic valuation based on future growth projections and its expectations. So the differences at a glance. So to summarize, it's essential to recognize the distinct roles of each of them. So shares and stocks. Stocks represent actual ownership in a company and they're tangible assets that can be fractional and traded on exchanges. Okay. Any stock exchange is going to be a broker where you can put in your bank account, your card, and buy some stock for yourself. Okay. That's what an exchange is, also known as a broker. So let's talk about equities. Equities are a broad term for the total ownership of a value of a company. It's an accounting term that includes all forms of ownership interest, and equities is the larger category, which includes stocks and stock options. They're a contract and a right to buy and sell shares, not the shares themselves. Okay, and you get paid based off of the direction that you think price is going to go into. And they're a tool for speculation or compensation and are not an ownership stake until they are exercised, until someone's to fill in the contract. So think of the company as a pie, okay, also known as the stock. A fraction of the pie, okay, is going to be known as a share. And let's say you're about to deliver pie. Let's say you project to sell 4 slices of pie. If you think that, you could buy an option based off of that. Okay. So put all of that into retrospective and understand. Okay. So If you think you're about to sell 4 slices of pie, then you buy in options. Okay, but the pie in and itself is going to be the shares. Okay, and the store name, let's say it's Stackmode Pies, is the stock. Okay, so that's how it all works. So by understanding these core concepts, you're just not a spectator anymore. You're getting informed, understanding the market, not a gambler, and you're becoming an active participant with the knowledge to navigate the complex world of finance. Alhamdulillah. So while the terms may seem confusing initially, their distinct definitions and functions are critical to building a robust financial vocabulary. And remember, stocks and shares equal ownership. Okay, they equal ownership. You can hold them for however long that you want. So use that money. Don't go buy clothes, stay down. Don't go buy drip. Don't go buy the best whip right now, paying the high monthly payments. Stay down, invest, and go ball out later. Let your money make infinite money and then go buy what you want. And equities are going to be a broad ownership value. And stock options are going to be the directional bias that you can get paid based off of. You can use all of these to create future value, provide for your family, and provide for yourself. Stay prayed to God. Head over to stackmode.net for all trading education and business education. Love you so much. I'll catch you in the next one.
The real danger in the options trading space isn't the market, it's the people jumping into it with zero understanding. And options can either be one of the smartest tools in your trading toolkit or one of the fastest ways to blow up an account. And the difference comes down to one thing: knowing what game you're actually playing. Most people think that options are some get rich quick button. They might see a clip on TikTok, hear someone brag about a 300% gain, or see something on Twitter, and suddenly they're buying weekly calls or puts like it's a lottery ticket. And that's exactly why they lose. Options aren't risky by nature, but they're risky when you don't respect how they work. Let's go and let's talk about and see if options are too risky. And let's talk about the difference between a gambler and a proper trader, inshallah. All right, let's go and let's talk about the truth. So is options trading truly too risky? This is the prevailing myth in finance, is that options is just strictly gambling. So with options, it's a little bit different. So let's go and let's break it down. So on options, you make money based off of time. So there's going to be 2 directions you can either buy based off of. You're either going to buy calls, which is when you're waiting for price to go in an upwards direction, or you can go ahead and purchase some puts, which is when you're going to be waiting for price to go in a downwards direction. Okay. Now on options, you get paid based off of predictions. So let's say for current example, a share price is at $50, right? So let's say you opened a stock and it's at $50 right now. If you think it's going to go up to, let's say, $55, okay, then you would go ahead and purchase a calls contract since you think price is going to go in an upwards direction. Let's say the share price is $50 and you think price is going to go down to $40. In that instance, you would go ahead and play a puts contract since you think price is going to be going in a downwards direction. Okay, so speculation is what they're mainly going to be used for. When speculation means that you're getting paid based off of directional bias. Okay, also hedging too. So since options contracts aren't pure ownership, you're getting paid based off time, and if your time prediction is right within a certain time period, then you'll get paid depending based off of that. So on options, you want to a lot of the times too have some time on your contracts. Once again, that's going to be one of the most important things that separates it from gambling versus actual trading. Okay, so your time matters a lot. There's going to be things called Greeks. You're going to have your delta, gamma, theta, and those determine how your profit moves. Okay, the more time that you have on your options contract, the more it's going to kind of pseudo play as a actual real investment. Okay, but if you have your options contract expiring tomorrow, the chances of a certain number hitting could be very, very skeptical. But if you have your options contract expiring in a couple of years, the chances of it hitting could be very, very likely. So it can be gambling if you make it, but it can also be a really, really good way to keep your money, let your money flow within the market and dominate the instrument by just taking advantage of the time on your contracts. So let's talk about if there are insurance policies on your portfolio, and let's go ahead and explore the mechanics of risk versus reward on options. Also, one thing on options too, options you can make infinite profit. Okay, so your profit that you can make is infinite, but your risk is going to be set. So if you pay $200 for an options contract, the max you could lose is going to be $200. Okay, but the max you could win is going to be infinite. Okay, so that's the big advantage of options too. So let's go. So just like we talked about in the last slide, what is an option in the first place? An option is a contract, not an asset itself. It derives its value from an underlying asset, stock, ETF, or index. So a call option, right? It gives you the right, but not the obligation, to buy shares at a specific price by a specific date. Okay. So if you think price is going to go in an upwards direction, then you're going to go ahead and purchase a call options contract. Okay. Calls, think of picking up the phone. What do you do when you pick up the phone? Okay. You call. Okay. And then we're going to have the puts to the right. Think of putting the phone down. Okay. So call, pick the phone up, puts, put the phone down. Okay. So puts give you the right, but not the obligation to sell shares at a specific price by a specific date. So calls is if you're betting on the price going in an upwards direction, and puts is going to be if you think price is going to go within a downwards direction. Okay. The United States stock market, though, is made to go up year after year after year after year. There's also laws in place such as the short sale restriction law, which kind of prevents and helps things from crashing down to zero very, very quickly. So a lot of the times on options, you might be better off playing calls, since it's going to go ahead and be on the actual investor side as well too. And the double-edged sword, let's go and talk about leverage. So options provide leverage, and one standard contract controls 100 shares of stock. And this is where the risk and reward are amplified. So scenario, right? Let's say stock XYZ is at $100. So the stock investor, let's say they buy 100 shares, right? So if the stock price is at $100, in order to buy 100 shares, that would cost $10,000. Okay. And an options trader, let's say they buy one call contract, okay, with the $5 premium. So let's talk about the decimal numbers on options too. So if you ever see an options contract, let's say 2.50, you always want to multiply every options contract by 100 to get the real dollar value. Okay, so 2.50 times 100 is going to go ahead and be 250. If an options contract is 14.20, okay, we're going to multiply that by 100. That's going to equal 1420. Okay, just make it super easy. Okay, whatever you guys see, you multiply that by 100. So let's say the stock price is, or let's say the options contract is 5.70. Okay, then multiply that by 100. It's going to go ahead and be 570. And that's how you're going to go ahead and get the share price for that. Okay, so if the stock goes to $110 and you have a calls contract, then that would be a 200% return. Okay. But if you have it on shares, then that would be a 10% return. Okay. Let's just say that, for example. So if the stock stays at $100, the stock investor loses nothing. And the options trader would lose 100% of their $500 because the contract expires worthless. Okay. So if your contract doesn't move the amount of ticks that you think it's going to move within that time period, then the options contract could very, very easily expire worthless, and you would see it at a negative 100%. But when you're buying things like shares, you're actually having the actual investment and you have the ownership power within your account forever until you decide to close. And why is it risky in the first place? So options aren't inherently risky. So gambling behavior is risky, and most retail traders fail due to two specific factors, right? Let's talk about time decay, data. So options have an expiration date. Every day that passes, the contract loses value if the stock doesn't move, and stock owners can wait forever. Option owners are also fighting the clock. So a good way to counter this, though, if you do want to play some options or you see some good plays, try and play what's called leaps if possible. Okay, leaps are going to be contracts that you're holding for like 1 to 2 years out. Okay, try to stay away from like 0 DTEs and things like that, and use your options as a seed to plant for the future. Okay, if you're buying contracts like 1 to 2 years out, and let's say the share price is at $50, right? Once again, so if share price is at $50 and your take profit, you think it's going to go up to $60, okay? The best contract to buy would be a $51 call. Okay, and you might ask me, Chris, why would we not buy the $60 call if that's our take profit? Because on options, once again, you get paid based off of prediction, and there's going to be bonus points on option. So if the share price is at 50 and you buy a $51 call, but your take profit's at 60, that's going to be a lot of bonus points versus just buying the take profit 60 contract, because then your contract wouldn't really start juicing and making good money until it gets hit. So if you buy a number before your take profit, you're going to get a bunch of extra bonus points, and it's going to hit really, really hard. Now let's talk about buying out the money, right? Try not to do that. Try not to buy cheap contracts. Also, don't forget that it's called trading. When you're winning, somebody else is losing. When you're losing, somebody else is winning. So beginners buy cheap, unrealistic contracts hoping for a lottery win, and these have a low probability of profit. And consistent losses of small amounts add up to account blowups for sure. So don't just buy any random contract thinking it's going to hit. try and buy 1 to 2 years out, and whatever the current price is, try and buy one above if you're going to purchase a call. Okay, so if the share price is at $50, try and buy a $51 call contract. Okay, if the share price is at $50, you think price is going to go down, try and buy a $49 put contract. Okay, play it like that, buy 1 to 2 years out. The chances of you losing is going to be really, really low. And using options for safety. So professional traders use options to reduce risk, not just to speculate. So the cover call income. So let's say you own 100 shares, right? You sell a call option against them and you collect the cash premium instantly. This lowers your break-even price on the stock, and this is safer than just owning the stock. Okay, so whenever you have enough shares of a certain stock, you're going to be able to actually sell the options contracts. Okay, and then you're going to have protective puts as insurance. Let's say you own 100 shares and you're worried about a crash, then you would buy a put option. If the stock crashes to zero, which most of the time, if it's a half decent investment, it won't, then you have the right to sell it at the strike price, and you've capped your maximum loss, protecting you on really both sides and just giving you a lot more leverage on your account to manage and maneuver your money exactly how you just want. So covered calls and selling options is something you can also look into. Going to be dropping a video on that very, very soon as well, inshallah. But before that, let's talk about it. So let's talk about selling versus buying the premium. So the house usually wins in options, and the house is going to be the options contract seller. So the options contract seller is pretty much wanting you to do some insane decision. Okay, they want you to make the most dumb decision of all time, and then they're going to get paid off of it. So that's not what you want. You don't want to get taken advantage of, so you need to outplay them. Okay, so the statistical edge. So approximately 70 to 80% of options expire worthless. Therefore, buyers have unlimited profit potential, but a low probability of success. But if you want to see a lot more successful wins within your options trading portfolio, I recommend you guys focus on contracts 1 to 2 years out. And once again, wherever the current strike price is, buy one above or below that number in order to have that consistent value. Okay, that way you're pretty much gonna trick it into almost a shares type of play. Okay, but you're getting the options profit. Okay, focus on time and stay near the current price. And sellers have capped profit potential, but have a high probability of success. Okay, due to the fact that they know people are going to make some uneducated, silly decisions and destroy their account. So don't let it happen to you, inshallah. So conclusion. So risky trading usually involves buying short-term options, right? Like 0 DTEs, weeklies, etc. And conservative trading involves selling options or using spreads or buying contracts within 1 to 2 years out to define your risk in every single scenario. Really just protect your money, okay? You're not on this earth working hard for no reason. Don't go burn your money down to the ground making dumb decisions, okay? You got it. So if you're not focused on your take profit, options can definitely be a problem. If you get reversed on certain areas, the Greeks are going to really hit you extremely hard. And it's things that's happened to me. There's been times where I've been up at almost $1,000 in a day, come back later on due to the fact that I was playing 0 DTEs, come back to negatives, okay? So it's not things like that I want you guys to go through. It's extremely toll taxing on your mental when you guys are trading, and it can bring a lot of anxiety on your next trade, and I don't want you guys to go through that. So understand that they're going to be too risky if they're going to be treated like lottery tickets. So if you're buying weekly out the money calls, 0 DTE without risk management, expect those results. But they're not too risky if they're used for hedging, income generation, or if you're buying leaps, which are going to be contracts that are 1 to 2 years out. Okay, so the danger really lies in the trader, not the trade. Okay, so control your flesh, be disciplined, don't make dumb decisions, stay prayed up to God, keep grinding, protect and provide for your family, and we'll catch you on the next one. So why do crypto tokens burn in the first place? And what happens when tokens disappear? Let's jump into it, class. So the technical mechanism, how tokens are permanently removed. A token burn is not a literal incineration like fire, but it's a cryptographic action that permanently removes a specified quantity of tokens from a circulating supply. This process is irreversible and transparently verifiable on the blockchain ledger. So you can see if it was actually completed and if the token was actually burned and removed. And the black hole address, the burn address. Tokens are sent to a specifically designated verifiable address for which no private keys exist. This is often a publicly known and accessible address like 0 times 000.0000 DEAD. It's an irreversible transaction. Once the transaction is confirmed and the address has been, or token has been deleted, all right? Once the transaction is confirmed, the tokens are then locked forever.
Because no one can access the private key associated with the burn address. The tokens can never be spent, moved, or recovered. And transparent and verification. The entire process is recorded on the public ledger, and anyone can verify the burn by checking the transaction ID and confirming the tokens were sent to the known burn address. This trustless verification is fundamental to the burn's legitimacy. So, some economic drivers. Let's talk about deflation and scarcity. The primary motivation behind most token burns is to introduce deflationary pressure by reducing the total or circulating supply. The burn aims to increase the scarcity of the remaining tokens, theoretically increasing their value based on basic supply and demand principles. And we'll talk about reducing circulating supply. Burns directly decrease the quantity of tokens available for trading on exchanges and held by users, which can lead to upward price pressure if the demand remains constant or increases in a certain direction. And countering inflation. Many proof of stake or yield generating protocols, and proof of stake is going to be the opposite system of proof of work, where you're exchanging power to create cryptocurrencies. Proof of staking, like Ethereum, uses smart contracts and a whole different system in order to create the cryptocurrency. And they have naturally inflationary token insurance schedule. Okay, so it's for minting new tokens. So many proof of stake or yield generating protocols has a naturally inflationary token issuance schedule, minting new tokens. And regular burns can offset this inflation, aiming for a net zero or even negative deflationary supply growth. So let's talk about some psychological impacts of it. Hype, for example. The announcements of a large token burn often generates positive market sentiments and media coverage, serving as a powerful marketing tool to signal commitment to long-term value. So if a token has a fixed maximum supply of 1 billion and 100 million are burned, the new effective maximum supply will be 900 million. And for every holder, their proportional ownership of the network has slightly increased relative to the total supply. So diverse implementation models. Examples of token burns. Token burns are implemented in various ways, often defined within the core smart contract code or through a governance mechanism. And understanding the type of burn is crucial to assessing its long-term impact on the network tokenomics. So the fee burns. A portion of the transaction fees, also known as gas. So if you ever heard the term gas, that's going to talk about transaction fees or platform fees, are automatically routed to a burn address. So for example, Ethereum EIP 1559. And that model burns a base fee on every transaction, making the network deflationary during high demand periods. So buyback and burn. The project uses profits, example, from an exchange or platform revenue, to buy its own token from the open market and immediately burn them. This creates both buying pressure and permanent scarcity. For example, that's how BNB does. So, scheduled and manual burns. Pre-announced or governance voted burns, often related to the initial token supply. For example, burning unallocated team or treasury tokens. These are usually large one-time events. For example, initial coin offerings, the opposite of IPOs, initial public offerings. For cryptocurrency, ICOs, they have post-sale burns. And the impact and critical analysis. Let's talk about benefits and concerns. While token burns are widely adopted, they are not a guaranteed solution for increasing token value and come with important caveats that investors and users must understand. And a key benefit, they have an incentive alignment. By making tokens scarcer, it encourages long-term holding and participation. And security. In some proof of burn mechanisms, burning tokens is necessary to validate blocks, contributing to network security. And certain perceived value. It solidifies the idea of the token as valuable, diminishing assets rather than an infinite resource. And criticisms and concerns. Let's talk about price manipulation. Large sudden burns can be used to engineer short-term pumps, potentially leading to instability. And sustainability. If a protocol burns too much too fast, it may not have enough tokens left for future development, funding, or ecosystem grants. And governance risk. Manual burns controlled by a centralized entity introduce risk, contradicting the decentralized ethos. So the whole point of it is to be decentralized, but if they're able to burn tokens, which can be controlled by someone with a lot of money, that can kind of make it centralized, but not everything's perfect in the world, only God is perfect. So, but tries to make it as fair as possible within the decentralized finance space. We do the best we can. So, token burning. It's a sophisticated economic tool that has become a staple in modern decentralized finance and crypto tokenomics. So it's irreversible. Okay. So irreversible, that means that once it's done, it cannot be done back again. Okay? So talk to me, guys. So if it's decentralized, right, and the whole point of the cryptocurrency space is to be sending transaction from one person to another. But if a large company with a large amount of money can come in, like a whale, for example, that's what a whale is. Okay, a whale is going to be someone who has a large amount of currency. If they can come in and spend a lot of money, right, and control a transaction or burn a token, right, to increase the scarcity. So let's say they burn a token, right, and then they're holding it, right, and scarcity equals demand. Okay. So if you guys ever heard of the term supply and demand, supply means when there's too much of something. Okay, when there's too much of something, there's supply, it's available. But when it's in demand, people are trying to buy that today. And the goal of token burning is to reduce the supply, introducing scarcity, putting demand into it, but it's also going to be used to burn things like certain fees, which can help manage inflation a lot. All right. So just think about it. All right. Is it something that's going to be beneficial to you long-term wise? And think the success of a burn really depends on sustained demand and the overall health of the underlying project. So it's not always going to be a positive thing. It's not always going to be a negative thing. It can really help people, with certain fees and stuff like that, but it can also introduce scarcity in certain coins, causing it to just go up way quicker than it may, right? And if anyone's in a short position of that could hurt them. So it could really just see what happens in the future with it. All right, token burning, it's something that's there. It's going to keep happening. And whether it's good or not, let me know in the comments. Catch you guys in the next one. Stay prayed to God. Keep grinding. Catch you guys in the next one. Peace.
Trading can be difficult sometimes, but through prayer, discipline, and being consistent, you won't have any days of you just sitting at your screen wondering how everything slipped out of your control. Emotional trading days feel heavy, but they don't have to follow you into tomorrow. The truth is, recovering starts with separating the market from your identity. One bad day does not make you a bad trader. Sometimes it's just the wrong mindset meeting the wrong moment. So let yourself step back and give your mind space to cool down, because the clarity never shows up when your emotions are running the show. Once the noise fades and once things shift, the mistakes you made earlier stop feeling like failures and start looking like signals. Little messages from the market about what needs to change, and that shift alone is powerful. It turns frustration into fuel, because the real comeback doesn't happen on the charts. It happens in your head. When you decide that today's chaos isn't your story, it's just a chapter, when you choose to reset instead of spiral, when you remind yourself that disciplined trading is built on composure, not emotion, then that's when you'll start seeing the profits flow in. Let's go and let's jump in how we can control ourselves and become a more disciplined trader, inshallah. So, trading discipline, it's going to be the factor that determines if you're going to be profitable or not. Okay, if you're not going to stick to your trading plan, if you're not going to stick to your risk parameters, okay, and if you're going to lead with your flesh, you're going to continue to get those results over and over and over again. Okay, so being spiritually grounded is going to be extremely important. In Quran, okay, it states, and those who, when they spend, do not excessively or sparingly, but are ever between that, justly moderate. Okay, so that means that you want to be spending your money not in an excessive manner, even when you start making 10, 20, 30K a month from trading. Okay, you don't want to excessively be blowing through your money. Okay, take your time and having that grounded mindset, trade after trade after trade mindset, stacking it up over time. Okay, no matter how much money you make from the markets, you're going to stay patient. Okay, you're going to still stick to your risk parameters. I don't care if you start making 50K a trade. Okay, you still wake up, pray, stay disciplined, and keep taking the same type of setups, because exactly what got you there is what's going to keep you there. So don't lose that consistency. Don't lose that discipline that's been built into you just because you start touching the money and the numbers that you finally want to get. Okay, do not start spending excessively, and do not start making excessive decisions once you start getting to a certain point. Okay, that doesn't mean once you start getting a 90% win rate, okay, to just start putting on 5 trades a day just because you have so much conviction, okay, based off of past results. It's about being consistent today and every single day. Okay. And finding peace through God, balance, and moderation. So let's go to the next slide. So you got to recognize the tilt. Okay. Check yourself emotionally. Okay. You know when you're about to get upset. You know when you have a feeling of wanting to trade over and over and over again. Okay. You know when you're having feelings of wanting to crash out. Okay. So keep heed of your emotional red flags. Okay. Before you can fix it, you got to admit to yourself, okay, that things got to change, that you're broken right now. So an emotional trading day usually involves revenge trading. Okay. So if you take a loss for $200, okay, say that was in between your 1 to 10% of your account risk parameters, right? That's fine. But then you take another trade. Okay. So instead of just using $200, you now lose $400. Okay. And then say you try to put on some size, trying to make back that $400. Okay. And then you end up losing $800. Okay. And that's how the cycle starts. And that's how quickly you can blow up your account. So don't revenge trade. Okay. If you take a loss, close your trade and that's it. Okay. Plot out another trade, a cleaner setup, and stick between your 1 to 10% of your account rules per trade. Okay. Because trying to make it back will end up turning your account into a whole different spiral in a different direction than you would expect it to go a lot quicker. Okay. Because if you lose, you might lose again. If you lose again, you might try and risk more than normal trying to make back the double losses. Okay. So I'm telling you, if you don't recognize the tilt, you could lead into a whole different spiral and mental mind space than you'd want to be in the first place. And paralysis. Okay. So staring at the screen, making you unable to execute a good setup. This is why it's really important to have your stop loss set up as well as your take profit too, with limit orders, especially if you're trading futures or Forex. Okay, this way you guys aren't going to have any emotional paralysis. Say something just clips way past your mental stop loss, you're not going to freeze, okay, because you don't want to lose all that money and close out your trade, even though you know you should, okay. And increased size, once again, increased size usually comes into play when revenge trading comes into play, okay, but for the most part, you shouldn't just be increasing your size out of the whim. Stick between 1 to 10% of your account per trade. Okay. So don't double down on risky trades out of anger or out of past losses. Okay. And check yourself. Okay. So ask yourself, are you feeling anxiety? Is your heart racing? Okay. Are you cursing at the monitor? Are you breaking things? Okay. If so, you got to stop immediately. Okay. You got to stop right then and there. Okay. Get up, go pray, take a breather, hop off the charts, immediately check yourself right then and there. Okay, it's not worth destroying your family's future, destroying your seeds that you have planted in the ground because of a quick moment of disparity and anger. It's not worth it. Okay, keep your account alive. In this game, it's not really about making money. It's about who can be consistent, who cannot be led by their flesh, and who can be disciplined every single day. Okay, so let's head over to the next slide, class. So the pattern interrupt. Okay, walk away physically. Okay, if you notice yourself, especially if you're on prop firm or trading something quick like futures or Forex, where you can instantaneously lose money fairly quickly, okay, you got to get off the charts. Okay, hop off the charts. If you notice you have a trading addiction, you got to pray to God, okay, and really ask to get better. Okay, ask yourself, why are you taking so many trades too? Are you chasing money? Do you have bills that you're trying to pay? Do you have some debt that you're trying to clear? Okay, because you can't trade out of desperation. Okay, trading is not something that you look to when you're dead broke trying to make it out. Okay, you got to get your life together first, get some income, then come on to the charts. Okay, get closer to God, build that relationship with yourself and know yourself intimately and deeply. This way you can check yourself and check any type of emotional parameters or boxes whenever you feel like you're about to crash out or having a rough trading period. Okay, you can't solve a trading problem with more trading. Okay, you need to sever the connection between your brain and the charts. Okay, so once again, you cannot solve a trading problem with more trading. You have to sever the connection between your brain and the charts. Okay, so close the terminal. Okay, if you notice yourself crashing out, taking multiple trades during a day, okay, you got to close TradingView. You got to close your broker and you got to just hop off. Okay, or sign out of your brokerage account and log into paper trading. Okay. And change your environment. Okay, leave the room, go outside, take a breather, and the change in lighting will really help reset your circadian rhythm. So when you come back on the charts, you're going to be like, you know what, I was tripping. Why was I crashing out and doing all that? Okay, and don't check quotes on your phone. Okay, whenever you enter in a trade, stop staring at it tick by tick. Okay, enter your trade, have your alert set at your stop loss and take profit, or set your limit orders. Okay, and don't look at it. Don't
look at it. Okay, because I'm telling you, you might look at it, make a decision that will ruin your trade, okay, and then end up taking another trade, and that could start a whole downward spiral that you don't want. Okay, so understand that trading is pretty passive and hands off. Okay, after you've aggressively studied and gained the knowledge, once you actually hop on the charts, it's going to be pretty passive. Okay, so let's head over to the next slide, class. So you got to reset your biology completely and get out of survival mode. Okay, give yourself a cold reset. So your nervous system is in fight or flight mode, especially when you enter a trade for the first couple of times. Okay, and you got to force it back to rest and digest. Okay, so some actionable tactics. Number one, praying to God. Go to God about all your issues. It's really going to help and really going to build accountability within yourself too. Okay, you can't just be blaming the markets like, oh, market's doing this, market's manipulated, market's not manipulated. Okay, it's been going in an upwards direction, especially United States stock market, year after year after year after year after year. It's not manipulated. You have to check yourself and hold yourself accountable. Okay, if you're making monkey decisions, don't make monkey decisions anymore. Okay, check yourself. There's plenty of times where I've made monkey decisions. Okay, plenty of times where I blew an account within a couple of minutes. Okay, due to the fact that I was chasing that quick money. Okay, so checking yourself and staying in tune with yourself, even when you fail, is going to be an important part of being a CEO and being a boss. When you're a trader, you're not just on here trying to get some money. Okay, you're signing up to be a business person. Okay, you're signing up to be your own boss. You're in control of your finances whenever you come onto these charts. You're in control of when you get in, when you get out, and how much you're going to risk. Okay, so don't run around blaming the market when you got to take accountability for the actions that you did. Okay, so breathe. Okay, breathing is also going to be a really good tactic too, something I've been working on myself. Okay, so breathing is really going to help you out. Okay, if you notice you're about to crash out, close your eyes, take a big breath. Okay, and working out in the morning too. If you notice that feeling of high anxiety or intensity in the morning, make sure you guys start your day with a prayer. Okay, and then go work out. Okay, when you guys work out, your body's going to release a lot of cortisol. Okay, and it's going to be in more of that healing and building mode instead of fight or flight mode. Okay, so your journal. Okay, make sure you guys have a trading journal. I don't care if you do it on Notion, Discord, a physical trading journal, whatever. Okay, just get it out. Write out your emotions. Okay, write out your goals. Write out how you're feeling. Okay, and emotions loop in your head until you write them down. Okay, once they're on paper, your brain is going to feel safe. Okay, to let it go. Okay, so if you notice yourself, you're struggling with over trading, like, man, I keep taking 4 trades a day, I can't accept a loss. Write down why. Write down what you're trying to chase. Why do you want the money that bad? Okay, and break it down logically, and it's really going to help you be more intimate with yourself. Okay, and write answers to these 3 questions. Okay, what specific rule did you break? If you notice yourself losing consistently based off of just emotional decisions, okay, ask yourself how you're feeling before you enter the trade. Okay, and ask yourself, what's the worst case scenario? If stop loss gets hit, okay, because if I'm hitting my 1-to-4 risk to reward ratio trades, let's say I'm risking $100, okay, if I'm making $400 per trade, okay, then I'm still going to be profiting $300, okay, which is going to give me more extra room in case I ever have a losing streak. Okay, so the worst case scenario is that you hit stop loss, but the thing about it is that if you stick to your rules, okay, you stick to your discipline, you stick to the plan that you wrote down. If you stick to your stop loss, how are you going to be unprofitable? If you have a decent win rate, you're sticking to your risk reward ratio, okay, and you're staying in between your risk management parameters, trading between 1 to 10% of your account per trade, how could you lose? The math is right there for you, okay? The only way you lose in this world is when you lead with your flesh, okay? It's the only way you will ever lose. If you are disciplined and consistent, it's almost impossible to lose. Let's head over to the next slide. So, radical acceptance. Okay, forgive yourself. Okay, beating yourself up creates more emotional pain, which leads to more bad trading tomorrow. Okay, and sunk cost. The money is gone. Okay, once it's gone, don't try and chase it back. Don't try and boot up your account again and be like, oh, I'm about to recover all this. No, don't do that. Okay, you cannot trade to get that money back. Once it's gone, it's gone. Once something is gone in the world, it's gone, okay? But that's perfectly fine, okay? Because you can only trade new setups. There's going to be better setups, okay? And view every single loss in life, in business, wherever, okay? Just view it as a lesson. View it as tuition, okay?
Some of you might be in college, okay, paying for your tuition. Treat every single loss in life, I don't care if it's on the charts, okay, business, relationships, whatever it is, if you need to view it as a lesson to learn and progress and go forward, okay? And you're not your profit and loss, okay? You're your risk manager. You're still going to be the same person if you're making $50 a trade or $50 million a trade, okay? You're still going to be the same person, okay? Your spirit is still going to be the same. So the money is not the thing that changes you, okay? The thing that changes you is the knowledge, okay? And you learn how to keep your spirit happy, how to not go through pain, okay? And that's what we're here to do on this earth, okay? Pray to God and find out ways to keep our spirit happy and avoid pain, okay? If you notice yourself crying at the end of the night because you crashed out your account and you got bills due the next day, okay? You need to learn from that pain so it doesn't happen again, so you don't grieve your spirit, okay? So if you're frustrated due to your own actions, stop doing it, okay? Pray to God on it, check yourself, and come back stronger and better. Don't let it happen again. Let's head over to the next slide. The return protocol, okay? Start small, okay? Don't jump back in with full size, okay? If you got to scale down, take a step back, okay? Because it's not about the money. It's not about the money, okay? If you notice yourself crashing out, if you're trading with $200 a trade risk, okay, and you're crashing out with that, lower it. Maybe you should be risking $50, $100, okay? Lower your size, especially when your confidence is damaged, okay? So for the next 3 days, okay, try to trade with 50% size or less, okay? If you just had a horrible streak of losing, crashing out, being led by your flesh and emotional decisions that led you to straight destruction, okay, take a step back, okay? It's all good. You can always come back stronger. So try it for the next 3 days. Try and trade with 50% size or less, okay? And prove to yourself that you can follow the rules before you're allowed to go back to risking your full normal size amount of capital, okay? Because before you can even start touching the money, you gotta have the discipline built in you, okay? You're not gonna touch a thing, or you're not gonna be able to keep a thing if the discipline isn't built in you. It won't matter. I'm telling you, it won't matter. So if you're making $1,000 a trade, you should still be happy if you're making $100 a trade, okay? Just the fact that we can come onto these charts, look at candlesticks going up or down, and clicking buy or sell, and being able to make money is a blessing. So why are you ruining it for yourself? Okay, please don't make it hard. It's welfare, okay? It's welfare here. And all you have to do in order to get it, you don't got to go sign up on no website. All you have to do is be disciplined, okay? Be disciplined. And praying to God is going to be the #1 way on this planet to build discipline. Then from there, you guys can start working out. Then from there, start grinding every single day. Then from there, you're going to get very strict on your setups. When you're praying to God every single day, you have a strict health diet regimen, okay, and you're sticking to your trading plan, trading is not going to be difficult for you. I'm telling you, it's going to be very, very, very simple, okay? But most people who struggle with this, and it just shows you how undisciplined 99+% of the world is, okay? The main reason why 95% of people plus aren't profitable is because most people on this planet lead with their flesh. Everyone always wants to feel good all the time. Everyone always wants to be comfortable all the time. Everyone always wants to be happy all the time. And that's not realistic, okay? You have to be disciplined, consistent, and you have to have that iron edge regardless of what's happening in life, okay? If you want to live in a fake realm, okay, being led by your flesh, that's fine. You'll continue to get those results, okay? But if you want to be the 1% in the world who's ready to reap the harvest, okay, who's ready to get the resources, who can help everyone else out, okay, you got to put yourself through the fire, okay? And you got to come out not tripping. Okay, let's head over to the next slide. So tomorrow is a new market. Stop tripping about the past. Okay, that little bread that you messed up, forget it. That account that you blew up, forget it. Okay, whatever happened back then, it happened back then. That was a weak version of you, and it's time for that version to die. Put it away. Okay, come stronger. Build yourself a whole new version and come way better. Think different. Okay, so wake up, pray to God, and work out. When you guys are working out consistently, it helps your cortisol run through your body a lot less intensely, so you're not going to have random crash out spurts. Okay, working out is really, really going to help you. Okay, and walk away from the computer too. If you notice yourself pansying on the market, spamming buy or sell because of a loss, relax. Walk away, go pray on it, check yourself, You probably did some emotional stuff that's your fault, and cool down physically. Okay, then go journal the mistake. Okay, throw it in your Discord, your Notion, your trading journal in real life, notes on your iPhone, whatever. Okay, you gotta release the loop. You cannot do the same things in life and expect different results. Okay, so if you're doing something in life and it's working, okay, you notice you're waking up, you're praying to God, you're grinding, and you're getting somewhere, continue to do that. Okay, but if you throw off the loop, if you notice yourself throwing in random days of doubling your leverage, okay, then your risk to reward and your consistency is not going to be able to be built like that. You can't be risking $100 one day and then 2 days later you're risking $400. It's not how you're going to build yourself. Okay, and then when you return to the market after a crash out series, start smaller. Okay, start smaller, because you're not even ready for the money right now. So if you're blowing up your account, you're not even ready for the money. Some of you guys are thinking about the money, but you're not even ready for the money. Too many of you forget about the grind. If you have a skill, a talent, and discipline in this world and you pray to God, you'll get to some money. But some of you forget about praying to God. You forget about the grind. You forget about the hours of studying that it takes to be successful in whatever you want to be in. Okay, I don't care if you want to be an athlete, if you want to be a CEO of a business, okay, whatever you want to do in this world. If you forget about the grind, and most importantly, if you forget about God, you're not going to be able to be successful. That emotional turmoil might catch you, and that one bad day could destroy you. But understand that one bad day does not define who you are in your career. Okay. Stay hard, stay disciplined, stay focused on God, and keep grinding. Don't ever give up. I'll catch you on the next one. Peace.
So what's the difference between major, minor, and exotic Forex pairs? Let's go on the jump into a class. So an introduction to the Forex market. So the foreign exchange, also known as the Forex market, is the largest financial market in the world, with the daily trading volume exceeding 7.5 trillion as of 2022. So this is a pretty recent study. It operates 24 hours a day, 5 days a week across major financial centers like London, New York, Tokyo, and Sydney. And it's a decentralized market where currencies are traded over the counter. And it involves speculation on currency, and speculation is going to pretty much mean to where traders can get paid based off of directional bias on currency value fluctuations driven by economic, political, and geopolitical events. And participants include banks, corporations, governments, hedge funds, and retail traders, which are just single individuals. So let's go on and jump into the classifications of the currency pairs, their characteristics, and how they impact the trading strategies. Let's go. So what are currency pairs? In Forex trading, currencies are always traded in pairs because you're essentially buying one currency while selling another. The first currency is the base. So let's say, for example, USD, okay? And the second one is the quote currency. So the first one here is going to go ahead and be the base. So USD before the slash is going to be the base currency. And the second one, okay, is going to be the quote currency. So let's say Euro. Okay, so let's say you were trading USD Euro. The first term, USD, is going to be your base. And then the second one is going to be your quote. So an example, for example, here in Euro USD, then Euro will be the base and USD would be the quote. And if the pair is at 1.10, it means 1 euro buys 1.10 US dollars. And currency pairs reflect the relative value and are influenced by interest rates, inflation, and economic data releases like GDP and employment reports. And understanding pairs is crucial for risk management and profit potential in trading. So for example, if you believe that the euro will strengthen against the US dollar, you go long on Euro USD. Conversely, if you think it'll weaken, then you'll go short, okay? And long means price is gonna go in an upwards direction that you speculate, and going short means that you think price is gonna go in a downwards direction. So some categories of the currency pairs. Forex pairs are categorized into 3 main types, okay? Based on liquidity, trading volume, and the economics involved. Majors, minors, and exotics. So majors, they're mostly traded and involve the USD and major economies. And minors, they cross pairs without USD and still for major economies. And exotics, involve emerging or smaller economies. And these categories help traders choose pairs based on their risk tolerance and strategy. So major pairs, here's the definition. Major currency pairs are the most liquid and widely traded in the forex market. They always include the US dollar paired with another currency from a major global economy, and majors account for about 85% of the daily forex volume. And the US dollar dominance due to the US economy size and the dollar's role as the world's reserve currency. And high trading volume leads to tighter spreads, okay, which means you're going to be hit with less fees whenever you do close or sell off your trades, and better execution, which means you're going to go ahead and get filled. So when you click buy, you're going to go ahead and be entered in the trade, or sell, you're going to go ahead and be exited out the trade. And major pairs are traded heavily during the overlapping sessions like London session or New York session. And New York session is from like 9:30 a.m. to 4 p.m. Eastern time, okay? And in between that, London session overlaps. So London session ends at 11 a.m. But due to the fact that New York session opens at 9:30 a.m., there's going to be time where New York session and London session are going to go ahead and overlap. And major pairs are going to be ideal for beginners due to their predictability and abundant market analysis available with so much data. And we know this is a left to right chart. That's just how it works. So examples of major pairs. Here are the 7 most common major pairs. Euro USD. So Euro/US dollar is the most traded pair globally, has the most volume, has the most money running through it, and has the most people trading it. So USD JPY stands for US dollar and Japanese yen, and is known for carry trades. GBP/USD, as that's for British pound. So GBP stands for British pound, okay? /US dollar is volatile due to UK politics. So the United Kingdom politics really affect the pair GBP/USD. And USD/CHF, okay, US dollar/Swiss franc, it's a safe haven pair. And Australian dollar/US dollar, okay, it's commodity driven. And USD/CAD, US dollar/Canadian dollar, it's oil influenced, okay. And New Zealand dollar/US dollar, it's very agricultural focused. And detailed example, so Euro USD, it's influenced by ECB and Fed policies. And for instance, if the Fed raises rates, USD strengthens, pushing Euro USD downwards. So some characteristics of major pairs. Majors exhibit specific traits that make them attractive. Okay, so high liquidity. Major pairs is really going to be a spot where trades are going to be able to take place quickly. So if you click buy, you click sell. Since there's so much liquidity, aka people trading or money being flowed into it, when you click these buttons, you should be filled pretty quickly. Okay, so high liquidity. They're easy to enter and exit positions without price slippage. Okay, and more stable. Okay, but can spike on news like non-farm payrolls. And tight spreads, often around 0.5 to 2 pips, reducing the trading cost. And there's going to be abundant information on major pairs, extensive coverage, a lot of government information, economic information, etc., affecting the price. And there's going to be extensive coverage from sources like Bloomberg and Reuters, for example, and different correlations. They often move in tandem with the stock markets or bonds. And these characteristics allow for scalping, day trading, or long-term position holding. And advantages of trading the major pairs. The pros include some lower risk due to the stability and liquidity. They can be cost-effective, they have minimal spreads and commissions. Diverse strategies are going to be able to play it within them. They're suitable for technical and fundamental analysis, so when you put news and charts together and your TA together, technical analysis, then it could be a really good way to make some money, inshallah. But not without risk, be careful. And global impact, you can react to worldwide events providing opportunities. So for example, during the COVID-19 pandemic, majors like USD JPY saw safe haven flows, creating a predictable trend. And so disadvantages of trading major pairs. So some cons to consider. Lower profit potential, less volatility means smaller price swings, and high competition. Crowded trades can lead to reversals, and new sensitivity and sudden announcements can cause whipsaws. For example, in 2016, Brexit, okay, which was something that involved the European Union, it caused GBP, okay, which is the British pound, US dollar/US dollar, to drop 10% in one day, catching many traders off guard. So even if you were in a good position, due to the fact that you're trading something that's based off of economic news, can still be subject to certain drops or certain uprises. So be careful. Make sure you have your stop loss set, and make sure you're trading within your risk parameters. Trade within 1 to 10% of your account. So the definition of minor pairs are going to be known as cross pairs, and they consist of two major currencies, but exclude the US dollar. They represent about 10 to 15% of the Forex volume and are traded between major economies, and they're derived from majors. For example, European/GBP is influenced by European USD, and GBP/USD reflects regional economic dynamics without USD influence. And USD stands for, once again, US dollar. That's going to be the fiat currency used in the United States. And they're more active during European or Asian sessions. And miners often offer diversification from USD-centric trades. And some examples of minor pairs. Some common miners include Euro/GBP. Now remember, minor pairs do not include US. Okay, so minor pairs are going to be Euro/GBP, Euro/AUD, which is going to be for Euro/Australian dollar, GBP/JPY, that's for British pound, Japanese yen, AUD/JPY, Australian dollar, Japanese yen, Euro/CHF, that's Euro/Swiss franc. Okay, so CHF equals Swiss franc. Okay, and Euro/GBP is Euro British pound. And then we're going to have CAD/JPY. CAD is Canadian, and JPY is Japanese yen. So for example, GBP/JPY, known as the guppy, it's volatile due to the carry trade interest rate differentials. So some characteristics of minor pairs. So minor pairs have moderate liquidity, less than majors, but sufficient for most traders. And they have higher volatility. They have more price swings than majors due to the fact of different certain parameters. They also have wider spreads. It can consist of typically 2 to 5 pips. Okay, so low liquidity is also going to lead to wider spreads. So be wary of that too. And they have a regional focus, influenced by local news. For example, European data for European pairs and correlations, often inversely related to US dollar strength. And they're suitable for intermediate traders seeking more movement. And pros and cons of minor pairs. Advantages: higher volatility for profits, bigger moves in shorter times, and they're used for diversification too. So you can avoid the USD exposure. Let's say the US economy is going through something, then you can trade minor pairs. Some disadvantages: they have higher cost and wider spreads eat into the profits. So let's say you made $200, okay, on your trade, the spreads would go ahead and make it like 184, for example, okay? So this way you're going to be down like $16, something like that, okay? So they also have increased risk too. They're more unpredictable during off hours as well. And during 2022 for inflation, for example, Euro/GBP fluctuated wildly on the ECB versus BOE policies. So once again, any big economic news that occurs is going to go ahead and affect the price. So be wary, have your stop loss set. Stop loss is going to be an automatic order that cancels out your trade for you, so you guys don't lose money for no reason. So exotic pairs, here's the definition of that. Exotic pairs are a major currency, usually USD, with a currency from an emerging market or smaller economy. And they normally have low trading volume, making up less than 5% of the market. And emerging economies like Brazil, South Africa, and Turkey are going to be involved. And they have high sensitivity to local events like elections or commodity prices. And they're traded sporadically with liquidity peaks in specific time zones. And exotics are for experienced traders who are willing to take higher risk, who believe in the future of a certain country, for example, or smaller companies' progression. So some examples of exotic pairs: you're going to have USD/TRY. That's going to be USD/Turkish lira, okay, for Turkey. So USD Mexican peso, so the US dollar and the Mexican peso. USD/ZAR, the US dollar/South African rand. Okay, it's going to be South Africa's currency. Euro/Turkish lira, so the European Union currency can be traded with the Turkish currency. And USD/THB, the US dollar and the Thai currency, the baht. So THB is going to be representing Thai's currency for the baht, and USD/SGD. Okay, that's going to be for the Singapore dollar. Okay, so SGD is going to be Singapore dollar. So for example, USD/TRY, it's highly volatile due to the Turkish inflation and constant political instability. And certain other countries too that have not a stable government can be subject to certain volatile price action fluctuations, so be careful. So some characteristics of exotic pairs. So some distinct features, class. They normally have low liquidity and they're prone to slippage and gaps. And they have a high volatility, and large swings can happen depending on the news. And that can be a good thing or a bad thing, because they could throw off your technical analysis depending on just certain events. And they have a huge spread when it comes to fees, and they have up to spreads of around 10 to 50 or more, okay? Which could mean that if you make like $200, you could be getting like $100 back, depending on the certain amount of spreads. So be careful. And local influences, commodity and politics dominate, okay? And certain governments are going to be corrupt. And higher swap rates. Overnight costs can be significant. And this requires deep research into an emerging economy and see if they're actually improving. And some pros and cons of exotic pairs. Advantages: they have high profit potential, and volatility allows big gains. And unique opportunities, okay? Less crowded markets. And some disadvantages: they have high risk and sudden devaluations possible. They can be expensive, as wide spreads and low liquidity can make certain things not work out. And limited data can be harder to analyze too. And in 2023, USD/ZAR surged hard due to the fact that South Africa decided to invest heavily within energy business, okay? So surge hard due to the South African energy crisis. So if you make a good investment and the economy starts improving, you could potentially make some good profit based off of that. So the key differences. So comparing the three. So liquidity, majors are going to have the most, then minors, and then exotics are going to have the least. And volatility, exotics are going to have the most due to the fact that they're going to be the most unstable, then minors, and then majors are going to be the most stable. And spreads, majors are going to have tight spreads, so you're going to get most of your money. Minors and exotics have wide spreads. And trading volume is high for majors, low for exotics, due to the fact that majors are more trusted, more news, more data, and risk levels are low for majors and high for exotics. And you could choose based on your experience and goals. And once again, I'm not saying one is better than the other, just do your research before you trade. And liquidity explained. Liquidity refers to how easily you can buy and sell without affecting the price. And majors have extreme liquidity with minimal slippage. And minors can be good but thin out after off hours. And exotics can be poor, leading to higher costs due to the fact that slippages can be destroying you. So if I would think different about trying to swing trade or trying to day trade exotics, I would maybe swing trade. And during low liquidity, exotic pairs like USD Tri can gap up like 100 pips on news. So be careful. And volatility explained. Volatility measures price fluctuations in the magnitude. So majors have an average daily range of around 50 to 100 pips. Minors move around 100 to 200 pips with more opportunities, and exotics can move 200 plus pips with high risk to reward. Not saying one is better than the other, do your research. And use tools like ATR, average true range, to measure if you want. And here's what spreads are. Spreads are going to be the difference between the bid and the ask prices. A lot of the time, the ask prices is what you're going to be buying at, and the bid prices is what you're going to be selling at. And majors have a 0.1 to 1 pip on average. Minors have 1 to 3 pips, and exotics have 5 to 20 pips or more. And a 10 pip spread on exotics means you start 10 pips in the red. And trading strategies for each. Tailoring strategies. Majors, okay? You trend and follow. Following the trend is really going to depict what you want to do on the majors, okay? And news trading. And minors, they can carry the trades and have different range bound systems. And exotics, okay? They have fundamental analysis and different long-term holding. And always use stop losses and position sizing. And some real-world examples. Applying concepts. So major, European/USD. During the 2022 Fed hikes, the USD strengthened. And minor, GBP/JPY in 2023, volatility from BOJ policy shifts. And for exotic, USD/MXN during the US-Mexico trade talks, swings on tariffs, okay? So different examples like that can be used. So for example, for a major pair, in this scenario, let's say you're trading USD/JPY during a risk-off event. Japan's yen is a safe haven, and in 2022 market crash, the USD/JPY dropped from 1112 to 101 as the yen strengthened. And the strategy, short USD/JPY on the stock market decline, and you ended up outcome with profitable low spreads, since it's a major pair. And exotic pairs risk. Let's say you're trading USD Tri during a Turkish lira crisis. Okay, may God bless. Okay, in 2018, let's say TRY depreciated 40% against USD due to inflation and politics going on and strategy. Then you could long USD TRY if you wanted to, but wide spreads cost extra. And with high rewards but overnight swaps, eroded the gains. Okay, so exotic pairs, even if you make a really good trade, fees, spreads, and stuff like that could just wipe away the money. Minor and exotic pairs is the key to successful forex trading, and it starts with majors, you can graduate to minors, and appropriate exotics cost sheets. You can practice on demo accounts and stay informed with economic calendars. Stay prayed to God, keep grinding. Put any comments below. I'll catch you guys in the next one. Head over to Stackmode.net if you want to trade forex or anything trading related. Peace. All right, Stackmode Chris here, and this is going to be everything that I wish I knew when I started buying and selling stocks within the stock market. So it can seem daunting, but it's definitely a powerful way to build wealth over the long term, and it requires a lot of patience, humbling yourself, being close to God so you don't lose yourself or your sanity, and just being disciplined. So what exactly is a stock? A stock is also known as an equity, and it's a security that represents an ownership stake in a company. And when you buy a company's stock, you become a shareholder, and you own a tiny fraction of that business. And as a shareholder, you're going to be entitled to the portion of the company's earnings, okay, so the company's money they make, and assets, proportional to the number of shares that you own, okay? So the more shares that you own of the company, the more piece of the pie you'll have. The primary goal of most stock investors is to profit from the appreciation of their shares over time as the company grows and becomes more valuable. So imagine this, for example. So if I have a pie, okay, let's say the pie is called Stackmode pies, okay? So Stackmode pies, the name is going to be the stock, okay? Whatever the name is the stock, okay? So stock is essentially the name, okay? Say I own 50% of Stackmode pies and I own 5 million shares, okay? So shares are going to be the percentage ownership, okay? And then there's going to go ahead and be directional bias. So if I said I was going to hand out 4 slices of pie today and I was correct, then that's going to pretty much be an options contract, okay? A stock options contract. So options contract, you're getting paid to pretty much predict price within a good time manner, okay? So that's the difference between all of them. So for example, imagine a company, okay, Stackmode network. Let's say we decide to sell 100,000 shares to the public, for example. And if you buy 100 of those shares, okay, you'll then own 0.1% of the company. And if the company's value grows from 10 million to 20 million, your shares value will likely double as well. So having an investor's mindset is going to be extremely important. Don't hop on the market thinking that it's a quick money grab, thinking that it's a quick get rich scheme. No, it's going to require discipline, day after day after day after day after day after day after day, repetition, not giving up, feeling like a failure. Okay, so many times where I just felt like I just wasn't for me, felt like I wanted to stop and was just feeling unmotivated, but I kept pushing through. I knew there was an end goal to it. And now, alhamdulillah, we're seeing green profits. Okay, so having an investor's mindset, having a resilient mindset is going to be extremely, extremely important. You've got to be patient. Okay, always be working on some other business or something like that while you're in a trade. Okay, you can't sit there having anxiety about the trade all day. You can't put yourself in lock. Okay, you got to keep going, keep flowing, keep building the wealth. Okay, inshallah. So investing is not about getting rich quick at all. It's about building wealth patiently and systematically and logically. And the biggest enemy to a new investor is often just their own emotions. Okay. So key principles of the mindset, long-term perspective. And think of terms and years, not days or weeks. Short-term market fluctuations are normal and often unpredictable. And true, wealth is truly built over decades, not quarters. Even if you run up $8 million, for example, in 2 years, okay, if you're not disciplined, if you're not structured, you don't know how to continuously win trades. Let's say you hit a couple meme coin plays, right? If you don't know how to continuously win trades, put the money away for taxes, budget, reinvest, you could end up definitely destroying that. Okay, you could destroy any amount of money by being undisciplined. Okay, so have a long-term perspective on it and avoid emotional decisions. Do not panic sell when the market drops. So the left to right chart. Okay, if the stock market or crypto market goes down, understand that inshallah, especially if it has value or something called market cap. Okay, market cap is going to show you the number of how valuable a company is. Okay, so if something has a high market cap, okay, and certain things occur on all of them, then you know it's also going to be something that you want to be looking at too. Okay, so a lot of the high market cap stuff can have decent volatility. Okay, and embrace that. Okay, the market's going to go up and down, and volatility is a natural part of the investing landscape. And you can view market downturns as potential opportunities to buy quality assets at a discount, also known as the dip. Okay, so if the dip is happening fast, people think price action is just willy-willy. Okay, so if you see your 4-hour candlesticks curling upward, daily candlesticks curling upward with closes, you know that you might able to find the low. Make your take profit in an area of resistance or support above current price. Okay, and just take your time. Okay, so taking my take profit is something that I wish I stuck to. I would hit take profit, but sometimes I would get greedy, hold past it, okay, or try and make 10 bands in a day instead of being happy with the 900 that I just made. Okay, I've had instances like that too. Okay, so it's about instances of being grateful, and this is why just reading the wisdom that God has left here for us, Quran, you know, etc. So it's really just going to help us put everything together and lock it all down and understand like, okay, I can't just be playing with my money emotionally. I actually got real people to protect and provide for. I got to be serious with my trading. I got to be serious with my money. Okay. And trade with this mindset. Never trade with the mindset of, oh, I'm trying to make some money. Not trade with the mindset of, I'm not going to lose money on this trade. Okay. And do your own research. Okay. Never blindly follow a stock tip from a friend. Instagram. Okay, there was times where I traded in a group of friends. That was before I even started mentoring on YouTube. Okay, I started off mentoring a group of friends, okay, and then they told me that I should start taking it on the internet. Okay, but that's how it started at first. Okay, started helping people get funded. Okay, after I figured out how to get funded and stuff like that. Okay, but trading with friends sometimes can lead to bad decisions if you don't do your own research. Okay, because no one is perfect, only God is perfect. So sometimes, like, especially if they're not studying more than you, okay, just try and stay in your own lane and your bag and your investor, okay? Study from your mentor, okay, and just stay locked in with your mentor and focus on the charts, okay? So God got you, okay? Find yourself a good mentor that you can trust, okay, and just trust your vision and your view, okay? Don't be arguing with anybody who doesn't believe in your view. So understand what you're investing in. So fundamental investing concepts. So to navigate the market, let's understand the language of it before we're just on here lost. Here's some of the most critical terms and concepts you'll encounter on your journey here a lot. So stocks, once again, stocks represent ownership in a company. They're higher risk but higher potential return, and you can participate in the company's growth. So if you catch a good company at the low, let's say you catch it at $32 a share or something like that, okay, and then price decides to go to $100 a share, okay, you would make a large percentage gain on your money, okay? Why? Because $32 a share went to $100 a share, okay? That's a 68-point jump, if I'm not mistaken, okay? So it's a lot of points, a lot of percentage gains to go ahead and be paid off of. So with stocks, you get paid as price decides to go in whatever favorite direction you purchased it in, okay? Whether be it you're wanting it to go up or down with the options contract, for example. So bonds are debt and stocks are equity. So bonds, they represent a loan to a company or government, and they're lower risk but lower potential return. And you receive fixed interest payments over time. And think of it as being a bank for the company. So let's talk about market capitalization, a very, 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 very popular term. Market cap is the total value of a company's outstanding shares, and it's a simple way to gauge a company's size. So a large cap is going to be anything over 10 billion. Mid cap is 2 billion to 10 billion, and small cap is generally considered below 2 billion. Okay, so small caps can be high risk, high reward because no one's really found them yet. But if you catch a small cap and it turns into a large cap, you'll be rolling in some dough, inshallah. Okay, mid caps, they have some higher growth potential. Okay, but they can also be more volatile since it doesn't have the most value. Okay, and large caps generally more stable. They do have a lot of volume though, so if price wants to correct, it'll definitely correct. So if it wants to dip down hard, it'll do that. So the art of research, okay, fundamental research versus technical analysis research. There was times where I only traded earnings, for example, okay? And I would just do research on the company, on the earnings, and that's fundamental analysis, okay? And then I started just trading with the charts, okay? And that's technical analysis, okay? And both are gonna be needed to mesh together the ultimate plan, trust me. So fundamental analysis, let's talk about what it is. So this approach is a company's intrinsic value, and you'll analyze its financial health, management, market share, and competitive landscape. Okay. And you're looking for a stock whose price is below its true value, believing that it's going to rise over time by helping people in the future. Okay. And putting smile on people's faces, inshallah. So some key metrics: the price to earnings ratio, also known as the PE ratio, okay, earnings per share, and return on equity, also known as ROE. These numbers tell a story about a company's profitability and their valuation. So for a PE ratio example, if a company's stock is trading at $50 per share and its EPS is $2.50, the PE ratio is $50 divided by $2.50, and that equals 20. And a low PE might suggest a stock that is undervalued, but it could also signal poor growth prospects, and it's a key piece of a larger puzzle. Put together what you wish. And technical analysis. This approach ignores a company's fundamentals and instead focuses on chart patterns, such as waiting for support to be broken, turn into resistance, or resistance being broken, turn into support. Okay. So instead of focusing on chart patterns, fundamentally, you could focus on chart patterns technically. Okay. And that's technical analysis. Okay. So technical analysis involves chart patterns, trading volume, studying the market momentum, and how the candles are moving. And technical analysts believe that all relevant information is already reflected in the stock's price. Okay. And the golden rule, diversification. Okay. And I also wish I was just saving way more money too. I would buy a bunch of Bitcoin, but then I would always just sell it. And I was like, dang, okay, everything that I've been buying and selling for the past 3 years, if I would have just held it, okay, then I'd be very, very up. But I'm glad I didn't do that because I get to teach this lesson here today. Okay, so the golden rule, diversification. So one of the most important lessons is to never put all your eggs in one basket. Okay, so don't just put all your P&L into just one share play. Okay, diversify a little bit, maybe like 1, 2, 3 plays at max. That's crypto and stocks included. Okay, 1 to 3 digital plays max. And diversification is the strategy of spreading your investments across different assets to mitigate risk. And when one investment performs poorly, another may be doing well, helping to balance your portfolio's overall return. So I hope you invest across industries. Don't just invest in tech, consider healthcare, consumer goods, energy, and finance. Different sectors react differently to economic cycles. Okay, so as of 2025, when this is coming out, we're in like the AI cycle. Okay, so AI stocks, for example, are super popular. Okay, or crypto brokers. Okay, anything allowing people to trade cryptocurrency, it's going to be popular too. So invest globally. Okay, the US stock market is not the only one. Consider international stocks to capitalize on global growth and reduce country-specific risk if you want. And use ETFs and mutual funds. Okay, these are powerful tools for instant diversification. An exchange traded fund, an ETF. That's a basket of securities you can buy and sell or an exchange, just like a regular stock. An S&P 500 ETF, for example, gives you an instant ownership in the 500 largest US companies. Okay. And mutual funds, a fund managed by a professional, which pools money from many different investors in a variety of assets. So here's some common mistakes I do. So chasing hot stocks, okay? So especially after I made my first couple of bands with like C3 AI, say seeing that, okay, making my first like flip like that, okay, I was just like, okay, whoa, trading can be super duper popular. But then after that, I ended up losing profit just buying some stupid stocks that didn't end up going anywhere. So be careful chasing hot stocks. So stocks that are currently making headlines or being heavily promoted are often already way overpriced, and the smart money has already made their move to go ahead and exit. Because remember, it's a left to right chart. So it's about who sees it first. And inshallah, I want you guys to see it instantly. And market timing. It's nearly impossible to consistently predict the market's short-term movements. And trying to buy at the absolute bottom and sell at the absolute top is a fool's errand. And time in the market is far more important than timing in the market. So ignoring your plan can sabotage you too. Many investors or traders have a solid plan. You know what you want to do. You know what your criteria consist of, but are you following it? Okay. Panic and greed could really lead you to abandon your trade, okay, or even frustration. Just why am I not winning the trade? Not accepting the fact that you lost instead of sticking to your steam clean setup criteria. Okay. If you're struggling, head over to Stackmode.net, but I really do assure you play break and retest. Okay, you can wait for support to be broken, turn into resistance, or you can wait for resistance to be broken, turn into support. Okay. And that's it. Just keep it simple. Okay. Don't destroy yourself over the charts. Please keep it simple. Set a strategy. Okay. Stick to it, regardless of the market noise or whatever's happening. And investing money you can't afford to lose. Never invest your emergency fund or money you need in the next few years. The stock market is for long-term capital that you're comfortable seeing fluctuate. Okay. So opening a brokerage account. A brokerage account is a financial account where you can buy and sell stocks and other securities. Okay, you can't just go to the company and buy shares. You got to go to the broker to facilitate the transaction for you. Okay, so brokers, you can check about their fees, see about their rules, see how their support is. Okay, and then you're going to be able to get a card. Okay, certain of them, like Robinhood, for example, offer a card where you can go ahead and use your day trading profits or whatever profits that you make from the market and withdraw straight on the card. So whatever broker that you want to use, go ahead and use that. Okay. So open your broker. You can start small. Okay. Don't just dump all your money. Okay. Take your time. Make sure you know what trades you want to invest to and do your research. Okay. Even if it's worth it to spend your money on education, mentorship first, and then come into the market. Okay. This way you're not going to have to get your education by just losing over and over again. Okay. So dollar cost averaging. Okay. So the most powerful strategy for beginners. And instead of trying to time the market, you just invest a fixed amount of money at regular intervals. Okay, and this ensures you buy more shares when prices are low and fewer when they're high, averaging out your costs over time. Okay, so make sure you guys know where you're purchasing. Okay, if you're not purchasing at the right time, that could really jurisdict your trade and really just sabotage certain things that you need. Okay, so focus on ETFs and mutual funds. So for your first few years, you can focus on a core portfolio of low-cost index funds or ETFs. Okay, that's going to be something to diversify too, especially as you're learning the market. So if you're new into the market, you still don't understand certain day trading while you're getting educated and stuff like that, ETFs can be something that you can look into as well too. Okay, so I wish I looked into more long-term stuff when I first started trading instead of just worrying about the instantaneous profit of like 0 DTE options. Okay, so look at long-term stuff because a lot of the time while you're learning the markets, you can still make money in these long-term plays, and your money a lot of the times is going to be a lot safer versus you just trying to throw yourself head into 0 DTE or something like that, or futures, and then losing everything. Okay, so that's where I wish I corrected myself. Okay, so start now. Okay, there's going to be no time limit, okay, to when you can start or end trading. Okay, you can trade till you pass away. Okay, and you can start trading right now, any age, any time. Just start now. Okay, know yourself. Okay, this is why being with God is going to be really important. Already becoming humble is going to be really important. Okay, you can't be coming with ego. Can't be coming with thinking that you're bigger than the charts. You can't be thinking that you're right and the charts is wrong. Okay, and use the right tools. Okay, TradingView, big tool. Come for mentorship. Okay, I offer a free call where you guys can learn how to trade as well too. And then I'll put a trading plan together. Okay, and patience. Okay, be patient. Even if you're making $10 from the market, okay, stack that up, okay, and after you withdraw, so whatever amount of money that you withdraw, let's say you make $10, okay, I like to leave 50% in my account of whatever I made, so I would only put $5 in my account. After that, 30% of whatever I withdrew needs to go to taxes, and that's how I break down my money. So I hope this presentation helped. Stay prayed to God, keep learning. I'll catch you guys in the next one. Class, are you guys investing or are you guys gambling like a casino? Let's go and let's talk about the difference between disciplined trader versus the gambler. Each scenario is going to go ahead and represent the scenario that we should be doing, which is A, being disciplined, being humble, not having ego, making sure we're being persistent and consistent within our investment methods. Or a gambler, someone who doesn't play within their risk parameters, does anything, overtrades, is emotional, Let's talk about the difference between the two. And which one are you? So the gambler's mindset. Focus on instant gratification, which is going to destroy you. Anything that comes super quick could definitely be lost extremely quick. Things take time to build, have to be planted like a seed. Okay. And the gambler's mindset, trader and investor, is going to seek quick, massive returns. And they view the market as a zero-sum game of luck, often driven by the excitement of large immediate payouts, instead of thinking of consistently trading the market year after year after year, generating income so they could stop trading effort and exertion for income. Instead, they could make their money, make the money. Instead of having that mindset, they're thinking, okay, let me just make this quick play real quick and try to pull out $10,000 from this trade instantly without any experience or anything like that. And the gambler's mindset trader is going to have irrational hope. They believe they can predict short-term price movements through gut feeling, hype, or just any type of randomness to the trade, ignoring historical data, quantitative metrics, or technical analysis, just buying things based off of the fact that, I think it's going to go up. I think it's going to go up. Okay. And without any true fundamental analysis behind it, make sure you have data behind why you want to get in, whether it be a technical data on the charts or fundamental data. Be like, this company's doing well. They just put an earnings report out of X, Y, and Z. I think the company's profitable. I think this dividends PE ratio is going to be worthwhile getting into due to the fact that it's pretty good, okay, compared to other dividends. Okay, so just examples here, but you can go ahead and use logical formations before you just enter in any trade. But the gambler is just going to be entering anything, and you don't want to be doing that. Plot your trades logically and take your time. And they treat capital as lottery tickets. And each investment is seen as an all or nothing bet. Never take your whole check. Never take all of your business income and invest it into one play. Don't do that. Okay, take your time, diversify, have risk into it. And that means that they often risk an unmanageable percentage of their total capital on a single position. Okay, so don't do that. Make sure you guys are controlling where your income is, spread it out, have it in different investments, and keep stacking cash. Okay, and the disciplined trader mindset. Focus on statistical edge. Okay, and they view the market as a long series of probabilistic outcomes, expecting not to win every single trade, but definitely expecting that, I can only lose the trade when I close too. So having that mindset is really going to keep you in the game. If you're here to trade year after year after year, stocks, cryptocurrencies, etc., go up year after year after year. So the goal is not to win every trade, but to execute a positive expectancy model of over 100 plus trades over the course of a couple of years, gaining data, and then having an edge. And disciplined traders are going to be prosperous. And success is to redefine, not by of a single trade. So even if you make a whole bunch of money on one trade, you're still going to be disciplined. You're still going to be waking up, praying to God, being consistent, being humble, not losing sight of the plan. Okay? You can't just make $10,000 on one trade, right? Which might happen. Sometimes you catch a gap up and things like that. It might be unintentional money. Okay, but you can't do that and then play with a whole different position size the next day that's way over leveraged, not in any calculations of your risk parameters, thinking you're the best trade ever just because you hit one trade. Relax, okay, withdraw, take a step back, breathe, pray on it, be grateful, and then come back with a logical, process-oriented mindset and make the next trade. And the disciplined trader focuses on capital preservation and just cash preservation in general. And the primary objective is to protect existing capital, okay, which is risk management, with profit generation as secondary. Independent outcome, and losses are budgeted expenses. So for example, the gambler buys a volatile stock based on a Reddit post, for example, or Instagram post, instead of actually looking at the chart, doing their own statistical and fundamental research, making their own analysis, which you should be doing, expecting it to double overnight, right? And the disciplined trader buys the same stock only after confirming its consolidation near a key support level in a trend, allocating less than 1 to 10% of their capital per trade. Okay, letting their money make the money, letting it stack up, and letting their capital just always generate. So the edge, the chance versus quantifiable advantage. So the gambler's edge. The gambler operates with non-existent or poorly defined methodology, and their decisions are typically random and highly discretionary and impossible to replicate or backtest. And no validation. They never test their strategy. They remember big wins, okay, and have confirmation bias, thinking that, it's going to do this over and over again. Now, I understand that if you find a strategy that works or some technical analysis that falls into place repeatedly, that's amazing. But don't expect this to work 100% of the time. Don't have an idealistic view of this will work, this will work, this will work. Don't think that you're really going to lose, but be comfortable with losing. You should only be investing in that you're cool with losing in this way, that if you win, you're not going to be emotional. And same thing if you lose, and that's going to go ahead and be able to cancel out any anxiety or fear that you're having on the markets. So the gambler is going to be following in other ways too, and trades based on news headlines, social media chatter, or recommendation from unreliable sources without performing due diligence and doing their own research. Don't do that, okay? Don't be a sheep. Do your research. Make sure you want to invest in something that you believe in, something that you feel a connection to. Be like, you know what? I think this is a good strategy. I think this is a good investment. I think this play is strong. And go ahead and get into it. And unseen rules. Entry and exit rules change mid-trade. And the plan is subjective. So if they say, you know, I'll sell when it feels right, or I'll hold until I'm even, instead of having logical checkpoints where they want to exit their trade and enter their trade. And we'll talk about the disciplined trader edge. The disciplined trader must have a statistically verifiable edge and a set of rules that over time yields a positive expensive T. Okay. So their win rate is high. Okay. And their average win percentage is high. Okay. And even if they take a loss, their whole account is not going to be destroyed due to the fact that being a disciplined trader means that you're not trading with more size than you should be trading with, meaning that if you lose, your account's not going to be destroyed. Why? Because you're trading between 1 to 10% of your account. And the disciplined trader back tests and optimizes the strategy if anything is wrong. And strategy is going to be rigorously tested and studied and back tested over decades of historical data. And the trader knows the system's maximum drawdowns and expected monthly return range. And the disciplined trader has a written plan. Every scenario is detailed in a formal trading plan. And this documents defined setups and valid market conditions, risk rules, and exit mechanisms. Okay? So the trader is going to calculate certain mathematical expectancy of their system. Be like, you know what, my win rate is this percentage. There are certain trading journal programs that can go ahead and calculate it. And I'm working on the Stackmode app right now, which is going to help you guys calculate your trade journal as well too. So risk management, annihilation versus preservation. And this is arguably the most critical divergence. And a trader's long-term survival is entirely dependent on rigid risk control, which a gambler fundamentally ignores. So I'll talk about the gambler's capital allocation. So averaging down, they panic when a trade moves against them and buy more to lower their average cost, instead of just staying on business on their position. Okay, be like, you know what, I lost. Let me go ahead and have a set place where I should be closing at. And if it exits there, or if the price hits there, I'm gonna go ahead and close and exit for a loss, okay? But instead, when the moves are going against them, they're gonna add more with that gambler's mindset, trying to convert the small loss into a big win. Instead, that small loss just turns into an even bigger loss most of the time, okay? Turning into a catastrophic concentration of risk. And sometimes playing with no stop loss can be bad. So it depends on what you're investing in and how you're investing too. If you're on futures or Forex, you should be trading with stop loss. Why? Because margin call is a thing. You don't want to get margin called by the broker and other broker money. So play with the stop loss, especially if you're on futures and Forex. Okay, stop loss in crypto, you can get away with no stop loss, depending if you're buying and holding. Same thing with ETFs. But for futures and Forex, definitely stop loss. Please do not gamble on futures and Forex, playing with leverage especially. And they believe that the market must come back, all right? And they refuse to accept a small loss, often leading to a margin call or a total account wipeout, which is most of the time only possible on futures and Forex. The gambler is also going to trade with emotional position sizing. And their position size is determined by current emotion or desire for profit, not mathematical risk. And they often risk very, very high percentage of their accounts, 10 to 50% of their account on one trade. And the gambler faces ruination probability. And that's the mathematical certainty of eventual losing all your capital due to oversized losses and emotional decisions. Now let's talk about how to be a disciplined trader. So the disciplined trader position size. So they have a fixed percentage risk. They never risk more than typically a fixed small percentage of their total capital per trade. Okay, so if you have $1,000 in your account, okay, and you're risking 1 to 10% of your account per trade, you're gonna risk between $10 and $100 of your account per trade, okay? Keeping your risk in place. And let's say stop loss. So a stop loss is placed before the trade is entered. So once again, especially if you're on futures and Forex, you gotta know exactly where you're gonna exit at and where you're gonna enter at. And it defines the point where the trade idea is invalidated and the risk is contained. And the risk position is sized. So the position side is calculated based on the distance between the entry price and the stop loss, ensuring the monetary risk does not exceed the 1 to 10% rule. And the disciplined trader ensures that even a string of 10 consecutive losses will only deplete the account by 10% if you're trading 1%, but if you lose 10 trades in a row, and I recommend 10%, 5 to 10% of your account if you're more experienced, because 10 trades, then you could destroy your entire account. But you shouldn't be losing 10 trades in a row realistically. Now, research and information processing. The gambler's information flow. Don't want to be trading like a gambler. So the gambler prioritizes novelty and social proof. Over objective data, information is consumed for emotional validation rather than strategic input. There's a reason why God says don't gamble. Gambling is wrong. Okay, it's bad. It's the reason why is because you don't have any jurisdiction in it. Okay, you're not trading with any logical output. You're not making monetary decisions with any logical output behind it. Okay, just throwing your money into the void, hoping for the best. This is not what we want to be doing. So hearsay and media hype. So they trade based on unqualified tips, sensational news stories, or expert predictions on cable television. Don't trade like that. Do your own research. Hop on your charts, hop on your broker, make your own analysis and decisions. And superficial charting. They may use rudimentary technical analysis. Okay, so you might draw random lines, okay, but ignore volume, market structure, or context. And their analysis is descriptive, not predictive or actionable. Okay, so you can go ahead and mark out something, right, that may look bullish on the 15-minute, but then on the weekly time frame, it's a whole different story. Okay, so you can't just look at one time frame either. Don't trade like that. Don't just look at one view. Look at the whole global perspective on every single time frame, and then make your decision. So, lagging indicators. So you can only get in indicators after price has already done its thing. So indicators are going to be pretty late. And getting it late is not always going to be a bad thing. Sometimes it's going to make it more confirmed within a trend scenario, but getting in certain indicators is just, it's not going to be it. Okay, like MACD, for example, it's very late. A lot of indicators are just pretty late. They can be used for confirmation, but you don't want to be relying on that. Okay, understanding how the wicks work, support and resistance, and read how the chart needs to correlate. So the disciplined trader. So the disciplined trader uses a multifaceted, systematic research process to validate setups that align with their quantifiable edge. Okay, know what you're getting into. If you're going to trade break and retest, you're going to trade some break and retest. If we're going to trade reversals, you get in a reversal. Okay, and get some data behind it. Study your setups, back test it, paper trade it first. Make sure it works before you start putting money into the market. And the disciplined trader is going to utilize a blend of TA, technical analysis. You can go ahead and look at your patterns. If you're looking for break and retest, put your volume into play. Make sure it's something people trade, and look at the momentum. Okay, see how it's moving. And relevant fundamental analysis. See if it's a profitable stock. See if it's something that trends heavily to really form a complete picture. And track the events too. Know when earnings is going to be too. You don't want to get into a trade and the earnings is the next day. Okay, that's going to be a form of gambling. Make sure earnings is pretty far away and then make your decision. Even if you're a long-term investor, you know, wait till earnings happens first and then go ahead and get in. And they're going to always be on top of the economic data releases or any stock or company releases that's going on, or any type of negative news that could affect the price movement as well too. Okay, you can over to couple of news sites which lets you fact it, like forexfactory.com. You can fact check and see all the news and the data reports and put that into correlation. That helps a lot with futures, for example. And TradingView, for example, shows you all the stock news, and a lot of brokers do too. And look at the market structure. Focus on the who, what, where, and why of market movements. Why is price making resistance here? Why is price making support here? Okay, ask yourself these questions before you get into the trade. Put everything together in your brain, lock it in, and then go ahead and make your trade. And work on the directional bias of the higher time frames. Feel like, you know, okay, I want to get in the trade here because of X, Y, and Z, and then make your decisions. And the trader's analysis really answers, okay, why do I want to get in here? Okay, what's my maximum loss? And I understand we're on the charts trying to make some money, but don't lose yourself, okay? Take your time, build up your capital, be disciplined. Because if you full port your account in one trade trying to make some money, you're going to be wishing that you were disciplined and you took your time. So I'm telling you guys, being disciplined is going to be the most worthwhile decision in the long run. So impulse versus automation. So the gambler is going to be trading based off of impulse. You got to pretty much be a robot if you want to be a successful trader. So the gambler is going to be chasing the market, entering super duper late on big giant candles, getting in the trend late and just missing the whole thing. okay, and getting pulled back on, getting wicked back on, and just living in drawdown. And they often buy at the high or sell at the super low after the move is already completed, catching the final remaining scraps and pieces, okay? So, revenge trading. After a loss, they immediately enter a new larger position to win back the money. And this is the fastest way to accelerate capital loss, okay? Don't do that, okay? Don't do that. If you take your loss, you gotta get off, okay? Plan yourself a better trade. Be like, you know what, why did I get into this trade? Did this trade really make sense? Okay, and if it did, okay, cool. Accept that loss. Take a better one, okay? Or try again. Play something with better volume, okay? There's probably some reasons why the trade didn't work out, because if you notice, once you start playing S plus setups, they're gonna work out a large percentage of the time. Not every time, but a very, very, very large percentage of the time. So ask yourself, why did I lose before you just get in the trade again, trying to make some money back? And keep a record too, okay? Know how much you're making, know how much you're losing, know how consistent you are, because it's really gonna help you go back and see, you know what, well, I've been slamming, well, I've been crushing it. And a lot of brokers keep track of that, but you guys can keep track of it too. So the disciplined trader, you gotta be like a robot in the game. You gotta get up, be a robot, okay, grind. And the most disciplined person, the most robotic person when it comes to keeping their emotions stable is gonna win, okay? You can't be letting fatigue, emotions, anger, fear, anxiety, and none of that get to you. Okay, you got to be a boss, stand on business, and get to it. And execution is for a disciplined trader, and it's robotic and unemotional. And the moment the trade is entered, all necessary parameters, the stop loss and the target are set. And strict adherence. Traders are only taken when the market offers a setup that perfectly matches the criteria in the written plan. Okay, the edge. And let's talk about the trade journal. Every single trade is logged with the entry, exit, reasoning, psychological state, and a chart screenshot. And this data is used to iteratively improve the edge over time, okay? You can go back, be like, whoa, okay, I was crushing it here. Let me stick to this. Why am I changing it up? Let me invest into this, okay? This led me to a positive equity curve at the end of the year. Okay, let me stick to this. Okay, it's gonna help you guys keep your data. And you're gonna have a positive expectancy focus, wanting to crush your goals and be a better you and just be better every single day. And you understand that the goal is not $10,000 profit today, but the statistical certainty that $10,000 will be achieved by repeating the process over a period of growing your seed, stacking wins, stack mode. Okay, take your time, okay? It's not a race, it's a marathon. And be in the game for decades, years, okay? Don't just lose your account overnight trying to make a FOMO trade. Relax, be disciplined. I'm telling you, it's gonna be worth it to be disciplined. When you're chilling on the beach, when you're driving in the Lamb, when you're doing what you wanna do, when you're chilling in your house, okay, when you're put up because you stayed down and you were in stack mode, you're gonna be cheesing hard, okay? It's gonna be worth it and chill up. So let's say, for example, the trader reviews their journal and finds their system has an 80% win rate, okay, on Tuesdays. And they use their objective data to confirm their edge. Let's say news is on Tuesdays and they notice that the news correlates with their edge, and then they go ahead and keep trading that, and they find a profitable way to make some money, for example. And let's say the gambler, okay, they review their account statement, sees a negative balance, leading to frustration, more reckless trading, booting up their account more, whole check into it, okay, and just losing their whole mindset, okay, and not sticking to a consistent edge, which is gonna help you grow your account over and over again, okay? Take your time. So, psychological mastery, detachment versus attachment. Trading is 80% psychology. I'd really say like 90%, okay? Because there's been times you can really give someone really good levels, and if they don't know when to close or if they're greedy, they can still destroy it all, okay? So the final differentiation lies in how losses and profits are internalized. So the gambler, they're really attached to the outcome, okay? They have way too much greed. They're fiending to win every single trade, and they're very impatient, wanting to make a trade every single day too. You're not gonna trade every single day. It's not realistic. They close profitable trades early too, destroying the risk to reward because of the fact that they're scared, okay? It's why you gotta trust God, okay? Relax, okay? Only trade with what you're okay with losing. You're gonna be cool. Let the trade play out, and if you see something, believe in it. And they hold losing trades for too long, okay? Now, if you see your trades going in the opposite direction and it's way past your stop loss, okay, you could go ahead and close your trade, especially if it's way past your stop loss. You got to. Don't hold something that's clearly not gonna go ahead and reverse anytime soon. That's ego trading. And that's viewing loss as a personal failure or an indictment of their intelligence. And this fuels revenge trading and their need to prove the market wrong, which could lead you to throwing more funds into a loss. And mood swings. They experiences extreme emotional volatility with deep euphoria on wins, okay, extremely happy, cheesing hard, jumping up and down. But then when they lose, crashing out, sad, okay. Be stoic. Whether you win or lose, just keep going. Stack mode, put 50% away, keep 50% in your account, keep stacking it up, keep going, go on to the next trade, okay. Keep getting richer, keep getting better. And the disciplined trader, they're detached to the outcomes. They have a sense of neutrality built into them. Okay, and you got to accept that a single trade is meaningless. Even if you make way more money on one trade than the other, that doesn't mean that that trade was better than the other. Did you stick to your process? Did you stick to your rules? Were you grateful? Okay, and stay humble after your wins. It's really going to keep you guys focused on the process, and which is really going to get you to the next level, inshallah. So the focus is on executing the edge perfectly, regardless of the P&L, profit and loss, and learning from losses. A views of a losing trade that adhere to the plan as a successful win. Okay. So even if you didn't make any money on the trade, if you stuck to your entry plan, you stuck to your stop loss, you saw what you needed to see and it just didn't work out, that's a win. Okay, keep yourself mentally balanced, keep yourself mentally good, and understand that losses in life and on the market are just tuition for you to learn from experience and go forward. Okay, and objectify. Okay, they use if-then statements to govern their actions. If price has stop loss, then they're going to exit. If price turns resistance to the support and they're looking for a long, they're going to enter. Okay, if price hits resistance, they're going to exit. Okay, so you guys are going to go ahead and have some parameters set. Like, if price does X, Y, and Z, I'm going to do X, Y, and Z. Okay, and that's going to help you trade logistically, robotically, and play the chess moves correctly. And mental discipline is going to be important. The disciplined trader sees a loss, not as I just lost $1,000, but I just incurred a 1R loss. You know what? It's okay, which is budgeted. I planned for this, and it's statistically necessary for the system to eventually produce 2R, 3R wins. Okay, so when you lose that 1,000, but then you make 4,000, you're not going to be mad. You're going to be like, you know what? I'm happy I only lost 1,000. I'm glad I didn't just risk my whole $10,000 account trying to make a whole play. Okay, because I just stayed within my risk, caught a nice trade, and I didn't blow my account even though I took a loss, and I made it back the right way. So don't be a gambler. Gamblers are driven by emotion. Don't be drinking alcohol. Don't be doing nonsense. Don't be trading with the mindset of, I'm going to come on and make some money. Nah, come on with the market and be like, you know what? I'm going to make some good financial decisions. I'm going to come onto the market. I'm going to enter because I have some logical parameters on why I'm about to enter. I'm going to enter because support is at this area here. You know what? Price doesn't want to go below here. This is safe. Let me go ahead and take this trade here. Oh, resistance just turned into support. Let me take this trade here. Okay. Take the money out of the picture. Focus on the charts. Take your focus off the P&L too. Okay. Get your eyeballs off the P&L. Don't be staring at that. Look at the chart. And the disciplined trader. Focus on statistics. Focus on getting better. Okay. Understanding that the ability to even trade in itself and make some money just looking at the screen is a blessing. Okay. Straight from God. God is great. Okay. So let's go hard. Let's keep going. Let's keep pushing harder than ever. So don't focus on the money. Professionals focus on the process, the discipline behind it. And to succeed, you must first manage your risk. And only then can you manage your profits. Stay prayed up to God, keep grinding, and head over to stackmode.net for all trading education. Catch you in the next one. Peace. The strong reasons why market's going to be going in upwards directions is due to the fact that these stocks help the United States economy. That's going to be the strongest reasons, and there's a reason why the billionaires within the trading community are people who play United States stocks companies, whether owning shares and options such as Warren Buffett, etc. Because it's going to be honestly the easiest market to play. Forex market is very sideways. Futures you can't hold overnight unless you have a certain amount of margin. So the United States stock market and even cryptocurrency is going to be great realms to just buy and hold your money. Okay, so let's go ahead and continue the lesson here. So these stocks aren't just random stocks listed on TradingView or these brokers so people to just make invisible money. These stocks are real companies that people actually work at, okay, that we might have worked at in real life, okay, and they generate real income. So since they generate real income, they can also employ people. So they can employ people. And when they employ people, these people pay taxes to who? The government. Okay, so as long as these companies are making money, okay, and people are working at these companies, then the government will continue to make more money. So these companies being profitable, these companies doing well, these companies making money, they help out the government. And anything that helps out the United States government will be pushed. Okay. That's just what we know about trading and just fundamentals of things. Okay. If it helps the government, it's going to be pushed. Okay. There's a reason why cryptocurrency didn't get a big push until SEC laws and stuff like that were regulated. Okay. So until the government regulates it, and unless the government has something to do with it, it's not going to have too much value until then. But every single one of these stocks boost the economy since they put jobs out for people. Jobs include people who pay taxes. Taxes go to the government, making the United States more wealthy. Wealthier we are, more power we have over other countries. Okay. So it all starts from just simple things like wealth. So options and the fact that these shares and stocks go up in an upwards direction is really important. Okay. It's way more important than people even think. Okay. So market's not just, oh, I'm going to come on here and just make some money. Okay. It's real life stuff happening on these charts, and really understanding everything is going to help us understand what we're going to be trading for. So market's going in an upwards direction. So this is why we're going to be focusing on call options. Okay. So as we know, call options, they pay you whenever you think price is going to go in an upwards direction. Okay. If you speculate and you're buying a call option and you think price is going to go in an upwards direction and you're correct, then you get paid. Okay. So that's going to be a call option. And the reason why we're going to be focusing on call options is exactly what I just broke down. These stocks have incentives to go up. There's also going to be laws such as the short sale restriction that are going to be in place too, to make sure that these stocks don't just fall flat down to zero. Okay, there's a reason why decades of these stocks of going in an upwards direction has been a thing. Okay, so it's about letting go of all the fear, trusting God, not having any weird anxiety of, oh, what if it just falls down to zero and it's time to start just investing and being a boss. Okay, so we're going to be talking about the proper levels to play at. Okay, and we're going to keep talking about why we're playing at these levels and what we're buying. Okay, I always want you guys to understand why. I never want you to just be like, okay, just do the X, Y, and Z and just do this. It's going to work. No, I want you to understand the deep reasoning why this works, why people are billionaires buying just shares and call options. Okay, so it's about finding things that are undervalued and catching the sweep up. Okay, every company wants its share price to go down. It doesn't make sense to really play puts due to the fact that market is not built to go down exactly. And even when market does go down, exactly. Even when market does go down, people are quick to buy the dip. People are quick to buy the dip, and market will recover right back to wherever it dipped from heavily. It'll fill it right back up. All it is just a discount. All it is just like clothes and cologne and whatever. It's just going on sale. That's all it is. Market just goes on sale whenever it falls down. So puts don't really make sense to purchase, especially when you get on your higher time frames, especially when you're playing companies that have good revenue and actually make money and the share price increases year after year. Playing puts, not only are you going to have significantly shorter trades, your take profits aren't going to be as easy to put down because one, you can't predict where the market's going to bounce at. Okay. So you can't predict where the market wants to stop at all the time. Now, shorting and stuff like that comes really from Forex traders and is something that's seeped over to the stock market. But the Forex chart and the stock market chart is completely two different worlds. Okay, stock market just goes up in an upwards direction. Okay, and that's just the truth of it. Okay, if I pull up the Forex chart here, Forex is extremely sideways. Okay, you have price action all the way up here. We got price action all the way from here from 1977. We got all types of stuff going on. Okay, but if I click on the fluffy stock market, it's literally going up in a straight line. Okay, it's almost impossible to not make money in the stock market. This is why I'm so passionate about teaching in these videos. I'm starting to realize that they've literally made it to where we can just get money for free. It's welfare. It's genuine welfare. Instead of making stupid decisions, trying to flex for people who don't care about us, trying to make decisions that are just way too fancy right now, instead of staying down and investing, Okay, those are the things that keep people back from being financially free significantly early. The opportunity is here for us to just invest money and infinitely turn your money into more money. This just goes up in a straight line. It's impossible for anyone to not make money on the United States stock market. It's impossible. Okay. And it's about just making really good decisions. So, price has an incentive to go up. So, forget put options. We're focusing on calls. Okay. We don't want to be shorting the stock market. There's a reason why you can't even short the stock market on a lot of brokers, too. You also have to think about that from a logical perspective. Most people on most brokers cannot short with shares. Okay. They can't short with shares. They can only purchase shares. So everyone's trying to just buy the stock. Also, CEOs are trying to be richer than the next CEO. So they want their company's share value to be going in an upwards direction. They want to be classified as a billionaire. So also more incentivization to go in an upwards direction. And there's also something called dividends. Dividends are going to be what the stock pays out. So the more you invest into a stock, if a stock is making good income, it'll pay out what's called a dividend. And that's going to be money that it pays out back to the shareholders. Okay, so it's like, you know what? Thank you guys for investing in us. Here's some money back. Okay, here's your reward. And that's what it's going to go ahead and say. Okay. So if a company has enough money to do that, that means that it's profitable. If it's profitable, it's most likely going up on the stock market. Okay. So there's incentive for it. The more profitable something is, the more it's going up on the stock market. Hence why when a company makes a big deal, it just shoots up. Okay. Because it's now more valuable. Okay. The more money and the more valuable something is, the more of a high share price it'll have on the stock market. Okay. So, cool. That's keeping those things in mind. So now let's talk about when a setup is going to be good to play and when not. Go. So let's say, for instance, here, I have this area up here. Okay. One area that we're not going to play at is going to be called all-time highs. Okay. We're just not going to be playing at all-time highs because, one, we're trying to catch a sweep up. Okay. So all of your setups will look like a V. Every single setup will look like a V. Okay. And what your profit is going to consist of is the right side of the V. Okay. So the left side of the V is going to be the resistance. Okay. This is where price is falling in a downwards direction. So you can see here, you could see price creating resistance here. Okay. This is the left side of the V. Price is falling down. Okay. The left side of the V. What we're looking for is playing the right side of the V. Okay. We're playing the right side of the V. All of your trades are going to be the right side of the V. Okay. You're going to be buying call options, expecting price to sweep up. Okay. That's what you're going to be looking for. So how can you play the right side of the V if price is falling the left side at all-time highs? You can't. Okay. So let me show you a good example of an actual good setup. So this is how we find a setup. What I'm going to be looking for is a couple of things. One, I'm going to be looking for higher time frame areas. So I'm going to make sure that I'm on my higher time frames. I'm going to make sure I'm on my weekly time frame first. My weekly time frame is going to help me see everything. It's going to be my eyes. I'll go from my weekly time frame to my daily time frame to my 4-hour time frame. Okay, so you're going to start off on the weekly time frame first, due to the fact that the weekly time frame is going to help you once again see everything. It's going to be like an eagle eye. Okay, because tunnel visioning when it comes to trading can be extremely bad. Okay, you want to be able to see the full picture and not just what you're seeing on a smaller time frame. You're then going to go to the daily just to see the picture painted a little bit in more detail. And then you're going to go to the 4-hour to see any hidden candles. So what we're going to make sure is that whenever you're on your 4-hour time frame, and this is why we can't just use the daily and the weekly, we have to make sure our extended trading hours is on. So as you can see, the daily and the weekly don't have that. That's due to the fact that they don't show pre-market hours because the weekly and the daily go off of 24-hour blocks. So that's why we still need our 4-hour time frame. And then we're going to be able to turn on extended trading hours to see all the true candlesticks that we're missing. Okay. So extending trading hours always needs to be on. So we're going to go from the weekly to our daily to the 4-hour. So let's go ahead and let's mark out a setup, for example. Okay, I'm going to talk about what I'm going to be looking for, and then I'm going to jump onto the charts. So my setup is only going to consist of two things. I'm only going to play setup 1, which is going to be a support mirror. Okay, if you see price bouncing at an area of support, you're going to be good to go ahead and purchase there. Okay, if you see price bouncing at an area of support, reacting from another area of support, okay, that's going to be a good area to purchase. Support is going to signify an area of demand where people want to buy the price. So it's going to indicate where buyers step in. Okay, so buyers step in an area of support. And we're buying call options, meaning we get paid when price goes in an upwards direction. Okay, so we want to be buying at areas of support. Okay, so if you see an area of support mirror itself one after another, that's going to be a good setup. Or it'll look like this. Sometimes you'll have an area of support. Price might run down through it. Okay, it might not bounce at the other area of support. It might break below it. But then it might come back up and bounce at the support again. Okay, even this would be considered a support mirror. Okay, so even if price runs down underneath the first area of support, if price decides to bounce at the area of support again, that's a clean support mirror, I like to call it. Okay, so you'll either see one area of support bounce right after another, or you'll see an area of support mirroring an area of support from the past that maybe didn't get reacted off of immediately. Okay, so your setup will either look like this, or it'll look like this for criteria number 1. And criteria number 2, very simple. It's when an area of resistance gets broken, and an area of resistance is going to indicate where sellers are. So resistance indicates where sellers are due to the fact that people have too much supply. So that's why resistance gets created in the first place. There's too much supply. When people have too much of something, when they've made too much money, they're like, all right, you know what? It's time to close. I'm out. Okay. And then they're going to go ahead and close their trade simultaneously. And a wave of enough people doing that is going to create what's called resistance. Okay. That's going to create resistance. So let's continue on here. So if an area of resistance decides to get broken past, okay, if an area of resistance or support gets broken past, we know that's called a breakout. So resistance getting broken past and turned into support is going to be called break and retest. Okay, break and retest. Okay, waiting for resistance to turn into support after it's been broken. So it's when you're waiting for the resistance to turn into support after it's been broken. Okay, if you see this, you can take the trade pretty much safely. Okay, we're going to talk about some certain criteria, how to read daily closes, etc., what a close is. But let's talk about some more fundamentals we are going to be looking at. It's important to have a logical mechanical process before we put down any type of size or money. Okay, did price do this? Did price do that? Having a large checklist is going to save us a lot of money when it comes to making any type of mistakes on the market. Okay, so one thing we're going to pay attention here too is the earnings. Okay, whatever broker you're on will most likely tell you, but before you put down a trade on whatever stock you're looking at, make sure that you look at the earnings. The earnings are going to go ahead and let you know when the report is going to come out. And the stock can significantly make upwards or downward sweep when these earnings reports come out. So we want to be making sure that earnings aren't anywhere near. Okay, if earnings are 7 days or less away, and you're trying to don't open a new trade. If you're already in something, it's fine. But if you're trying to open a trade and earnings are 7 days or less away, don't do it. Okay, because the price action is already going to be weird, and people are going to be wary of the same thing. They're going to wait for earnings to happen first and then make the trade. Okay, so if you see earnings a week away, 7 days or less, don't take the trade. Okay, just don't take it. Now, if earnings is far, you're fine. So those are going to be the criterias we're going to be taking. Let's talk about it on the chart. So once again, we're always going to start off on the weekly time frame, doing what's called top-down analysis, TDA. T stands for top, D stands for down, A stands for analysis. Okay, top-down analysis, TDP, TDA. Okay, so what we're going to do is I like to always mark out, okay, where would I want to close this trade if I got in? Okay, I can see price made all-time highs up here. So let me just go ahead and draw a zone up here. Okay, and I like to just eyeball. Okay, we don't use any indicators. We're not going to need any indicators. What we're going to do is pay attention to straight candlestick price action. Just like I told you, price should be doing the right side of the V fill. Okay, so we can see price decided to fall in a downwards direction here. Okay, this is going to be the left side of the V. Okay, and what we're doing is catching the right side of the V. Okay, we're going to be catching the right side of the V. So let price form the left side of the V, and then we're going to get in and catch the right side of the V. Okay, so you can see price maybe potentially trying to make a low right here. Okay, potentially trying to make a low right here. Let me go to my daily. Okay, I can still see price making a low right here. Okay, I can see, okay, I'm on my daily time frame. So I'm going to get on my weekly, put an area of resistance, put a zone around it. Okay, because I know, one, price has an invitation to go in an upwards direction. Okay, it helps the government, helps the economy. It's trying to go and be the most profitable and helpful company. Okay, it's a lot of recognition, and as human beings, we care about things like that. Okay, so recognition will be coming with being the most profitable and best company. So in order for that to be credible, share price has to be decent. People have to be investing into it. So let's increase the share price. Okay, that's what people are hoping for. So let's drop better products so people buy from us. Okay, is what people are really hoping for who are behind these companies. So let's think like them. Okay, so you can see price deciding to make a bottom here. Okay, so then I'm going to start on my weekly. Okay, I can see just this large gap of space here between here and up here. So here I have the left side of the V. Okay, I have the left side of the V. Price already created it for me. And then price already drew out the bottom point. Okay, so now I'm going to go to my daily here. I can see price drew out the bottom point for me here. Okay, now we can see price potentially wanting to fill up the V. Okay, so what we're going to be doing is catching the whole right side of the V. Okay, so we can see price made the left side of the V already for us. Okay, we can see it. It made it left side of the V. Now, price made a low already. I can see on my daily candlestick, and this is what I'm going to be looking for. Okay, no indicators, no nothing. If I'm on my daily and I see price bouncing from a low, okay, with a large gap of area from an area of resistance, and I see price making multiple daily candlesticks go up in a multiple color stick direction. So I can see here green candlestick, green candlestick, green candlestick. I see multiple green candlesticks in a row. Okay, multiple green candlesticks in a row, just like we have multiple red candlesticks in a row going down. If I have multiple green candlesticks in a row going in an upwards direction, and I see a large area looking to be filled in, to fill in the right side of the V, okay? Even if price falls down at the resistance and goes down to all the way down there, we don't care, okay? Because we can clearly see that price wants to try this area of resistance again. It's like, hold on, how am I gonna fall down right here? I'm not with that. Let me try it again, okay? And it's gonna try it again. And when it goes to try it again, that's gonna be our profit window. That's our opportunity. We're not here to get the best entries in the world. We're not here to predict the most high point of the market, the most bottom point of the market. We're here to react. We're here to come onto the market, scroll down, see, oh, market made a low right here and it make it high. It looks like it wants to try this high again. Okay, it might want to break this area. And that's what you do is you react within the market. Okay, and this is going to be the trick on options. So option sellers, right? Before we jump into the trick and why we're going to do what we do, let's talk about it. So option sellers, what they're preying on is that people make some ridiculous gambling dice decision, okay? They want people to make some just fried, horrific decision. So options aren't just spawning out of thin air. There's a reason why certain stocks don't have any options attached to them. Because one, nobody is selling the options in the first place, okay? So options are not just spawning out of thin air. It's called trading for a reason. Once again, it's called trading for a reason. Okay, contracts have to come from somewhere, and they come from people turning their 100 shares into a contract and then selling it. Okay, and what they're trying to make money from is that we don't win. Okay, they're trying to make money hoping that we're wrong. Okay, but we're trying to make money hoping that we're right as options buyers. Okay, so here is how, as an option buyer, how we can make some good profit, right? Let's talk about it. So as an options profit buyer, okay, of course we want to make some profit and some money by being in the right direction of the trade, okay? So obviously we're buying calls, so we want market to go in a upwards direction, okay? So in order to outplay the option sellers, we're just going to play not ridiculous bets. So you can see we just did all that criteria to determine if price was ready or not. We looked at another trade and saw it was at all-time highs. We would not buy because that's the left side of the V. We're looking to only purchase the right side of the V, which looks like it wants to be filled up here. Okay, let's catch the rest of the candlesticks and farm the rest. So what I'm going to do is come up here to the T. Okay, and I'm going to be able to see the options list. Okay, so the furthest to the left here would be the closest, and the more right I go will be the furthest. So what I'm going to be focusing on is called an options leap. The reason why people say options are so risky and etc. is because they're just not playing it right. Everything in the world is risky. Okay, driving on the road every day is risky. So we're not going to be scared. We're going to be smart. So options leaps. Okay, this is what we're going to be focusing on. Leaps is a contract that I say you hold between 3 months to 2 years. Okay. Any contract that you hold between 3 months to 2 years is a leap contract. Okay. So let's say this contract here, right? Let's say I bought this. Let's say I analyze this area of support, right? Let's say I'm like, yeah, price make the bottom of the V here. Okay. Just like a V, you know, a V has a point. Okay. Let's say I like the bottom V here. Let's say I want to go ahead and catch the right side of the V, right? Let's say I believe in this. Okay. I'm like, you know what? I'm on my daily time frame here. I can clearly see market's been trending in an upwards direction for quite some time. Okay. You can clearly see we're just sweeping up year after year after year. You know what? This is a profitable stock. Oh, okay. Cool. We're beating earnings, beating earnings, beating earnings, beating earnings. I like that. We're paying out dividends to people. Okay. I like that. This is going to be a comfortable play. So I would go ahead and purchase a contract that makes sense. Okay, so this is going to be some sauce right here. So I'm going to buy at least a year out if I wanted to. Okay, so I would buy for a year out. Okay, or I could buy 2 years out to be even safer. Okay, so let's say I want to buy 2 years out. This is how you know what's going to be the best contract to buy. Okay, so what a lot of options people get destroyed on is the theta. Okay, and what theta is a Greek. Okay, so options has Greeks. We have delta, theta, and gamma. Okay, theta is going to be the Greek that equivalates to time. Okay, so whenever you think of time, think of theta. Okay. So once again, whenever you think of time, think of theta. So in order to outplay the theta, we need to make sure that we have plenty of time on our contract. So the theta and the Greeks don't destroy our mental patience, okay, and make us want to crash out. Okay. So instead of worrying about, oh man, I gotta close my trade in 2 seconds, like I gotta close my trade in a week. Nah, you have years on it to hold. Okay. And you can see price is already bouncing in an upwards direction. So what you're gonna do is whatever the current number is of your options contract, okay, whatever the current number is, and your options broker, wherever you're on, will always tell you. Okay, it'll always tell you, it'll be in the middle of whatever options chart that you're looking at. Okay, the best contract to purchase at all times, okay, is going to be the contract one number above, okay, we're going to purchase the contract one number above the current price. Okay, so if current price is at 26.20, right? What we're going to go ahead and do is purchase the 27 contract. Okay, that's all we're going to focus on since we're buying a call contract. Okay, because we only want to buy in an upwards direction. Okay, just like we broke down, there's reasons why stocks wants to go in an upwards direction and why they go up year after year after year. Okay, and why people get rich by just turning their money into more money by investing into companies that put the money in the government's pocket. So you can get rich by investing in companies by putting money in the government's pocket, inshallah, if God wills. So we're going to go ahead and focus on the call side, since that's the side that pays us whenever options are going in an upwards direction. Okay. So we're then going to focus on the current price. Okay. So let's say current price of this stock is 26.20. Okay. We just did all of our verification. Is price ready on the right side of the V? Okay. If price is ready on the right side of the V and already made a bottom point, we're ready to go ahead and purchase that. We're going to go to our options. We're going to make sure that we're buying at least 3 months to 2 years out, depending on how far your take profit is. Okay. My take profit here, let's say I did on the weekly, I think this gap is pretty big. So just to be safe though, don't be cheap. Okay. Be safe. Okay. Being safe is what's going to get you wealthy within trading. Okay. Focus on the trades that aren't going to lose you money. Okay. People want to trade zero DTEs, trying to make some money feeding for bread, but they end up blowing up their account over and over and over again, not making anything or making some money and then losing it all. Okay. Because it's not safe. It's not consistent. So play options in a safe way. Buy 2 years out and buy the number one above current price when it's already trending in a positive direction. So this way, you're going to get your bonus points too. So this is why we use our higher time frames for options too, because we want to be catching the whole move. Okay, so we're buying years out and catching the whole move. So the higher time frames is going to show us the whole move here. So I can see I would personally close at the area of resistance. Okay, you always want to fill in the V structure. This is why the V structure is important. Okay, price will make the left side, you catch the right side. Okay, and you fill in the V structure. Wherever the V started at, slanting to the downside, is where you close at. Okay, so it's going to be where you close at. So price started resistance here, fell down, made a bottom point. I'm going to keep my profit window is going to be the remainder of the V. Okay, the remainder of the right side of the V. Even if price was up here, okay, I would still be able to catch the remainder of the V up here. Okay, the earlier entry that you see is just the more money you're gonna get. But even if you enter later, that means that you have a higher probability of being right. Okay, and we're here to play safe. Okay, you want to focus on the trades where you're not gonna lose. Okay, you don't know if price wants to bounce down here. But once price has showed you that it wanted to bounce down there, it's a lot easier to get in and make your decisions based off of that. Okay. So let the market react for you. You don't have to predict, just react to the market. Okay. React. Okay. Market decided to make a heavy area of resistance here, close at the heavy area of resistance here so we don't get reversed on here again. Okay. We don't know if price wants to reverse right here. Okay. It might not, or it might want to. All we know is that price wants to go and give it another whirl, it looks like. Okay, and we're just going to take advantage of that and be happy with that profit. Don't ever try and 50-50 the breakout. Okay, your take profit will always consist of an area of resistance above current price, or it'll be an area of support above current price sometimes. Okay, sometimes your setup's going to look like this. You're catching the right side of the V and you're closing at the area of support. And that's because, just like the opposite, resistance can be broken, turn into support. Support can be broken and potentially turn into resistance. Okay. So we want to keep that in mind and trade safely. Yeah, it's really just taking your time and just letting the market react and do its thing. Okay. So these are going to be the two things we're going to be looking at. Okay. Close at areas of resistance above current price, which a lot of the time it'll be, or support above current price, since resistance can be formed there and you want to get in before market falls down. Since we're focusing on calls, we want to get paid whenever market goes in an upwards direction. Okay, so we don't want market to fall down. Okay, so keeping all of this in mind, catching the right side of the V, we know what contract we want to purchase. Okay, I'm gonna go 2 years out. Okay, I'm gonna look at current price. And even though my take profit up here is 29, I'm still going to look at current price and buy the contract one above. I'm still going to buy the 27 calls contract. The reason I'm not going to buy the 29 calls contract is because options, once again, you get paid based off of predictions. So even though our chart closing is going to be at 29, we're going to buy the 27 contract because all the profit we get is going to be bonus points. Okay, 27 is the number before 29. So even if we bought 28, you would get bonus points too. So any number of a contract that you buy before your take profit will be bonus points. So it makes sense to buy the number one above. So even if take profit was 35, I would still buy 27, just because 27 is before 35. And I would get all the bonus points. I would get, and the more points that you go, so if I bought at 27 and I closed at 35, it would get bonus points per number. So it would be bonus points at 28, at 29, at 30, at 31, 32, 33, because I'm so right. Because I'm right way before. Right? So because I'm so right, it just pays you out stupid amounts. And that's how people just do nasty flips. And I've done some nasty flips on option myself. Okay. So let's talk about another setup here. Okay. So you're always going to want to be looking for a price to be forming at a low. Okay, you want price to have made a low already. All right, and you want price to have made a high too. Okay, so in this instance here, market's still looking for its low. Okay, it hasn't quite made its low. It tried right here, and this is why I like to look at the daily here and wait for multiple candlesticks going in a green upwards direction. Okay, so you can see here, we wouldn't have gotten faked out by that. Okay, so this right here, say this low that people tried to buy, this is why we don't buy what's called falling knives. Okay, you don't know where market wants to bounce at. Okay, you can have a good idea of it, especially when it comes to the upside. Okay, and you don't know if market wants to break out. So if market creates resistance here, I'm gonna close at this resistance. I'm not gonna say, oh, market's not gonna fall down there again. No, I'm just gonna close at the resistance. Okay, it's a lot easier to play like this and play to the upside than it is to catch ultimate bottoms. Okay, just wait for the bottom to form and then play to the upside that's already been formed. It's a lot easier. Okay, so instead of trying to catch every single bottom and then price keeps falling and then you're losing money catching a falling knife, wait for the bottom to form. Okay, until I'm on the daily time frame and I start seeing green candlesticks going the upwards direction, I'm good. Okay, I want to see multiple green candlesticks in a row before I take any type of trade. Okay, so take some type of low like this, right? If I see price make a low and I see multiple green daily candlesticks in a row going up, I'm like, oh yeah, price wants to do that. But I can clearly see here, like an area like this, price just faked them out here. Okay, price tried to go up, but it's red, okay? Red candlesticks, and they're very sideways, and then market just dumped, okay? But then we have a low right here, green heavy candlestick. I'm sure this candlestick was green too before the close. And then green candlestick, okay? Super heavy low right here. Green candlestick, green candlestick, green candlestick, okay? Even right here. Green candlestick, green candlestick, green candlestick, right here. Okay, same thing. Green, 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 green in a row. So if you're not seeing at least a couple of green candlesticks going in an upwards direction on the daily, then that low just isn't true. Okay, the low is just it's pointless. Okay, it's what you want to be looking for. Look at this low here. Okay, this low worked out, it formed, and then we started seeing green daily candlestick. See, I would have answered on the second one. I never answer on the first one in the zone because I don't know if price really wants to bounce there. But if I see another green candlestick and then another green candlestick, I'm like, oh yeah, that's cool. But price, it was pretty much close to the area of resistance here, and then we'll see if price wants to continue from here. Okay. So price decided to fill in this area of resistance right here. Okay, we have this area of resistance right here, and then price falling down right here in the zone. Okay. And then one day price will try and break this area potentially. And then we'll try and go up to this area of resistance, I assume, up here. Okay. So could wait for price to find another V and then take the whole side upwards like that. Okay. But right now, it's just not ready. Okay. Market is dumping on this. And it gotcha. So here, gotcha. So if I bought right here, I would close my first contract here. Just because price keeps spamming this resistance. Okay, I would close, close the first contract here. And then if I have more, then I'll go ahead and I'll close the next one up here. And this is why I buy years out though. But even if yeah.
It's 2026. What's going on? We're back in the Stackmode community, and first week, I just wanted to go ahead and recap and let you guys know what the business is. So we're up about 6% so far in the first week of 2026. I'm going to start doing a recap kind of once a month, just updating you guys on my P&L. Sometimes twice a month, showing you guys like the first week what my plan is, and then showing you guys like the end of the month result and showing you guys progression on how to start an account from nothing and grow it into something. So here, focusing a lot on AI stocks, tech stocks, and stocks that really have stuff to do with the future is really what I'm going to be going forward with this year. So a lot of people like to invest in stocks that have been around for decades and years and stuff like that. Me personally, I like to invest aggressively. This year, I'm going to be really focused on shares as well too, pretty heavily compared to options and futures like I have in the past. I'm really going to be just trying to go hard on shares this year, scouting out good companies, finding good buys, purchasing them, and just holding and sitting on my trades. That's noticing it's been working out for me really well. Been able to grow my account at a relatively fast pace. Been really happy with the profit. And one thing I really like about swing trading shares compared to options trading or futures trading is whenever you're swing trading shares, you can just sit back and chill on your trades. You don't have to worry about time, no expirations, no getting margin called. You could just buy your shares, sit and hold, and that's it. That's all you absolutely have to do. And taking your time on shares, trades, and scouting out the companies that are going to be making the most ample progression within our societies, getting rewarded for that, getting rewarded for your research, for your knowledge, for knowing to not buy at all-time highs and to buy at certain low areas. The reward that you get from shares compiled with the risk factor that's pretty much taken off because say options, for example, I've changed my whole mental mindset. When it comes to options, people can pretty much sign a death contract. Your contract is pretty much locked in. It has to hit or it's going to miss. Okay, that's 100% just what it is with options. With shares, as soon as you buy,
your money will fluctuate over time. But one thing about it is that you 100% do own. If your options is not going towards your directions, you're going to be losing. Okay, even with shares, if it's sideways or moving slowly towards your direction, you're still going to have all your capital. If you put down an options trade with not enough time and it's moving slowly towards your price direction, but it's still moving, okay, either A, your price is going to go negative on the contract due to theta and time decay, or your profit's going to be moving extremely slow and not how you want it. Also, another reason why I'm focusing on shares instead of options this year too is that at a certain point when you get too rich, you can buy all the options contracts for most stocks that you're looking at. Okay, so that's why billionaires have to play shares. So I'm trying to get to the financial point to where I'm one of the best traders. Okay, so personally this year I'm going to be focusing really, really heavily on shares. Got Bitcoin, of course, and in order to generate income, maybe later down the line towards this year, first couple months within the year, I look forward to playing some futures as well too. Okay, so I look forward to playing some futures within that. And I'm just going to be fully transparent with you guys at all times. I want to just show you guys stats, show you guys what I'm holding, and show you guys how I plan to continue to go forward. So let's go and let's jump into some performance, inshallah. So jumping into the stats here. So compiling an account, guys. Okay, I want to show you guys what it looks like starting an account from 0 to 4 to 5, 6, 7 figures. I want to just be fully transparent with you guys and show you guys how it's done. So starting here, you could see just have this account here, kind of restarted it July 2025-ish. Okay, started growing it throughout this time, just reinvesting income from business, winning trades, adding over a single time. Okay, and as you can see, P&L is just heading in an upwards direction month after month after month after month. Okay, so your work income, your business income, or even your options and futures income should be funneled back into your account. Funnel it back into your account. Say your business, for example, if you're doing 5K a month in your business, okay, try and take 4K a month of that, okay, and invest it. Okay, you could put maybe 2K in the crypto, 2K in the stocks. Just try and break it down and invest what you're making. So your P&L is always going in an upwards curve. Okay, every time you guys get some money, try and invest. And then as you win trades, okay, there's going to be times where you may lose, okay, but then you're going to win more trades, get in different seasons, and continue to uptrend. Okay, if you feel like you have to invest every single time you get some money, then do that. Do that. Okay, I'm absolutely addicted to investing. I'm going to keep it 100%. Okay, shares is not something that I played past 2-3 years. Yeah, shares is not something that I've played or really looked at. It's really just been a lot of options in futures. I played options on Robinhood, TradeStation as well too. So I have some stats just spread across everywhere. But as far as Webull, I want to just use it for my shares portfolio. And I just want to be just fully transparent with my portfolio and how I plan to upscale it. Okay. So when you guys are growing your account, right, patience is going to be the number one thing. Okay. It's going to take time for you to know how to identify the setups you need to take. I recommend you guys go to stackmode.net so you guys can get with my trading mentorship, so it doesn't have to take you a long time in order for you to understand what a decent setup looks like. But I went through a lot of unnecessary losses early on within my trading career due to the fact that I was just being uneducated and being impatient and being stubborn. Okay, so completely my fault while I was struggling in the beginning, but once I started getting my foot, I was able to go ahead and progressively increase my P&L year after year after year after year. Okay, so all your business income, all your work income, okay, after your bills are paid, of course, and make sure you guys are reinvesting the profits from the trades that you win. So your income vehicle generating skills are going to either be your options or your futures. Personally, I'm going to go with futures this year. I've played options for a few years and I like just the stability of futures and how you can just turn dirt into diamonds. Same thing on options too, but the time decay factor and stuff. But I don't know. I'll see even this year if I'll even touch futures or options at all, honestly. I might just stick 100% on shares
find little small caps and just really try and turn up like that. And just continuously do my research on these stocks and these companies and try and catch some stuff at the lows. I'm really having fun doing that, finding the best companies, and playing shares. Just really been having a blast. Options, it's really funky with options. Options has a lot of derivatives built into it. Price could be going in your direction and you could still be down due to multiple factors, due to like how much volume a contract has, etc. And all of that stuff is just really ghetto, especially when I'm trying to protect and provide for my family. I don't really want little random factors determining whether or not I'm going to get paid. So I like shares a lot, even when if I, inshallah, if God wills, if I cross into like the 10 million plus range, 50 million plus range, I can comfortably trade I can comfortably trade shares even as a 100 millionaire into billions of dollars. Okay, due to the fact that shares are going to be pretty much always available for the most part. So shares are really just my favorite instrument. This year, I'm focusing completely on shares. 2023, I played a lot of futures. 2024 was a lot of options. Um, Same with 2025, was a lot of options as well too. 2026, let's swap up the game. Going to be focusing on shares. I've been finding some success recently in just investing in little tech stocks and stuff like that. And just I want to just break down and give you guys full guides on what I do to find the stock that I want to play, why I'm getting in said stock, and what I see in said stock within their future, right? So is this stock even going to be half decent in the first place? And as you guys can see, this is completely live. P&L, you can see it moving up here. Market is closed right now though. So yeah, that's going to go ahead and be that. So keep all of that in mind. And let me head over to the positions here. So this is what I'm currently holding. Okay. We got some Path right here. Path is a stock that is been in the works in the limelight recently. I bought some more at like 16, but I sold some a couple of days ago. So we got Path. That's one thing that I am holding. Once again, bought it at around 17.75. Let me get on my higher time frames here. So on my higher time frame, I could see we IPO'd all the way up here at around 90. So I liked that a lot. So I can see a lot of upside room, at least to this 30 area here. They've been getting a lot of funding. I see higher lows being put in. So Path, really, 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 really happy there. Excited to go ahead and take that up as well. Let me go ahead and open up NVTS. So we got NVTS here as well too. NVTS, this is one I'm really, really excited for. So we're currently at 10.31 right now. We got price trying to head up. I bought around 9.89 right here. Okay, and once again, we got price heading in upwards direction. We IPO'd. IPO stands for initial public offering, which is where the stock decided to open at. So we IPO'd at around 22.19, and it looks like price just made this high resistance at around 17.82. So yeah, we're gonna go ahead and wait here and wait for price to go ahead and catch up, do its thing, and then we should be able to make some good profit on this as well too. So I like this a lot. Big fan of NVTS here. They collabed with NVIDIA, and that NVIDIA collaboration, of course, helped it a whole bunch. Whenever we're collabing with NVIDIA on certain things, of course, that's going to be, pretty successful for us to be looking forward for the most part. So NVIDIA is going to be one of the biggest stocks, and I personally sometimes like to look at stocks that NVIDIA is collaborating with, or say Apple or something like that. Any big world-leading stock, if they're making collaborations with other stocks, I like to look into those too, and then I like to see if profit can be made. So EOS as well too. This is an energy enterprise stock, about around 14.22. Price is trying to push up here. Let me get on my monthly time frame here.
So I could see price decided to IPO at this 31 area up here, 0.95. And we just recently created this area of resistance here at this 19.91 area up there. Okay. So just waiting for price to go ahead and go up. Feeling this area here. And I could see here, even on the weekly, I could see higher lows being put in constantly. Okay, constantly. We got constant higher lows being put in. Okay. And it's really just taking heed, noticing price how it goes up, goes down, goes up, goes down, and continues to just spam that. Goes up, goes down, comes up, comes down, and it'll just continue to spam that over and over and over again. Inshallah, especially since this seems like a half decent stock that people will care about. And once again, this is an energy enterprise stock, so I like this one a lot too. Price looking to swoop up. Let me head over to IONQ. Big dog right here. So IONQ, one of the leading quantum stocks. We just had a burst to this area of resistance at this 84 here. So as soon as I saw this higher low get put in, I was like, oh yeah, let me go ahead and hop in those. So that higher low, I loved it a lot. Was a big fan that it put in right here at this area. So as soon as I saw that, I was like, okay, price is looking to progress. And even after that, it came up, made new resistance, it came down, and then made some new support. So I like that a lot. Even if I head over to my 4-hour here, let me turn up the poo-poo time frames. Get on my 4-hour here. So even if I hop on the 4-hour here, boom. Could see price decided to come all the way up here, fall all the way down here, bounce up, create a new resistance wall here. As you guys can see, we have one push down here, another push down here, and then we got price falling down, making a higher low here. So this low is higher than this low. I like that a lot. Super big fan. And then from there, we can go ahead and wait for price to come up, smash past this area of resistance, and then after that, inshallah, we should be able to go ahead and catch price upwards right after that. Okay. So it's really just about taking your time, being patient, and waiting for the setup. Okay. Remember, you want your gap to be filled to the right. You want market to make the left side of the V, let it fall down, let market make the bottom of the V, and then we catch the right side of the V. Okay. We catch the empty right side of the V. Okay. That's what I want you guys to be doing. Catching the empty right side of the V, okay, like this. Okay, this is what we're catching. All of this whole empty space between this resistance and this area of support, right? This whole area is nothing but profit, right? Nothing but profit, all up here, okay? So 40, plus 40 points left between this area of support and this area of resistance up here. So a very, 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 very long way to go. Intel, check this out. Up crazy on this one here. All right, Intel, I got it at around this 35 area. I'm going to go ahead and hop up on my higher time frame here just to show you guys why I got in here on Intel. So Intel, I decided to get in this area. Kind of the same reason, even if I'm on monthly here. I could still see price making upwards progression for the most part. Yes, we did fall down and make this low here. Although after this low, I put that into combination with some fundamentals. Since all the tariff stuff was going on, the United States needed their own AI chip making company to make AI chips for them, and Intel decided to partner up with other companies. I believe NVIDIA is included. And as you can see, we're starting to get a lot of bullish reaction looking to fill in this V. So we first had price falling down from this resistance here on the weekly. And then we could see price deciding to come up and fill in this gap area up here. Okay, so just go ahead and let price do its thing. Let it fill up. Okay, and just give it its space, give it its time. Okay, let market do its thing. That's going to go ahead and be that. As far as Intel, this trade was super duper simple here. And I bought after this little higher low area here too. After I analyzed this higher low area, I was like, okay, cool. Yeah, super duper bullish after this. Check on the daily here too. Even after this resistance, we came down, made another higher low. After this higher low here, saw 1, 2, 3, 4 green candlesticks, bought in. So you can see you're getting a nice V fill here. And on my monthly time frame, we can go ahead and head up to this resistance up here and head up to this 40 area up here to all-time highs. I'm praying. Okay. So that's going to go ahead and be a flip from, let's see, I opened here. So it's about 28 points here. Very great flip. And then Weeble here. You know what I'm saying? Weeble, they're hating on Weeble. We're waiting on this. I'm not going to lie. Waiting on some Weeble here. I just keep adding into this. This is going to be a huge play. Weeble is my favorite broker. I'm using this right now. If you guys are wondering what I'm looking at to look at the charts and do all this at once and see the price right here, Weeble. Weeble is going to be my favorite thing to analyze my stocks on. Well, I use TradingView, but honestly, I might just use Weeble itself from now on because I think it's a cooler interface and you guys can actually see some specifics of everything too, which I really like. So yeah, that's going to go ahead and be that. I pray it helped. That's how I'm opening this year. All the stocks I'm watching, that's the profit I'm up. And yeah, I'm just going to be fully transparent going forward. Just want to show you guys absolutely everything. Not going to be one of these mentors being cringe, making things uncomfortable, and just not trying to be truthful. I always want to show you guys the truth. All right, love you guys so much. Stay prayed up to God. Keep grinding. Catch you in the next one. Peace. So I want to talk to you guys about trading with the trend. Understand that trading with the trend is going to be trading with where the money is flowing. You have to trade with where the money is flowing. Think of the market like a river. If you're trading against the current or you're swimming against the current, what's there going to be? Counter resistance. It's going to be hard. So if the market's going in a heavy uptrend, lots of buying is happening. Lots of liquidity, lots of money is flowing into the upwards direction. And you put in a short and you notice market still keeps going in an upwards direction, you're swimming against the current. Stop swimming against the current. If you're doing that right now, stop doing it. If you see market going in an upwards direction, you need to be buying in an upwards direction. If you see market shorting, okay, then you need to trade with the trend and take shorts. Stop trading against the market. Stop trying to see market go in an upwards direction and be like, market's going to short exactly right here, and then try and plant something that's not even going to happen. Next thing you know, buyers are still in place, the breakout happens, and then price continues in an upwards direction. Why? Because the trend is so heavy. The buyers have stepped in. If it's an upwards trend on the higher time frame and it's real, it's going to be a heavy trend. Okay. Trading. It's the art of reading human psychology through price. Most traders fail because they look at the reflection and not the source. And price is the only really thing that matters. Where's price going? Is price going up or down? Price can literally only go up or down. Trading is quite simple when you think about it. Okay, everything else is pretty much a derivative. So any type of indicators, things like that, all delayed, not things you need. So let's talk about the cycle of money. So accumulation, right? Professional buying. Accumulation is going to be people loading up on things, people loading up on shares, people loading up on crypto. When people are accumulating large amounts of an asset, such as the government, many governments buying hundreds of millions of dollars worth of Bitcoin, for example. Okay. Accumulation is going to be when an investor or an investing class, such as a government, a hedge fund, and the hedge fund is pretty much just a bunch of people with a lot of money coming together investing, and they buy. Okay. And markup is going to be letting you know that there's a visible trend. Okay. And professional selling as well too. Distribution coming into play. Okay. Is market going in a downtrend? That's all it is distributing going on. Okay. And accumulation is just a bunch of buying, people loading up on shares, cryptocurrency, whatever. Okay. And the markup. So as far as certain things, you can wait for pullbacks, wait for support to confirm, and you could see breakouts, such as breakouts into new all-time highs, to confirm the markup phase. Okay, a lot of the time that's going to be where the easy money lives, and risk is going to be the lowest. Okay. So if market is continuously breaking areas of resistances, okay, you can wait for market to pull back and buy each pullback until market comes back to the area of resistance. And you can continue to hold your contracts for a breakout if possible too, because you have to understand that market, in order to continue an uptrend, for example, has to break areas of resistances above current price or areas of support above current price. Okay, let's head over to the next slide. So the anatomy of an uptrend. So higher highs plus higher lows equals a trend. So higher highs equals exactly what I talked about on the last slide. Areas of resistances, which is just going to be areas where market decided to sell off at. That's all an area of resistance is. And then you're going to have areas of support, which is going to be areas where market decides to buy at. And that's going to be where buyers are stepping in it. Yeah. So sellers resistance, buying at areas of support. And you see higher highs, which means areas of resistances are getting broken into higher areas of resistances. Okay. See these areas of resistances, see how each one of these are higher, and then you're going to have the higher low. So look at this low, this area of support where buyers are stepped in. Then this low, buyers have stepped in. And this low. This low is higher than this low. This low is higher than this low. This low is higher than this low. Okay. So whenever you see higher lows getting put in and higher highs getting put in, then you know price is trending in upwards direction, inshallah. So certain things matter. Resistances getting broken out into new highs and higher lows being maintained, so price doesn't keep dumping down to the same areas of support over and over again. So it can actually trend in a staircase. So identify the last higher low. Higher lows are going to be good areas to enter, and that's going to be a really good pullback entry. And some people do find success in breakouts as well too. Find your bread and butter, find what you like to play, and play that. And as long as that low holds, then the trend is going to go ahead and be intact. And risk versus reward. So you might see certain things like on the risk reward tool, like 1 to 4, or you might hear terms like 1 to 2. So what this means is, let's say the 1, let's say you're risking $100. So if you're risking $100, then the 4 is going to be a multiple of that. So that means you made $400. So if your risk is $100, you made $400, your overall profit would be $300. Okay. So you always want to try and make double at least whatever you're risking. Okay. So if you're risking $50, try and at least make 100. If you're risking 70, try and make at least 140. Okay. If you're risking 1,000, try and at least make 2,000. And that's going to be a 1 to 2 whenever you're just catching the double multiple like that. And the strategy is only as good as the exit. So remember, as higher lows and higher highs are getting put into place, let's say you are trading in an uptrend. Let's say you caught a higher low entry, such as right here. You want to make sure you're closing at the area of resistance, most of your contracts at least. Okay. And then if you want to play a breakout, let's say you have 3 contracts, then maybe you hold 1 contract for a breakout and see if price will continue. Okay. But don't be greedy and take profit. Target the next major horizontal resistance or area of support above current price. And that's going to be a trouble area where a lot of orders are going to be sitting. Okay. People are going to have what's called limit orders and bracket orders, which are automatic orders when price comes in contact with a certain area. Either price is going to sell or buy, because people know price is waiting to react at that certain heavy area. So if market falls down heavily from a certain place, people might have limit orders placed at that area of resistance if they're in buy, so price will automatically close. Or some people, which you, depending on the market, could affect you, could be good and sometimes not. Some people might have sell orders at the area of resistance too, expecting price to fall downwards. Okay. And structural protection. So your stop loss. It's an invalidation point. Okay. And if price hits it, your thesis was wrong. Accept it and move on to the next trade. Don't break your account structure and everything you've been working hard for because you want to have an emotional moment. It's not worth it, I'm telling you. Okay. Stay focused, stay disciplined, and stay prayed to God, and just keep working on your craft. Don't give up. It's really important to not give up. Okay, let's do it. Indicators. Just trash. Okay. All of them. All of them, in my opinion, are trash. Okay. Everything you need to see is baked into the candlestick chart, which I'm going to cover right after we get over these slides. Okay. But all these RSI, MACD, stochastics, EMAs, barf. Okay. Trash can. And we take the indicators and we put them in the trash can. That's what we do. Okay. We grab the indicators. You get on your trading view. You get on your broker. You click the trash can on them. And you delete them. Everything you need is baked into the chart. Why are you looking at lagging indicators? It's not worth it. They tell you what already happened. Just look at the chart. Look at the chart and look at your higher time frames. Stay prayed to God and focus on your wisdom. Focus on how you're analyzing the charts. Focus on how you're feeling the charts. Okay. So the lag. Late data is going to kill your edge because you're relying on something that's already in your face. So stop it. A lot of people do that in life. A lot of people look instead of just doing and reacting. And it can cause analysis paralysis. Clutter clouds judgment. Instead of just being confident in the candlestick chart analysis mixed in with the economics with whatever you're playing, you're waiting for an indicator. Stop it. I used to be there. It's not worth it, I'm telling you. So, naked charts. Okay, just straight up candlestick charts, all you need. Indicators suggest reversal, and price action proves it. Stick to the source data. Stick to the actual candlesticks that are moving in your face, not lines that react off of the candlesticks later. Please don't do that. Don't destroy your account like that. Don't destroy your future's family profit like that. You got this. You're the breadwinner. You can't fail. Okay? And if you do, get up, scrape your knees off, and pray to God and keep winning. Don't let these indicators hold you back. Let's go. Simplicity wins. I'm going to show you guys how to read the chart with just candlesticks. No indicators, no squiggly lines on the candlestick chart. It's not making sense. Turn it off. Turn everything off. Okay, trade price, not the derivative. Follow institutional footprints. You can see it all. A lot of it's going to be baked into the higher time frames. Okay, stick to your weekly, daily, your 4 hour, okay, and lowest maybe your 1 hour. Okay, stick to your higher time frames. It's really going to help you get that good edge and break everything down strategically. Remove the clutter, use your higher time frames, and use horizontal lines. Let's go ahead, continue on to the charts. So we're on the charts with it. Let's go ahead and analyze Bitcoin. So I'm going to show you guys two examples. I'm going to show you guys how to read an uptrend. And then after this, I'm going to show you guys how to read the downtrend. So a lot of the times the United States markets and cryptocurrency are meant to go in upwards directions. So US stock markets are meant to go in upwards directions due to the fact that the more successful that these worldwide companies are, the more taxes they're going to be able to pay to the US government, whether via business taxes or the more employees they're going to be able to hire since their companies on the stock market. And the whole reason companies list themselves on the stock market is so they can generate more income, which causes them to build more buildings, which needs more people to maintain. The more people, which means more taxes can be taken out of their wages, the richer that the US government gets. So it's really imperative that US stocks go up year after year after year, especially the big important ones that help the whole world. And cryptocurrency is meant to go in an upwards direction because the creators of them, especially Bitcoin, is going to be finite, which means that there's a limited amount. Okay, so people are trying to buy it up, and there's a lot of imperative value to owning cryptocurrency and buying and holding. So let's talk about how to read the uptrend. So a lot of the times you want to be starting on your higher time frames first. Make sure you're not trading when price is already at all-time highs, okay, because then you're just going to go ahead and get pulled back on. It's not worth it. You don't want to get pulled back on. It can really just destroy your account buying at all-time highs. Buying after all the hype is done, you want to buy at pullback areas and then catch the sweep upwards. okay, back to the area of resistance above current price. Okay, so I'm going to go ahead and show you guys how to analyze the trend. So I'd like to go ahead and zoom all the way from the beginning. I don't like trading trash personally. I like to make sure I'm trading a trending asset. And I like to ask myself, does this asset go up year over year? Okay. If it doesn't go up year over year, I'm not even worried about the uptrend. I'm worried about if I'm trading something decent or not. Okay. Bitcoin, for example, I can see has gone up year after year after year after year after year. Okay. So in my opinion, this is going to be a good asset for me to trade and catch an uptrend on. If it doesn't go up year after year after year, if it's sideways, like if price action was like this, and then this, and then this, and then this, and then price was over here today, it's not something I'll be looking forward to uptrending on personally. Okay, but I could see price starts from here and decides to progress over time. And I like that a lot. Okay, I can see a lot of upwards projection value in this since year after year data is showing me that it likes to uptrend. So I can see price decides to burst up. So we started here from the beginning of time. Price came up and it bursted up here. So buying started happening. So when you start seeing price heading up in an upwards direction, multiple green candlesticks, a lot of times is what I like to look for. Multiple green candlesticks on my higher time frames in a row. Okay, it's going to signal a lot of the buying. Okay, a lot of buying happening here. The price decided to top out right here. And then it fell down. Price decided to fall down and create an area of support. So let me go ahead and show you guys here. When price decides to fall down from an area, that's going to be called an area of resistance. And when price decides to bounce upward from an area, that's going to be called an area of support. Okay, resistance is going to be an area where price falls down from. Support is an area where price decides to bounce upward from. Okay. Then we could see this area of support. Price decides to bounce in an upwards direction here. Price decides to bounce up and stop again. So whenever I'm looking at an uptrend, I like to think of price moving in a V. V meaning that the top left of the V is going to signal the resistance. Okay. And the bottom of the V
power off
is going to go ahead and signal the area of support. So I'm going to have the left side of the V, which is going to signal area of resistance. And the bottom of the V is going to signal the area of support. Our goal, if we're catching an uptrend, is to catch the right side of the V. So on my higher time frames, I like to wait for price to make an area of support first. And if I get multiple green candlesticks heading in an upwards direction after price has already fell down, because that's going to let me know that sellers are selling. And then if I see price making a bottom and then buyers start buying, that's going to let me know that price is done selling and buyers have stepped in. Okay, price is not going to sell forever. And there's also going to be a lot of laws, especially on the stock market, such as the short sale restriction, which prevents a lot of things from just flash crashing to zero. So you can see here, price decided to create resistance all the way from here. And price decided to fill in and even break the area of resistance right here. Okay. And price decided to make a new high from here. Price decided to come up here and make an area of resistance up here. From there, price decided to make the left side of the V again, come down, bottom out, and make the bottom of the V. Right here. And then we see multiple green candlesticks going up in a row on the higher time frames, and the right side of the V being filled. Okay, we got the left side of the V, bottom, and then our job is to catch the right side of the V. Okay, so the later you enter on the V, let's say you enter like right here where that black line is, the later you enter in the V, the more confirmed
The earlier you enter, the more profit you're going to be able to make, but more of a chance that you could potentially get burned. So it's going to be depending on the certain setups you take. So if you wouldn't enter like right here on the black line, if you're trying to close at this area of resistance, it's like not a lot of money left. But if you enter like right here, like that would be fine. Or even right here, that would be fine too. Try and enter like halfway of the V and then go ahead and close at the resistance. Yeah. And then you can see price decided to make a low right here. Prices had to come back up to the resistance. Didn't quite break it. It said, nope, gonna go ahead and reject again. We came down. And then we bounced at this low here. So this low is higher than this low. And then this low is higher than this low. Now we can see the V right here being filled in. Again, just like the V here filled in, V here filled in. Okay, and price will continuously do that. And you can also use your daily time frame to go ahead and plot out trades too. So even if I delete something here, and I just see this trend, I have the bottom area of support right here. We got another area of support right here. Then we got another one right here too, the C being generated. Price making higher lows. Price is making higher lows. See price uptrending. Yeah, it's going to be a really, really important thing to look at. And you can see these V structures being filled in. So top left of the V, price started here, area of resistance was formed, price came down, bottomed out. Then the right side of the V got formed, resistance area got broke, price came down, did the same thing again. Price bursted up towards this area of resistance here. Came all the way down, made this area of support, and did the same thing once again. Okay, could see price deciding to progress over and over again. Okay, and we're coming down here. Looks like it's trying to hold a new low, and we could potentially see over time if this low will remain higher than this low here. Okay, and if so, that's going to be another verified area of support. I like the multiple green candlesticks here on the daily. On the weekly here, we do have some sideways weekly candlesticks that are green. So we'll see about another week here too. Okay. So higher lows and higher highs are going to be something to look at whenever you're reading your uptrend. Let's over to the downtrend. All right, let's go ahead and talk about analyzing the downtrend. So when you're analyzing a downtrend, you want to be looking for lower lows and lower highs. Okay, so let's go ahead and let's talk about it. So let's say price decided to super top out right here. You know, it had a good run. It's been uptrending for a while, but since then, it's been trying to head down to the graveyard. So let's analyze and break down how you can catch trades when price is heading in a downward cycle. So you can see price here created an ultimate area of resistance. And resistance is just going to be an ultimate area where sellers are coming in. Okay, sellers are coming in to this area since price is falling down. Then you're going to have price making bottoms. Okay. Once again, that's going to go ahead and be areas of support. Support is going to be an area where buyers are going to be stepping in. Okay, you're going to have support and then you're going to have resistance. They both correlate. And the cool thing about them is resistance sometimes can be broken and turn into support. And a lot of the time support can be broken and turn into resistance. Just as resistance can mirror another area of resistance, even if price decided to previously break it. Say, for example, price decided to create an area of resistance here. Price broke it, came down. Price could still come up and short at that resistance again. Same thing with an area of support. Price decided to come up, break below the support.
price could come above the support and pull back at the same support again. Okay, price is very reflective over what happened in the past. Okay. So let's go and let's keep analyzing. So you're gonna have the area of resistance where price decides to fall downwards from, and then you're gonna have the area of support where price decides to bounce in an upwards direction from. Okay. Both important areas to look at. So resistance, just like I said, can sometimes be broken and turn into support. Support can sometimes be broken and turn into resistance. Okay. Keep all that in mind. And put it all together on the charts. So a lot of times when I'm downtrend shorting, I'm looking for two things. I'm either waiting for an area of resistance. I don't even care if it's in the past, to meet up with an area of resistance, and I'm taking it again. Okay. Or I'm going to wait for an area of support to be broken and turn into resistance. Okay. So let's find an example here. So let's say price decided to make this area of support right here. Could see price decided to make this mini bounce after a heavy downtrend from a while. Okay. After that, price decided to hunt back up to this area. So look at this support zone right here. Price decided to bounce up for a little bit here. Okay. To this area of resistance here. Okay. And even this area of resistance right here. All right. Sometimes you'll be able to look to the left and be like, okay, I see why resistance was created here. Okay. So for instance, if I drag it all the way over here, we can look to the left and we could try and piece things together and see, okay, was there any price action that reflected? So I could see this area of resistance here. And if I zoom in close, I could see another area of resistance right here. Okay, so stuff doesn't just happen for no reason. You could see the two areas of resistance both cause price to fall downwards for a while. Okay, very, very reactive market. So stuff even from years, months ago, okay, could be reactive. And even right here, price decided to create support. Price broke it and turned it into resistance. Support right here got broken, turned it into resistance, and then price headed in a downtrend. That's going to be one of my favorite ways to downtrend. Is going to be waiting for support to get broken and then waiting for price to run back up to it and turn it into resistance. A lot of the times, if you see that, it's going to be a really, really good short or a good time to short. And even if you see two areas of resistances meeting up with each other, it's going to be a good area to short at as well, too, a lot of the times. Okay, but be careful with that, especially during uptrends. You don't want to get caught trying to short something that's not meant to be shorted. That's in a clear uptrend because you're just hunting for something. Okay, so that's why I like to wait for support to get broken and turn into resistance cleanly, whether it be it on my daily. A lot of the times I'm gonna wait for it on my daily because that's gonna give me the cleanest structure and what I'm actually looking for, making sure it's confirmed. Because I don't want to be taking any type of nonsense trades. Okay, you don't want to be wasting your funds. You don't want to be wasting your time. You want to try and take the trades you know are going to be making you good money. Okay, and waiting for confirmation is also going to be really, really important too. So just as you're waiting for, let's say, an uptrend, I like to wait for 2 to 6 daily candlesticks going in an upwards direction to the right. If I'm waiting for a downtrend, I'll wait for 2 to 6 red candlesticks going down just to make sure. Okay, I don't buy the first immediate reaction a lot of times because I don't know if it's going to be completely true. So let me go ahead and pull up an example here on natural gas. Okay. So even here on natural gas, we can see price farming this downtrend here extremely, extremely heavily. Okay. And certain trades can be found by just being patient, okay, analyzing the market, and really just taking your time. So even right here, take this area of support. That was very important. I like to look at very important areas of support, especially on my higher time frames. You can see price decided to break below it. We could see a daily wick right here. After that, I got one red candlestick, 2, 3, and then we got price heading in a downwards direction. Okay, from there. Okay, and you could have did take profit at like this support here, or even this support right here. Okay, and caught that good trade down. Could enter down here, take profit here, and that will give you about a 1 to 2. Yeah. So taking your time with the setups and analyzing everything, it's really going to be important. And when you're downtrending, a lot of the times your take profit is going to be either an area of support above current price or below current price, not above, an area of support below current price, or an area of resistance below current price too. Because just like I talked about, resistance can turn into support. So when you're shorting, your take profit can either be resistance or support. Same thing if you're uptrending too. So yeah. So say here, price decided to create a little buy zone right here. Price bounced in the same area 3 different times. Price broke it, and then price hunted all the way up to it, shorted, and then gave us 1 red candlestick, 2, 3. I like that a lot. You could have did take profit at like this support right here, and you could have went ahead and caught your trade. Okay. Boom. Could even take profit down here. And then the amount of days this would have took, you can use your rulers from on trading view. You can start on the resistance, drag it to the support. It took about 90 days, but that would have been a real account flipper. Okay. A lot of the times it's not about getting a trade over and over and over and over again. It's about just taking a couple of good trades. Okay. A month, a week, or even a year sometimes. Even if you did it right here, this resistance to the support took about 14 days. So if you did a smaller take profit, it would take less time. So yeah, so cool. That's gonna go ahead and be that. Stay praying to God, keep grinding. Catch you guys in the next one. I pray this helped. Head over to stackmode.net for all trading education. Peace. Class, let's talk about crypto arbitrage trading, the pursuit of risk-free profit in digital markets. Welcome to the lecture. Welcome to Stackmode, and let's jump into it. So the essence of arbitrage. Arbitrage is fundamentally the practice of simultaneously buying and selling an asset in different markets to profit from a temporary difference in price. It's the closest thing to a risk-free profit and opportunity in finance. And in the cryptocurrency space, this occurs because the global market is highly fragmented, with hundreds of independent exchanges that are not perfectly synchronized their prices in real time. This creates transient imbalances within the cryptocurrency community. So arbitrage is not about predicting the future prices, right? That's going to be speculation. It's about capitalizing on the current now price discrepancies for the same asset at the exact same time. So why do discrepancies exist in cryptocurrency in the first place? So latency and speed. Network delays mean that a price change on one major exchange reflect on a smaller, slower exchange. And this tiny window is the opportunity that people use in order to capitalize on some profits. So let's talk about some regulatory and geographic factors. Differences in regulatory frameworks or capital controls in various countries can cause persistent price differences. The community premium is a classic example. And liquidity differences. Exchanges with low trading volume might have larger bid-ask spreads, leading to minor price offsets compared to high volume exchanges. And we'll talk about transfer fees and withdrawal delays. The cost and time associated with moving capital between exchanges also contribute to price gaps that need to be larger to be profitable. So the foundation, let's talk about simple exchange arbitrage. So the two exchange model. And this is the most straightforward form, involving just two exchanges and one asset. For example, Bitcoin, all right, also known as BTC, BTC USD. The goal is to exploit a direct price difference. So step one, right? So this is how you do it. For example, you would buy low and simultaneously place a market order to buy one Bitcoin on exchange A, where the price would be $50,000, for example. And then step two, you would sell at high. At the exact same moment, you would place a market order to sell one Bitcoin on exchange B, where the price is $50,050. And result, a gross profit of $50, okay, and less trading fees and withdrawal costs. Okay, so capital allocation challenge. For this strategy to work instantaneously, an arbitrage must have the capital prepositions on both exchanges. This is known as the capital risk or funding issue. So the required capital setup. You must have the fiat currency, for example, USD, okay, dollars, stable coins, etc., ready on exchange A to buy, and the asset, for example, let's say you're buying Bitcoin, ready on exchange B to sell. If you have to transfer the asset after buying, the price gap will likely close and the opportunity will most likely vanish. And due to razor thin margins, the speed required, this strategy is almost exclusively executed by automated trading bots that operate in milliseconds. So the advanced strategy, right? Triangular arbitrage. So 3-active cycle. Triangular arbitrage all occurs on a single exchange and exploits inconsistent pricing between 3 different currency pairs, creating a closed loop trade with a net profit. The core idea is that the implicit exchange rate calculated from 2 pairs does not match the exchange rate of the third pair. And the path. Example, using USD, Bitcoin, and Ethereum, and trade 1 to start it. Okay, so you would start by converting your crypto currency. Let's say, for example, let's say your starting currency would be USD to Bitcoin. Okay, so turn your fiat currency into cryptocurrency. Okay, so via the BTC USD pair. Okay, you could also turn your cryptocurrency into cash as well too, and do the same thing by whatever asset you want. Let's say you wanted to do Ethereum too. Okay, and the midpoint, you would convert the final asset, all right, or the first asset, that would be Bitcoin, to the second asset, for example, Ethereum, okay, via the ETH BTC pair. Okay, so you can use a cryptocurrency to swap it to different cryptocurrency pairs as well, or use your cash to do cryptocurrency and then buy the pair that you want. And you convert the second asset, such as Ethereum, back to your starting currency for your USD via the Ethereum USD pair. So the margin requirement and the speed of this. For the trade to be profitable, the final USD amount must be greater than the initial USD amount after all 3 trades and associated fees are deducted. And why this is faster? Since all 3 transactions happen on the exchange, the trade can be processed much faster than moving assets between exchanges. And this makes it a primary focus for institutional high-frequency trading. Okay, which can be a good thing and a bad thing because that can bring up bots as well. And this strategy is highly dependent on sufficient liquidity for all 3 legs of the trade to ensure that the bot can execute its large volume orders without slippage, which is the change in price due to the order execution itself. So the frontier, right? DeFi arbitrage and flash loans. So let's talk about DeFi pools and DEXs. Decentralized finance, which is DeFi arbitrage, involves capitalizing on price differences between different automated market makers, also known as AMMs, like Uniswap and SushiSwap, or between a DEX and a traditionalized central exchange, okay, also known as a CEX. And let's talk about the liquidity pool inefficiencies. Prices on DEXs are determined by the ratio of tokens in liquidity pool. And when a large trade happens on one DEX, the ratio shifts, creating a temporary price difference relative to other platforms. And there's going to be a gas war, right? So gas in the cryptocurrency world equals fees. So when you see the word gas, think of fees. So a gas war. A significant risk here is the cost of gas, right? The network transaction fees. And arbitrage. Bots must bid high gas fees to ensure the transaction is included in the next block faster than their competitors, okay? And nice writing here. And the game changer, right? Flash loans. So flash loans are a novel decentralized finance concept that allow a user to borrow any amount of uncollateralized assets, provided liquidity is available, so long as the funds are borrowed and repaid within the same blockchain transaction. So let's talk about some zero capital arbitrage. Flash loans enable an arbitrator to perform a large-scale arbitrage without needing any initial capital. The bot executes the buy low, sell high sequence, and then repays the loan plus a small fee, all in one automatic transaction. Okay. And if the transaction fails for any reason, for example, if price moved, the loan is automatically reverted, eliminating execution risk. So the automated life cycle of an arbitrage trade. So opportunity scanning, right? We can go watch it. So the bot, right? Having a bot, especially as AI progresses and things like that, the bot continuously monitors real-time price feeds across depth exchanges, calculating the net profit after all fees for every possible pair or triangle. And it seeks a spread that is going to be wider than the combined cost of trading and transferring the funds. 2, trade evaluation and execution, the trigger. Once a qualifying spread is identified, the bot initiates the simultaneous execution. And for interchange arbitrage, this means sending API calls to both exchanges at the same moment. And the execution must be extremely fast to beat other bots. And let's talk about the settlement and rebalancing, right? The closer. So after the trade fails, the arbitrage now has an imbalance of assets. For example, more Bitcoin on exchange A or less on exchange B. And the final step is often transferring the net profit back to the seller account and rebalancing the capital for the next opportunity, which incurs more fees. So the necessity of automation for arbitrage, the bot stack. Manual arbitrage is essentially impossible in modern markets. An entire process relies on sophisticated low latency software, written primarily in languages like Python or C++, and the API integration. Bots communicate directly with exchange APIs, application programming interfaces, right? That's what API stands for, to retrieve real-time order book data and submit orders. This bypasses the slow web interface entirely. And collocation. Professional arbitrage often host their bots physically close to the exchange servers, known as collocation, and to shave precious milliseconds off their network latency. And high frequency data. The bot must process tens of thousands of market data updates per second to stay. And algorithmic sophistication. The net profit calculation. A good bot doesn't just look at the price gap and must factor in variable market maker fees, taker fees, slippage estimates, and potential withdrawal transfer fees to calculate the true expected net profit before initiating trade to make sure that's worth it. And the competitive landscape is going to be fierce as more capital flows into arbitrage and the profit margins are driven closer and closer to zero. And this creates an arms race of technology and speed and execution efficiency. So 1, the execution risk, right? The closure. So this is the biggest threat. The arbitrage opportunity often disappears before the second leg of the trade is filled. If you buy low on exchange A, but the price on exchange B drops before your sell order executes, you are now holding the asset at a loss. This intended simultaneous nature of the trade hasn't failed. So 2, slippage in the costs, right? Arbitrage profits are often less than 0.5%. If an exchange increases the trading fees or if a large order causes slippage, just filling in at worse than expected price, the small profit can instantly turn into a loss. And arbitrageurs must strictly track their trading tiers and fee schedules to make sure that the trade is going to be worth it before they put on some size. So withdrawal and funding risk, right? The weight. For inter-exchange arbitrage, the capital needed to rebalance the accounts, right? So moving the final asset back to the original exchange can be tied for minutes or hours due to blockchain confirmation times or exchange enforced withdrawal limits. This is known as going to be opportunity cost. So walking through a hypothetical Bitcoin trade, right? Let's say on exchange A, you bought low. Yeah, let's say the Bitcoin USD price, 60,000, you have 100K available, $100,000 available. USD, fiat currency. Now on exchange B, you would sell high. Okay, on exchange B, the Bitcoin USD price is 60,050. Okay, and you have 1 Bitcoin available. And for the fees and the spread, for the trading fee on the each side, right? So trading fee, 0.1%, and the gross spread would be $50, right? So the buy cost on A, be buying 1 Bitcoin for $6,000. Okay, take the trading fee times 0.001. Okay, so 60. Sell 1 Bitcoin for 60,050. Okay, and then same thing with the other trading fee. That'd be 60.05. Okay, 60.05 plus 60 is 120.05. gross profit, okay, and that's just going to be the total fees paid. Okay, so that's the calculations you do to get the fees, and then your gross profit would be $50. Okay, the gross profit minus the fees, then boom, you see the arbitrage fail due to fees, making the trade not worth it. So sometimes fees can destroy your profit. So keep it in mind about that. Even if you're a day trader, spamming trades, stuff like that, especially if you're losing, can increase your losses. And certain fees depend on certain brokers or exchanges. So check them out, depending on whatever you trade on. It's not going to be the same everywhere. And arbitrage is only profitable when the gross spread significantly outweighs the total cost, right? The fees and the slippage. The threshold must be met first. Okay. So the evolving landscape and the challenges ahead. So the market efficiency. The long-term impact of successful arbitrage is the increase of market efficiency. Arbitrage and a pursuit of profit automatically correct the price imbalances, forcing the market to converge on a single fair price. Okay. So reduce volatility. By buying low and selling high, arbitrage stabilizes prices and reduces unnecessary volatility caused by large temporary discrepancies. And fair pricing is involved, and ensures that retail traders, which means just non-bank traders, just individual traders pretty much, are less likely to buy or sell at an artificially poor price. And the competition and innovation. From HVT to MEV, the focus has shifted from simple inter-exchange arbitrage to complex, low latency strategies like minor plus maximal extractable value, right? MEV, arbitrage on the blockchain networks. Blockchain is going to be the cryptocurrency network where people can go ahead and trade. Okay, it's going to go and check all the transactions and manage everything via smart contracts. Okay, so unlike a bank system where money goes from person to the bank where they confirm it, and then the person, cryptocurrency, happens to work on a person-to-person system. Okay, making it one of the most dominant systems in order to send money or receive money. And as global crypto markets mature and become more interconnected, traditional arbitrage opportunities are shrinking, and success now requires cutting-edge technology, faster network access, and highly sophisticated risk management algorithms. And the race for speed continues to define who profits and who loses in the zero-sum game of crypto arbitrage. So summary of arbitrage trading, right? Arbitrage is the simultaneous trading of an asset to exploit temporary price differences for risk-free profit. It's not speculation, but rather a corrective mechanism for market inefficiencies. If you have enough capital in the initial, it'll be profitable. And types and methods. Okay, so we covered inter-exchange markets, right? That's the two markets, triangular, three pairs, okay, and one market. And DeFi, which stands for decentralized finance, using flash loans. And they're all highly dependent on extreme speed and technological automations. And the reality of risk. While theoretically it's risk-free, execution risk, high transaction fees, and slippage can easily eliminate the tiny profit margin, turning a potential gain into a guaranteed loss. And automation would be mandatory for success most of the time, inshallah. Okay, so I pray to God, keep grinding. If you want to learn how to trade cryptocurrency, head over to stackmode.net. Peace. All right, let's go ahead and talk about how we can go ahead and make income by trading options. It's going to be a simple guide, an easy guide, and we're going to go ahead and break down the fundamentals of why stocks go up in the first place, what options is, and how we're going to use this whole logical formation to make some money. So one, let's talk about what an options is in the first place. So an option is going to be a contract that lets you trade 100 shares worth of value. Okay, so it's pretty much going to be a leverage asset, and it gives you the power to trade 100 shares per options contract. So if you don't have enough to buy 100 shares, but you have enough for an options contract, then you'd be playing with the power of having 100 shares. Now, the best way to play options is to take advantage of the time. Okay, so on options, you're not just getting 100 shares to play with 100 shares, you're playing against time as well too. So on options, you get paid based off predictions. Okay, so whenever you're buying an options contract, you're thinking that price is going to go to a certain direction, and if it hits it, then you make money. So it gives you the ability to play with 100 shares worth of product. Okay, whatever stock you play with, one options contract equals 100 shares worth of pretty much leverage. Okay, but the downside to it is that there's going to be time. Okay, so unlike shares where you can sit there and hold forever, options contracts actually have expiration dates. So these expiration dates will trigger whenever the expiration date hits. Okay, so we'll talk about that as time goes on. Every option expires on a certain date. Now, there's going to be two ways you can play options. Okay, you're going to buy a call option, and then you're going to have a put option. So you have a call option and a put option. So call options we're going to play if we think price is going to go in an upwards direction. Okay, so if you think price is going to go up, let's say current price is currently at 26 and you think it's going to go to 28, then you would buy a call option. So call equals up. Okay, if you think price is going to go in an upwards direction, you'd buy a call. Okay, think of a call like, what do you do when you call somebody? You pick up the phone to call somebody. So pick up to call. So up equals call. And a put equals if you think price is going to go down. So if current price is at 26, you think it's going to go down to 24, then you will buy a put. After you're done picking up the phone to call, you put down the phone. So think of put down, you put down the phone. Okay, so you're going to be putting down the phone. Okay, so putting that into logistical reasoning, let's go and let's keep talking about certain things. So the stock market, okay, so options give you the ability to buy 100 shares. Okay, you're going to buy 100 shares. And I like to look at the market all the time on my higher time frames. Okay, so the higher time frame that you're looking at the market at is the real answer. Okay, so I like to look at the market on 3 time frames I'm going to be focusing on for options. I'm going to be focusing on the weekly. The weekly time frame is going to be my full eyes for everything too, and so is my daily. Okay, so the weekly and my daily, my higher time frames, they're going to give me the true price action. See where true areas want to be created at and where true areas want to continue towards. Okay, instead of me being tunnel vision on the smaller time frames, on the minutes, getting told a completely different story. Okay, we can use the weekly and we can use the daily to put a logical trade into perspective and win. Inshallah. Okay, then after the weekly and the daily, we can go ahead and go to the 4-hour time frame. Okay, so the 4-hour time frame is going to be the last time frame that we're going to go on. And the reason why we're going to use our 4-hour time frame is that in the bottom right, there on your trading view, wherever, you're going to see something called extending trading hours. Please make sure that that is enabled. Okay, setting trading hours is going to let us see every single candlestick that we need to see that we can't normally see on the daily or the weekly, since the daily and the weekly time frames don't show pre-market or like the weekend stuff sometimes. Okay, so in order to see the full picture and make sure we're seeing everything we need to see, we're going to do top-down analysis. We're going to go from the weekly to the daily to the 4-hour. Okay, from the weekly to the daily to the 4-hour time frame. Okay, and that's what we're going to do. Okay, weekly, daily, 4-hour. Okay, making sure we get the whole perspective and picture. Now, let's talk about why stocks go up in the first place. So stocks just don't go up to go up. Okay, stocks go up for a certain reason. Okay, one, these stocks fuel the economy. Okay, and what the economy is pretty much jobs, money, and just what's going on within the United States. Okay, so these stocks fuel the United States economy. They put jobs within the market. Okay, and jobs lets people feed their families. Okay, and it also generates money for the economy too. The more money companies are making, the more taxes they get to pay to the government, thus boosting the government economy. Okay, so these companies aren't just random companies. Okay, people work at AT&T, people work at Amazon, people work at Wells Fargo. Okay, there's people who work on these actual stocks. Okay, and you might even be working at one of these stocks at some point in time. Okay, there's people who work at Chevron. Okay, people who work at these stocks. So these stocks employ people. Okay, and in order to employ people, that means a company has to be making some money. And if a company is making money, that means they're paying taxes to the government, which is helping out the economy. Okay, so stocks have an invitation to go up in an upwards direction. There's also going to be these things down here, which you're going to see the blue D's. Okay, the blue D's at the down here are going to be called dividends. So whenever a company is profitable and it starts making money, what it's going to do is anyone who's investing into it, they're going to give them some money back. So the whole reason why companies put stocks on the stock market anyways is because of the fact that they want to generate some more money for themselves. Okay, so they're going to generate more money for their company by having people invest into them. Okay, so instead of begging for $1,000, they're going to just put their company on the stock market and have 100 million people invest $1,000. Okay, which is going to be a lot better. Okay, and then from there, after they use their profit to do whatever they need to do, whether increase company production, hire more people, pay more people, etc., they're going to go ahead and pay what's called dividends. Dividends are going to be money that they pay out to the shareholders. If a company has enough money to pay out people who aren't even employees, but they can pay out its investors, that's a really, really, really good sign. Okay, a good sign that the company is making money, okay, and that the company wants to continue in a positive direction, most likely. Why? Because it wants to take care of its investors and wants people to keep investing. It's just paying people for no reason. Okay, there's a reason why they give those dividends out. Okay, they want people to keep investing. Like, come on, we'll pay you guys to invest into us. And then they're going to take that profit, do what they need to do, and then go ahead and make their trade and do what they need to do based off of that. Okay, so let's go and let's talk about hopping on the chart, what we need to do to find a setup, and the type of setups I like to take in first place. So I'm going to start off with the type of setup that we just don't take. Okay, so the type of setup that we don't take is where we don't really take trades when they're all-time highs. Okay, so if market's at all-time highs, that's not something that we want to trade. Okay, so all-time highs means that market, it doesn't really have much further it can go in upwards direction. Okay, so when market's at the tippity top, okay, it can't really go anymore. We're gonna stay away from that until market decides to come down. Okay, so even here on Google here, okay, and I'm gonna always start off on my weekly time frame. Okay, so I'm gonna look at the highest area of resistance all the time. Okay, so once again, these companies employ people too. Okay, they're competitive, and one way companies can be competitive is by having the highest share price. So if one tech company has a higher share price than the other tech company, it's going to clearly show that one tech company is more valuable than the other. Okay, share price is going to show how valuable something is. And this is a competitive world. Human beings, we're all competing with each other for the best spot. Okay, and there's people coding many hours behind these companies, working behind these companies, investing. So they want to see their share price go up so they can increase their revenue. Okay, and pay out more to their investors, which is going to signify people to invest into them back more. So it's a full circle plan if the share price goes up. A lot of advantages. But what I'm going to stay away from is when price is already near all-time highs. Okay, I can see there's not much of a gap here left to the all-time highs. There's around 5 points left, okay? So even if I did take this trade here, okay, which would be possible, I know that price wants to always break all-time highs. Why? Because it's a competitive market, once again. Price has incentive to go in an upwards direction. So that's why for options, I'm only going to be focusing on call options. That's all we're going to be playing. If you're playing the United States stock market, you should only be playing call options. There's no reason to short the market. You could just buy something else that already made a low. Okay, so you could see Google decided to make this low down here based off of this area of support right here. And we're going to jump into exactly what that is. And then price decided to bounce in a upwards direction. Okay, and we know where it's going. It wants to meet up with this area of resistance and try and break it. So just like we know, areas of resistance will either try and reverse or break. Same thing with support. So we can see support decided to bounce at the same place twice. And what support is, it's going to be an area of demand. Okay, once again, we're going to be looking at everything on our higher time frames too. The weekly, the daily, and the 4-hour are going to show you the true key areas of support and resistance. So support, it's an area where buyers are, and it's going to signify demand. People want it right there, okay? And buyers are stepping in. So support has the ability to mirror itself like that. Price decided to bounce in upwards direction at one area of support. Price came all the way down and bounced at the same area of support again. Okay, that's how simple market can be. Okay, 2 areas of support being bounced at, and then price decided to go in an upwards direction. And then we could see here, price stopping at this area of resistance here. Okay, price fell down once, fell down twice, Okay, and it tried to fall down the third time, but now we're trying to get above it. Okay, so we came up here, fell, came up here again, fell, came up here again, fell, and now we're trying to break above it. Okay, so just like areas of support can bounce on each other, we also can have areas of resistances bouncing on each other. Okay, so even if market decides to run through it, market can still repeat an area. Let's talk about what that means. So say price decided to bounce at an area of support. Even if price broke the support, if price came back up and then bounced at the same area of support again, that would still be a good area for me to go ahead and purchase because it's doing the same thing. Same thing with resistance here. Okay, if I was taking a certain example like this, okay, then you could see price would still potentially mirror what it needs to, even if it ran through the original one. Okay, so, and that's gonna be the same thing said with break and retest too. So price formations will always look like a mirror. Okay, it'll always look like one of these things. Okay, it'll either bounce at the resistance twice or bounce at resistance twice like this, even if it ran through in the middle, or bounce at support immediately, one support into the next, or support, run through it, and then bounce at support again after it comes back above it. And then we have the ability for price to take the area of resistance, wait for price to break it, and turn it into support. Okay, and then wait for price to go in the upwards direction. Okay, so support can be broken and also turned into resistance. Okay, so this is mainly the setup we're going to be focusing on though, since we take calls. So we're going to be waiting for resistance area to be broken, and then we can wait for that area to turn into support. And if so, we can take it up if it's probable. Or we're going to take a support mirror where price is just going to bounce at certain low like this and then bounce again. Okay, making it extremely easy, making it easy to be successful within the market. Okay, so the reason why we're closing at areas of resistances is because these are where areas can reverse at. If we're buying a call option, that means we're expecting price to go in an upwards direction, just like the workers are, just like the competitors are, just like the CEO is. Okay, they all want their stock to go up. Okay, so it's a bunch of people who want the stock to go up versus down. The CEO doesn't want it to go down. The employees don't want it to go down. We don't want it to go down. Okay, so that's more people who don't want it to go down than there does. And the government doesn't want it to go down. Because if these companies can't stay alive, the economy would suffer. Who's going to bring our Amazon packages? Okay, things like that. Okay, these are important companies that run the world. So price is either going to bounce at areas of support, okay, or it's going to fall down at areas of resistance. Okay, and why price decides to fall down at areas of resistance is because there's too much supply. Okay, there's way too much of it and people want to sell off. Okay, they're already up a bunch of money, and it's going to indicate an area where sellers are going to be at. Okay, so resistance indicates that's too much supply, so people are going to go ahead and sell. Okay, they got in way down here. Of course, they're going to go ahead and sell. It's a left to right chart too. Okay, so people got in way back here. Of course, they're going to go ahead and take profit eventually. Okay, so whenever you see market going down, all it is people taking profit, taking their money off. Okay, and since I know price wants to keep going in an upwards direction, since the CEO, the employees, and we want it to too, and the government does too, I like to only take trades when I have resistance above current price, so price has something to travel to. Okay, and even if price decides to reverse at the area, okay, like it did over here, even if price decides to reverse at the area here, 1, 2, and then 3 times, right? One time, eventually, inshallah, it'll break the area. And if it breaks the area, it's going up to the next area of resistance. And it'll try and break this and maybe reverse here. Okay, and then break this, maybe break and retest and continue on. But price always wants to do one of two things when it comes to the stock market. It wants to always try and chase an area of resistance above current price to either reverse at it or break through it. Okay, so we're always going to be chasing an area of resistance above current price or an area of support above current price. Okay, because we know, just like we talked about, support can turn into resistance. Okay, so price might need it to come up to the support, turn into resistance, and then break the resistance. Okay, but we know price at least wants to go up to the area of support above current price to maybe turn it into resistance, so price can go down further, collect ammo, make a new low, and then break the previous area of resistance and support, making it line up with the new area of resistance. Okay, so that's how things work. Now let's go ahead and jump into some setups. Okay, so what I'm going to go ahead and always do is start off on my weekly time frame. But I like to start off on my weekly time frame, and we'll go to 10 through 100. Okay, so criteria I'm going to be looking for. Okay, this is not fit criteria. Okay, this stock right here, it's at all-time highs. So this is why I start off on my weekly time frame. If I zoom all the way out, this is the highest point of the market. Why would I buy at the highest point of the market? So I can eat the whole dip down and then be in the red? No, we're not going to be doing that. Okay, we're just going to go choose something else. You do not want to be buying at all-time highs, because if you're on drawdown getting pulled back on, you're going to be upset. So we're not going to buy at all-time highs. What we're going to do is make good, logical decisions, and we're going to be patient. Do not buy at all-time highs, okay? Unless it's Bitcoin or something like that, do not buy at all-time highs. Do not do that, okay? And even with things like that, I don't even recommend all-time highs, but some things you're investing into to just stack cash, okay? You don't really care where you buy. You're just using it to stack cash. You know, price is going to try and break it, or just using it more of like a savings and stuff. But when it comes to your options plays, you have to be extremely precise. Do not buy at all-time highs. Try not to buy anything at all-time highs, because yes, price can continue upwards if it wants to, but since there's no resistance or support above current price, you don't know how high it wants to go up. So you're pretty much just gambling, because there's no structure up here. You don't know where it wants to travel to. You don't know where it wants to stop at. And you're pretty much making random miscellaneous decisions that you just don't want to be making, okay, within a market that can be played if you just play it correctly. Okay, so all-time highs is one thing I'm going to go ahead and ignore. I'm just not going to take that. So I'd rather take something like this, for example. So I'm going to be on my weekly time frame. Okay, and once again, I know price wants to always chase areas of resistance above current price. Okay, so I can get on my weekly time frame and I can see this area of resistance above current price. I'm going to go to my daily, okay, and I can see the area of resistance up here being created, okay, before price decided to fall down. Okay, even if I want to do this area down here, okay, this is the whole area of resistance right here. Okay, we have this area of resistance right here, and then we have the area of resistance right here. Okay, so I can wait for price to easily just fill in this gap here. Okay, and how do I know it's ready to fill in the gap? So this is one thing I'm going to pay attention to. Look at the low. Okay, so on your weekly and your daily time frame, if you see price made a low already, okay, you can see price here making a low. You see price making a low. And one thing we're never going to do, okay, so you could say we have one area of support here, and then I have one area of support here in the same exact area. One thing we never want to do is buy in the zone, okay? I would wait for a candlestick to get above the zone, okay? Whether it be on my weekly, my daily, okay? I'm going to wait for a candlestick to get above the zone. So if I see price bouncing at this area of support, right? And then I see price coming down again. So we have this area of support here too. And then let's see I have price coming down here again, right? To bounce up. I'm not going to buy the first candlestick in the zone. Okay, this candlestick right here in the zone, I'm going to ignore it. I'm just not going to play this one. Okay, because it's in the zone. What I'm going to do is wait for these candlesticks above the zone. Okay, these candlesticks are above this gray box where these bounces are. Okay, because I don't want to buy and then see it wicking and then get dumped down on. Okay, no. I'm going to wait to see if, like, okay, price actually wants to confirm the support. Even if you got to wait a couple of days, see if it wants to happen. Okay, just because you didn't get the super low entry, don't cry. That's not money you're missing out on. If anything, this is better. Okay, because it's just showing you that price wants to confirm itself. Now you can clearly see this whole rest of this gap up here is straight profit. Okay, straight profit. From here, price already made its low. You're playing an upwards chart. Okay, Coca-Cola, there's plenty of people who work here. Okay, and price most likely wants to go in an upwards direction here, or already created a low. So this whole area of profit up here until the area of resistance, and we're going to close the area of resistance because price could fall all the way down even lower if it hits that area of resistance. So we know price wants to at least hit the area of resistance. It could either fall down there or it could break out above. But either way, it wants to hit there to see what it's going to do. So we're going to take advantage of that, and that whole gap up until the area of resistance, okay, is what we're going to go ahead and take and what we're going to go ahead and trade. Okay, and we're going to take that up to the upside and use that as the remainder of profit. Now, for the contract, okay, so for instance, I will come over here. So as of when I'm recording this video, it's October 2025, right? So I like to buy at least 3 months to like 2 years out. Okay, so to be safe for this trade, okay, since I found my trade on my weekly, I would go ahead and buy a year out. Okay, about. So this is how I know this is the best contract to buy. I would look in the middle, wherever current price is on your options contract list. You're going to see current price. Whatever the one above the current price is going to be the best contract to buy. I don't care if your take profit is all the way up here. Okay, whatever the one above the current price is the best contract to buy. And the reason why is because on options, you're getting paid based off predictions. So if you think price is going to go to 70, okay, but you buy a 67.5, okay, it's going to be all bonus points. 68, 69 are going to be all bonus points because you're closing at 70, but your prediction that you bought is 67.5. 67.5 is before 70. So that is going to help you make a lot more profit if you buy certain what I call bonus plays contract. Yes, they're going to be more expensive, but it's going to be more worthwhile. You never want to be cheap in options. Okay, being cheap in options is a good way to just destroy money. Okay, we never want to be cheap. If we don't have the profit to buy a contract, we either play something else or we get into stack mode, collect some more funds, and try to buy another contract. Okay, that makes more sense for us to purchase. Okay, so if I take 67.5 here, and I'm going to go ahead and pull up my price chart. Okay, so this is going to be the options price chart here. So the options price chart is going to show me how much the options contract costs and how much I could potentially make if it hits certain areas. So I could see here, price decided to make this certain low. So just like the actual chart, price made a certain low. Okay, it made this tiny low. And then I could see this candlestick right here. And then price decided to bounce in an upwards direction. Guess what? Price came back down into the same exact low. And it looks like we're trying to go ahead and fill in the area of resistance. Okay, so even on the price chart here, price is looking like a V. So what we want to be doing is just playing V formation, okay? And we're going to be waiting for price to meet up with these areas of resistance over and over and over and over again. Okay, it's really just about making trading simple, not making it difficult, and just taking probable setups. So when you get on the price chart and your price chart looks exactly how your chart looks, that's a really good sign. Okay, that's a really good sign. That's going to let us know that, okay, market might want to actually do what it needs to do. When you start seeing a V formation and a curl, that's a really, really, really good sign when it comes to buying in the upwards direction. Okay. So even Cisco here, for example, okay, I can see all-time highs up here. Okay, we're not quite at all-time highs yet. So let me go to my daily time frame. I can zoom out. Okay, I can see price decided to make a low right here. So price made a low right there, and let me go to my 4-hour time frame and see everything. Okay, so I could see price made this low here. Got on my daily. Okay, I could see a candlestick above the zone. Okay, multiple 4-hour candlesticks are going up. Okay, so even if I bought right here, okay, I know, inshallah, God wills, price wants to have resistance get meet up here. Okay. So even if price were to do something like break and retest off of this resistance over here on the 4-hour, or if it mirrors this area of support over here. Okay. So we can see I have some tiny 4-hour resistance here, which turned into support. And then just like we talked about, even if support gets created, price gets ran through. Okay, you could see price ran through the support here, and then price came back above it and bounced on it again. And then price came back above it and bounced on the support again. Okay, you're gonna be able to see it right there. Okay, so that's letting me know that, okay, price is bouncing in the same area of support twice. Okay, still a support mirror. So even if I wanted to take the trade there, that would still be fine. Okay, and I could go ahead and close it at the resistance all the way up here at all-time highs. Okay, so it's still, let me get my ruler. pull it out, I still have around like 3 points left. Okay, so here I could do the same thing. I would still buy a year out just to be safe. And I can see on my price chart here, price already made a certain low. Okay, and I can see price wants to try and fill in this resistance gap right here. Okay, and that's gonna go ahead and just be our profit, the resistance gap. Okay, because you know price wants to try and break this area. Okay, it's gonna either try and reverse at this area there, okay, or it's gonna try and break out. Okay, that's just what it's gonna do. It's either try and reverse or break out. So even right here, take steady group here. Let's say I have price down here. Okay, I could see price decided to make a low. Okay. Price decided to make a low right here. And then it made a low. 4 hour. Okay. Have this area of support here. And then I have this area of support over here as well too. Okay, so I have triple area of support here. Boom, another area of support right here too. Actually, I'll say just double. We'll delete this one. So I have this double area of support here. Okay, so support being bounced off of once, price went in upwards direction, and then price came down again in the same place, gave me a daily close. Okay, so we have the first one, and then we have a daily close above the zone. So even if I wanted to buy right here, okay, I would go ahead and be able to catch the rest of the gap up to the resistance area up here. Okay, and catch the remaining of the 5 points. Okay, so price is always going to try and hunt this area of resistance. It might not want to break out immediately. Okay, price could definitely hit this resistance and fall straight down. But we don't care because we close at the resistance. Okay, so as long as you close at the resistance, you're going to be good, or support above current price. Okay, so take this trade here on knee. So I marked this out a couple of weeks ago here too, and let's go and let's chat about it. So we can see price here. Price decided to create an area of resistance twice at the same area here too. Okay, so let's go and let's talk about it. So price decided to, okay, let's start over here. Okay, price decided to make resistance right here. Okay, resistance is going to be the area where price decides to fall in a downwards direction. Okay, price made resistance right here. Okay, it made resistance. So resistance is an area where price decides to fall in a downwards direction. So resistance can be broken and turned into support. Okay, so resistance can be broken and turned into support. Okay, resistance can be broken and turned into support. Okay, so resistance can be broken and turned into support, which we can see right here. Okay, and that's going to give us the break and retest staircase formation, letting us know that price potentially wants to go ahead and fill the gaps. Okay, so, and then we can see up here too, price decided to fill in this area of resistance up here. Okay, price met up with this area of resistance. So even after we broke out of the area over here, price decided to make a high. Okay, price turned the resistance into support, did it again. Okay, and then price decided to come up to this area. Okay, and then we met up with this gray box of resistance before price decided to fall in a downwards direction. Okay, and now you can see we're above it to this day. But then you can see this area of support here. So resistance can be broken and turned into support, and that can be the same thing said for support. Support can be broken and turned into resistance. So you can see here you have this area of support right here to the left. So we can see price decided to break that area here. Okay, price decided to break the area of support right here and then turn it into support, turn into resistance. Okay, so support can be broken and turn into resistance. Okay, then you can see the resistance got created again over here. So especially when we're reading our chart on the higher time frames, we're going to be able to eyeball everything. Then we can see the resistance got broken, okay, and turn into support. And then we can see here, price decided to head up to the previous area of resistance, up here. Okay, and then we could see up here again, resistance got broken and turned into some more support. Okay, resistance got broken and turned into some more support, and price is going in upwards direction again. Okay, so it's just about making it simple. Okay, not making the market hard, taking good trades that we need to be taking. Okay, not taking any bonky ghetto trade. Okay, and not investing in any ghetto company. Okay, we want to be making sure that the company is making some money and is profitable, etc. Okay, so take this example. Go and pull out my watch list here. Okay, this would be something of what I'd personally like to play. Okay, so something with just large areas of gaps to be filled. So I could see here, let's take this stock for example, right? You can see price decided to make a low down here. Okay, and made a low down there. Okay, and then price looks like it decided to continue in the upwards direction. Okay, so we made a low down here. And then we made another low up here. Okay, then I see a higher low being mirrored over here. Okay, so I see a support mirror. Once again, support mirror. So even if we run through it, it's fine. Support mirror. Support. 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 Okay, support. Confirming the lows. Okay, confirming the lows. And even right here, price potentially wants to go for some break and retest. Okay, we want to see if this area of resistance wants to turn into some support here. I'm going to my 4 hour here, and we can see here. So this is why we need our 4 hour time frame. Okay, we want to make sure our extending trading hours is on. You can see the wick down here. Okay, the wick down here correlates with this area of resistance right here and right here within the zone. Okay, and then price decided to bounce in an upwards direction. So if I got on my daily time frame here, just like the other trade, I, inshallah, God wills, would be able to take it up to this area of resistance up here. Okay, price already showed me break and retest down here. Okay, I can see this area of resistance that was created over here. Okay, I have resistance. Okay, and this is going to be resistance because I can see price falling in a downwards direction from this area. Once, and then twice. Once and then twice. Okay, huge. Then from there, we could see price turn the resistance into support. And I like to get on my daily time frame, and I can see a candlestick above the zone. So I have multiple candlesticks above the zone. Okay, so now I can go ahead and safely take my trade, inshallah. So then I know price might want to meet up with this area of resistance. So it already turned the old area of resistance into support, or it already broke out the area. Now let's go ahead and let's make some progress. We're going to make some money by catching the rest of the gap fill to the area of resistance up here. Okay, so same thing. Since I'm on my weekly time frame and my daily time frame, right? You could see the area of resistance up here on the weekly too, where price suddenly just kind of went up and then came down. What we're going to do is catch the whole remainder of this block up here. Okay, we want price to trickle in an upwards direction, inshallah. Okay, this is what we're waiting for. Okay, waiting for price to trickle up. You want it to trickle up. Okay, that's what you're waiting for. So I'll go path, options, I'll buy a year out. Okay, and then I would go ahead and buy the contract one above the current price. Then I can go ahead and see price made the low down here, and then I would go ahead and be able to just wait for my play to go ahead and work out. I could set alerts where I want to close on the chart and wait for my trade. Okay, so let me go ahead and check out another example here. Okay, so even if I traded something like this, okay, I can get on my weekly time frame here. Okay, can see price decided to make a low right here, and then I see price decided to have this area of resistance created with support here. Okay, and I'm gonna go to my daily, and then I have this area of resistance here, and this area of resistance got met up with recently. Okay, so I can wait for price to go ahead and find a certain low. Okay, whether if price wants to make a low down here. Okay, even if it wants to make a low down here, or even if it wants to make a low where it's at right now. Okay, I would wait for price to come up and meet up with this area, because we could see price decided to reject at this area once and then twice. Okay, it rejected at the same area twice, and it bounced at this area once, twice, 3 times. Okay, so right now this is going to be the range that we're going to be able to play. Okay, if we go down, then we go down to a new low. Okay, and then we could try and bounce maybe at a different low and then wait for it to get to the resistance. Either way, no matter how low it dips down to, once it finds a low, it's going to try and break this resistance up here. So whenever price starts curling in an upwards direction on the daily, we can go ahead and get on our options, buy a couple years out or just a lot of months out, and then take our trade. And then take this trade here too. I marked this today. I marked this yesterday, so I can't fake this. Go. So check it. We have this area of resistance that was created right here. Okay. Once again, like I told you, price is always going to be chasing all-time highs. Okay, it's always going to be trying to break resistances. Okay, so let me go to my weekly here. Okay, I can see this resistance high. Okay, and then I have this resistance high, and price broke out. When price gets past an area of support or resistance, that's going to be called a breakout. So let me get on my daily here. I can see the breakout occurring. Get on my 4-hour. Okay, I can see the resistance got broken, turn into a support a bit. Okay, and it looks like price wants to travel in an upwards direction to meet up with this area of resistance up here. Okay, so we still have, from current price, we still have until this resistance up here, still around 3 points in order to catch the remainder of the trade. And then next take profit would be this resistance up here. And then the other resistance is up here too. Okay, then we're gonna have this one, then this one, and then final take profit all the way up here. Okay, so let price come to each of these resistance levels here. So resistance there, resistance there, resistance here, resistance here, resistance here, and then we got resistance up here. Okay, we got price passing this area of resistance here with what's called a breakout. So a breakout is when price breaks past a higher time frame area of resistance or support. Okay, and I emphasize higher time frame because that's what we want to be looking at. Okay, a lot of lower time frame levels can really just be tricks and just stuff to make you look at things you don't even need to be looking at in the first place. So you see that price wants to try and bounce to take it to the resistance. Price could potentially reverse at the resistance maybe. Okay, but for the most part, we'll see what it wants to do. Okay, so this is what I mean when I say like look for a setup here. Okay, we want resistance to be above current price. You want your take profit to be here. We can see why we're entering. Okay, either we're looking for a confirmed low or a confirmed like breakout area. I can see the break and retest got confirmed here, and I can see the remainder of the gap wants to fill into the area of resistance. Okay, so same thing here. Options, I would go about a year out, and then be able to buy the contract one above current price, and then that's going to go ahead and show me the contract cost. Okay, so if I'm right here too, okay, if I'm on AT&T, I like to go ahead and mark a zone at all-time highs, especially if I'm close, for example. Okay, and I could see the daily here making curves. Okay, so I could see price decided to make a low right here. Okay, now I'm gonna go to my 4-hour time frame, make sure it looks like what it needs to look like. I have a one low there. Okay, and then I have another low created right here near this zone. Okay, and right here. So even though it broke out down here, okay, price decided to try right here, and it's just holding it again. And on my daily time frame here, okay, one outside of the zone, I have multiple daily candlesticks above the zone. I have one right here, and then I have another one right here. Okay, 2 daily candlesticks going up outside of the zone. Looks like we want to try and fill the rest of this resistance gap here. I can get my ruler, measure the gap here, and that'll be the remainder of points I'd be able to go ahead and catch. Okay, get on my options, choose. We're gonna go a year out. Okay, and then contract I'm gonna purchase. I'm gonna look at the current price within the middle, and then I'm gonna go ahead and buy the contract that's one above the current price. And then from there, I can see here too on my contract, Price decided to make this certain low right here. Okay, price made a low and it looks like it wants to fill the V formation. So that V formation is what all your trades should look like. All options trades should look like a V. All options trades should look like just like this. It should look like an upwards V. Okay, and you should want price to fill the upwards V. Okay, fill the right side of the V. Okay, because this is a left to right chart, so the right side is always going to be the current price action. So you want the right side of the chart to be filling up the upward curve of the V. Okay, so the downtrend is going to be the left side of the V, and the uptrend is going to be the right side of the V. Okay, and we're going to go ahead and catch the right side of the V, catch the upward curve. And even if price wants to reverse here, we don't care because we caught it up to the resistance. Price could resist and fall all the way down there if it wants to. And we wouldn't care because we closed at the resistance. Okay. And then it might want to find an even lower ultimate low and then come back up. But just the fact that we know it wants to chase the resistance and see if it wants to either go lower or break out from the resistance, we're going to take that logic and just trade to the resistance. Okay, we're going to completely outplay the system. Okay, so that's going to be how to trade options for a living. Stay prayed to God, keep grinding, and that'll be the lesson.
You don't got to make trading too difficult. I'm going to show you guys an easy way how to identify trending stocks and how to catch good plays. So identifying higher lows and higher highs aren't going to require any indicators, just straight candlesticks and chart work. Let's jump into it. All right, here's going to be top to bottom how to find an options contract. So first thing I like to go ahead and do is open my trading view. I'm going to look to the very right, and I like to open up the screener. So depending on your certain account budget or size, let's say I'm playing with the $2,000 account, or if I'm playing with the $3,000 account or even $1,000 account, right? I'll stick between like the 10 to 100 range, or even if I want to, I could come up here and edit it. And I could look at stocks that have the share price between 10 to maybe 150. Okay. In this way, you're going to be able to trade contracts that are within that range or within whatever account range that you're playing. If you're trading with 5 figures plus, then you could disable this and you could trade with everything. Okay. So you could come here, manual setup, and mark your parameters depending on your account size. So let's just say for this example here, I'll come manual setup, and we can do 10 to 100. Okay. Once again, if you wanted to change it, you definitely could. Change it here, 150. So I have access to all of these stocks on the list. So these are going to be all the stocks that are going to be relatively pretty good to play for a good budget within like 4 figures headed into early 5 figures, which I assume most of you are booting up at. Even if you are playing with like 5-6 figure account, these stocks, if you get some good plays, you could stack up some contracts, buy some far out contracts, hit some really good plays. So one, you're trading the United States stock market. So it's pretty much just meant to go in an upwards direction year after year after year due to multiple reasons. One, taxes. If these companies are able to hire more people, the government's able to garnish more wages for taxes. And the more taxes that are being able to be paid to the government, the richer the government will get. Okay. So as long as these companies are going up, the more profitable they're going to go ahead and be, and then the more they're going to be able to do for the United States government. So these companies and these stocks are meant to go in an upwards direction year after year after year. Take Exxon, for example, okay, the gas station. You can go ahead and see here, price headed in an upwards direction year after year after year after year after year. Okay, or this is an energy company. So constantly, price decides to rise due to the fact that it's a valuable company that affects the world. Okay, it's very, very helpful. And one thing you're going to notice about the chart is that it doesn't just go up in a straight line or straight down. Price moves within staircase scenarios. So price is going to move like an upward stairs. So identifying that lets us know that we have to get in at certain times, and also lets us know that market trends. So let's identify what the trend is and how to see an upward trend versus a downward trend. So when you're trading the United States stock market, a lot of the times you're going to be trading upwards trends, and you're going to be trading what's called pullbacks. Okay. If market's meant to go up, then wait for market to come down, buy it, and then wait for it to go back up, and then catch your profit. Okay. Reverse engineer it and really just have your psychology on point. So once again, if market is meant to go in an upwards direction,
you're trading the United States stock market, if you're trading options or shares, whatever, and it's meant to go up, then instead of buying when it's all the way up, wait for market to pull down, buy it then, and then take it back up. So it's that logical. Okay, don't make it difficult. The charts are not mumbo jumbo. You don't need any indicators. Disable all the indicators on your screen right now. Just keep it easy, keep it fresh, keep it clean. So boom, you could see price heading in an upwards direction year after year after year. And one thing too, you want to be looking at price on your higher time frames. Time frames you're going to be needing in order to find your setups a lot of the times. You're going to be needing your weekly time frame. You're going to be on that first. It's going to give you that full vision, so make sure you can see every piece of price action. You don't want to be trading stocks that aren't trendy, otherwise you're pretty much just going to be wasting your time. Then you're going to go ahead and scale down to your daily time frame afterwards too. Your daily time frame is going to give you a little closer view, and a lot of the times your daily is where you're going to find your take profit. Okay, and it's where you're going to determine whether or not price is ready for your entry. Okay, so your daily is going to be for your take profit identifications and your entries. Weekly is going to be for the full bird's eye view, making sure you're not trading anything that's horrible. Then after your daily, you're going to scale down to your 4 hour. Now there's a reason why you scale down to your 4 hour. The daily is one of my favorite time frames, but you do need your 4 hour. 4 hour is also one of my favorite time frames. And the reason why you need your 4 hour time frame is, check this out. If I'm on the daily time frame, I'm going to notice sometimes there's going to be little gaps in between the market. Okay, little gaps I'm going to be able to see here in between the market. But if I go on my 4 hour time frame, I'm going to be able to see price moving successively. Now, if you're still seeing gaps, which you're going to go ahead and need to do if you're on TradingView or whatever brokerage you're looking at or trading on, you need to turn on your extended trading hours. If you're on TradingView, look in the bottom right and just turn on ETH and turn on extended trading hours real quick. Okay, this way you're going to be able to see every hour and ounce of price action, and you're not going to be able to see those little gaps. So after you're done with your weekly and your daily, make sure you scan your 4 hour time frame. From there, here's how I go ahead and find setups. I like to go ahead and scan my stock screener. I like to start on my weekly time frame, and I'm going to stay away from things that are near all-time highs. Okay, because I'm going to want price to be at a point where sellers have already sold and buyers are just now stepping in. I like to call it the V formation. So you're going to let sellers make the top left of the V. You're going to let early buyers make the bottom of the V. And then we're going to catch the rest of the V as confident, assured buyers. Okay, letting us know that the trend has swapped. We don't want to be buying falling knives, and we want to be buying when price is confirmed. In order to do that, make sure you're having at least 2-6 daily candles headed in an upwards direction, ideally that are going to be the same color, green, if you're using green and red candlesticks. Okay, whatever color you're using for buying, the more candlesticks you see going in an upwards direction successively with the same color scheme, okay, is going to let you know the trend a lot of the times. And price moves in V formations. And what that means is, let's take this V formation here. Price decided to come up, make a sharp stop, and then price decided to fall downwards. So price made the top left of the V. That lets you know sellers stepped in here. This is going to be an area of resistance. After that, price fell down, made a bottom, made an area of support. That's going to let me know that buyers went ahead and stepped in. And price went ahead and filled in that whole area back to where sellers originally started selling, broke past it, and it's going to go ahead and try and make some new highs. Okay, fall down here, and then price will try and come back up, break that, and price will continue to zigzag, go up and down, and make staircase formations to new all-time highs over and over and over again. And that's how the trend works. Now, knowing when to get in, they're going to want to get on your weekly time frames and stay away from things that are, once again, at all-time highs. Price can pretty much only go down, find a low, and once it finds a good low, then you buy it and then take it back up. Okay, and ideally your take profit is always going to be where price originally fell down from. So even right here, let's say price decided to fall down from this area. Price trickled up, stopped right here, fell down, and made what's called a higher low. So this low right here is higher than this low down here. When you start seeing price making higher lows and what's called higher highs, which means that this high is higher than this high,
Okay, when you start seeing price make higher lows, which means this low is higher than this low, and this low is higher than this low. When you start seeing price trend in a staircase like that, that's how you know you're heading in an upwards direction. Okay, so to find a good setup, okay, here's another one that I went ahead and marked as well too. My daily, I could see that price decided to fall downward from this area here. Price decided to make a heavy area of support, made a higher low off of that. I identified that, and price decided to went ahead and smash take profit within a couple of days. Okay. Within 6 days. So extremely simple when you're finding your setups. You want to buy when the buyers are buying. Okay, and if it took 6 days, try and buy these contracts. Ideally, if you're taking smaller take profit setups using your daily and your 4-hour, you can buy contracts as far as like 2 weeks out plus. At least try and be 2 weeks out, and then you can build your account from there. But having at least 2 weeks on your contracts gives time and price to fluctuate in case it does, or in case some news comes out or anything. But even an example here on Disney, could see price meeting up with this area of resistance. I marked this a couple days ago, and you can see buyers fiending to have price trickle back up to this area. Even if you're a trend line type person, you could do that too. You could see a little retest off the trend line here, and price heading in an upwards direction as well too. Okay, and if you wanted to, you could play the remainder gap to the resistance if you wanted to. Okay, you could buy at least like 2 weeks out, could buy 17 days if you wanted to, and take it up here, catch a nice flip. Okay, November 12th. And then you could buy your contracts. You could buy like 2 weeks out, 15, 12, $3. So yeah, 188 to $3 there. And you'd be able to just flip your money consistently there, even if you went 10 days. You'd be able to catch your flip there as well too. So play market how you would like to be playing it. Even a scenario like here, I kind of like this maybe potentially. I like how price is making higher lows here. Confident in that. Looks like buying wants to step in here from this low to the new low. Go to my daily. We got multiple green daily candlesticks. So 4-hour, honestly, I might take this up to at least this resistance here. And then that might be a clean little trade as well too. Pep. So about like 2-3 weeks out. About 145 and take it up. Yep. So cool. That's how I make it simple. That's how you find options contracts. Just no fluff, no BS. Just straightforward price action, reading the candlestick chart, understanding buy zones and sell zones, and just really taking the trades that you need to be taking. And understanding when buyers are buying is really important. Say this, for example, I could tell buyers are buying here since I see higher lows are being made. And the more you live on TradingView all day, the better your eyeballs get, really. So chart time is really important. Okay, I could check here on the weekly, see price decided to fall from here. Get on my 4-hour. Price falling down from this area of resistance. I see this area of resistance before it here that happened on the 2nd. I like that. I'll even hop on my 1-hour with it. I have this area of resistance too. Okay, so even if I wanted to close on this 4th area here, could definitely do that. Yeah, these contracts are a little far actually. So 120 minimum. So yeah, you'd have to play for like up here. So it'd be worth it to just buy some months out. I'm sure these are probably cheap, yeah. And then you could catch this flip if you want to and hold these for a minute. So yeah, all types of scenarios, different ways to grow your account. It's just choosing the most effective ways and staying patient. Okay, play the stocks that you know you're good at. Pick stocks that have good volume, and really just take your time with your setups. And yeah, that's how you find options trades. Head over to stackmode.net. I pray it helped. Peace.
All my day traders out there, there's going to be a completely different world to trading, and that's going to be long-term investing. Take some of your profits and siphon that back into shares, certain stocks that you believe in, into certain cryptocurrency plays, into ETFs that pay out dividends, so that you can generate passive income. Use your money as a tool. And that way you're always going to be using your money to generate some more money. Okay. So trading, it's really going to be more of a career, more of a wealth generating tool as far as day trading, weekly trading, options trading, and just swing trading, closing position from between 1 day to a couple of months to weeks. And the other one is going to be holding positions for year after year. There's also going to be some long-term tax benefits that come into play as well too. So you actually get some benefits for holding trades for over a year. So I recommend you guys have 2 portfolios, one portfolio for your day trading portfolio and another portfolio for your long-term investing portfolio. It's really going to help you break everything down. And when it's time to do taxes, you're going to be able to calculate and differentiate everything pretty quickly, easily. So let's jump into it. So class, even if you start making 3 figures a day, 4 figures a day, 5 figures a day off of day trading, don't lose yourself. Okay, it's really easy to be reset back to zero, especially after a season of like a long wing streak and market, say for example, swaps the trend. Okay, you might get into some kind of ego horizons certain time, not being able to accept certain losses, especially after you just streak like that. So you had a really good month, you just won pretty much every single day of the one. And then when you take your loss, you might end up taking 2 or 3 trades, okay, losing 3 times in that day because of the fact you just won so many times. So your brain can kind of get skewed. This is why it's really important to be with God and really just be humble at all times. Focus on the discipline and just forget about P&L. Update your contract size as your P&L grows, of course, but you can't just think money, 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 money. Okay, focus on the consistency and the process and the infrastructure around the type of trades that you're taking in the first place. So once you start making your day trading income as well too, take 50% of that away. Okay, say you make $100 in a day, for example. Take that $50, okay, and then you're going to take that $50, whatever the withdrawal amount is, okay, or say you make $1,000 in a day, okay, then you're going to go ahead and withdraw 500. Okay, so that $500, you're then going to take 30% of that $500 and you're going to go ahead and put that away. Okay, that 30% of $500 is going to be for taxes. Okay, and then whatever you have left over of whatever your withdrawal amount is, okay, take 30% of that, put it away for taxes. And then whatever you have left over, or you can honestly just split it 50-50 if you want. You could go ahead and do 50% of your initial withdrawal profit and then break that down into half as well too. Split that into 2 separate accounts, and that way when you pay your taxes, you're gonna have some overhead money. So you can go do whatever you want, either reinvest it or ball out, do whatever you want to do, because your stuff is going to be together, taxes are paid, and anything that's overhead you can either use to get further ahead or just spend on it if you want. Okay, and that's kind of going to be your reward account, especially when you have overhead after paying your taxes. It's okay to go ahead and ball out. You know, we're still only here for one life, so do that, especially in your tax account. You can use that as a reward for being on top of your finances. So when it comes to long-term investing, and that really means holding position for over 1 year, because remember, there's going to be long-term tax benefits for holding positions over 1 year. And the goal of that is really going to be to just build wealth, security, and you're not going to be trading your time for money at this point. Okay. In hindsight, you are, because you're going to be waiting for things to go up, but you're not going to be wasting physical human exertion in order to gain income. So at this point, your account's going to be built up. Let's say you have around 50K. Okay, let's say you have $50,000, right, inside of a ETF paying you dividends. Let's say that dividend pays you $2,000 or $1,500 a month. So if you have $50,000 invested, right, so that's a pretty average income, right? $50,000. If you have that invested into a dividend, say that dividend is paying you $1,500 quarterly. That's all of your rent, your expenses, etc., paid just because you invested. Okay, so you can actually get $2,000 a month for just being invested. So start working on your dividend portfolio, keep siphoning money into that. And once you have enough investment, the shareholders will pay you out what's called dividends. And you can make like $1,500 a month, $2,000 a month, and have your money put up securely and safely. So forget 401k, Roth IRAs, all this slow type of wealth. There's a lot of wealth you can really be building now. So stay down for a couple of years, you know, don't do anything, just work, grind. You know, get closer to God, work on your spirituality, and it's really going to take you on a long-winded journey, especially once you start touching the 6-7 figures. Your mind can really go aloof. Okay, so it's really important to just stay humble and keep reinvesting that profit into cycles. This way, you're not even going to get the chance to blow up your account in the first place. Okay. When you're taking that profit and constantly reinvesting it, and you have the mindset, you've trained yourself to understand, like, okay, money's just a tool. Like, I'm not just going to use this to go splurge and do X, Y, and Z. I could just get wealthier and then let everything pay for itself. Because when you get to a certain point of investments, you can pretty much live completely for free. And living for free is just no stress. You don't have to physically exert to pay your bills. As long as you have a certain amount of investments, you can live stress-free. You'll have money coming in at all times. You'll be making money every single second. So if you just stay down for a couple of years, couple of months, keep your head down, stay focused, okay? All those friends telling you to go out, etc., that's not doing anything for you, okay? If you want to end up broke in the future, that's fine. But if you don't want to progress, if you don't want to put your family in a better position, then go ahead and slack off. But for the people who do want to actually achieve their goals, get somewhere and provide for their family, stay down for a couple of years, okay? No buying clothes, no buying jewelry, okay? If you have a super nice car, like a premium, for example, okay? I used to pay premium gas. I used to be an idiot when I was around 18, 19. I had an Audi A4 and was paying premium gas during the height of it. It was around $6 a gallon, and I lived in Georgia. So I couldn't even imagine what gas was for people on the West Coast at that time, probably like $10 a gallon. So spending around like $190 or around $80 per fill up, it's really just wasting money, okay? Just driving around doing absolutely nothing instead of investing, okay? And Bitcoin example, I made a mistake where I had tons of Bitcoin, okay? I had around like 30 grand worth of Bitcoin and would just constantly spend it. Constantly spend it every single cycle. Would just spend it. So me not staying down, me not stacking up really resulted into me realizing, like, okay, you can set yourself back years if you don't plant your seeds. Okay, you got to think of investing like a garden. You got to really plant your seeds in the ground and let everything sprout and grow over time. Okay, but if you plant your seeds and say the tree gets big overnight and you instantly just chop the tree, how do you expect to keep getting fruit? How do you expect to keep growing from that? Okay. So even when you touch that big bag, you can't just chop down your tree. Don't just withdraw all of it and stop trading. No, you got to stay down. Don't get overzealous, reinvest it. And then you're going to be able to get to the point where you can pretty much live for free. Okay. And once again, living for free is going to be just being able to pay your bills, feed your family, and go on trips, etc., without any physical exertion involved. Okay, so work hard now. Okay, you don't have to physically exert yourself forever. If you do the hard work for around like 1 to 5 years, okay, hard investing, hard work, growing your business, growing whatever niche that you want to execute in, then you're going to be able to achieve the goals that you want to achieve. Okay, it's going to be easy to jump into real estate from there, especially with all that capital from there. Okay. And say you were to generate a large income, okay, and have a large savings amount. Say you were to chop down that savings and buy a house, for example. Say you wanted to buy a house or buy a duplex or a triplex, right, and rent it out to a family, okay, or a couple families. Let's say you bought a multifamily, okay. If you use that profit and bought a multifamily, okay, let's say the multifamily costed you like $300,000, $250,000, right? Okay, if you buy that, and you use a good chunk of your savings and you still have money within your dividend investments, you're going to be fine. You're still going to be getting paid around $1,500, $2,000 a month from the money that you already have initially invested in, which is also stacked up on top of that. So just from your dividends alone, you're pretty much going to be able to live. So while your multifamily income is generating, while your real estate profit is generating, whether you do Airbnb, get a multifamily, whatever route that you go, okay, you're going to be able to survive based off of just the investments that you made in the first place. Okay, so it's really important how you spend your money, even just $1,000, right? Instead of buying the newest computer, the newest phone, okay, go invest. Okay, because when you're dead broke, when you end up flat, you're going to be wishing that you could sell those items and restart over again. So don't do that. Okay, make the smart decision, invest. The reason why a lot of people are behind when it comes to bills and stuff like that, living paycheck to paycheck, is because they don't invest. Okay, when you invest, not only do you have your stash, okay, you have money that you can pull out and execute back into your bank account at any time. You have money that's generating you money at all times, pretty much. Okay, especially when you put down good trades, whether it be at options, futures, forex, whatever. your money's going to always be generating you money. Okay. And then when you take that day trading profit, put it into shares, which are definitely going to be always generating you money, inshallah, especially when you invest in good companies. Take Build-A-Bear, for example. Build-A-Bear, it does nothing but go up in a straight line, for example. The company just a couple of years ago, as of 2025, when this video is coming out, was around like $2 a share. Okay. And it's had no dramatic pullbacks. It's a really low key stock, but Build-A-Bear is a good company. Okay. It's now at like $72 a share after this video. So it's just a good investment. And once you find really good companies to go ahead and invest in that provide future value to human beings, go ahead and invest in that. Put your money into that. You're not going to regret it. Okay. A large percentage of millionaires come from the stock market. Okay. So after your business goes up, after you start getting a nice paying job, whatever, after your income increases, invest. And this way you're going to be able to sit down and really just sit on your butt whenever you want. Okay. You're not going to have to physically exert yourself constantly for income. That's not going to be reasonable, especially as you get older. Okay. There's going to be certain mental things. Your mental is not going to be as sharp. Your body is not going to be as strong. Okay, so it's really important to invest. So this way you guys aren't going to have to rely on other people, you know, trying to rely on certain things like family and things like that. It's not always going to be the smartest and wisest thing. So you always want to just try and put yourself in a position to where you can provide. Okay, so if anyone falls short, you got them. Okay, so invest. So you be the one to stay down. You be the one to stay in the stack mode. So instead of you falling short, okay, and having to beg, okay, you be the one that's going to take the sacrifice, okay, not go buy all the flashy things, really stay down, okay, get groceries, not be eating out, and not be doing things you shouldn't be doing. So this way, whenever things do get hard, you're going to be the one to be able to take care of the things that need to be taken care of. So this way people don't struggle, okay? So just stay down, get into stack mode, and whenever anything goes down, you're going to have the financial security, and it's not going to break your bank, because things happen in life. Hospital bills, okay, car crashes. There's a lot of things that just happen randomly in life, and you can't have rent coming up on the 30th and then you have a $600 car repair bill. That's going to throw off all your calculations, and then you're stressing about that. Okay, but when you're investing, you have your money making you money at all times. If something like that happens, you're going to be fine. You're going to go dig in the stash, pull out some money out the stash. You're not going to be tripping. Okay, but when you're reliant on that calculated paycheck only, okay, you're not going to be able to grow within an exponential way. So this is why it's important to start your own business, because this way your income is going to be pretty much unlimited. When you start your own business, your income is based off of how much effort you put in. So however much a business makes, it's based off of how much effort they're putting in and how much they're helping society. And then B, invested portfolio income too. Okay. So when you invest income constantly, especially into certain things that are almost guaranteed to generate you a positive equity curve year after year after year, you're going to go ahead and subsede your constant income. And then you're just going to be way ahead of things. Okay. So if anything dramatic does happen in life, because life definitely does life, you're going to be cooling. Okay. You're going to be able to dig in the stash. You're not going to be tripping. So long-term investing, it's definitely lower risk for sure. Okay. I'm glad I went through all the day trading struggles at first. Okay. Going through all the emotional highs and lows, making $1,000 one day, losing $900 the next day. You know, going through the emotional high and lows really teaches you emotional control. But as far as long-term investing, once again, there's people who are millionaires who barely look at the chart and just invest into just certain things. So certain ways, effort, especially when it comes to the market, effort is not going to always guarantee profit. Okay, someone who makes 10 trades a day is not going to be as profitable as somebody who just bought and hold something for 5 years. Okay, a lot of people who just buy and hold actually outperform a significant amount of day traders. That's because day trading is not something that's going to be inherently easy to get down. So yeah, I've been trading for around 2 or 3 years now. And I'll say April 2025 had one of my most successful day trade months. I took 30 trades, won 25. Okay, and the 5 trades I lost was just not looking due to news. Okay, so those were my fault. So that month really taught me, like, okay, if you day trade, you can win pretty much every single day if you wanted to. As long as you're taking the right type of setups, you're waiting for confirmation. I personally trade break and retest. and you're waiting for key levels to be broken, then yeah, you could almost win every single day when it comes to the day trading aspect. Now, how long your day trades will be, that's also going to be an inherent question. You might be closing like in a couple of minutes. But if you're going to be trading between like hours and days, that swing trading area, that's still going to be kind of within the day trading space too. So I'd say anything that you're closing less than a year would be like considered within that same environment. Okay, so be careful with that too. It can come with extreme risk, because especially with futures and Forex, you have a lot of power. You can just instantly click buy and sell constantly, and your money's going to fluctuate. Okay, well, depending on the amount of leverage and ticks amount that you have on, your money is going to go ahead and fluctuate. So the risk is extremely high. Do your research. If you're struggling with trading, head over to stackmode.net. Okay, the risk is going to be extremely high when it comes to day trading. Okay, so be aware of that. Okay, if you just lose your whole check in a minute, you probably did something wrong. Okay, you got to really analyze how much size you're putting down. There's calculations, entry criteria, time frames, and you have to really understand the overall direction of the market before you just start getting in and doing anything. And day trading is really going to require some advanced market knowledge, technical expertise, and your TA needs to be on point. Okay, so if your technical analysis is not as structured as it needs to be, you're not going to get to the type of profits that you want to be seeing when it comes to day trading. Okay, you have to really live on the charts. There was at least 2 years of me staying on the charts 16 hours a day. Okay, and I still look at the charts at least 2 to 8 hours a day, every single day. So if you want to be a day trader, you have to know how each and every single time frame correlates. You have to know how to read the higher time frame trends, and you have to really understand break and retest. That's really going to be a big thing that's going to help you keep your account safe. I'd say break and retest. Understand that price going in upwards direction is based off of resistances being broken, which you can logically put into hindsight. Height of the market, also known as all-time highs, is always going to be being chased to be broken. So say the Bitcoin height is going to be 100K. Even if price dumps down to 50K, it's still going to try and get back up to that 100K one day and break it. That's just how trading is. Okay, so you have to really know the logistics of the market, understand it's a left to right chart, and do your information before you just start day trading. But as far as just putting some shares into a certain company, just know how to read support and resistance on like your daily time frame, and you can be a pretty decent investor. You don't even have to day trade in order to reach the type of income that you want to receive. But I understand that some people might be day trading due to FOMO too. I have a lot of day trade recaps too. You guys can see it's pretty easy to make hundreds, thousands of dollars within a day, but that's after you've struggled. That's after you've really humbled yourself. And that's after you've studied hundreds and hundreds and hundreds and hundreds of hours. Okay, so it's not something you're just going to jump into fresh and be successful in. Okay, a lot of times it's going to take information and knowledge. Okay, because with day trading too, your emotional control has to be a lot higher. When it comes to long-term investing, you could really just hold for years and forget about it. Once again, there's a lot of people who are wealthy who don't even look at the chart. A lot of people who just had Bitcoin in their Coinbase account, on their USB drive, whatever, in their Phantom wallet, and just came back to it 10 years later and they were a millionaire. Okay, so you don't have to be the best trader of all time or the smartest person of all time to be a millionaire. You just have to really just invest and make the right decisions. So, but if you're going to be a day trader, make sure that you're at least ending the months positive. Okay, and you shouldn't be taking money from your business, money from your savings, and hauling that into your day trading account. Really have some discipline. Okay, and you should need to be earning your position size. So take the account from $1,000 to $2,500. Okay, then take it to $5,000. Then take it to $10K. Then take it to $15K. Okay, start it at $100. Take it to $500. Then take it to $750. Take your time. Okay, grow your account, earn your position size. Don't take, even if you have M stashed, don't go take all of that and throw it into the market, especially when you're new. Because if you lose that, you're going to be distraught and you might do some emotional things. Okay, you might put down more size after a loss, trying to make it all back, thinking it's about to be the one play that's going to save your account. But that's the wrong mindset. That's why risk management is important. Okay, so instead of trading with 50% of your account in one trade and then go on 2 trades. Okay, and that's completely your fault. but you could lose 5% at a time. Okay, 5%, 5%, 5%, 5%. Okay, and then say you take a win for 40%. You don't care about that 20% that you just lost. Okay, because now you just won 40%. Now that 20% is canceled out and you're up 20%. Okay. So the math is in the risk. Okay. Whether being a day trader or long-term investor, understand that math is always going to be within how much risk that you have calculated, and as well as when you buy and when you exit. So taxes and transaction costs. So long-term investing, like we talked about a couple of slides ago, it's going to go ahead and give you lower taxes and lower fees. There's going to be long-term tax benefits for holding a trade for at least 1 year. And you only pay tax when you sell, okay? And that's going to be realized gains. And if you hold an asset for over 1 year, you pay the lower long-term capital gain tax rate, which saves you money. Okay, so fewer trades equals lower taxes and fees, which can definitely eat out your profit. So future traders, don't just be spamming buy and sell instantly, because a lot of the time the fees are going to go ahead and cancel out the profit that you're scalping. And you shouldn't be trading like that. Trading is not a game. Okay, if you want to just give your money away to profitable people, it is called trading. That's fine. But all the market is people getting rewarded for being disciplined and patient. That's strictly all it is. And if you're getting your money robbed, or if you're not being consistent, that just shows you who you are as your person. So you could either change or continue to be the same. So day trading can be a little tax inefficient. You can still make some great income though. And profits are taxed as short-term capital gains. And these are trades that are held for less than 1 year. And they're equivalent to much higher ordinary income tax rates. So high volume of trades per month, per year, per day, you're going to be subject to just higher taxes and commission friction. Okay. So for almost everyone, both, okay, can be a strong option. But if you're just someone who has a family, has a lot going on, has a big business, you can't really stress about the charts, I really recommend just long-term investing. Okay, you could still make millions of dollars, achieve your goals, and get to where you want to be by just buying shares. Okay, you can buy shares, not have to worry about it. No time decay like options and futures, no leverage or margin you have to really worry about, especially if you're on a cash account. And you can really just stress-free, just invest, let your money sit, let it grow over time, put it in a company that you believe in, and yeah, just let your money work as a tool. Now, day trading. If you have time to study the market for, I'll say at least 6 months, like every single day, constantly, at least 16, 18 hours a day, then yeah, you can go ahead and definitely day trade. Okay, but if you don't have that type of time commitment to put into the charts, then it's not worth it. So your screen time has to be consistent. You have to know how every single candlestick moves on every single time frame. Understand how the market structure is going to correlate as well too. And you got to be really quick when it comes to closing your trades. So day trades are going to be different. If you don't close at your certain levels when it's time to close and you get reversed on, you get emotional, that can turn into a spiral in itself. Okay, so you got to be really strong to day trade. Okay, and swing trade as well too. So take your time. Make sure you guys have tons of screen time on. Test it out in paper trading before you start putting in real money into the market, and make sure that your strategy works. Okay. Make sure that you guys are able to afford to lose the capital too. Don't trade with no rent money. Don't trade with no grocery money. Don't trade with no bill money. Don't do that. Okay, stay down until it's time. Put some income to the side. Once you have some income ready, okay, then it's time to start trading. Take care of yourself first. Okay, clear your debt. Okay, pay your credit cards off. Okay, make sure everything's good and structured, and then we trade. We don't come onto the markets desperate for income. Okay, get your life together first, and then you come onto the markets. The markets are for people who have their life together. Okay, so that's why you get rewarded for one, holding your trades for over a year, because you're not fiending to withdraw your money. When you have a business that's making you income that you can survive off of, you're not worried about the money that you have invested in your brokerage account. Okay, there's a lot of benefits for holding plays for over a year for a reason. Okay, they want to reward people for being financially structured. You can get rich if you're just financially structured. They make it really easy in this world. All the credit you guys can get. Okay, all, whether it be a business credit and or personal credit. Okay, all the loans you can get with certain things when it comes to real estate loans, and you can flip that into certain things. Okay, all the approvals you'll get. Okay, getting any truck that you want. Let's say you have a construction business. Okay. Once you're a put together, financially stable individual, the world will treat you as such. Okay. So investing, it's really going to be the long game, and you're going to be the owner of your shares. You can sell them whenever you want. You're going to be in control of your portfolio. And day trading, it's going to be, I wouldn't say a short sprint. You could day trade until the end of time if you want, but understand that that mental exertion might get to you. So having money in ETFs, having money just put into something that's going to be making your money, so you can step away from day trading if you ever wanted to. All right. So I pray up to God, keep grinding. Head over to stackmode.net for all trading education. Peace. I'm going to go ahead and break it down and make it easy. So what exactly is trading volume in the first place? So volume is pretty much going to be the amount of people and the amount of money being flowed into a cryptocurrency token, stock, or whatever. So whenever you hear the term volume, just think about the amount of money that's being flowed into or out of something, as well as the amount of people that's trading it. So it's a fundamental metric that represents the total number of units of a cryptocurrency, for example, in this case, that have been traded over a specific period. And it's a simple yet profound measure of market activity and liquidity. And think of it as the heartbeat of the market. And a high volume indicates a strong, healthy pulse, while a low volume can signal a weakening or stagnant market. And encompasses both buy and sell orders that have been executed, reflecting the total flow of capital into and out of a particular asset. So let's talk about the total transacted value. So volume is often reported in both the base currency, for example, Bitcoin, Ethereum, for example, and the quote currency, aka USD, USDT. A volume of 10,000 Ethereum on a given day means that 10,000 Ethereum coins were exchanged between buyers and sellers. There's also going to be time-specific measurements involved too, and volume is always measured over a defined time frame, such as 24 hours, 1 week, or even a single minute. And this temporal context is vital for analysis, as a sudden spike in a 15-minute period can signify certain sudden movements within price, even if the daily volume remains average. So if you see a bunch of volume coming in within like a 15-minute time period, then you know lots of flow coming in. Maybe a whale might be purchasing, okay, somebody putting in a large amount of orders, okay, or a large amount of orders being flowed into a specific direction. Okay, that's going to be volume. Whenever you see price action being flowed into, whether it be it on the flow chart or via the order book, okay, you're going to be able to see all the transactions happening. And the more transactions you see, the higher the volume. So let's talk about liquidity indicator. So a high trading volume is a direct proxy for liquidity. An asset with high liquidity is easy to buy or sell without causing significant change in its price. And this is crucial for large-scale traders and institutions who need to enter or exit positions without a large price impact, also known as slippage. So slippage is pretty much where you're not going to be getting all the money that you're intending to receive. So say you sell for a profit of $500, okay, you're expecting to get all that $500. But depending on your broker, depending on the fees, also known as gas, etc., stuff like that, okay, then you're going to be able to calculate the amount of slippage that you may have to pay for. Okay, and slippage is pretty much going to associate itself with fees. So slippage, say you make $500, okay, you might withdraw $480, okay, due to the fact that the other $20 would have to go to the slippage. Okay, so that's slippage, for example. So why is volume crucial in the first place? So for crypto traders, volume isn't just a number. It's a validation signal that confirms the strength of a price move. So for instance, if you see on the order flow chart or the flow chart in general, and you're intending to play within a bullish direction, right? You're intending to long the market, and you start seeing a bunch of buying coming in, then you could kind of put together with your technical analysis along with the flow chart. Okay, if you start seeing volume, especially buying volume coming in, then you can go ahead and be like, all right, you know what, I might be right, and go ahead and take your trade based off of that. So it can be some good validation to come in because you're going to see other people making trades. Okay, so it's going to be a level maybe everyone might be waiting for. And if you see a bunch of volume price coming in and your intended direction, then it could mean that that's a good level and you're most likely right. So price increase or decrease is far more meaningful when it's accompanied by high volume. Without this confirmation, a price change could be fluke or the result of a single large transaction, also known as a pump. So that can be unsustainable, and certain high volume tokens grow year after year after year after year. But if you just see a bunch of selling coming in, for example, on like a meme coin stock, then that's what certain coins, like such as the pump and dump or rug pull coins, Thus where those terms come from. Okay. So volume gives us a window into the market consensus and what's going on. So give us an example here. So the bull trap. So imagine Bitcoin price rises 5% in 1 hour, but the trading volume was unusually low for that time of day. A savvy trader would be cautious, and this low volume price surge could be a bull trap, and a false signal is designed to lure in buyers before the price collapses. The lack of the significant volume indicates that not many people are participating in this price move, suggesting it lacks genuine market support. So volume can help you with confirming certain price trends. Okay. So a strong upward trend is going to be confirmed by increasing volume on up days and decreasing volume on down days. And this shows that the buying pressure is strong and consistent. Conversely, a downtrend is confirmed by high volume during price drops, indicating strong selling pressure, for example. So volume can also help you identify reversals. So when a market has been in a long downtrend, a sudden spike in volume as the price starts to rise can signal a potential reversal. And this is often the first sign of institutional or smart money entering the market, absorbing all of the selling pressure. And it can help you validate breakouts too. This is also going to be something I've talked about quite a bit on my channel as well too, when it comes to breakouts or certain levels. Confirming it with volume, confirming it using the order flow chart is really going to go ahead and help you out. Okay, you can also look at your order book, tape, whatever you want to look at, and volume can help you validate breakouts. And a breakout is going to be when price moves outside of a defined resistance or support level, and a breakout with high volume, which means a bunch of people are intending to trade in that place too. So a breakout with high volume is considered a genuine sustainable move, while a low volume breakout is often considered a fake out or a false breakout likely to reverse quickly. So if you don't see tape going crazy, order flow going crazy, whenever price hits a certain breakout level, it's most likely not going to happen. Okay, so that's one of the main things that people use in order to trade breakout levels. So analyzing volume in practice. So understanding trading volume isn't just looking at a single number. It's about interpreting its relationship with price and other technical indicators. And traders often use visual tools like volume bars on a chart to identify patterns and anomalies. And this allows them to see how volume is distributed across different price levels and time frames. So volume profile. Volume profile is an advanced tool that shows the total volume traded at each specific price level rather than over a period. And it helps identify areas of strong support and resistance where a lot of trading activity has occurred. Okay, so it's going to be a bunch of lines, and it's going to be showing you longer lines, okay, and short lines where there's low volumes. Okay, so in the volume profile, if you turn it on, trading view, wherever you want to turn it on, it doesn't matter. Okay, the shorter lines that you see is going to indicate low volume. When you see those long giant lines on the volume profile, that's going to indicate high volume. A lot of people are trying to get it right there. Okay, it's a very probable area, and it's a successful area. So on balance volume, OBV, the technical indicator that adds or subtracts daily volume based on whether the price has moved up or down. And a rising OBV alongside a stagnant price can signal hidden accumulation by large players, and that's a bullish sign. And volume price divergence. This is a powerful signal. If an asset's price is making new highs but the volume is declining, it's a bearish divergence, suggesting that the uptrend is losing steam, people are selling off, and a reversal may be near. The opposite is true for a bullish divergence. So for example, here's how to use divergence to predict a reversal in hindsight, inshallah. So a trader notices that Ethereum's price has been steadily climbing for weeks, right? Or, you know, we'll say Stackmode stock. So a trader notices that the Stackmode stock has been steadily climbing for weeks, reaching new all-time highs. Let's say the Stackmode stock is at $800 a share, okay? However, they observe that the daily trading volume has been consistently lower with each new high. Okay, so investors are starting to sell off. So the trader then recognizes this volume price divergence, okay, and anticipates that the upward momentum was weakening and that they might decide to reduce their position as well. Okay, just like the big investors, they're starting to slow down their positions, trim off, okay, sell off. No one's about to hold infinitely, okay, take off some money. And they also might decide to reduce their position or set a tight stop loss order or trailing stop loss order, correctly anticipating a potential price correction. Okay, so if you're anticipating that Stackmode stock has hit the top and that volume is deciding to slow down, aka meaning that buying is slowing down, okay, so volume could increase to the selling side, okay, and then you could go ahead and trim off your stock, trail your stop, and do what you need to do depending on your certain parameters. You should know your entry, exit, take profit, and stop loss before you put a single dime into the market. Don't do anything related to gambling. Make sure you're extremely informed of what you're doing. So the dangers of playing things with low volume. One, slippage. Okay, trading things with low volume, you could potentially buy all the crypto coins. If you have enough money, you could definitely buy like all of a meme coin or something like that. And if people aren't investing to it, it's going to be hard to sell off their remaining shares, and it's going to be a lot of slippage involved in that too. So low volume, you might not get your orders filled. And trading in a low volume market carries significant risk, and a lack of liquidity can make it difficult to enter as well too. So not only can it make it difficult to exit, like I just spoke about, but even to enter. So you might be like, why am I not getting filled? Okay, like why am I putting my money in and I'm not getting my asset? Okay, that's because there's not a lot of orders available. So volume is going to be a good thing to look at before we throw our money at something. Okay, because you might buy all of something and you might not be able to trade. Say stock options, for example. You can buy all of a stock options contract, and if there's not enough volume, there's going to be almost no one to sell it to. Okay, and you're going to be stuck with contracts. So something that I've gone through before. Okay, and I then had to understand that's why people buy shares. So there's going to be times where you buy shares, and there's going to be time where you trade options, for example. Okay, so try to trade things with high and decent volume. So let's talk about slippage in the first place. Let me break it down. So slippage in a low volume environment, placing a large market can eat up all the available orders on the order book at a certain price level, forcing your trade to be executed at a worse, higher price. Okay, and this difference is slippage. Okay, so pretty much you're gonna be paying more money for something, so you're gonna be losing money at the end of the day, and that's not what we want. So slippage is gonna be a frustrating thing, and to avoid it, try to play things with decent or high volume. So price manipulation. A single large buy order in a low volume market can cause a massive price spike. So once again, the rug pull scam, for example, or pump and dumps. Okay, people have Discord chats. Okay, they run ads, they do whatever, and then from there they own a large majority of the meme coin, for example. Okay, let's say they own 70% of it, and these are things you can go and check on certain brokers as well too, where you can see who owns a percentage of a lot of the meme coins. So let's say they got it at the bottom, okay, and they own 70% of it. So they own majority of the volume. It's already not worth anything. So they own majority of the volume. So they start posting ads, they start paying influencers, maybe hacking influencers, doing what they need to do. Okay, it starts getting some popularity. People start investing into it, thinking that they're about to make some big money, and something that has no future context, isn't helping anybody, isn't putting a smile on anyone's face. But for some people, they want to come into the market thinking that it's a get rich quick scheme, and you're going to go ahead and get your bread snatched just like that. So while people are feeling excited, thinking that they're about to make some money, the people who created the meme coin are in at the bottom, hold 70% of the share. And by the time it starts getting popular, by the time people start investing in, starts going in an upwards direction, they're going to go ahead and take that profit. Their profit's going to be disgusting because they already have a large majority of it. And it's kind of like a reversal IPO. So just like how the stock market works, let me go ahead and break it down. So before the stock market can even hit the public, someone has to buy all of the shares in private. And crypto is subject to a lot of manipulation because you don't have to do that. Okay, so the creator can be a participant. And same thing for the normal stock market too, but it's a lot less manipulation involved because someone has to buy all the shares prior to it being available to the public. So you can't get robbed as easily as you can someone just creating a meme coin and saying it's going to be the best thing of all time. So be careful following anybody too. All right, be careful following anybody. We're all human beings. Okay, a lot of people are flawed. I'm flawed. Okay, so whenever people are trying to prospect something, study it. Okay, see if it's putting a smile on people's face, see if it's making money. Okay, if it's not something that's going to be here for decade after decade, something that's bringing future value, something that's progressing the world, whether it be at a human level or at a physical level, okay, or transactional level, just forget it. It's not worth it. Okay, investing in Pepe the frog coin is not going to make you a billionaire. Okay, there are billionaires from people who trade United States stock market, who trade consistently, who trade at a disciplined high level. Okay, so when you're trading sheep coin on Phantom, expecting to make some M's, and then you come to me saying, Chris, I'm trying to make some M's trading meme coins, I'm gonna yell at you. Okay, there's no billionaires trading meme coins. You invest in things that have value. Okay, even when I was horrible, I was still able to make money due to the fact that I was investing with things that have value. Okay. There's millionaires who don't even look at the chart due to the fact that they plant their money into things that have value. Okay. Instead of spending it at the store, okay, spending it on unnecessary things, you invest, stay down, let your money make your money, and then you can live in overly leisure. Okay. Making money in your sleep, making it when you're waking up, making it while you're eating, making it while you're making money. Okay. So put all this together into your trading plan. So technical analysis, right? Technical analysis relies on a broad market participation. In low volume assets, chart patterns and indicators can often be unreliable because the chart is going to be so skewed. A lot of the time in a low volume environment, the market's not even going to look how a high volume market would look. Okay, the candlesticks are going to be all skewed. It's going to be all over the place. And it's going to be something you just don't even really want to be touching for the most part. And they can easily be distorted by a few individuals, which is why sometimes you'll see huge, giant, like 1 minute candles or candles that just don't really make sense, for example, especially with something that has no earnings involved. So stay away from certain manipulation. Don't get robbed. Okay. And it's a general rule of thumb to avoid trading assets with extremely low volume. And unless you have a deep understanding of the market and its participants, then high volume is going to really provide a more stable and predictable environment for trading. You could still try to catch something at its lows if it has future value. Okay. I'm not saying you can't catch something at the low and catch the whole sweep up. Okay. I really pray you catch that move, but don't be buying sheep coin and thinking that it's going to be the best thing of all time and be profitable. Okay. Don't try to compare it to something like Bitcoin or Ethereum that has real world uses. Okay. So trading volume is not just an extra data point. It's a critical component of any comprehensive data strategy, and it acts as a powerful confirmation tool, helping to distinguish between the genuine market trends and false signals. And by incorporating volume analysis into your decision making, you can enhance your ability to identify strong trends, spot reversals, and avoid risky low liquidity assets and taking unnecessary trades you don't need to be taking. I don't want you guys to be losing money unnecessarily like I went through for a long time. Okay, I want you guys to just start off profitable, and it's really refreshing. It's a real blessing to start off. My students, and they don't even lose money. Okay, my students, they start off, instantly start making money. Alhamdulillah. Okay, so do your research, get educated before you put a dime into the market. Okay, and you're gonna save yourself from a lot of struggle. So always check your volume alongside your price action. Okay, look for high volume to confirm breakouts and strong trends. Be wary of low volume price surges. Okay, that can indicate certain things like rug pulls, for example. If you just see like one giant order coming out of nowhere and then the whole market moves, be careful about stuff like that. Okay, low volume stuff can be subject to manipulation. Say for futures, for example, if you're trading crude oil, let me tell you guys about a story. Okay, on my futures account, okay, was growing it very consistently. And I've always been good at making money within the market, but one thing I was horrible at was keeping the money within the market. Okay, my first couple of trades I've ever taken were $600 trades and stuff like that. Didn't withdraw, didn't know what I was doing. Always been good at making bands within the market. Was always horrible at keeping the money or consistently growing it. Okay, and that's what I realized. I had to humble myself, you know, really had to turn to God. I had a lot of ego problems. Okay, I never thought it was enough. Even when I would make $100, $1,000, anything like that. Didn't think it was enough. Was always just chasing that M, always chasing the billion, always thinking of the next thing instead of just being focused on my discipline, my process, my consistency. Okay, and then starting 2025, 2024 as well too, just had an extremely consistent year. Focused on a lot of day trading and once again, just making really good money. Okay, but then really had to just think about something. You know, there's people who are once again millionaires without even looking at the charts. So I had to understand that trading is really about a long-term perspective. It's about planning in the future. It's about holding these trades for years and years and years on ends. And there's a reason why there's tax benefits for holding trades for years and years on ends too. Now, day trading is still amazing. I still love day trading. I still love taking like a couple week swings and stuff like that. Still give signals for that. Okay, but instead of me taking that bread, right, instead of me taking that money and going on vacation like I was doing, instead of me taking that money and stupidly going to LV instead of it buying shoes, stupid things like that, right? I could have been reinvesting. Okay, and by that time, and by this time, could have easily been a millionaire. Okay, so this is the whole point of why I created Stackmode. Okay, because I realized if you don't stay down, if you don't hold yourself back from certain things, put yourself in position to be a boss. Okay, and a boss is really staying down and grinding. You don't get that bag and go blow it. You get that bag, you stay down. You don't even think about it. Keep it in the stash and you keep working. You keep praying, you keep working. Okay, I was a kid, was very foolish. Okay, and God humbled me many times, and I'm very thankful because I got to come back stronger and I was able to make the money back 10x. Okay, and was able to keep my account healthy. And now that I know how to grow my account, it's really nice to see my students growing their account, coming back to me with results. Okay, so I just know that my struggle is not for nothing. So thank God. And avoid assets that have consistently low volume, guys. Okay, don't want you guys losing your money. Okay, I know you guys work hard. Okay, frustrating days, frustrating nights. Okay, just keep going, keep pushing, keep investing, keep staying down. I promise you, you're gonna catch the right play. Okay, stay prayed up to God, keep grinding. Head over to Stackmode.net for all trading education. I'll catch you in the next one.
Trading options can really be crazy. You could be right directionally and still be losing money, and I know that can be extremely confusing. So I want to break down the Greeks for you guys. They're the factors that control your options P&L and your contracts. And if you don't understand the Greeks, you just aren't trading. You're donating money to Wall Street and the people selling you the contracts. So here's going to be the cheat sheet to the engine that actually drives your contracts. I'm going to explain delta, gamma, theta, and vega, and understand that you can't control the market, but you can control your risk and the math. Let's go and let's jump into it. Inshallah, if God wills. Before we even think about throwing $1 into options, we gotta understand the Greeks. Inshallah, if God wills. It's extremely important. You don't want to just be in a trade, seeing it go up, and you have some calls purchased, and you're like, why am I not making any money? It can be heartbreaking. It can be confusing. And I'm telling you guys, the science, the math behind these Greeks, once you understand them, you're going to be able to avoid a lot of things. So before we get started, let me go ahead and just tell you guys a quick little cheat code to help you with Greeks. Your time that you have as far as when your contract is going to expire on options is the most important thing. Stop trying to buy 0 DTE contracts and have extremely far take profits. Okay, that's not making sense. Okay, if you're going to play on the higher time frames and have further take profits, then you need to have more time on your contract. Okay, ideally, one of the best ways to play options is via leaps. Okay, you guys might have heard me talk about leaps before, but what leap contracts are contracts that expire in 1 to 2 years. Okay, when you give yourself years on your contract, you have so much time to sit and wait for price to reverse, because you have to understand that the United States stock market, it's meant to go in an upwards direction year after year after year. Okay, Amazon, Google, Microsoft, Apple, these are all global companies that are implemented in the whole world. Okay, but these are American companies. So the US stock market, which is based off of stocks, okay, which options derive from, has to go up year after year after year after year. So you have to understand that. Okay, you can't be closing your trades early because you're like, oh, it's just going down for a couple of days, couple of weeks. If you have time on your contract, because your risk on options is how much the contract actually costs. So if your contract costs $200, the max you could lose is going to be that $200, but the max you could win is going to be infinite. Okay, so putting everything into perspective like that really does help you. So your stop loss on options should be exactly how much you purchased the contract for. Okay, if you purchase a contract for $200, then on options, that should be your stop loss. Okay, don't close your trades early. Purchase time on your contracts. Okay, and use your stop loss as the full value that you purchased the contract for. And I'm telling you guys, watch how your trading will change. Let's go and let's jump into how the Greeks actually work though. So trading options is going to be kind of like driving a race car. You're going to have 4 main gauges on your dashboard. They're going to go and have your delta. Your delta is going to go ahead and determine how fast that you're going. Then you're going to have your gamma. Your gamma is going to determine how much your contracts are accelerating. Your theta is going to be your fuel tank leaking. Okay, for example, think of it as time. And your vega is how bumpy the road is. Okay, the fear, the intrinsic value baked into it. Understanding these Greeks are really going to change everything. Okay, let me go ahead and tell you guys a quick story. There's been a time where I was trading SPX. Okay, I was trading a 0 DTE, and what DTE stands for is date to expiration. Okay, so whatever the day is before you see DTE is how many days before the expiration. So if it's 0, that means that the contract will close on the same day. Okay, so the stock market is open from 9:30 a.m. Eastern to 4 p.m. Eastern. Okay, so in each time market comes up to 9:30 a.m. Eastern, that's another day that goes by. Okay, but if we're going to play a 0 DTE, then the contract has to be closed by 4 p.m. Eastern. So what I did was open up a SPX contract during a Jay Powell speech. I'm sure you guys have heard of Jay Powell, and was up around $930. The reason why I didn't win that trade is because of greed, pure greed. What I did was trade with P&L instead of looking at the actual chart and understanding Greek, so I got burned anyways. So I didn't close the trade, one, because I was P&L trading, and I didn't understand the Greeks. Two things. Okay, so the first reason, I was on like $930 and didn't close it because it wasn't $1,000. I was trying to make 4 figures a day. Stupid mindset, I know. I was young. But thank God I learned. And another reason why I lost is because I just didn't understand the Greeks, truthfully. Okay, so SPX, I told myself, you know what, if I'm up $930 right now, but you have to understand that things work off of acceleration options. If you have a bunch of price action bursting really, really quick, happening fast, your contracts are going to be going up. But as soon as that contract slows down, starts consolidating, if you don't have enough time on your contract, okay, then your contract value is going to go down immediately. Okay, so if it's bursting in a certain direction that you have a contract based in, so let's say you have a calls contract, okay? Calls contracts mean that you're preparing for market to go in an upwards direction. So let's say you have a calls contract, right? If market's pumping up super duper fast, okay, even if you have an out the money contract, and what that means is, let's say a contract, let's say a stock is at $30, right? And you think it's going to go up to $35. Okay, if you buy a $35 contract, which is out the money, okay, it's not there right now, okay, then if price is bursting really fast, even though it's not near $35 yet, you're still going to see some profit. But once again, as soon as that price action starts consolidating and going sideways, your profit can instantly be wiped away from you if you don't have enough time on your contract. So having time on your contract, theta, is going to be one of the most important things. So try and buy contracts that are 1 to 2 years out. Okay, this is going to give you guys a lot of more flexibility and purchasing power to really do what you want with your contracts and how you want to trade on the markets. Okay, so let's go and let's break it down. So delta is going to go ahead and be the speed. Okay, so here's a definition. So if the stock price moves up $1, how much money would the option make? Okay, so if the stock price moves $1 and the delta is 0.50, then that means the option price would move 0.50. Okay, so 0.50 per dollar. Okay, so that means that every time the stock moves $1, okay, the options price would go ahead and move 0.50 cents. Okay, and remember, you want to go ahead and multiply everything by 100. Okay, so the options price 0.50 is going to go ahead and equal $50. Okay, that's going to go ahead and equal $50 once again. So you want to grab whatever decimal number you see on options and multiply that by 100. Okay, so 0.50 times 100 is going to be $50. Okay, if you're going to have 2.70 times 100, that's going to go ahead and give you 270. Okay, if you're going to have 4.50, you got to multiply that times 100. It's going to be 450. Okay, so whatever one of these decimal numbers that you see, you got to multiply it by 100. You have to. Okay, multiply all decimal numbers that you see in the options world by 100 in order to get the actual currency value of that. So think of delta as the concert ticket. So it's going to be the coupon, right? Imagine you have a coupon to buy a concert ticket for $50. Okay, and let's say the price rises. If tickets are sold out and scalpers are selling them for now $100, your coupon is now very valuable. Okay, that's high delta. And let's say the price drops, right? If nobody wants to go and tickets are $10, your $50 coupon is now worthless. Okay, that's 0 delta. So you want your delta to increase, because the more that your delta is increasing, the more that your contract is going to have more value behind it. Okay, but if price is dropping and your contract isn't working out in your favor, or it's not going in the direction which you have purchased, okay, so if you bought a calls contract and market's not going up, okay, then that means that the delta is going to help destroy your contract because your prediction is not right. Okay, but if your prediction is right, then the delta is going to go ahead and go up, deeming your contract valuable, making your contract more expensive, meaning you'll make more money. And gamma is going to go ahead and equal the turbo boost. So think of it as acceleration, right? Delta tells you your speed, and gamma tells you how fast your speed is changing. So think of gamma kind of like the nitro button, a super fast acceleration. Okay, think of this rocket ship. Boom, the turbo is behind it. So gamma is going to be like the nitro button in a racing game. Okay, so you're speeding steady, and then you got to just burst. Okay, that's what gamma predicts. So gamma makes your profits explode faster as the stock goes in your favored direction. So if you're on a calls contract, meaning that you're waiting for a price to go in an upwards direction, then the acceleration is going to help your contract make a lot of money, even if it's out the money once again. So let's say the current share price is going to be $30. Okay, if you think price is going to go up to $40, okay, you don't buy a $40 contract. Okay, what you're going to do is buy a $31 contract. Okay, so always buy the number one above or below current price in order to have your Greeks move the best. Okay, if you guys don't want to get destroyed by Greeks, do this: buy contracts 1 to 2 years out. Okay, buy contracts 1 to 2 years out, and buy contracts. If you're buying a calls contract thinking market's going to go up, I don't care where your take profit is. If the share price is $40, the contract you should be purchasing is a 41 call contract. Okay, that's just what you should be opening. Okay, you should be opening a 41 call contract. Okay, then if you're going to buy a puts, then you should be opening a $39 put contract. Okay, so understand that in order to have the best Greeks as possible, you need to have the best contracts. You need to make sure that you have as much time as possible on your options contract, and on top of that, you need to make sure that your prediction is going to be hit fairly quickly, or very likely to be hit. Even if it's more expensive, it's worth it. You don't want to just throw money into the void just because contracts are cheap. They're cheap for a reason, and they're plotting on you and preying on you for your understanding to not kick into your brain so that they can make some money. It's trading for a reason. These options contracts aren't just spawning. You have to understand that somebody is creating these options contracts behind. All right. So theta, it's going to be the melting ice cream, ticking time bomb. All right. Theta is extremely, extremely important. So time is money. And every day you hold an option, it loses a tiny bit of value. So once again, this is why I really put on emphasis on, if you're going to play options, try and buy contracts that have 1 to 2 years out. This way, you guys are going to be able to sit on your contracts with confidence. You're going to be able to hold it, and you're going to be able to do your thing. Okay. So theta is the time decay. So let's say day one value of a contract, right? Let's say you have a weekly expiration. So let's say you have a 7 DTE. Okay, 7 DTE. Let's go and let's break this down. So DTE stands for date to expiration. Okay, so the DTE tells you how much time is left. Okay, then the number tells you how much time is left. Okay, so if you have 7 days before expiration, then in 7 days the options contract will disappear and it'll go ahead and be expired. Okay, and whatever you get, you get. Okay, if it closes in the money, which means that you're up some profit, then you'll get that. But if it closes worthless or down, then you'll just get the remainders. Okay, so understand that theta is going to be the time decay. So here's how our options contract works. So day one value could be $100, and theta decay could be -$5, right? And let's say the day two value could be $95, even if the stock didn't even move. Okay, but because on options you're getting paid based off of time and prediction, you could lose money during a chop. Okay, so if the market is sideways and it's not going in a direction, it's not like shares or crypto where your money will just sit there. Your option could be deemed worthless because you're getting paid based off of how fast and how right you're going to be. All right, so here's an example of theta, right? Think of it as a rental pass. So theta, let's say you have a 30-day pass. Say, imagine you bought a 30-day pass to a theme park. Okay, so day one versus 29. So on day one, the path is worth a lot. It's jumping. On day 29, it would pretty much be almost worthless because the time ran out. The pass was only good for 30 days. Okay, so your options contract is only good for the amount of time that you purchase it for. So you want to be able to have as much time on it. Try and have some years on it. This way, if anything goes wrong, any type of speeches, with any type of government shutdowns or anything that affects the market, that would make the market move in a negative reaction from whichever way that you purchase, okay, then you'd be able to survive that. Okay, you wouldn't just be getting destroyed. Okay, so when you have time on your contract, instead of having a 30-day pass, imagine having the 3-year pass or the 2-year pass. Okay, the 30-day pass is not long enough. Okay, so the lesson: don't hold on to options that are worthless. Otherwise, pretty much they're gonna just melt away anyways. Okay, so buy your contracts 1 to 2 years out. Okay, try and buy them 1 to 2 years out, and make sure you have your take profits too. Okay, so that's also what I mean by don't hold them too long. You should know exactly where you're going to close. Options is extremely strict. It's not like crypto and shares where you can just sit there and hold it forever. Please don't do that. You need to have a strict place exactly where you know you're going to exit. Okay, you need to know where you're going to go ahead and exit, get your money, and close and hit take profit. Okay, once you do that, it's going to be a lot easier to go ahead and progress. Okay, do not sit there and try and hold your options forever, especially once you start seeing profit. Horrible mistake I've made in the past, and inshallah, God wills, that's not something I want you guys to experience. Okay, so please have an exit plan, know where your take profit is, and please close your trades. And Vega is going to be the fear index. So think of Vega as hurricane insurance, right? Vega measures how expensive options get when people are scared and horrified. So on a sunny day, insurance is going to be cheap, right? That means that the Vega is low. But when a hurricane is coming, okay, whether it be earnings coming, a big news event, whatever, the insurance is going to be expensive. It's going to raise, and that's going to lead to high Vega. So even if your house is fine, the price of insurance goes up because of the storm. Okay, so you guys might have heard of the term implied volatility. Okay, so when earnings come up or when big events come up for stocks, the options value could shoot up due to the fact that people are preparing for a big move. Okay, so there's a lot of cool plays you can make in options too. So instead of actually playing earnings with certain stocks, if you buy a contract before earnings, you might make a lot of money, but then after the earnings, it might go away just because of the hype and expectations. So people are preparing for the future, and that's why options are even a thing in the first place. So certain times when people are preparing for the futures between a big hurricane event that's going to change a lot, your price of the contract could change regardless if it's in the money or out the money. So very cool things you could do with options. So think of Vega as the earning party, right? So before the party, everyone's excited, right? The price for tickets go up. It's a lot of high volatility. Everyone's hyped. It's jumping. It's good music playing. Everyone is getting turned. Okay, but then after the party, the event is over and the excitement is gone and ticket prices crash instantly. Everyone was like, all right, that's it. We already went. It's not lit anymore. Forget it. Okay, so don't buy options right before a big news event. And if you do, make sure that you sell before the big news event. Okay, you do not want to be in a short-term options plays during news. Okay, this is why I also say try and buy contracts 1 to 2 years out. Okay, because if you're playing on your higher time frames, like your daily, your weekly, or even your 4-hour, okay, right, you're gonna have bigger take profits, right? And there might be earnings in between that, which is going to be amazing, just fine, because a lot of the times earnings will benefit you if you're playing in the right direction. But if you have 1 to 2 years out, you're not going to be getting destroyed by things like news and certain events like that as easily. Why? Because you have so much time on your contracts. So having time on your contracts kind of wipes out all the negatives of options. Have some time on your contracts and buy reasonable contract too. If the current price is 40, contract you should be purchasing for calls is 41, for puts is 39. Okay, you should always buy the number 1 above or below. That's going to be the best way to avoid these Greeks destroying your profit. I don't want you guys going through any of that weird cringe anxiety or anything like that. Okay, you guys got it. So let's go on this recap. Let's jump into it. So Delta is going to be the speed, right? And it moves with the stock price. Then you're going to go ahead and have Gamma. Gamma is the nitro. It's the thing that accelerates your wins or your losses too. And Theta is going to be the melting time. Okay, it's the time that eats your money. Okay, and then you're going to go ahead and have your Vega. That's the storm, and fear makes prices expensive. Okay, so if it's about to be a big news event and you notice your contract shoot all the way up, try and sell before news events. But if you're playing a higher time frame setup, you know what you're looking at, whether on your weekly, daily, or 4-hour. And if you don't, head over to stackmode.net. I'm here to teach you guys, okay? Whether you guys want to learn how to trade options, futures, crypto, or whatever, I'm down to get into it. I love you guys so much. Stay prayed up, stay high. Keep grinding. I'm going to catch you guys in the next one. Peace. I'm going to be teaching you guys how we can use support and resistance in order to catch some profitable setups. Let's jump straight into it. The downward areas here where price decides to make a V and bounce in the upwards direction, that's going to indicate an area of support. And opposite to the area of support, we're going to have resistance. All right, resistance is going to be an area like this one, for example, where price decides to fall within a downwards direction. Okay, so that's it. So let's talk about logistics. Let's talk about why each of them occur. Let's talk about what support and resistance is on the charts. Yep. So one, support occurs on the charts because price isn't going to continuously dip down to zero for the most part. So even if the price dump happens, a lot of the times stocks, they have something called a short sale restriction, and cryptocurrencies most of the time, especially if it's not a meme coin, they're not about to dump down to zero like a good chunk of the time. So price will go ahead and try to find itself a certain low, okay? And people will like to go ahead and buy at a certain discount and go ahead and sell from there. And we also have to put it in perspective too. This is the left to right chart. So price started way back over here, okay? Even further from that. So people have shares from way over here. Of course, they're going to sell and take profit. So whenever selling occurs, whenever take profit occurs, then resistance is going to get put into place. Okay, all it is people selling. Okay, if people got in way over here, of course they're going to take profit. Okay, they're going to go buy their boat. They're going to go put a down payment on their house, do what they need to do. Okay, so whenever you see market correcting, making sharp tops and falling in a downwards direction, that's going to legitimately mean that there's too much supply. There's too much supply and there's not enough demand, causing the price to go in a downwards direction. Okay. But then you're going to see price make a certain bottom, just like here, for example. So whenever we see price make a bottom and bounce in an upwards direction, that's going to go ahead and classify as support. Okay. And support is going to be important because that's going to be where demand is going to be put into place. That's going to be like, hold on, prices, it's done selling off. It's been selling off way too much. People are starting to find out that price might want to buy it at a certain area, create a certain low at an area. And then once everyone agrees that price wants to make the low there, price will go ahead and start sweeping back up in an upwards direction. Okay. Causing it as a verified level of support. So chatting about it again, resistance is going to be areas where sellers step in. Okay, it's a left to right chart. So the goal of the stock market, cryptocurrency market, etc., is to go in an upwards direction. There's coders behind it, people with jobs in it, heavy investors in it, millions of dollars invested into these cryptocurrency tokens and companies. So of course, people are trying to make some money by having their stock go up in an upwards direction too, especially when it comes to stocks. People are definitely wanting their share price of their stocks to go in an upwards direction because that's more money in their hands. Once again, say billionaires, for example, right? It's not $1 billion in fiat currency laying in their account. Okay, it's not a lot of bank accounts in the world that can even hold more than like 50 million, for example. Okay, so a lot of the core value is going to be in assets. So what makes billionaires for the most part is going to be their assets. Okay, so and a lot of the times it's going to be shares, okay, because most of the time it's business owners. So if Tesla is valued at 500 billion, okay, then Elon Musk being the company owner and he holds most of the shares or a large majority of shares, he would then be a billionaire too. So this is what makes stocks so important. So the proof is in the pudding right in your face. So billionaires are billionaires not by certain amounts of revenue made, but how much the company is valued on the stock market based on their shares. Okay, or take an artist, for example. There's an artist and he painted something for Facebook. Okay, he painted something for Facebook in 2006, 2007 or something like that. And instead of Facebook giving him actual money, Facebook gave him shares. Okay, he was then able to retire a multimillionaire based off of just doing one mural or doing one painting for the company. Okay. So shares are going to be an important part to just becoming rich. Okay. So a lot of the times
shares or even getting paid in cryptocurrency is going to be a longer term, smarter option to get paid. Okay. So he was able to go in there, paint what he needed to paint, and Facebook paid him his shares, and he was able to get wealthy and retire for the rest of his life based off of that. Okay. So that's the legitimate reasons between the two. So we have to understand that, okay, that's why resistance occurs, and that's why support occurs. So now that we understand them legitimately, let's put everything in perspective. So let's talk about the two things that market will try to do before market can go in an upwards direction. So if I'm trading cryptocurrency and if I'm trading stocks, a majority of the time, I'm going to be looking to play to the upside direction. Okay, I'm not interested in shorting for the most part. I rather personally buy a dip. Okay, but shorting is going to come for something more like Forex, but we'll talk about shorting as well too. Okay, so the stock chart for the most part, as you can see, if I check out Microsoft, it does nothing but go up in a straight line. If you dollar cost average into Microsoft, you can see you're almost guaranteed to make some money. Okay, so year after year after year after year, the stock does nothing but go up in a straight place. Okay, so while people are spending money on anything on the block, okay, you can go ahead and be investing, keep dollar cost averaging, and he's going to infinitely make you more money. You'll retire quicker than everyone. You won't be stressing about bills as much as everybody. And you'll also be getting paid some dividends too, depending on how many shares you have. So it's a lot of advantages to being invested in the stock market. And dividends are going to go ahead and be quarterly money that the stock owners give you, because they're like, hey, thank you for making us money by investing into us. We're going to give you some money back. So it's infinite money to be made as long as you know what you're doing. That's why education is going to be extremely imperative. And you can just see your portfolio year after year after year on the max long-term gain. You know, forget certain small, just day trade gains. Okay, we want to see our portfolio all time when we pass away be positive. Okay, substantially. That's the goal here. Okay, so don't think so short term. Too many people are thinking short term, thinking now, thinking too quick, and that's really going to ruin your long-term perspective. Okay, so even when you are putting these support and resistance setups into play, okay, we need to be trying to make sure that we're holding trades for at least some time. We don't want to be closing like instantly. We don't want to be trading like that. We want to be making sure that we're sitting on our trades, making sure we're really having. So let's go and let's talk about support and resistance setups and how we can put all this information into finding profitable setups. So, one, we always know that cryptocurrencies and stock market companies are trying to go in an upwards direction. Why? Because there's benefits to them. Okay, the higher the cryptocurrency, whoever coded the cryptocurrency, whoever runs it, whoever created the whole idea, signed the white paper, etc., is going to benefit from them. So they definitely want it to go in an upward direction. They want people to be investing in their token. Okay, what pros does it bring? Okay, Bitcoin lets you send money, or cryptocurrency in general lets you send money to anywhere across the world instantaneously. So it already has some baked in value. And then it might do some other cool stuff as well too, like, you know, throw on Solana. It lets you trade meme coins, create your own cryptocurrency coin. Okay, so bringing more power back to the people, making people feel even more involved. So certain cryptocurrencies expand on the fact that it just lets you send currency from one person to another at a quick rate, but it actually lets you put some power back into the economy. So this is why charts are going up and down. They're not just going up and down for no reason. I'm not going to give you guys fake mentorship, fake courses, just fake information. Like, it's not just about wicks. It's not just about candlesticks, and it's not just about logistical formations. We have to understand the true logical fundamentals of why the whole chart is even going up and down in the first place, because then we can understand things from a really big long-term perspective, and it's really going to help your anxiety too. Okay, if you're feeling emotional, like, man, I don't know if this is going to go up, you have to understand that the goal of it is to go up. No matter how low something dips down, the goal of it is to go up. Check out this Amazon example here. Okay, Amazon, it was at $188 a share in 2021. Okay, dipped all the way down to $82 a share. I'm sure people thought, oh man, that's it, Amazon's going to zero. But guess what, guys? As you can see here, and we'll jump into the technical basis of it here, all it did was bounce at the same area of support to the left. All it did was retest. Okay, all it did was retest. So instead of trying to predict the exact tops and bottoms, just understand that the goal and the basis of the market, okay, even Forex, for example, okay, the goal of the basis of the market, every single market, is to go in an upwards direction. I don't care if you're trading gold, stocks, crypto. Understand that it's the basis of it is to go in upwards direction. Now, that doesn't mean that you can't short when the opportunities arise, but understand that the whole reason price is dipping down is to find a new low and go back in an upwards direction. Okay, especially when it comes to stocks and cryptocurrency. So you can see here, and we'll jump into the technical understanding of this here. All market did was bounce at this area of support and then come over here and do it again at the same place. Market is not difficult, okay? The real reason people make money is because they sell too early. They're playing with too tight of stop loss, okay? So that brings me back to the point again too. If you're trying to be perfect within the market, you're gonna struggle, okay? Don't be perfect within the market. Only God is perfect. Just get your money, understand how your levels operate and work, and make the best play that you can. Okay, now when it comes to something like options, futures, and Forex, you do have to be a lot more precise, but understand what type of directional bias that you're playing when you're getting into a trade in the first place, okay? So if I'm trading Amazon here, right? Let's say I didn't catch this ultimate low, right? So price decided to bounce up this area of support once here in 2020, came down a whole 3 years later, bounce at the same place. All right, cool. Let's say I didn't even catch that certain low. You're fine. There's still going to be plenty of opportunity you can catch, okay? Because one, you know, price is always going to try and chase the resistances above current price, okay? Because they're trying to break into all-time highs. Investors are trying to make some money. Company holders aren't just slaving, busting tail for no reason. They want their company to be the biggest, the most profitable, okay? So share price is trying to increase for an incentivization. Okay, there's a reason why it's trying to increase. So say I didn't catch this ultimate support low here, okay? And speaking of this, market will try and do one of two things. A, market's gonna try and bounce at an area of support, okay? Or it's gonna try and bounce at an area of resistance, okay? Just simply cleanly, okay? So market will duplicate itself, either just like this example here, you'll see two areas of support being bounced upon on the same exact line, same exact tick, same exact level. It's extremely simple once you start realizing what you're looking at, okay? So market will either bounce at the same areas of support or bounce at the same area of resistance. I personally call that a mirror. So in the Stackmode community, this is what I call the mirror, okay? So I'm either gonna see a support mirror or I'm gonna see a resistance mirror. Okay, this is gonna be a really, really clean way to look at the market. Very, very simple. And the market's gonna do this over and over again a lot of the times. Okay. So that's criteria number A. Let's talk about criteria number B. So A, say resistance can be broken and turn into support. Okay. So these two examples here, a support mirror and resistance being broken and turn into support, those are going to be examples that you take in order to long. So if you think or you speculate whatever you're trading is going to go in an upwards direction, these are the only two setups you should ever take. You shouldn't be taking anything else. Either you're looking for two areas of support to mirror each other, just like the blue line right here, or you're going to be waiting for an area of resistance to be broken and turn into support, okay? And that's going to let you know that, inshallah, for the most part, price wants to make a structural continuation, okay? And if you're going to take a downside trade, okay? So let's say you think price is going to go in a downwards direction. You're either going to take this setup where you're looking for two areas of resistances to mirror each other and then fall down, or you're going to be waiting for support to be broken and turn into resistance. So the opposite of resistance being broken and turn into support, you'd be waiting for support to be broken and turn into resistance, okay? And this is going to let me know if I'm going to take a short setup. Okay, so these setups over here, two areas of support bouncing on each other at the same line, okay, and then bouncing in an upwards direction, okay, boom. That's going to give me a support mirror. That's going to let me know that price wants to go in an upwards direction. Or I can wait for support to be formed after an area of resistance is broken. That's going to be break and retest. And if I'm going to take a short setup, which means I'm speculating that market's going to go in a downwards direction, I'm going to wait for two areas of resistances to mirror each other and fall in a downwards direction. Or I'm going to wait for an area of support to be broken and turn into resistance and wait for price to fall in a downwards direction. Okay, giving me a downward staircase. Or if I'm looking for an uptrend play, I'm looking for an upward staircase. So I'm going to go ahead and show you some examples here. So we're going to go ahead and scan the stock market, cryptocurrency market, and let's go ahead and let's talk about how we can analyze plays. Okay, so first thing I like to go ahead and do, start off on my higher time frames. We're going to always start off on our daily. Okay, we're going to be on our daily time frame due to the fact that we see everything. Okay, we got to see the whole chart from left to right. We're not about to be tunnel vision on the smaller time frames. That can be really frustrating, misleading, okay, and it could really just make you look at something that you don't even need to be looking at in the first place. Okay, it's giving you a whole different story, something that's just not true. So we're gonna be looking at the daily. Okay, zoom out, see everything, and get the bigger picture of everything. And after the daily time frame, you can go down to your 4 hour, especially on the stock market too, since it's 24/7. You got to go down to your 4 hour time frame to see certain wicks. Since extending trading hours is going to be a thing. So on whatever broker you're on, make sure you have your extended trading hours. If you're on Trading View, go to the bottom right, turn on ETH, extended trading hours. Go. So your daily time frame is going to help you see everything. So one, don't trade anything that's going to be at all-time highs. Okay. Don't short at all-time highs because that's gambling, in my opinion. Wait for support to be broken and turn into resistance. Okay. Or if price goes below and gives you a resistance mirror, then you could take a short. But even if price is at all-time highs, don't just short because it could really keep going in an upwards direction. But that's the thing. You don't really know how high it's going to keep going because there's no resistance above current price that's made appear or appear. Okay. So something's at all-time highs. A lot of the times I like to wait for a pull back. Okay. I'm not going to trade it way up here. I'm going to wait for something that's either below, okay, and then catch a sweep in an upwards direction, okay, or I'm just not going to trade it at all. So I'm not going to force myself to trade something all-time highs. I'm going to go to the big, giant, mighty stock list that I have, okay, and I'm going to be able to choose something else, okay. So one, I want resistances above current price. So I can see here on Amazon. Amazon will be a great investment in my opinion. One, I got resistances above current price here, okay. Tons of resistances above current price. So that's letting me know that one, price has somewhere to lead to, okay? Price has space to fill. When I can see space that needs to be filled, okay? This is just money I'm looking at. All I'm looking at here is money, okay? I know the stock market is trying to continuously break areas of resistance because price needs to keep making new all-time highs. So after price decides to make its own little base, make its own little low, like here, for example, okay? You can clearly see this is the most easy setup of all time. God is good. Okay. So when you just study and you have the eyeballs, okay, of just a warrior trader, things become easy. Okay. So check it out. You got support being created right here. And then you got an area of resistance being created over here. Okay. I'm going to go to my 4 hour time frame. Okay. I'm just super duper excited about this. Okay. Because check it out. I'm excited right here. So I'm going to let me know resistance being created right here. Okay, I can see the breakout happen. I'm not a breakout trader, okay, so I'm gonna let them have that. They can take the breakout. I'm cool off that, okay? What I'm gonna wait for is the area of resistance to come back down and turn into support. And I can see price decided to do that. So price decided to turn the resistance over there into support, letting me know that, okay, price wants to continue the staircase, doesn't want to push down any lower. This is gonna be a pretty safe phase for me to go ahead and buy. Not only that, I see price making what's called higher lows. So I can see that. Let's go ahead and let's methodically map this out here. So I can go ahead and see that this low right here, right? This low is higher than this low. And this low up here is higher than this low. So not only do I see break and retest, I see price moving within a staircase direction. So I can go on my daily time frame put everything into perspective, be like, hold on, okay, cool. So I can go ahead and use these two areas as stop loss if I wanted to, okay? And take profit and catch this whole area up here to the upside. Okay, I still got 15 points of price action I can go ahead and catch. So much money for me to go ahead and make up there. Okay, it's super duper exciting. It's exhilarating once you see the market structure like this. So putting everything in perspective, you can see that, okay, there's so much money for me to be made. Even though I didn't get in at the pixel perfect entry, a lot of the time you don't want to get in at the pixel perfect entry. You don't want to be getting in at the first wick of the blue. Okay, I'd rather get in on the second candle. I'm personally waiting for a candlestick close. Okay, you want to wait for candlesticks to be above this certain entry because you don't want to buy at the wick and then get dumped down on, because then you're going to be upset. And then you might just be really in a situation where you're just praying it goes up. Okay, so play logically. I would personally wait for a candlestick close. I can see the area of support got tapped. Okay, price decided to try the zone multiple times. Buyer stepped in multiple times, held the same area, and I can go ahead and take this whole upside and catch the whole remainder of this amount of profit. It's crazy amount of money to be made. Okay, so this is how I'm going to be able to use support and resistance and put that into a logistical setup. Okay, so I'm looking personally for gaps. I'm looking for these gaps to be filled. I know that price is trying to chase the resistance, so I can use the whole gap as my profit window. Okay, break it down logically. I'm going to go ahead and show you another example here. So class, it's about making it simple. Mark your levels. Okay, no indicator is going to help you more than horizontal lines. That's one thing I'm going to go ahead and tell you. Okay, I don't use any indicators, and most decent traders don't need indicators. Okay, don't rely on something that's late. Okay, your eyeballs and the way that you're reading your technical analysis is going to be a lot safer and a lot more reliable than an indicator that's going to be late. Okay, take this area right here. It's easy. You can see price breaking here. Okay, price decided to break through this area. Okay, and this area seems to be important. And if you don't see everything you need to see on your 4-hour, don't feel afraid to go down to your 30-minute in your 15-minute. Okay, so I can see supports being created at this area right here. All right, and price broke out right here. Let me scale down. Let me see what happened here. Okay, I'm gonna scale down a little further. Okay, so it looks like price just wants to hold some support here. Okay, so price wants to just create its own structure. Okay, the support seems to want to hold. It could potentially break down, but we'll go ahead and we'll see. Okay, if it does break down, we can go unprepared though. So just like we talked about certain models, I'm personally looking for resistance below current price to turn into support, or just like you see right here, supports to be mirrored upon each other. All right, so say the support gets broken. I'm cooling. I'm not gonna be tripping. I'm gonna go and put the next entry right here. Okay, I'm gonna try again right there. Okay, you can go ahead and try an entry right there. Okay, try a zone right here. And personally, if I see price come down to these areas of resistance, turn into support, then I know it's going to be a pretty safe place for me to go ahead and continue the staircase. Okay, so even if this area of support gets broken, I can go ahead and re-add or try again at these certain areas right here too. Go. So putting everything into logical perspective, once again, is really just going to help you understand how the market works. And it's really just about patience too. So patience, 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 patience. So waiting for the setup to happen, reading everything on the higher time frame, and just letting the market do its thing. Okay. And you could really just eyeball certain curls too. Okay. Even if you get on the line chart, for example, and I'm on my daily, if I'm on the line chart here, for example, I could use no candlesticks if I wanted to. Okay. I can just look at this pure line chart, see price curling up in an upwards direction here. Okay. And I can clearly see, okay, if I have a daily curve, like bottom on the line chart, for the most part, I'm good. I'm just going to be honest. Okay. That's just what I'm going to be looking for sometimes too. Okay. So I can clearly see that price wants to try and chase these areas of resistances up here and this area of resistance up here. Okay. So if I got on my line chart here, I can see price decides to create area of support right here. Okay. Look at how simple this is. So you have the area of resistance right here. Okay. Being created. Price broke out. Then price decided to turn this resistance into support. And then price is looking to fill the whole rest of the gap. It's extremely simple. It's over and over and over again. It's every pair. Okay. You can make money every single day, every single day. Okay. So even if I check it out on the candlestick chart here, it's going to show me a little bit different information, but I can see on my line chart here, everything plays out how I need it to. And it's confirming the fact that the rest of the space does actually want to be filled on the candlestick chart and the line chart, inshallah. Okay. And then from here, I would go ahead and just buy a contract a couple weeks out and just take the whole rest of the gap fill. So let's jump into some crypto. All right. Stocks are easy. All right. Crypto can be a little bit more sideways. Stocks, for the most part, they just go in a straight line. If it's a decent stock, it's going to be really easy to read. Crypto is really easy to read though too. So it's just about trading what you want or trading both. Okay. Because take this example right here. So I marked out this all-time highs a couple days ago, and we decided to break it. Looks like today or yesterday. So mark this out here, and looks like price decided to break out. As you can see, I had the line there before we even got into the recording. So I know that price is always looking to break areas of resistance, what I tell you guys. So no matter if it's all-time highs, price is looking to break it, and we're going to keep breaking it over and over and over and over and over and over, inshallah. Okay, even if we sweep all the way down, it'll still try and come back up one day and go right back up. Okay, we can sweep all the way down there. Okay, if price wanted to, price can sweep all the way down there and then still break all-time highs one day again. Okay, that's just purely how market works. When market decides to go down and find certain lows, all it's doing is collecting ammunition, pretty much collecting more money. Okay, from anybody who's trying to long. And all of this is people selling who got in from way over here. Okay, let them sell, let them sell, let them sell. You know it's gonna whipsaw back up, inshallah. So all-time highs getting smashed. So boom, all-time highs got broken today and yesterday. So extremely exciting here. So I had these lines placed a couple days ago, and price decided to just meet with them. Okay, so you guys know I'm not lying here. Okay, price is always gonna be looking to break all-time highs, certain areas of resistance here. Okay, so let's make it simple. So even if you didn't get in at the super Goku low all the way down here, okay, you could still see market doing its thing. Okay, so market bounced at this area of support here twice. Okay. We had one little area. Okay, if you would have missed it, it just was what it was. Okay, nothing to cry over. Plenty more entries. Okay, plenty of more entries. So we had this entry, for example, here. See, we had this area of resistance. Price decided to break above it. And then turn it into some support. And then price decided to go in a upwards direction. Okay. So very, very simple. Just clean area. And we're looking for break and retest, waiting for price to go ahead and continue over and over and over again. Okay. Even here too. So just like I told you, support can be broken and turned into resistance. I like to call this support invalidation in the Stackmode community. So you got this area of support here, and you can see resistance got created off of it. So support turned into resistance, and then price invalidated the support, met up with that area, right? And then, yeah, filled in that gap. So support and validation. If you see an area of support above current price, and price just runs through it, all right, then that's going to be a pretty safe area to go ahead and momentum trade as well too. Okay, because an area of support above current price, if the resistance doesn't hold and price runs through it, then it just wasn't a strong area. Okay. So let me get on my daily time frame here. So I'm going to go ahead and put a line on the top of all-time highs here. Got this area of resistance all the way up here. Very cool. And let me go ahead and go to my 4-hour time frame here. All right, on our 4-hour time frame, and I can see we know where price is heading to break this all-time highs here. Okay, Ethereum's not about to reject here forever. Even if it created resistance on the blue line a million times, inshallah, and dipped all the way down to like 1K, inshallah, one day it was still trying to get broken. Still, it's just how the market works. Okay, because you have to remember there's still investors in from way back to the left. Way back here, people are invested, so they want it to go up too. So price is trying to reach this all-time highs area up here and fill in the rest of this gap here. So when you close, well, no, I won't say that. But when you close and when you buy are both extremely important. When you buy, I'll say it's less important than when you close. Because you could buy at a pretty bad area, but if you close at the right time, like you'll still make money. Or you could just buy pretty late, but if you close at the right place, you'll still make money. Now, if you try and hold past an area where you should be closed, that's where things could get scary. And you bought a bad area, that's where things could get really, really bad. So yeah, it really depends. Like if you were to buy it right here and you just profit at the all-time highs up here, that's fine. But if price hit this all-time highs and then dumps down, okay, you bought up here. So anything less than up here would be negative profit. Okay, so it really just depends how you play it too. So even here too on Ethereum, I could see this area of support got created here. And that's because this area of support bounced off of this area of resistance over here. Okay, resistance got broken through. As you can see, we even had another tap right here too. And then price decided to go in an upwards direction, and price came back down into the zone. Okay, turn the resistance here into support. Okay, it's really this wick right here. Turn the resistance here into support and bounce in the upwards direction. And as you can see, the whole area decided to stay and fill in. Okay, and then price decided to continue to just break and retest and do its thing. Okay, and it even spammed it again right here too. If I go ahead and put this line here, check out this area of resistance. And you can go ahead and see this area of support being created off of this area here too. And then price decided to go in an upwards direction. And no coincidence as well too, it's also going to be a support mirror. So once again, you can see price deciding to make this area of support over here because there's support over here. Okay, so support decided to mirror itself and bounce in an upwards direction. Okay, you can also see over here, price decided to create resistance here because of the resistance over here. Okay, then price broke that too and continued to go in an upwards direction. Okay, so all price is going to do is just mirror each other. Now, as you can see, whenever it does short, it's not lasting. It's not falling down to zero. That's because it's not time. Okay, it takes a whole market wave in order to have that happen. Okay, it takes a lot of traders, a lot of liquidity, and a lot of money in order to have that happen. Okay. So we'll jump into some Doge here. So this example here I marked out yesterday, and looks like we're getting some positive price action from here. Okay, pretty good trade. Very, very simple. So all I did was mark out this area of resistance here. I have this strong area of resistance right here, and even way to the left over here. Okay. This whole area is just letting me know that, okay, price keeps shorting here, and I could see that price decides to break the area of resistance, turn it into support. Okay, and now price is going in an upwards direction. Okay, so I can go ahead and see price wants to try and fill in this whole gap all the way up here. Okay, so even a Doge gap here would be pretty simple to go ahead and take and play. Okay. So just take your time. Okay, whenever you're analyzing your setups, take your time, and you're looking for support and resistance in just certain key areas. Okay, you want these key areas to be reacted upon off of, and you want gaps to be filled. So, yeah, so you're just looking for gaps to be filled. That's all you're looking for, essentially. That's it. That's it. Okay, you know resistances have to be filled because price is trying to break new highs. Okay, and that's it. You're just taking advantage of knowledge. Okay, so take this example. I can see price wants to go ahead and reach this areas of resistance up here. Okay, so I can go already and see price wants to fill this whole gap right here. Okay, so I go to my 4-hour time frame. Check out the area of resistance, super duper clean area right here that reacted off of twice, once and then twice. Simple. Okay. And I can see that price wants to at least try and gap this area here. Okay. So how can we catch a setup? One, I already know price decides to create some support over here. Okay. Once you see some support created like that with multiple daily closes, a lot of the times, you know, price wants to go ahead and sweep. Okay. So sometimes too, it's just about just buying. Okay. So if you see price starting to curl like that, or if I get on my line chart here and I start seeing a daily curve like that, okay, and I start seeing a sharp bottom with the V formation and everything looks how it should, then ideally I can be like, okay, you know what? I think price wants to actually go in an upwards direction. Okay. And you can go ahead and you take your chance and you mark out your trade. Okay. So let me go ahead and check this out here. So I can see this area of resistance here on the line chart. And sometimes you can bust out the line chart just to see everything a little bit clearer. You can also see these areas of support over here too on the line chart. So I'm like, okay, is this area of support pretty decent? Okay, it's being reacted off of once, and we had a large area of support being reacted off of over there. Let me go back to my candlestick chart. Can see the support a little cleaner. So if you notice the candlestick chart is a little too jamboree or too much, feel free to turn on your line chart sometimes too. Verify your levels, look for curls, and get your gap fills. Okay. It's going to be really, really simple to make some profitable trades. Okay, so I can see from way to the left over there, the support level. It's not just any level on the block. It's actually a pretty good level. Okay, that price wants to react off of. So let me go ahead and let's do another example here. So let's pull out some BNB. Yeah, BNB is normally always at all-time highs. It's a really good crypto. So it's at all-time highs. How would I play this? So personally, I would wait for a pullback. Okay. If I'm going to short it, okay, well, let's talk about that for example. If I'm going to short it, I would take this area of support here, wait for it to turn into resistance, and then take it to the downside. And my take profit would either be the area of resistance below it or area of support. And the reason why I'm not too keen on shorting, honestly, is because my take profits are going to be smaller. Okay, you don't know how badly people want to just buy the dips. Okay, people could be fiending and hounding to buy the dips instantly. Okay, as soon as these things dip, people buy the sweep up. Okay, let's check out Bitcoin for example. Okay, that second Bitcoin dips, it recovers instantly. Okay, Bitcoin could have an extremely heavy dip, and it's not people thinking, oh, it's going to zero. No, it's people loading up their pockets in stack mode, ready to unload. Okay, so boom. Price dip down to 100K. Okay, out. Okay, we dipped down to about 100K, and the dip instantly ripped up and recovered. Okay, instantly decided to just capitulate that whole reversal and just reverse the reversal. Okay, and as you can see, continue to see breaking new all-time highs or making higher lows constantly. And higher lows is always going to be a great sign here. Okay, I can go ahead and see here. Price decided to make this area of support here too, or make it higher lows. Okay, higher lows. It's going to let us know that we're trending. Okay, we're trending in an upwards direction. And that's what we're going to be wanting to just take advantage off of. So just keep dollar cost averaging, looking at the areas of support, be like, okay, you know what? If this area of support gets broken, I can look for the next area of support. Okay, so you could use this for your short or your long end. Okay, or you can wait for price to come down, maybe bounce at this area of resistance here. Okay, and if you see price come down to any of these areas, give you a daily close with a sweep up, feel free to go ahead and buy any of these lows. Okay, they're already verified. So if price wants to retest these lows, all it is confirming that price wants to trend even harder. Okay, could potentially be this low right here from this support. Okay, could either be an area of support below current price or an area of resistance below current price. It's going to choose. Okay, and then from there, we're going to just go in the upwards direction. All right, so that's going to be the support and resistance masterclass. Head over to Stackmode.net for all trading education. Stay productive, God. Keep grinding. What's going on, class? We're going to be talking about options mistakes that we just have to avoid, inshallah, if God wills. Okay, we don't want to be destroying our portfolio, destroying our future, destroying our dreams of buying the house, buying the car we want, living how we want, paying all of our bills and clearing our debt, etc. Okay, Avoid these mistakes to avoid destroying your future. Okay, we got people to protect and provide for. Okay, and even yourself, you got to provide for yourself. Okay, so let's go and let's jump into the mistakes that we just absolutely have to avoid. Let's jump into it. So, mistake number one, having a gambler's approach. So, one, you got to know how options work. Okay, you got to know what you're doing. You got to know what expiration date you want to buy, etc. Okay. So the problem that people have when they come onto options is that they see people posting, okay, they see people making big flips, big giant profit flips, etc. And then they're like, whoa, options is going to be crazy. And they come on with a lack of information expecting certain results. So don't have a gambler's approach. Have a logical approach. Know where you're going to close at. Okay, if you're going to take a long trade, okay, you should know that you should be purchasing a calls contract. Okay, if you're going to wait for an area of resistance to be broken and turn into support and then take it up to the upside, then close at an area of resistance. Know where your take profit's going to be. Know where your entry's going to be. And most importantly, know where your exit's going to be. Okay, don't just hold your trade forever and cook your trade past certain areas. Because there's going to be a lot of things that come into play with options, such as theta. And theta is going to be part of what's called the Greeks. Okay, and theta controls time. Okay, so theta controls time. So keep that in mind. Okay, so there's going to be things we can do to get past this. So have a good time horizon. Okay, even if your take profit isn't that many points away, try and buy contracts at least, I'll say 3 months to 2 years out. Okay, and that's going to be called a leap contract. Okay, you want to be buying leap contracts. Okay, you don't want to be buying 0 DTEs, you don't want to be buying a week out, etc. Okay, due to the fact that you're going to be fighting time. Even if you're right, you're still going to be fighting time. Let me tell you guys a story. There's been times where I made $900, I think $30 in a day. Okay, I hedged on a Jay Powell speech. Okay, hedged on a Jay Powell speech, and I was up. I told myself I had a 0 DTE SPX contract. Okay, if you've ever played SPX, it tracks the S&P 500, but it's just a really boosted up version of it on options pretty much, okay, compared to the SPY. So I had SPX contracts, they were boosting up. I'm up around $930. I'm thinking I'm going to hold all day, not understanding how theta works, not understanding how the time works on the options. So due to me thinking that, came back to the trade, and the trade was then in the negatives. Okay, so I went from up being almost $1,000 in a single day to coming back negative a couple hours later. Okay, due to the fact that I got eaten up by theta. Yes, the trade continued in a certain direction, but as the day decided to decline and go on a further downtrend, okay, the market decided to flatten out, killing the 0 DTE contract. Okay, so if a transaction that you buy for a contract is looking to expire on the same day, okay, you can't expect to hold for a long time. You can't see your trade out the way that you want it to. So make sure you guys are buying at least 3 months to 2 years out. Okay, it's gonna really be important. And having the gambler's mindset is gonna be the most fundamental error. And options trading offers high leverage. Okay, due to the fact that an options contract, it lets you play with 100 shares. Okay, keep that in mind. So options trader offers high leverage, which attracts speculators. Okay, speculators is when you're playing off directional bias, and on options, that's how you get paid. Okay, you're getting paid based off of choosing the right direction. So if the current price is going to be at 50, you think price is going to go to 52, okay, and you buy a 51 or 52 strike price contract and price hits there, you're going to go ahead and make some money, inshallah, if God wills. Okay, so that's how it works. So anyone who treats options though like betting and has a lack of repeatable tested strategy means that your results will be entirely random and often negative by the end of the year. And why it fails. Okay, you could have inconsistent and entry exit rules. You got to know where you're playing at. You got to know why you're playing. Okay, ask yourself why and where when it comes to the market. Okay, where am I going to close? Where am I going to enter? And why am I going to enter? Ask yourself these questions before you press buy or sell. And traders enter on a hunch, right, and exit based on panic or greed sometimes, leading to inconsistent P&L, profit and loss. When you're just closing wherever, you're destroying what's called your risk to reward ratio. Okay, so if you risk $100, you want to try and at least be making $400 or at least $100. Okay, so then you would double your money. Okay, so 100 plus 100 is 200. Okay, so put that into mind and do your risk to reward. Okay, you can play 1 to 2 risk to reward, 1 to 3, okay, 1 to 4. Do your math. So, but just try and at least make your return back. Whatever that you risk, if you risk $750, try and make at least $750 back. Okay, so that's gonna be a really a 1-to-1, I'll say. Okay, just try and make at least your risk back. So, and journal as well too. Okay, put your trades in a Discord and your notes, your physical notepad, whatever, wherever you want to do. Okay, I'm creating the Stackmode app, generating it right now, where you guys can go ahead and track all of your trades as well too, coming out very soon, inshallah. So you can have some emotional decision making can happen sometimes in the market. Don't do anything that you don't need to be doing. If you're invested heavily into a shares play, okay, don't just pull out your money. Okay, keep it. Okay, if you believe in your view, if you believe in your trade, you can't be disrupting your process because you want to take out some money and be hasty and do something real quick. Go grind and go get some more money. And when it comes to pure candlestick formation, if you see markets going a big upwards direction, a big burst, and you don't have any logical plan around it, no area of resistance where you want to close at or support above current price or any type of plan behind the trade, just don't take it. Okay, and the solution, right? Define your edge. Okay, figure out what you like. Okay, do you like calls? Okay, you know that market's going to be an upward trend. There's a reason why market goes in upwards direction. They put jobs in the economy, and the company pays taxes, okay, which feeds the government, okay, and then the government can help the people, and it's a big cycle. So there's a reason why these stocks want to go up in upwards direction. So choose for focus. So ask yourself, are you an income trader? Okay, do you like cover calls on puts, or are you a volatility trader? Where you like straddles and strangles? Okay, stick to one initially, and never enter a trade where the potential loss exceeds the potential gain. Okay, just don't do it. It's not really worth it at all. Okay, take your time. Okay, make sure you guys are getting at least try to get at least a 1 to 2 risk to reward ratio, 1 to 3 risk to reward ratio, and at least a 1 to 1. Okay, never try and go negative with certain things if you want to earn on a good trade. Now, if you lose, you lose, but try and make some money on your trade. Try and go for at least a 1 to 3 minimum if you want to start growing your account. And specify the maximum duration that you want to hold for, okay? Because the longer that you have, the more of a risk reward that you can get, because you can have bigger take profits. You can use your higher time frames to look at your take profits, okay? You can use your weekly time frame, your daily time frame, your 4-hour time frame, and set take profits weeks and weeks and weeks away. Grind in real life, wake up, pray to God, go work out, keep building yourself, keep working on yourself, and then boom, trade hits take profit, take the next play, take the next play, take the next play. Since you've been working on yourself so much, then inshallah, God wills, you have some more capital. Put that into the next play and just keep going hard. So we'll talk about the Iron Condor. So a structured strategy is like the Iron Condor. Okay, it's a non-directional, and it relies on the stock not moving too much, meaning expecting it to go in a flat direction. Okay, and your strategy must detail how far out of the money you place the wings, the expiration date, and the precise profit target, for example, 50% max profit, and where you will close the trade, regardless of the market movements. Okay, so keep everything in mind like that. So mistake number 2, right? The silent killers. Let's understand theta. Theta pretty much just equates to time. So options are decaying assets. So as soon as you buy it, it has an expiration date. You can hold shares forever, but options are leveraged. So if you're right in a certain amount of time, you will get paid. And options are decaying assets. And unlike stocks, time is going to be an enemy to the buyer and a friend to the seller. The rate of decay is known as theta, and accelerates rapidly in the last 30 days before expiration. And the theta trap for buyers. Okay, sometimes there's going to be a steep decay curve, and an option may lose 20% to 30% of its value in a final week due to theta, even if the underlying stock price remains favorable. And buying too close to expiration. Trying to maximize leverage by buying 0 DTE. All right, and 0 DTE means 0 days to expiration. It'll expire at 4 p.m. Eastern Time, New York Stock Exchange time. and then can't be held overnight, and you have to reopen it again. Okay. Or 7DT. Options increase the risk of total capital loss exponentially. And the implied volatility rate, crush. The implied volatility measures market expectations of future stock movement. And options prices surge when the implied volatility is high, usually before earnings reports or major news. And if you buy an option high IV, an expected event passes without a massive move, the IV would crush, causing the options value to plummet, regardless of the stock's minor price change. And some practical fixes. Options bought with the 45 to 60 days to expiration offers a better balance between theta decay and market responsiveness. And if your IV rank is high, right, say above 50%, consider selling the options. And strategies like spreads, okay, are going to be in the play too. And if IV rank is low, it's generally better to buy a premium in general. Okay. So, mistake 3, the blow up risk. So, using too much of your capital on a single trade. So, make sure you guys are trading between 1 to 10% of your account per trade, okay? And choose whatever percentage that you want and just stick to that, okay? Don't over leverage. Even if you hit a big giant chunky play, you make the most money in the world, okay? Stay between your risk parameters, okay? If you have $1 million, then the max that you ever want to trade with is 100,000, okay? You need to be doing it like that, okay? Break it down, okay? Break it down. Or I'll say 10,000. Yeah, 10,000, and break it down like that. Okay, decide how you want to trade and how you want to grow your portfolio. So options provide phenomenal leverage, which is their double-edged sword. And a beginner often uses 50 or 100% of their available capital on 1 or 2 trades. Now, if you know what you're doing, you're depositing your money in certain ways, like, okay, I'm going to use all this money for options, then that's different. Okay, but putting up your account where you have shares and everything, and then just showing your account on a couple of trades or bad decisions, it's just not. Okay, so believe in the high probability of return justifies the risk. And this single mistake accounts for the fastest depletion of trading accounts. Okay, please do not overexpend your risk. Take your time. Do not use too much capital over your trade at once. Okay, spread out your trades and grow the wealth over time. Get rich slow. Okay, it's important to take your time. It's important to just stay down, wake up, pray to God, and just grind. Okay, keep putting the money away, keep investing, and I promise in a couple of months, the play that you're investing to, whatever, okay, just give it time. Inshallah, it'll pop. Okay, you have to give it time though. You can't rush by trying to use your whole account unless you structure your account like that. Okay, but if you know that you're trying to keep your account alive, don't just put it all into one giant trade. Try and spread it out. Diversify a little bit. So all of your capital can't just be tied to one underlying asset. And if that asset faces unexpected news, the entire account can be at risk. And sometimes there could be margin calls on spreads. Now, selling options or spreads without sufficient collateral means a sudden unfavorable move can trigger a margin call, forcing liquidation at a loss. And trading the farm. So risking more than 5% of your total account value on any single trade is mathematically unsustainable. Okay, so you could do 5 to 10% if you want, but 1 to 5% is going to be strong too, as a short losing streak could really wipe you out, honestly. Okay, but if you lose 10 trades in a row and you blow your account, then yeah, I understand how you could lose 10 trades in a row, but 5 trades gives you a lot more trades. Okay. So the 1% rule of risk management. So the gold standard, right? Never risk more than, I'll say, 1 to 5% of your total trading capital per trade. And these mean that if your account is $10,000, your maximum potential loss in your position, it should be around $1,000. Okay, $1,000 if you're doing 10%, or it should be $500 for 5%. And this ensures that you can sustain a long sequence of losses while preserving your capital for future high probability trades. And this is for you to have protected thoughts, choose trade structures with limited risk, like defined spreads, and trade smaller and with more manageable positions. So calculate your max loss as well. So before every trade, determine the absolute worst case scenario and ensure that your trade is meeting the 1 to 5% rule. Okay. So keep majority of your capital in cash if you're not sure that you want to trade, and then you can deploy your positions when you take your time. So mistake number 4, right? the hope and pray method. Okay, we wake up, we pray to God every single day, but we can't just make horrific, horrible decisions. And bad traders set a trade and then just ignore it. Okay, we got to know where we want to close at. Okay, you can't just hope the trade is going to work out. Okay, you got to have a logical plan before the trade is even placed down. So make sure that you have a highly active process that involves a strict entry, exit, and stop loss criteria. And don't hold your winners too long. Close at take profits. So letting a trade run all the way to 100% max profit is rare and inefficient. You expose yourself to accelerated theta and assignment risk for a minimal additional gain. Okay. All right. So we pray to God every single day. Okay. We ask for hope. We ask for strength. And we're going to ask for wisdom to not make bad trades. Okay. We don't want to be buying at all-time highs and then expecting it to go up. Okay. There's certain things. Okay. Take Jesus, for example. Jesus did not jump off the cliff. Okay. Due to the fact that just didn't test God. Okay, so there's certain things that we just don't want to do as human beings. That's just a bad decision. Okay, I want to pray for wisdom. So cut your losses too. If you know your trade isn't going to work out, if you know you need to chop it up, chop it up. Don't hold past stop loss, especially on Forex and futures. Get margin called. Okay, so take your profit too. Take profit at certain places and make sure that you guys know what you're doing. And the unforeseen cost, okay, ignoring regulatory and tax complexity. So the IRS and other tax authorities, right, treats options differently than stocks. Furthermore, the risk of assignment or exercise an option can create unexpected financial obligations, especially when dealing with short sold options. So the tax headaches. So certain options like those broad-based indices such as the SPX or NDX are at a tax beneficial of 60% long-term and 40% short-term rate, regardless of the holding period. Okay, and this is the active factor ignored by many traders, so keep that in mind. And trading options can easily trigger complex wash sale rules, preventing you from deducting a loss if you reestablish a similar position too quickly, leading to unexpected taxable gains. And avoid risk at expiration. So when you're selling options, there's always a risk that the options holder will exercise it, forcing you to buy for a put or sell for a call. And the underlying stock, this could be especially dangerous when a stock closes exactly at the strike price. Okay. And for the solution for that, always close short options, even those worth just a few pennies, before market closes on expiration Friday to eliminate assignment risk if that's how you're selling options. And the tiny commission is going to be worth avoiding the overnight risk of being assigned thousands of shares of stock. So some key takeaways, right? Develop a mechanical, repeatable trade plan with defined entry and exit and management rules so you know what you're doing whenever you're putting down some size. And respect theta. Theta means time in options world. Can be mindful of the time decay. And trade strategies that benefit from high implied volatility when selling and low implied volatility when buying. And adhere to strictly to 1 to 5% maximum of your account, okay, per trade to protect your capital from inevitable losing streaks. And you can close soon winners, okay, you could trim, okay, make sure you guys know where you want to close your trades at, okay, set take profits, okay. If you have 10 contracts, make it to where you can close 6 contracts at this area, 2 contracts at this area, 2 contracts at this area, if that's how you want to play it. Okay, and know the rules. Understand the tax benefits of Section 1256 and actively manage assignment risk by closing short positions before the expiration. Trading is a marathon. It's not a sprint. Okay, stay prayed to God. Keep grinding. You can't give up. Okay, whenever you feel like trading's hard, when you feel like you want to give up, you got to keep pushing. Okay, you got to wake up, pray to God, ask for wisdom, ask for strength, and keep persevering. Okay, I don't care if you blow in your account. Wake up. Get 2 jobs, grow your business, keep grinding, keep making plays, and keep studying. Don't ever give up. Stay prayed to God, guys. Catch you in the next one. Allah is amazing. Head over to stackmode.net for all trading education. Peace.
To survive volatile markets, discipline is essential, more so than strategy or indicators. Volatility punishes bad habits, not just bad trades. When a trade moves against you or price runs, an undisciplined trader panics or chases entries, making them unpredictable, not the market. Discipline distinguishes consistent traders from the gamblers. It means that you stick to your plan, you manage your risk, and you wait for confirmations and wait for the right entries, even when your emotions urge you to break the rules. Long-term success requires self-control, as the most dangerous factor in a volatile market is an undisciplined person trading. And it doesn't matter how much you've made either. A season of having low self-control can wipe out months of progress. Let's talk about how we can train our mind to make the right and righteous decisions in the market, inshallah, if God wills. Welcome. This session will not focus on charts or indicators, but on the single greatest detriment of long-term trading success and success in general, whether it be in business, on the charts, wherever. Discipline is the separation factor, which is going to separate from who's successful and who's not, who's going to be sticking to their stop loss, who's going to be adhering to their risk management, and who's going to be able to take the setups that they said that they're going to stick to. Self-mastery and emotional control, whether in the business world, on the charts, is going to be the separating factor between who's successful and who's not, and who's going to be winning within this world. Let's go and let's jump into the presentation. So the volatility trap, right, where most traders fail and fall in a downwards direction. Volatile markets, like cryptocurrency, amplify human emotional biases. Same thing with futures, leading to impulsive and destructive decision-making that quickly can drain capital. But it doesn't have to be that way, I really promise you. When the market is volatile, it's extremely bearish, which means markets falling in a downwards direction quickly. Or if market's extremely bullish, which means market's going in an upwards direction quickly, you need to be prepared for either sides, okay? If you're telling yourself you want to invest into some spot cryptocurrency, right? Which is where you're going to be making money when price goes in an upwards direction. So if market is volatile and it's making a certain low, you need to think of that as a positive. If market's dumping down really fast, you shouldn't think, oh my gosh, I'm losing all my money. No, that's going to be an opportunity for market to collect more ammunition and sweep back up further. You have to understand that no matter how low the market's dipping, when you're trading a good asset that puts a smile on people's faces and helps the future, within a couple of weeks, months, or years, inshallah, a lot of the times, and you could check out some old price action to see if I'm lying, you'll see price recover way past where it fell below, okay, and previous all-time highs as well. In order for price to keep breaking into new all-time highs, market has to fall in a downwards direction. Market has to come down in order to go back up. It has to collect ammo and collect liquidity. So don't fall into FOMO, okay? There should be no fear of missing out, okay? The fear of missing out causes traders to enter late and buying near the top based on social media hype, ignoring their own analytical framework, and doing things like that, buying based off of hype, is going to destroy your P&L. You should be looking at the chart. You should be knowing what type of economic decisions or factors happen within the world to base your assessment on how much you're going to invest. Okay, once the SEC laws started getting passed and Bitcoin started becoming a more government-friendly asset, it started going up to new all-time highs. We started seeing 100K plus get passed. So analyze what's happening within the world and on the charts before just making a certain decision, before you just sell everything or buy quickly. And fear, uncertainty, and doubt, FUD. This can lead to panic selling at the bottom during a market correction. Okay, make sure you guys are trusting God. You guys don't need to be panic selling. You don't need to be making yourself lose money quicker than you need to. Sit on your trade and wait for the trade to cook. Wait for take profit to get hit. And locking in losses just before a rebound hits is what keeps people unprofitable. Wait for market to hit your take profit before you close your trades. The majority of you are losing money within the market because you're selling too quickly. You think you're going to hit your take profit overnight, the next day. No, sometimes trades are going to take days, weeks, months. That's why I tell you guys to do everything on your higher time frames, okay, to remove that cognitive bias from you from the smaller time frame. You need to have your higher time frame bias and understand that the market is going to take months, weeks, years, and days in order to get to where it needs to be. So don't sell off of a quick couple of days worth of price action. Stay on your trade. And two key psychological phenomena drive irrational exits and entries, okay? Trying to avoid loss. The pain of a loss is psychologically twice as powerful as the pleasure of an equivalent gain. Okay, so humans prioritize survival mode, but don't just think losses as survival mode. When you're down in your P&L, don't think that you lost. You only lose your money when you decide to close your trade. Okay, when you exit the trade, then you are going to be out of your money. Okay, until then, market can continue to do whatever it wants. Hey, not saying to sit there and hold trades forever, but A lot of you are losing because your stop loss is way too small. So if you're on options, I recommend your stop loss be the contract itself. Try and buy 1 to 2 years out, okay? Buy a leap contract, and this way you can sit on your contract for some time. Same thing for your shares. Try and hold your shares for some years. There's also going to be some long-term tax benefits for crypto and shares when you're holding your trade for over a year, meaning that they want you to hold for a long time. Same thing with futures too. Don't get destroyed by the prop firm cycle. Boot up your own live account, have enough margin, and hold your trades overnight. This way you can play the real structure, and you're not going to be taking any trade on the block, destroying your account much quicker than you would trying to conform to somebody else's rules, or even worse, trying to make some quick profit. That's never how we want to think on the market. Never think quick in the market. Okay, and confirmation bias. Seeking out only the news and opinions that support a trade that you already entered, ignoring clear signs that the market trend has reversed. Okay, not everyone knows everything. Okay, read the chart and do your own economic decision making when it comes to getting in and out of trades. Okay, and you gotta have a plan. Lay out your blueprint. Okay, if you're a break and retest trader, wait for resistance to get broken and turn into support. Okay, if you're a reversal trader, wait for support to get formed and catch the right side of the V into an area of resistance or support above current price. Okay, have a blueprint. Know what you're buying. Okay, if you tell yourself you want to buy $500 or $1,000 worth of Bitcoin every single month, you got to do that regardless of where the price is, because you're trying to DCA, and DCA means dollar cost average. Okay, stick to your plan. I don't care what you're trading, futures, crypto, options, it doesn't matter. Having your blueprint and developing an ironclad plan that you pretty much never break is going to set you apart from every other trader. Discipline begins before you place a single trade, and an ironclad trading plan removes emotions by codifying exactly when you enter, when you exit, and how much risk you're going to manage. Okay, if you have $1,000 account, for example, right? If you have $1,000 account, you should not be trading with more than 10% of your account at a time, ever. Which means that no single one of your trades should ever be more than $100 if you're trading on a $1,000 account. Okay, try and trade between 1 to 10% of your account at a time. This way, you're going to have a significant advantage in many ways. Okay, make sure you have that advantage. Okay, to stick to 1 to 10% of your account per trade. Do not break this rule. I don't care how much your account is up or down, try not to ever break this rule. And define entry and exit criteria. Your plan must specify clear, objective, technical, or fundamental conditions for both entry and exit, and never enter a trade based on gut feeling or instincts. Make sure you guys have definitive, structured layouts and boxes checked. Be like, okay, market did this, okay, market did this, okay, cool, I think I'm ready to get in. And have a rule-based entry. Okay, here's an example. I will only buy asset X if the daily RSI is below 30, for example, or I will only buy asset B if the V formation is starting to form and curl in an upwards direction on my daily or 4-hour, or I'm only going to buy asset C if market hits this certain price and I'm going to buy the dip. Okay, see how you want to structure your plan and stick to it, and stick to your time horizon and review your schedule. Define whether you're a scalper, day trader, swing trader, or an investor. Okay, do you like to trade for ownership? Then maybe you need to look towards crypto and shares. Do you like to trade based off of speculation? Then maybe futures and options are going to be based for you. Or you could take that futures income and put it into crypto and shares. That way you guys are going to be able to get that speculative money based off of your skill quickly, and you're going to be able to take that and put that into ownership. This way you're going to be able to leave some crypto for your family if you ever pass, God forbid. Okay, or you'll be able to leave some things down for the future. Okay, so your future you is really going to be happy that you sat on your investments. So make your future self happy and plant your seed. Okay, think of it like a big tree. You got to plant it. Okay, water, sun, water, sun, water, sun. Okay, that's how you have to grow your account. Make sure you guys are getting the proper water and sun every single day. Okay, rather in real life too, you got to keep your emotions based. Okay, make sure you guys ground, try and get some outside time if you can. It's not good to live like a rat, especially in today's generation with all this technology and stuff everywhere. If you can, especially before the market, if you're a day trader or something, have some outside time, get some oxygen, touch some grass, touch some plants, take a walk, and really work on your mental health. Getting closer to God is going to be one of the easiest ways to get better mentally. Okay, it's going to give you the full layout on how to be a good person here on this earth. Okay, and keep yourself from being mentally sick. Keep yourself from hurting yourself. So when you lose a trade, you're gonna be like, oh, I'm broke, I want this and that. No, you gotta relax. Okay, you gotta chill. Even when you lose a trade, understand that sometimes you're gonna lose. It's how you handle that loss, and it's how you prepare for the loss too. And you must stick to your chosen timeline and resist checking shorter time frames if you're a long-term trader. Okay, don't be caught up on the 15-minute bias if you're on the weekly and daily time frame. Okay, your take profits aren't gonna hit as quick as you think all the time. Give it time, let your trades cook, and take your time. Protect that capital of yours, okay? What are you trading for? Some of you open up your broker account and just start losing all of your money, okay? You're not on the market to lose money. And the main reason you guys are losing money is because, one, you're closing your trades too early, especially my futures and options traders, okay? You're just going to literally delete capital like that, okay? My crypto and shares traders, you guys are a little more stable, okay, due to the fact that you understand ownership. Ownership a lot of the times is going to make you profitable, especially when you're owning something that puts a smile on people's faces and helps the future in many, many, many ways. And the prime directive, right? Capital protection, okay? The most important rule in trading is not how much you can make. It almost kind of doesn't matter, but it's how little you can lose and how healthy you can keep you alive year after year after year, month after month after month. Risk management is the mathematical enforcement of discipline. Extremely important to make sure you guys are trading within your 1 to 10% of your account rule. Okay, as you get better, you can increase from 1%, but I recommend you guys even start off with 1% when you're first starting trading. Okay, this is really going to help you guys just get down to the motions of, okay, you know what, take profit gets hit, boom, let me go ahead and do this, let me go ahead and do this. Okay, but as you get better, you can increase it to like 5% and then even 10% at the max. 10% is going to give you 10 trades before you blow your account. Okay, 5 trades, 5% is going to give you 25 trades of your account before you blow it up. Okay, and then 1%, you're going to have 100 trades. So depending on your percent, it's going to determine how quickly you're going to be gaining profit, but also how quickly you'll be losing profit too. So think about that. If you have a higher win rate, extremely high win rate, feel free to go up in your percentages within the 1 to 10% range. And a non-negotiable stop loss, right? Extremely, extremely important. If you say you're going to close your trade here, okay, I don't care if it's a stop loss or a take profit. If you say you're going to close your trade at a certain area, close the trade. Some of you guys are literally extremely undisciplined and you're wondering why you're not making money from the markets. Take profit literally gets hit. You got to close at that certain area before you get reversed on. Okay, it's not like you're just, oh, I'm going to close here. I'm going to close at this area of resistance because I want to. Oh, I'm going to put my stop loss here underneath this area of support because I want to. No, if price were to click past underneath that area of support, price might fall down dramatically. And if you're a long, that's not what you want. Okay, same thing if you're in a long. If you win, you hit take profit, close at an area of resistance or support above current price. Okay, make sure you guys catch your gap fills. Get your money. Some of you guys are just losing your trades since you want to hold way too long. You gotta know where you're exiting at. You gotta know where market wants to temporarily reverse in order for it to continue its flow. Understand the staircase method and head over to stackmode.net. I have a free course for you guys so you guys can understand the charts and market a little bit more, and tons of free videos too. A stop loss order that's pre-planned, right, is really going to help you out. You're going to know, okay, if market goes here, market will instantly close out my trade, or I'm going to close out my trade here. Okay, and it's where you admit the trade idea is going to be wrong at. And in volatile markets, a stop loss must be placed the moment the trade is entered. Okay, because market can make an extremely fast move and you might not be ready for that emotionally. You might have a $500 stop loss, okay, but if you didn't set your stop loss, say you were like, oh, I'm going to close manually, and market decides to go down and turn that $500 loss turns into $1,300 loss because the candle was so fast, you might freeze, you might pause, you might panic, and that's not what I want for you guys. Okay, so set your stop loss with a order if you can. This way, when market hits that order, it'll automatically close your trade the best that you can, and it's going to prevent catastrophic loss and help you protect against unexpected flash crashes or major news events, which definitely happens. Especially if you're on futures or forex, you don't want to be getting what's called margin called. Okay, this is going to be something where you might be owing the broker money if you go below their requirements, so keep that in mind. Okay, and never risk more than a small fixed percentage of your total trading capital. Once again, stick to 1 to 10% of your account per trade. If you have $10,000, your maximum loss on any one trade should be capped at $100 to $1,000. And this ensures that a string of losses will not wipe you out and allows your edge to play out over many trades instead of just getting destroyed instantly and quickly because of a bad couple of emotional decisions. Okay, you gotta callous yourself. Think of yourself like a turtle shell. You know how turtles have that shell? You gotta put the shell over your account. Have the protection so you're not out here getting swooped up and eaten by every single bird and shark in existence. Okay, take your time, protect your account. Emotional detachment, right? The zen of trading. This is why it's really important. Wake up. I pray to God instantly. Okay, I read Quran and I just am in a way better mindset. I'm in a calm mindset. I'm in an entranced mindset and I'm ready to succeed for the day. And once a trade is entered according to your plan and stop loss is set, your primary job is to watch the market execute the strategy without interference. Place down your trade, hold, okay? You're either gonna hit stop loss or you're gonna hit take profit, okay? You're gonna hold until either one of these. And it's really cringe too. Don't close your trade before stop loss or take profit gets hit, because what you're doing is destroying all of the math. You're destroying the risk to reward ratio, okay? Let's say you're taking a trade, right? And you win a 1-to-4, okay? Let's say you risked $100, okay? If you risked $100 and you hit a 1-to-4, that means you would have made $400, okay? So that's $300 in profit, okay? So hitting your risk to reward ratio is going to be important for growing your account within a mathematically correct way. This is literally how the math of the market works. If you're making more than you risk, you will become profitable, okay? You will become profitable, inshallah, if God wills. You have to make more than your risk. If you're risking $200, okay, then you should be at least trying to make $400 at the minimum, okay? And that's going to be a 1-to-2, okay, since you're going to be doubling your money within an asset, okay? That way, if you take another loss, you'd at least cushion. So try and at least always trade for at least a 1-to-2. You should at least always try and double your money within a trading scenario before it's closed. And once a trade is entered according to your plan and stop loss is set, you have to watch either take profit or stop loss gets hit. Please don't be touching your trades with your hands, because if you're impulsive, you're emotional, and you're led by your flesh, you're going to destroy absolutely everything. So overcoming impulsivity, impulsive decisions, and moving a stop loss further away, adding to a losing position, right, doubling down, or exiting too early are the quickest ways to violate your discipline. And mental reframing exercise, right? When you feel panic or greed, physically step away from the screen for just 5 minutes, okay? Go pray to God, go breathe, okay? Take a step outside and ask yourself, do the market conditions violate my original trade thesis, or is just this noise right now? And if the thesis is intact, you must adhere to the plan, okay? You gotta adhere to the trading plan. Why are you breaking your trading plan? You say you wanna go put your mom in that big crib, okay? You say you wanna take care of your wife and your kids, or you wanna take care of your kids or whatever. You wanna take care of yourself. You want to go get the lamb, yet you hop onto the market, breaking your discipline, breaking your trading plan, not taking the setups that you said you were going to take. We don't have time for this. We got to go harder, okay? We got to go harder. When you feel panic, when you feel greed, you have to understand that that is the enemy. That is the devil. And we have to pray these emotions away, okay? A'udhu minash-shaytanir rajeem. Okay, it's very important for us to pray this away. This is just the devil trying to attack you guys, so you guys get pulled back away from the goals and dreams that you want to attack, that you want to feel and be attached to, okay? The devil does not want you to be happy, okay? But understand that God loves us. God wants us to be happy, and this is why God even talks about in Quran about spending moderately, okay? You have to know how much you're risking, and you have to stick to your plan. And the art of taking profit is extremely important. Greed causes traders to hold winning trades past their logical target. And this is something that's happened to me. Okay, I'm trading straight P&L at one point in time. Okay, looking at the money. Okay, I remember I hit this one really good trade on C3AI, and I've started seeing the bands go up. Okay, start seeing the money go up. I've hit plenty of trades like this. And the next thing you know, instead of me trading based off of the chart, I start trading based off of P&L. And guess what? Since I'm greedy, and since I was trading with my eyeballs focused on the money instead of on the chart and focusing on my discipline, everything was taken away, or my win was not nearly as big as it should have been, due to the fact that I didn't stick to my logical targets. And I don't want you guys to go through that either. Your plan must include defined profit targets. For example, target 1 at 2R or target 2 at 3R, okay, where you sell a portion of your position to secure gains, ensuring that you never let a winning trade turn into a loss. And make sure you guys also set your stop loss to above break even or certain levels too, to even keep the trade going and flowing. And only God's perfect. So if you make a mistake and overtrade a certain day, at least care about what you did. Journal down how you felt. Journal down the emotions you were feeling when the trade was in your face. Were you close to take profit, but did you close your trade too early, ruining your risk reward, leading you to take another trade and then crashed out your account? Or what type of scenario led to you losing that trade or overtrading in certain scenarios? When you really write it down, you're able to visualize and see your mistakes. It's a lot harder to repeat them over and over again. Discipline is really a muscle that has to be trained, and the trading journal is the feedback mechanism that allows you to objectify your performance and eliminate certain weaknesses, especially when you have your numbers jotted down. If you see certain things that you're doing is leading you to lead certain results that's not making you happy, then you need to change some certain things up. And your journal needs to capture certain things. Make sure you have your pre-trade analysis, how you're feeling before the trade, why you entered, and make sure your criteria is met before you press buy or sell. And talk to yourself. How do you feel emotionally? How did you feel before, during, and after the trade? It's really crucial for identifying certain biases, especially when market changes certain directions. You know how to pinpoint certain issues that you're having. And violations. Did you adhere to your stop loss and your take profit rules? And ask yourself why. And talk about the market context too. Did you take a long? Did you take a short? And note the macro environment. And do your weekly and monthly review. Treat this review like a performance audit. When you're trading, you're your own business. So identify your most frequent violation and need to cut certain things out. If you're constantly moving your stop loss, your issues and strategy, you got to stop being led by your flesh. You got to be way more disciplined than that. If you want to touch that big bag, even when you touch that big bag, it doesn't really matter. It's about keeping it. You're not going to be able to keep it if you keep moving off impulse. Okay. Your loss aversion and lack of conviction in your plan can really lead you to certain areas that you don't want to be led to, such as overtrading. When you overtrade, one tiny loss can lead into a whole destruction series of your account. And it's a lot harder to bounce back from that, just from one tiny loss, especially on things like prop firm, where you're chasing certain parameters. So detach from the money, focus on the charts, and be more disciplined. And trading small is really going to help you in certain areas too. If you notice you're feeling a high amount of pressure, like I have to win this trade, you probably shouldn't be in it. Okay, if you lose the trade, you should be completely comfortable. And just like the previous slides we talked about, staying within that 1 to 10% risk management parameter percentage field is really going to help you out. Okay, it's going to be a lot harder to blow your account when you're not going over 10% of your account per trade. Okay, you could do 5%, have 25 trades, and that's a lot of trades before you blow your account. You shouldn't be that inconsistent, truthfully. You got to wake up, pray to God, and be consistent with every dollar that you generate. You also got to be a little more loose within the markets too. You got to stop being so restrictive. Having super tight stop losses and trying to micromanage every piece and point of price action is a good way to lose all your money and be frustrated. Okay, play with much bigger stop losses and give your trades some time. Sit on it for some days, some weeks, some years, and really let your money sit. Okay, if you're going to invest, you can't be desperate for income. One thing I recommend you guys do is hide your balances. On all your brokers, you should have the ability to either hold down your number, and this way, even if you're down, you're not going to be tripping. Okay, you could be down 50%. You're not going to be in anxiety. You're not going to be in survival mode, because I can assure you, within a couple of days, weeks, or months, price will reverse and go way past wherever your original take profit was. Okay, market has to go down in order to come up. So you can't have certain emotions, especially in volatile markets. Okay, if market's moving super quick, you can't feel like you have to close your trade instantly, because you're not going to be able to see the bigger picture. Being on the higher time frames, your monthly, your weekly, and your daily is really, really important. Because if you're too zoomed in on your smaller time frames, that fast price action is going to look like the scariest thing of all time, especially when it comes to futures, forex, and things with margin like that. But it's really not that bad. So I really recommend you guys stay on your 4-hour plus, turn on your extended trading hours, of course, but try and stay on your 1 hour on like the lowest time frames a lot of the time. Because when you're on your super small time frames, price action, especially during volatile days, news days, etc., it's going to look a lot quicker than it needs to be. And on the 4-hour, it's going to look like a normal trade, or going in a completely different direction than you might think. On the 5-minute, you might be looking at a bearish scenario, and then on the 4-hour, market's going in an uptrend. Okay, so you can't go off of your lower time frame bias. I truthfully believe it's there just to get your emotions riled up, especially when it comes to future scalpers and things like that. You have to know your higher time frame bias, and don't get tricked about that. Okay, There's plenty of people who are successful within the market who just buy and hold, who never even taken a look at the charts. Okay, so before you tackle volatility, you have to build the discipline to execute your plan. And you have to get those psychological parameters down. It's really, really, really psychological, the charts. You can be really, really good technically, but if you don't close at your take profit, it won't matter. Or if you feel like you're better than closing at your levels, then you'll definitely get punished, reversed on certain areas, and get what you deserve. Market is also very, very fair. So if you're disciplined, you wake up, pray to God, you close at your levels, I can assure you 99% chance, just like my students, you'll see a very, very, very successful upwards equity curve in your account. But if you're undisciplined, getting greedy, even when you've hit your take profit, trying to trade past that, it's not about the money. Okay, if you break your cycle, break your consistency, and start averting from your plan, it's gonna build into you, and then that's gonna build into bad habits. That's gonna lead to you being overconfident in certain scenarios that's not logical, leading you to overtrade. And when you crash out your account, you might be frustrated on the market, but you should just be frustrated at yourself. Okay, I don't want you guys to go through that cycle. That cycle can be really, really hurtful, especially when you've been grinding your business, grinding at work, and putting that money into the market, expecting to make some money, and then you lose everything. Okay, I don't want you guys to be going into debt, going through frustration, losing your account. So please just wake up, pray to God, and plan your trades. Okay, promise me, if you guys watch this video, plan your trades before you put a single dollar into whatever. I don't care if it's Bitcoin, options, Forex, futures. Promise me you'll plan your trade. Okay, don't ever just trade thinking that, you know what, I'm going to get in this making some money. No, have a technical plan. Know when you'd exit, know how much you're going to invest, know how you're going to close your trades as far as take profit and stop loss wise, and have this process repeated, especially once you find your positive flow. Once you find your flow, I don't care if you're taking break and retest. If you're a breakout trader, I'm not going to tell you guys to trade one way, because different things work for everybody on the planet. It's the cool thing about life. Okay, God gave us all individual separate brains for us to do separate things. If you're a breakout trader and that's working for you, you need to stick to that. If you're a reversal trader and that's working for you, you need to stick to that. You can't get on YouTube, see what this person's doing, and then change everything even though something's working for you. Okay, find your process, find your flow, find what you like to trade, and then stick to that year after year after year after year after year. Think of it like working out, for example. You can't get on the floor, do 20 push-ups and 6 crunches and get a six-pack. It takes days and days and days of eating consistently, eating clean, okay, working out consistently, getting the proper sleep, making sure your bones and your muscles regenerate properly. You have to treat your account, your income, or your business the same way. Okay, you have to be consistent. You can't have $10,000 in Bitcoin and then think $20 is not a lot. Okay, this is why I say you have to detach from the money. You could have 5 million in Bitcoin and still, when you get $5 extra, throw that into some Bitcoin. It's about the habit. Okay, I'm telling you, when you build that habit and you start thinking and planning and doing your actions for the future you, the current you will be a lot more happy and you'll be leveled up a lot quicker. Okay, so head over to stackmode.net for all trading education. Catch you guys in the next one. Stay prayed up to God. Keep grinding. Peace.
Okay, so this is going to be the best time in order to take profit. Okay, so we're just going to be talking about taking our money off the table at certain key areas. Okay, so let's go ahead and let's talk about certain examples in the first place. Okay, so one, let's say we're in a long trade, right? Okay, let's say we're anticipating price to break an area of resistance, right? So ideally, if I'm trading a resistance breakout, okay, and resistance is going to be in a key area where sellers are going to be stepping in, so price is going to head in a downwards direction. Okay, this is the left to right chart, so people are still going to be invested in. A lot of times way lower. Okay, so someone's going to be in the chart way over here, so eventually they're going to take profit, and that's what resistance is going to go ahead and be. Okay, so say an area of resistance decides to get created. Okay, if price decided to break out, okay, and you took a resistance breakout entry, your take profit would be A, at an area of resistance above current price, okay, because resistances can go ahead and fall at the same place as each other. Okay, resistances can go ahead and mirror everything that one other resistance can do potentially. Okay, and that's going to be the same thing for supports. Okay, so an area of support can go ahead and mirror another area of support. Okay, so it's about really paying attention what we're doing as far as the reversals. So it's know that two areas of support can go ahead and reverse at the same place, even if price decides to do something like this. Okay, even if price say shoots underneath it, okay, comes back up, price could potentially still mirror the support from the left to the right. Okay, and then let's say price decides to blast up. Okay, then my take profit would still be the resistance above here. Okay, so no matter how I take my setup, if I'm taking a long trade, okay, or even if I'm waiting for an area of resistance to turn into support, okay, if I'm taking a long trade, my take profit is going to be an area of resistance above current price, or it's going to be an area of support above current price. Okay, and that's due to the fact that support has a chance to turn into resistance. So we know that price could potentially reverse there too. Okay, and we want to be closing before price reverses. Okay, so once again, you want to close before price reverses. That's going to be a big thing. Okay, so price could go ahead and break that area of resistance. Once again, take profit will go ahead and be at the area of resistance here. Okay, or price can go ahead and do something like this. Okay, and just run up to the area of support, and this could go ahead and be a trade in itself, even if it doesn't run through. Okay, and the price could potentially do that, and you close that. Okay, so knowing that how the chart works is going to be imperative to knowing how to read when to close. Okay, so resistances will try and mirror each other, and let me go ahead and show you an example here. So check this out. So looking here on a video, if I go ahead and start off on my daily time frame, okay, I like to start off on my daily time frame. Using my bird's eye view lets me see all the price action I need to see in one screen. Okay, I'm going to go ahead and zoom in. I can see here at these all-time highs, price is deciding to fall pretty much in the same exact zone. Okay, so after my daily time frame, okay, and especially if I'm looking at the stocks or crypto market, I know that price is trying to chase and break resistances. Okay, because price cannot go in an upwards direction until resistances are broken or a support above current price gets broken. Okay, so one of the two things have to happen in order for price to go in an upwards direction. And people are working hard at these companies, they're grinding, and they're definitely trying to increase the profitability of the companies. Okay, so you can see here on the daily, price decided to fall at the same area once, twice, and 3 times here. Okay, so if I go to my 4-hour time frame, we can see price decided to fall down here. Okay, 1 area, 2 areas, 3, 4 times. Okay, and even 5 over here. Okay, so in the gray box, price decided to fall down in the same area over and over again. And that's because price is always trying to meet up with areas of resistances, especially in a long scenario. Okay, so your take profit area, if you're looking for price to go in an upwards direction, would be in an area of resistance above current price or support. Okay, so this is why I don't personally like to trade I don't like to trade past all-time highs. Why? Because there's no structure above me. Okay, so I have no areas of resistance or support above me at all-time highs. Okay, so personally, what I would do is I'll buy a pullback. So I'll wait for price to come down to potentially this area of support right here. Okay, or maybe this area of support here. Okay, or maybe try and bounce at an area of resistance or something like that. Okay, maybe right here. Okay, and then I'll see if price wants to go ahead and mirror something. Okay, maybe this area right here. Okay, we'll try and mirror with this area right here. Okay, and then maybe the price will try and go ahead and dip down. Okay, but if price doesn't give me a bounce at any of these 3 levels, okay, I can try an even lower level. Okay, maybe even this one down here. Okay, and then from there, I can go ahead and see if price wants to sweep up to there. Either try here, or try here. Okay, I'm working on my levels below me, trying to catch the entire sweep up. Okay, and I'm going to be using my daily and then going down to my 4-hour. And it's just about paying attention to the key areas and just knowing that resistances are always trying to meet and be broken, okay? Because that's how price continues in upwards direction, okay? All the time. And price can also do things like hunt downwards to areas of support to try and see if it wants to bounce up. But if support gets broken, then price can try and bounce at areas of resistances, okay? Because we know resistance can be broken and turn into support. Okay, so price can come down, turn old resistance, it can be turned into support. Okay, and price can try and come up, and wherever we would close would be either the all-time highs or wherever the resistance area decided to stop. Okay, so or I could close at this area of support right here. Okay, so either one. So if I didn't want to close up here, I could easily close at this area of support here too. So if price gives me a bounce at this blue line down here, okay, I could go ahead and catch a sweep from 242 to 246 on Google if I wanted to, okay, if it did what I needed it to do. So it's just about taking your time, okay, reading the price action and going over the flow, okay. So let me go ahead and go over a crypto example here. So crypto charts is going to be the same way too. Just using our daily time frame, using our 4-hour time frame, taking our time and just reading everything. So let's start off with some Ethereum. So I'll go to my daily time frame here. Okay, I'm going to zoom all the way out. I love to zoom all the way out to just see where price action is. Okay, and I can see price decided to kind of short from the same place that all-time high shorted at before. Okay, so all-time highs is the highest point of resistance. You can see in 2021, Ethereum created a high of 4,868. Okay, and then we touched the high as of August 2025. Okay, and price decided to push past it a tiny bit, but price decided to pretty much short from the same place. So you know that price is trying to break past the black line now. Okay, it's trying to break past the area of resistance. It already got met. Okay, it got created here. Then price swept all the way down. Okay, swept all the way down to this low down here near 861. Okay, then after that, started trickling way up, doing its thing. Okay, and then price decided to make a high of 4,868. Okay, or around the 4,900s. Okay, so yeah, Ethereum decided to sweep all the way, and as you can see, it met up with the areas of resistance. Okay, it swept the whole time. Yes, it took some time, but it happened. Okay, catching a sweep is going to be extremely, extremely nice to your P&L, your bank account, and it should help you a lot, set you really, really nice bundle of money, and especially when you catch the right trades. Okay, so we can check here. So the daily time frame, I can clearly see price wants to try and reach this level here, all-time highs. Okay, so we have this previous level here from 2021, and a level from 2021 is being reacted off of in 2025. Okay, so we know that up here, the black line is to take profit, right? So let's say I bought a pullback. Okay, so let's say price decided to go to our time frame. Okay, so as you can see, price is trying to bounce, okay, from this area of support right here potentially. Okay, so I can see here, price decided to create an area of resistance here. Okay, you can see this area of resistance being created here on the 4-hour time frame. Okay, and then price decided to break above it and continue upward, but then price broke the resistance here and turned it into support, and then price decided to go up in upwards direction. Okay, so we'll see if price wants to hold this little zone down here. Okay, and we'll see what it wants to do. Okay, and one way to tell is if we're getting daily closes. Okay, so we have 2 daily closes, okay, which means we have 2 daily candlesticks that aren't the first candlestick where it touched in the zone. So as soon as the candlestick touches the zone, I'm not feeding to get in. I like to see if the price actually wants to reverse. So if I see second candlesticks or third candlesticks, also known as candlestick closes, okay, showing me that price wants to continue potentially, okay, especially if it's going from red to green from a certain area, okay, then price could be like, you know what, this could be a decent area where I want to go ahead and buy. Okay. And take profit will go ahead and be the area of resistance, okay? And even if I'm shorting, okay, let's go over a short example, for example. Okay. Even if I'm shorting, okay, I'm going to go to my 4-hour time frame. I would take an area of support, okay, mark it out, okay, and I can clearly see here this area of resistance turn into support. Okay, if I see an area of resistance, okay, to the left of an area of support being broken and then turn into resistance, that's going to be really good. Okay, so for instance, I have this area of resistance right here, okay, created at this 964 level. Price decided to break out, okay, and then price came down, turned the area of resistance into support, and then created the high up here, okay, and price is trying to go ahead and sweep up here and fill this gap, okay, so this whole gap here from here to here, okay, it's trying to go ahead and fill that. So by doing that, we can go ahead and check something else out, okay, so knowing that that's trying to fill, okay, we can be like, okay, this low is extremely strong. So we can determine whether or not we ever want to short this low. Okay, so if price decides to break the support, turn it into resistance, you could take it down. Okay, but the take profit for shorting, okay, would either be at another level of support, okay, and especially for stocks and crypto, I wouldn't make your take profit too far or too big or too hefty. This is why I personally don't really short too much, because it's just riskier and you can't really hold as long compared to holding to the upside, where price is always trying to go to a higher price. Okay, that's just how the human eye works. People want to see their favorite stocks, favorite cryptocurrencies at high prices, and they'll do anything to get it there. Okay, and so yeah, so when you short, close at areas of support, or you can close at areas of resistances below current price too. Okay, because you know resistance can turn into support. So that's why shorting can just be a little tricky sometimes too. But when you're using your high time frames, you can catch some pretty solid setups, make some money. Okay, but a lot of the times, especially when it comes to the crypto and stock market, we want to just be playing to the point to where we can catch long trades. Okay, catch long trades because we are playing a bullish market. Okay, if you pull up any half decent cryptocurrency or stock, if you go to the left to the right, the left is going to be nowhere near where it's at today. So in 2020, crypto like was just starting to bubble. People weren't really investing into it. Okay, and then like 2022, etc., started progressing. So we can see over here that price started at around like $17 a share as of 2020, and price is now at 1,025. Okay, for BNB USD crypto token. Okay, so it really just depends on when you get in, and holding for years is also going to have some benefits too. Okay, so when you hold for years, there's going to be a lot of long-term tax benefits, and you're pretty much just going to always be able to sit on money here. Okay, so let's go and let's check out Microsoft. So I like to start on my daily here, and I always know that price is trying to chase an area of resistance above current price. Okay, so I can see that price is trying to chase this area of resistance, this area of resistance potentially, this area potentially, this area potentially, and then all-time highs. And then I'm going to go to my 4-hour time frame and verify everything. Okay, check it out. So I have this area of resistance here, recently created. Then I have this area of resistance here, okay, with 2 taps. Okay, 2 taps of resistance at that area. It lets me know that's definitely a strong area. Okay, and then I have this area of resistance up here. Okay, well, price is falling down. Price falling down. I have another area of resistance up here. Okay, 537.73, 532.01, 524.94, and 519.34. Okay, and I'm also going to have an area of resistance marked up here at 559.02. Okay, so I have all these areas of resistance marked. Okay, so even if I didn't want to catch a pullback, right, because I'm scared of a falling knife, let's say, then you could go ahead and catch a continuation trade. Okay, you can go ahead and catch a resistance breakout, wait for it to turn into support, and take it up to the next level, okay, of either support or resistance. Okay, close there, or you can hold for the whole sweep all-time highs, depending on how much capital risk you're ready to put down, how much time decay you have too. Okay, especially if you're on options or you're a shareholder. Okay. So it's just about taking our time and really making sure we're putting down good trades. So check this out right here too. So I can see here on Walmart, price is deciding to give me some break and retest. Okay. So check out this area of resistance here, being reacted with this area of support here. We're going to 4 hour. Okay, we got resistance right here. Resistance being broken and turn into support. Okay. And I can see price wants to go ahead and push up and potentially try meet up with this resistance, meet up with this resistance. Okay, or just straight to all-time highs, honestly. Okay. And then maybe up here. So yeah, making your trader agent is really going to be just imperative to your success. So just put down logical formations and just know what type of setups that you want to take. Okay, so if you're going to take a long trade, okay, and if you want to wait for an area of resistance to be broken, okay, you could take it up to the next area of resistance or support above current price, or you can wait for the area of resistance to hit the area of support. Okay, you could short if you wanted to. Okay, so it just really depends whatever you wanted to do, how flexible you are. But as long as you have your levels on your screen and you could just wait to see if your levels even get reacted to in the first place, and then you can go ahead and assess, do your information, and make your trade based off of those factors. Because then from there, it's going to be simple in order to be like, you know what, I know what I'm doing. I do this consistently. And then you're going to be able to hunt down and find profitable trades pretty quickly. Okay. And try to stay away from things that are all-time highs. Okay. We can't really do too much when stuff is at all-time highs. Okay. So what we need to do is wait for a pullback. Okay. We need to wait for a pullback. We need to wait for price to go in a downwards direction. Okay. So Google, for example, all-time highs, no resistance above it. We got to wait for price to go down before we buy it again. Okay. Because you don't want to buy all the way up there, whether it be on options, calls, or shares, and then lose because you just didn't wait for a pullback. Okay. So even this area here on Palantir, so this area here is being reacted off of right now. Okay. And I could wait for price to break under this level if I wanted to. Turn it into resistance and take a short down to this level right here if I wanted to. Okay. So it gives you the flexibility to trade how you want. Okay. Trade how you want. And as long as your risk is in place, your parameters are in place, you can do your thing. Okay. Same thing right here on Costco. I can see above current price. We have an area of support right here with an area of support. Okay, so we got two areas of support here. Okay. So both these areas of support here are going to be important. Okay. So if price decides to turn these areas of support into resistance, then price could fall down. Or it could run through it and then go ahead and try and fill these resistance gaps all the way up here. So then price could try and go ahead and continue within an upwards direction. Okay. So it's just about really taking our time, knowing what we're investing in, playing with the trend, or just trading pullbacks. Okay. So doing either or is really just going to be absolutely imperative. Okay. So head over to Stackmode.net for all trading education. Stay prayed up to God. Keep grinding. Peace. Class, today we're going to be talking about passive income. Let's talk about ETFs. They stand for exchange traded funds. Extremely useful to just go ahead and invest in a safe manner. Let's go and let's talk about how we can go ahead and invest and how we can build some long-term financial success. Inshallah, let's go. So what exactly is an ETF in the first place? An exchange traded fund is essentially a basket of securities like a stock, bond, or commodities that trade on a stock exchange like a single stock. They combine the diversification benefits of mutual funds with the liquidity of common stocks. So what liquidity is pretty much going to mean the price action, the volume that common stocks have, but it's going to trade safely like a mutual fund. So instant diversification. Buying a single share of an ETF often gives you exposure to hundreds or thousands of underlying assets. For example, a single S&P 500 ETF share grants exposure to 500 of the largest US companies. So as soon as you buy one share of the S&P 500 or one share of QQQ, which is going to expose you to 100 of the tech companies, then you're going to be able to go ahead and invest and diversify yourself off of one singular company investment or an ETF investment. So intraday liquidity. Unlike traditional mutual funds, which are only priced and traded once per day after the market closes, ETFs can be bought and sold throughout the trading day at market prices. And there's going to be lower crosses for expense ratios. Most ETFs, particularly passive index funds, boast extremely low expense ratios for annual fees, making them significantly cheaper than actively managed mutual funds. And this cost saving compounds drastically over the decades. So, the concept of instant diversification is central to modern portfolio theory, allowing investors to manage unisystem risks effectively. So if you don't know what companies to invest in, you could just purchase an ETF, which is going to go ahead and instantly diversify you in a whole sector or in a whole sector of companies. So navigating the core ETF universe. So ETFs are categorized based on what they hold and their investment mandate. And choosing the right type is going to be the first step toward aligning your investments with your goal. So we'll talk about passive index equity ETFs, and they track major indexes. So for example, S&P 500, QQQ, YM, and the goal is to really match the market's return, okay? And it's best for core holdings, long-term wealth accumulation, and it's pretty good as far as tax efficiency as well too. When you're also holding positions for over a year, you get a lot of long-term tax benefits too. So keep that in mind whenever you're holding your positions. So as far as fixed income, okay, we'll talk about bonds. So you can hold various bonds, government, corporate, or municipal bonds, which are used to reduce portfolio volatility and provide income, which are most likely best for safer traders, okay, and safe long-term investing. And it's best for capital preservation and retired investors. You can also ETF invest based on certain sectors. So let's say you believe in Bitcoin, okay, there's going to be some ETFs like BTSE, okay, for example, which you're going to be able to invest in, or BTCI, okay? And those ETFs you can invest in if you believe in Bitcoin, for example, and it's going to go ahead and follow that. There's going to be some ETFs that follow gold, for example, okay? So each ETF is going to have its own sector and track its own theoretic things. So it's going to focus on a specific industry if you're going to choose a sector ETF. For example, semiconductor ETFs, renewable energy ETFs, or megatrend. Okay. And it's best for tactical bets, satellite holdings, and investors with high conviction in specific areas. So if you believe that Bitcoin, for example, will be the future, then you could look into crypto or Bitcoin ETFs. If you believe in Ethereum or power grid or AI will be the future, then there'll be ETFs involving strictly technology and AI stocks. So you could choose whatever sector you believe in and invest on that, and look what type of dividends they pay out. Dividends are going to be quarterly income that the ETF is going to pay out back to you, because the more that you're invested into it, let's say you're invested about $1.5 million in SCHD, okay, then you'll get around $60,000 in yearly income, okay, and that's more than the average bachelor's degree job for the most part, okay, so you're going to pretty much be able to live on $5K a month for the rest of your life, okay? And by the time you have that much invested, your house should be paid off, should have no debt, so you're gonna pretty much be able to live for free forever just by putting your money in the stash or investing into a certain ETF. So you can select stocks based on specific criteria and different factors like value, momentum, or low volatility, aiming to outperform traditional market cap weighting, and it's best for sophisticated investors seeking risk-adjusted returns. So, for example, we'll talk about diversification. So instead of trying to pick the next Apple or the next best stock, an investor can buy a single total stock market ETF, okay, which is a passive index, and automatically own a small piece of virtually every publicly traded US company, diversifying away single stock risk, and you can trade with the whole sector if you just believe in the whole sector, okay? If you believe in the healthcare sector going up, you could trade healthcare ETFs, etc. And it really just puts power back in the trader's hands and lets you diversify your portfolio, but stick within a single area. So defining goals and assessing the risk. So your time horizon and comfort level with market drops are the ultimate deterrents of your ETF allocation. An investment plan without defined goals is merely just speculation. And goal horizon and asset allocation. So for the most part, be looking to trade forever. Okay, you're not in this to get into the market, make a bag and hop off. Okay, it's not what it is. Business doesn't work that way. The market doesn't work that way. You got to really plant your seed, plant it in the ground, water it day by day. You got to get some sun. Okay, keep stacking cash into whatever you believe in, whatever ETF that you like. Okay, doesn't matter. I'm not going to tell you guys the best one to invest in, because there is no best one to invest in. It's whatever you personally believe in. Okay, focus on your investment and keep stacking cash. Okay, and you guys can head over to stackmode.net if you want to learn how to, one, decrease any type of unnecessary finances that you're expending, and two, how you can invest into ETFs and build some passive income for yourself. And this is actually passive income, because it's income you don't have to do anything for. You're just stacking cash in a certain area and they pay you out money for that. Because the fact that you're stacking cash in their area, they're going to pay you for that. So instead of a traditional bank taking your money and doing what they want with it, okay, let's say you have 100K in your bank. You can't go to the bank and get 100K in cash. Why? Because the bank most likely isn't going to have that. They're most likely going to only have 20K cash at their location. Okay, so the fact that that's in a factor is going to let us know that, okay, what is the bank doing with that money? Why can't they immediately give it to us? They have it invested. So you need to be doing the same thing. So instead of keeping all of your money in the bank, where the bank's just going to invest your money anyways, banks aren't just opening banks to help people out and keep people's money. Okay, they don't, world is not that friendly. Okay, most of the time someone's getting something out of something. Okay, so that's what banks are getting. They're getting capital allocation and pretty much taking your funds and trading with it on the side. So that's why you can't immediately wire transfer out all your funds. That's why on Zelle, there's certain daily limits. That's why you can't immediately send $1 million to someone instantly. This is why something like crypto, right, is becoming so popular, because it takes that centralized power away. You can instantly send however much you want from one person to the next instantaneously without anything stopping it. Just person to person transaction, bringing it back to like a traditional barter system, taking the power away from the centralized control. Okay. So make sure you guys are having a balanced approach to clear your debt, okay, pay all your bills, do what you need to do, and then whatever you have left, invest and stay down. Okay, live way below your means. Try to do it for at least 1 to 5 years and stack cash. Okay, it doesn't matter your age. Never think you're too late either. I don't care if you guys are 40 watching this. I have some mentorship students that are as of old age, have kids that are teenagers, etc. Okay, and still just getting into investing now. So it doesn't matter your age. Start today. Start today. Start planting your seed. Okay, if you want to be someone who's chilling in the long run with your family, having money in your bank account, having money in case your kids, your grandkids, or someone needs any type of funds, because life happens. Okay, let's say someone's house blows up or something like that. You know, instead of them being out and down, you could be able to help them out. Okay, just because of the fact that you invested. And let's say your play hit 500%. Okay, you just be able to take some of that profit and help out your family, help out yourself, and really have an emergency fund for yourself. Okay, your profits is really going to be helpful, because whatever you want to spend, it's pretty much going to be canceled out. So the more you invest, it's compounded based upon that. Okay, so the more you invest $1,000, $1,000, it's not just $1,000 being put up like in a savings account. Especially when you're in a profitable sector that you're investing in, it's going to constantly compound, and you could see 100% returns. Okay, so $1,000 will quickly turn into $100,000, especially if you keep stacking, investing in something that's profitable. It's investing in an ETF that goes in an upwards direction for the most part, and that pays out pretty good dividends. You're going to be like, okay, cool. And then you're going to start making passive income from the dividends as well too on the side of that. Okay, so make sure you take care of your taxes and just keep reinvesting your profit, keep growing it, and then you guys are going to be able to stop work. Okay, so if you ever actually wanted to stop work, you need enough seeds planted. Plant all your seeds today. Okay, if you ever want to retire successfully, not have to come back, not have to worry about putting in 60-hour weeks, 40-hour weeks, 80-hour weeks, okay, invest today. So let's say, for example, if your first 10,000 is in an S&P 500, for example, okay, so that's going to give you access to 500 stocks, pretty much just put into jumbled up into one big compound, and that's an ETF. So let's say it dropped to $6,000 during a recession. Okay. You still don't panic sell. Okay. Sit on your portfolio. Understand that the goal of these markets are to go in an upwards direction. You shouldn't be trading with money that you're scared to lose. So that's the big reason why people aren't successful in trading too, because they cut their losses. So even if your 10K goes down to 6K, you still shouldn't sell. Okay. You still shouldn't sell due to the fact that, one, you should be comfortable with holding your position for ample months, ample years. You have to know that wherever you bought at, price will most likely blast way past that. Okay. This is why I personally don't like buying all-time highs for a lot of things. Okay. So learn how to read the chart before you just invest if you don't want to get pulled back on. Okay. But I can almost assure you, no matter how much the chart pulls back, I can promise you, inshallah, 99.9% of the time, especially when it's a good ETF that people invest in, price will sweep back up and will break those highs, and it will continue in an upwards direction. Okay, you can check most ETFs, they most go in an upwards direction. Okay, so don't panic sell and lose bread for no reason, and you can lose a lot of money for no reason just closing early. Okay, you shouldn't even be staring at the charts like that. Go work on your business, go do something, go just improve yourself any type of way. Okay, go get more money so you can come back to the market, keep stacking cash, keep putting into your investment, keep growing your ETF portfolio. So once you know the type of ETF that you need, you got to evaluate the specific product. So performance is going to be imperative and important, but these three metrics are non-negotiable for long-term success. So understand the ER, expense ratio. So this is the annual fee that you pay, and it's expressed as a percentage of your total investment to the fund manager. And lower expense ratio is always going to be better. So a 0.50% ER versus a 0.03% ER can cost you tens of thousands of dollars in loss, compounding over a 30-year period. Why? Because of 0.50% ER significantly higher than a 0.03% ER. Okay, so once again, the lower the percentage, the better. So tracking errors and holdings. So tracking error. It measures how closely the ETF's performance mirrors its stated benchmark index. A high tracking error means the manager is either doing a poor job or taking unexpected risk, and aim for an error close to zero so you guys can get the most stable tracking of whatever stocks or sector that you're trying to invest into. And underlying holdings. Always check the ETF prospects. So does a global technology ETF contain the companies you expect? Does it have big dogs that move the market? Or is it overly concentrated into one stock? Okay, look at the top 10 holdings to understand the actual exposure of what the ETF is investing in before you put your money into it. And liquidity and assets under management, AUM. While ETFs are generally liquid, smaller new ETFs pose risk and prefer ETFs with high AUM, assets under management. So for example, 1 billion plus and high average daily trading volume. So you know people are going to be constantly investing into it, lots of flow being put into it, lots of money being put into it. And this ensures that you can buy and sell easily and that the fund is unlikely to close down. And it's a process that can be costly and inconvenient. So building a robust portfolio utilizes the core satellite approach and incorporates global exposure to maximize diversification and capture returns from different economic cycles. So the core, 70-90%. So this is going to be the foundation consisting of low-cost, broadly diversified, passive index ETFs. Okay, so a lot of the times, okay, even for my day traders, let me talk to y'all real quick. So even for my day traders, if you check your max at the end of the year, even if you're really good at day trading, a lot of the times it's harder to perform or outperform somebody that's just stacking cash in an ETF. Okay, so really take that into account. All the losses you have to take into account, the emotional imbalances, the swings, the anxiety. So think about it like, okay, is it really worth it? And you have to really put into a chart, look at your max, be realistic with yourself. And if you think that passive long-term investing is going to be a better way to become more profitable, and that's what you need to swap to. Day trading is not working out. It's time to swap it up and take the risk off, and let's actually get some cash. So the satellite, 10 to 30%. So this is where you introduce higher risk, potentially higher reward ETFs, like factors, smart beta ETFs, or crypto ETFs. And you could also buy sector ETFs too, like technology ETFs, for example, or biotech ETFs. And these allow for calculated tails without compromising the portfolio stability. And global exposure, developed versus emerging markets. And don't limit yourself to US and domestic ETFs only. A fully diversified portfolio includes international exposure if you would like, which historically does not move in lockstep with the US market, offering critical diversification benefits. So you can also invest in other countries' ETFs like Japan, Europe, Canada, Brazil, China, India, etc. Okay. And this way, in case the US dollar becomes worthless and the US stock market starts suffering, then you can be invested into a whole other country's ETF. Or if you believe in a country's development, like let's say a lot of countries in Africa, for example, are starting to be powered super heavily by a lot of China's development. So ETFs for Africa, for example, might go up in an upwards direction since the economy is going to be looking in a bullish scenario. So section 6, all right, practical allocation in the final checklist. So putting it all together. All right, let's talk about these two examples here. So let's say a young investor, right? Say they're around 25, okay? They're looking to invest long term, okay? Let's say they have 60% in core equity ETFs, okay? So they have QQQ, okay? They have 60% in QQQ. They got 20% and some international equity, okay? Let's say they have it in some China ETF, okay? Because they believe in their economy. Then core bonds, okay? Or some crypto ETFs, okay? So you can go ahead and invest like that too. Now, dividends, especially as you get older, because one, you can't expend as much as your energy for money. So as you get older, I really, really highly recommend you guys start looking into dividends. Do your research on that and do your research on dividend ETFs that pay well and are stable, okay? Because the ones that pay well and are stable is what you're going to want to be looking towards, especially as you get to the ages like 50, 60, 40 and stuff like that. You can't work all the time. Okay, it's not realistic. Your kids are going to be doing stuff, okay? Family's going to be doing stuff. And even if you don't have a family, okay, your body's not going to be able to handle the amount of turmoil, stress, and fatigue that you were when you were younger. Okay, so you got to make sure your income's making you income. Just prepare for the future. Okay, your older self is really going to thank you for doing the work today. So ask yourself, does the ETF align with your time horizon? Okay, do you want to invest in that ETF for decades? Okay, is this something you want to be in for a couple of years, take some profit? Okay, ask yourself. And is the expense ratio below 0.10%? Okay, for broad index funds? And does it have high AUM? Okay, over $500 million is going to be a pretty good value to look at for a daily trading volume, at least. And does the tracking area demonstrate a tight correlation with the benchmark? And do I understand all the underlying holdings, okay, with no hidden surprises, no downturns, and just making sure that it's a consistent ETF I can invest in and safely keep my money in. All right, if you want to learn more about ETFs, diversification, and investing, head over to stackmode.net. Stay prayed to God, keep grinding. Catch you guys in the next one. Class, let's go and let's talk about fundamental analysis, what it is, and how you guys can use your outside of chart skills to make profitable trades. So you can see, is the company going to be futurely effective? Is it something that's going to advance society, put some smile on people's faces? And these are all going to be questions that we're going to need to ask before we even look at the chart as well too. Okay, so let's jump into it. Let's see if the company makes some money. Let's determine the fundamentals before we put down some size. Let's go. So what is fundamental analysis? FA, the core definition and the goal. Fundamental analysis is a methodology used to evaluate a security's intrinsic value by examining related economic, industry, and financial factors. And the core idea is to determine if a company's stock is truly worth its current price, whether we're looking at the real business behind the ticker symbol. And the goal is simple. Find stocks that are trading for less than the calculated intrinsic value. And this is the margin of safety. So we assess everything that could affect the company's value, from the strength of its balance sheet to the quality of its management team. Everything that's going to be extremely important to take a look at, okay? Because this is all going to be affecting future growth, okay? You want to be investing in a stock that's going to be making money, okay? Because if it's making money and it's profitable, then inshallah it's going to be in a much better position to go in an upwards direction than a company that's not making money, okay? Because then they're going to take their shareholder profit, put it back into the company, and they're going to be paying out higher dividends, which are going to be payments that stocks give if they're making good money to their shareholders. Okay, so if the dividends are increasing, not getting cut, then that means that the company is also going to be making money. So a lot of good things we can look at too to see if a company is profitable or not. Now let's talk about fundamental analysis versus technical analysis. So the difference in focus between the two. Technical analysis focuses on price and volume movements on the candlestick chart, still extremely important to know. And it studies charts and patterns to predict future price direction, and it assumes all fundamentals are already priced into the stock. In fundamental analysis, it focuses on value, and it studies the financial health and futures earning power of the business. It assumes the market can be wrong in the short term, creating opportunities. Let's talk about the two main pillars. So 1, quantitative factors. The numbers, revenue, profit, assets, debt, and key financial ratios derived from financial statements can all be used to see if a company's making some money or not. And this is going to be the bedrock of our analysis. And some qualitative factors, the intangibles, management competence, industry standing, brand loyalty, patents, and competitive advantages, right? The economic moat are all going to be things we could take a look at as well too to determine if a company is going to be worth investing into or not. So the top-down approach, right? Let's talk about the EIC analysis. So before diving into a single company, let's understand the environment that it's operating in the first place. Let's take a look at the economy, then the industry, then finally the company EIC. So let's talk about the E, economic analysis, right? The macro. So understanding the national and global economic landscape is going to be crucial as it dictates the environment for all businesses. And a rising tide lifts all boats, but a recession sinks many. Now let's talk about GDP. GDP stands for gross domestic product, and it measures the total output of goods and services. And a high GDP growth generally suggests strong corporate earnings, okay? Which means that it's exporting and putting out a large amount of goods, which means people are buying, okay? So interest rates, they're set by central bank, and their higher rates set could increase the cost of borrowing for companies, affecting debt costs, and consumers, affecting the spending power of the company, okay? So if the interest rates are higher for borrowers, that means that more of the company's money has to go into paying off debt versus growing the company, okay? Which could lead to slower stock progression. Keep that in mind. Inflation. Inflation is the rate at which prices rise. High inflation can squeeze profit margins if a company cannot pass on increased costs to its customers. And the unemployment rate, a key indicator of consumer health. Low unemployment usually means that companies are hiring more and more and more and more, and they have enough money to even hire new people. Let's talk about some industry analysis, right? MISO. Some industries offer better long-term prospects than others. You want to invest in companies that are favorable, growing, or defensible sectors. And you want to look at the industry life cycle. Is the industry in the growth stage? Does it have high potential? Okay. Or is it in the mature stage? Is it already super duper stable and a competitive competitor? And adjust your expectations accordingly. Take a look at its competitive structure. How intense is the rivalry? Does it have low competition? Because low competition allows for higher profit margins. And high competition, like airlines, for example, often means thinner margins because there's so many companies that do the same exact thing. And bargaining power. Do suppliers or customers have high bargaining power? High customer power, for example, a few big retailers can force prices down, harming the company. So for example, the tech industry is currently in a growth phase, okay? While the tobacco industry is in a decline, thank God. Okay, people are starting to get healthy, change their ways, and the crypto industry, for example, is also on an uprise as of when I'm dropping this video. So depending on the time era, invest based on that. That's also going to be taking a look at your fundamental analysis, looking at what time period you're in and making your decisions based off of that. So the company analysis. This is going to be the final deep dive stage where we look directly at the individual's business health, operations, and future prospects. This is going to lead us directly to the financial statements. And let's talk about the competitive moat. What makes this company hard to replicate? Is it a powerful brand, network effects, or patents? And this creates pricing power. And let's take a look at the financial health. And we must verify their ability to generate profit and cash, manage debt, and efficiently use shareholding capital. This is the heart of quantitative analysis. And operational efficiency. Are they managing their inventory and accounts receivable effectively? High efficiency often translates to higher profitability. So the three pillars. Let's decode financial statements. So these three documents, released quarterly and annually, are going to be the company's report card, okay? Remember back in school when you guys were scared of showing your mom the report card, for example, okay? Companies can sometimes be nervous to show earnings, especially if they're not putting out good profit. So that's why you might see a company put out bad earnings, but it might follow up with a video or display of what the company holds for the future to save the shareholders and to make the current people holding the stock, even if it dumps down, invested so they can trust the future. So let's talk about the income statement, right? So what does it show? It shows profitability over a period of time. For example, 1 quarter or 1 year. And it details revenue, cost, and ultimately the net income, okay, which is going to be the profit. And the revenue, right? The total sales from goods or services. And the growth here is going to be critical, okay? You want your companies that you're investing into to be making money. So the gross profit, the revenue minus cost of goods and sold. And this shows how profitable the core product is. And operating income is profit after deducting operating expenses like salaries, rent, R&D, and this indicates core business performance. And the net income, right? The bottom line. What's left for shareholders after all expenses, interest, and taxes. And the balance sheet. So what does it show? A snapshot of a company's assets, liabilities, and shareholder equity at a single point in time, and it must always balance. All right, let's talk about the accounting equation, right? So assets equal liabilities plus equity. So assets, it's what the company owns. It says cash, inventory, property, plant, and equipment. And liabilities, right? It's what the company owes. It's accounts payable, short and long-term debt, and watch for companies with high debt. And equity, this residual claim shareholders have on assets after liabilities are paid. And the cash flow statement, CFS. So what does it show in the first place? The true movements of cash, tracking how much cash the company generated and where it was spent in the first place, separating it into 3 main activities. Okay, so we're gonna have the OCF, and the OCF stands for the operating cash flow. And this is cash generated from normal business activities. Okay, this is the most important business section. Then we're gonna have the ICF. The ICF is cash used to buy or sell long-term assets, like equipment or real estate. Then we're gonna have the SCF. Okay, this is financing cash flow. Cash from issuing debt, paying dividends, or buying back stock. And the key takeaway, a company can show a profit income statement, but have a negative cash flow if customers haven't paid yet. So understand that cash flow is gonna be king in this scenario. So the power of ratios, quantitative deep dive, right? I'm gonna give you guys a deep dive here of the power of ratios. So ratios normalize the data, allowing you to compare companies of different sizes or evaluate a company's performance over time. They distill the financial statements into actionable insights. And the profitability and efficiency. These ratios measure how effectively a company is converting sales into profit and managing its resources. And the net profit margin, NPM. It tells you what percentage of every dollar of revenue ends up as net income. And high and stable NPM suggests strong cost control and pricing power in general. And the ROE, the return on equity, ROE. It shows how much profit a company generates for every dollar of shareholder equity. And the higher ROE, which is typically above 15%, suggests management is using shareholder money very, very effectively. Let's talk about the ROE. Return on assets. It measures how effectively a company uses its assets to generate a profit. And it's crucial for asset-heavy industries like manufacturing. All right. And liquidity and solvency, right? The risk. So these ratios assess the company's financial health, specifically its ability to meet short-term and long-term debt obligations. And the current ratio. It measures a company's ability to cover its short-term liabilities, which is due within 1 year, with the short-term assets like cash and receivables. And a ratio above 1 is generally preferred, indicating ample liquidity. Let's talk about the debt to equity ratio. It compares a company's total liabilities to its shareholder equity. And a high ratio indicates that the company relies more on debt financing than shareholder funding, leading to higher financial risk. And the interest coverage ratio. It determines how easily a company can pay interest expenses on its outstanding debt. And the high number suggests minimal risk of default on interest payments. All right, the context checked. So remember that a good ratio is highly dependent on the industry. And a utility company, for instance, can safely carry a higher debt to equity ratio than a high growth technology startup. Because 1, the cash flows are more predictable. And always compare ratios with the same sector. So valuation metrics, finding the intrinsic value. Valuation is going to be final, and it's a crucial step in determining what the company is actually worth to you. If the market price is below this value, then that means it's a potential buy. And the price to earning ratio, PE. So this is arguably the most common valuation metric, and it tells you how much investors are willing to pay for one of a company's current or expected earnings. And the high PE, a high price to earnings ratio, often suggests investors expect high future earnings growth. All right, so that means it's a growth stock. And think of tech companies, for example. And a low price to earnings ratio can suggest the stock is undervalued, or that investors expect slow or negative growth. All right, and it's a value stock. And the caveat, comparing to price to earnings across industries is meaningless. Compared to the historical price to earnings for the same company and to its direct competitors. Let's jump to DCF, right? Let's talk about discounted cash flow. And this is considerably the gold standard of evaluation. And conceptually, it attempts to estimate the value of a business today based on cash flow, okay? And it's expected to generate the future. And it focuses on its future cash. The model requires forecasting the company's free cash flow for many years into the future. So the discount, future money is worth less than money today. And the model uses the discount rate, which reflects the risk and cost of the capital, to bring those future cash flows back to a present day value. And inherent subjectivity. The final value is highly sensitive to the inputs, like future growth rate and the discount rate, making it more of an art than a science. And the margin of safety, a key concept popularized by value investors like Benjamin Graham and Warren Buffett. It's the difference between the intrinsic value and the market price. And protection from error. When we buy when the market price is significantly lower than our calculated intrinsic value. And this margin protects us if our valuation assumptions were slightly too optimistic. And an undervalued asset. If we value a company at $100 per share and it's trading at $60 per share, the $40 difference is the margin of our safety and the remainder of our profit. And the concept encourages a disciplined, conservative approach to investing, avoiding speculative purchases of overvalued assets. So the intangibles, right? Qualitative analysis and synthesis. So numbers don't tell the entire story. The best fundamental analysis blends hard numbers with an assessment of the company's non-financial and leadership. And management and leadership. Okay, the people running the show are crucial. Even a great business can be ruined by poor management. And the integrity and vision of the business is extremely important to take a look at. Does the management team communicate honesty with its consumers? And do they have a clear, credible long-term strategy for their business in general? And as far as capital allocation, how have they used the company's cash? Are they wasting it on poor acquisitions, or are they intelligently investing in R&D, buying back stock when cheap, or paying dividends? And its track record, look at its past performance. Have they met guidance? Have they successfully navigated previous economic downturns? Okay. And have they survived? All factors we have to keep it in mind whenever we're going to be investing. So the competitive moat. So this term is often used by Warren Buffett, for example, and it refers to what a company uses to protect them from being eroded by competitors. So one, their strength. Are they iconic? Okay, certain irreversible brands are here to stay. So for example, a certain beverage company, certain tech companies allow for premium pricing and customer loyalty. And network effects. As more people use the product becomes exponentially more valuable to existing users. For example, social media platforms. And switching costs. How difficult is it for a customer to switch to a competitor? And high switching costs, for example, business software systems lock in revenue. Okay. So, synthesis, forming the investment thesis. Fundamental analysis isn't about finding the best ratio. It's about building a compelling investment thesis. And this thesis is the unified argument that's based on your EIC review, the quantitative data, and the qualitative assessment. The company is undervalued and the market will eventually recognize its intrinsic worth are all going to be things you can put into play before making in your trade. And check some things out on the chart too, just to make sure it all lines up. Okay. Always look beyond the price of the intrinsic value of the business. Focus on free cash flow. Okay. It's the honest measure of a company's health, and invest with a margin of safety. Okay, don't pay $100 for something that you value at $80. Okay, and if you value something at $300 and it's at $80, then inshallah you can make your decision. And management and the competitive moat are just as important as the numbers. Okay, does the brand have its own stable concept? Okay, is it super competitive in the industry that it's in? Is it a leader? Okay, is it an innovator? All questions you got to ask before you put money into something. Okay, I love you guys so much. Stay prayed to God. Keep grinding. And if you want to learn how to invest, head over to stackmode.net. Catch you in the next one. Peace. What's going on, class? Today we're going to be talking about layer 0 protocols. Let's go and let's jump straight into it. So what is layer 0 in the first place? Layer 0 is the underlying infrastructure that connects and supports different blockchains, also known as layer 1s. So the foundation. So layer 0 is like the internet protocol. It's like the IP address, but for blockchains. And it provides the base layer for communication and security. And layer 1 protocols, like Bitcoin or Ethereum, are built on top of the network provided by layer 0. And enabling interoperability. It solves the walled garden problems where chains cannot talk to each other. And it allows for trustless transfer of value and data across different chains. And it's key for realizing the vision of a connected multi-chain future. So this way, cryptocurrency, the whole infrastructure, whenever money is being sent within the network, everything can be securely done. And share security. It allows for smaller, less established chains to borrow security from the robust layer 0 network. And it reduces the cost and complexity of launching a new secure chain. And it's vital for the stability of niche decentralized applications. So, Polkadot. It's the relay chain, the central hub of the Polkadot network. It handles the finality and consensus for the entire network, and it does not process user transactions like token transfers. And it maintains security by coordinating all connected chains. And layer 1s, parachains. They're independent application-specific blockchains. And these are the layer 1s that process transactions, okay, for DeFi, gaming, and identity. And they rent a slot on the relay chain for shared security. And they can have unique governance models and features. And Polkadot uses shared security and a centralized relay chain approach. So let's talk about Cosmos, also known as Atom. So the SDK and Tendermint, they're tools that let developers launch independent blockchains easily. And Cosmos SDK is a modular framework for building application-specific chains. And the Tendermint, it provides the consensus engine for instant finality and security. And it allows chains to be launched in weeks, not months. And IBC stands for Inter-Blockchain Communication, and it's the standard for chain-to-chain message passing. And it allows sovereign chains to connect and exchange tokens and data. So it's going to be a big link for everything. And each chain manages its own security and validators. And IBC, Inter-Blockchain Communication, is the fundamental layer 0 protocol for communication. And Cosmos uses sovereign security and a decentralized hub and spoke model. So the blockchain layer stack. Let's talk about layer 2s. And the purpose of layer 2s is to scale a single layer 1, okay? And examples are Arbitrum, Optimism rollups, and they improve transaction speed and lower fees by bundling transactions off of the chain. And layer 1s, purpose of layer 1s are going to be to execute and implement finality via smart contracts. Smart contracts are going to be the autonomous contracts that let the cryptocurrency space pretty much operate. Okay, so when you have smart contracts implemented, no middleman is going to be involved. So take a normal bank account system, for example, you would have to have a bank intermediary to confirm transactions or decline the transactions. Okay, but we can go ahead and bypass that by using smart contracts in the cryptocurrency sphere. So this is why the decentralized finance system and the whole blockchain sphere is extremely popular in the first place. It brings a lot of power back to the people, and people are going to be in an effective way to where they can go ahead and just transfer money. Say someone is completely out of in a different country, for example, you'd be able to go ahead and send them however much money you want to, whenever you want to, and it would go ahead and hit their account within their crypto wallet within a couple of minutes or hours. Okay. So, but using the traditional fiat bank systems, say you try to send, 1,000 USD to somebody in, let's say, Thailand using bot. Okay, there's going to be fees behind that, etc. Okay, but cryptocurrency, there's going to be fees, okay, gas, also known as the fees. And those are just going to be tiny network fees involved to just send your money from one place to another. Sometimes they could stack up depending if you're sending a large amount, but a lot of times if you're sending a large amount, the fees realistically aren't going to matter too much depending on what network you send them off of too. So that's also going to be a big factor too. And let's talk about layer zeros. The purpose of layer zeros affect interoperability and provide a network setup. And examples of layer zeros are going to be Polkadot, Cosmos, and they allow layer 1s to communicate and share security, forming a network of chains. And the future is going to be all interconnected. And layer 0 is going to be the foundation of everything. So think about a house, okay? What's below a house? That's especially that's tall. A lot of the time, it's going to be pillars. It'll be connected to some mountains. Okay, a lot of the times, the house before it's built, it's going to have a B structured on a base. Okay, and layer 0 is going to be the base, and layer 0 connects all the building blocks of Web 3. So the whole cryptocurrency sphere, okay, and it moves beyond single isolated chains. And the interoperability race. Polkadot and Cosmos represent two of the leading distinct architectural approaches to this critical problem. And layer 0 enables a seamless, cohesive, decentralized internet. So within the layer 0 functionalities, okay, we have to understand that, okay, it's used to connect all of the blocks within Web3, okay? And it's gonna be a hub. It's gonna connect the separate layer 1 blockchains that would otherwise operate in silos. And developers can also build custom blockchains like layer 1s, tailored to specific use cases, using the tools, consensus mechanisms, or security provided by the layer 0. And layer 0 offers a shared security model where multiple chains can inherit the security of the base layer's validators or consensus mechanisms. And some layer 0 protocols focus on ensuring data availability for transactions, allowing layer 1 chains to process transactions efficiently without storing all data on the chain. So Polkadot, for example, uses a relay chain, okay, for layer 0 to connect multiple parachains, which are layer 1s, enabling interoperability and shared security. And developers can create custom blockchains, parachains, tailored to specific needs like DeFi or gaming. Okay, so like a token like DOT, okay, and the token be DOT. So that's just how layer 0 works within the cryptocurrency space. Okay, and just think of layer 0 as the internet's core infrastructure. Okay, think of it as the cables, okay, the base to a house, the routers and the protocols. And think of layer 1s as the websites or the apps. Okay, like Google or Amazon. And layer 2 is the tools that optimize those websites, like content delivery networks. And layer 0 makes it possible for websites to exist and communicate, even if they're built differently. And here's why layer 0 even matters in the first place. As blockchain adoption grows, the need for scalable, interoperable, and customizable solutions become critical. And layer 0 protocols address the limitations of isolated layer 1 blockchains, enabling more connected and efficient decentralized ecosystem. And they're particularly relevant for DeFi, NFTs, gaming, and other applications requiring cross-chain functionality or high throughput. Okay, and if you want to learn more about layer 0s or cryptocurrency in general, head over to stackmode.net. Stay prayed up to God, keep grinding. Catch you guys in the next one. Peace. What's going on, guys? Let me go ahead and show you the full guide on how to detect when prices are going to go ahead and reverse, whether it be for an uptrend or a downtrend. So let's talk about it. So first, price is going to reverse when it meets at its congruent areas or opposite areas. So what does that even mean? So if price, for instance, is trying to find an area of resistance, price has a chance to reverse at an area of resistance again. Okay, so that's going to be one potential reversal pullback area. So if you're looking for a short, this is going to be setup number A. Okay, if you're looking for a short setup, okay, then we're going to have setup B for the short. Okay, or if there's an area of support above current price, okay, price can come up and turn that area of support into resistance. Okay, this is also going to be a probable area to short too. Okay, so both of these models right here are going to be usable in order to catch a reversal trade to the downside. Okay, so if you think price is going to go in a downwards direction, okay, if you think sellers are stepping in and price is going to short, then you're going to go ahead and be able to play model B. Okay, and you're also going to be able to play model A. Okay, so model A and model B are going to go ahead and work if you're trying to short trades, for example. Okay, so let me go ahead and show you if you're trying to long a trade. Okay, so let's talk about model C. Okay, model C is if an area of support decides to be created. Okay, an area of support is going to be an area where price decides to bounce upward at. Okay, so an area of support can go ahead and be mirrored and bounce that again. Okay, so if you see an area of support getting bounced at similar times, then that can go ahead and be a trade. This will also count as model C2. Okay, say price didn't exactly do a clean level of support. Okay, let's say price decided to break past this level of support that's going to be right here. Okay, so let's say price decided to do that. Okay, price could still run through it downward, come back up, and give it support. Okay, and that still be a support mirror. Okay, and then you can go ahead and take it up to the areas of resistance, which would go ahead and be another reversal point. Okay, so we're going to be closing at congruent or reversal areas. Okay, so if you're in a long trade, then you're ideally going to be closing at an area of resistance. Okay, because you're expecting price to go in an upwards direction. Price can't go up if it doesn't break resistances or break past areas of supports above current price. Okay, it has to do one of the two. Okay, so you know price is going to try and either A, reverse at the resistances before the breakout, or reverse at the area of support above current price. Okay, causing a support into resistance. Okay, candlestick formation. Okay, also known as break and retest. Okay, so as far as a long example 2, okay, example D, price can also break an area of resistance, turn it into support. So resistance can be broken, turn it to support, and the price can go up to the upside and decide to go up. Okay, so this is going to be like the staircase model, and this is going to be my favorite model personally when it comes to longing trades. Okay, even when it comes to pullbacks. Okay, so even prices or areas of resistances below current price, price can still hunt back down to it eventually, turn it into support, and then you can catch an even bigger sweep up. Okay, so let's go and let's talk about on the chart how we can identify certain pullback levels. Let's make it easy. So if I'm on the stock market and cryptocurrency market, I like to always start off on my daily time frame. Daily time frame is going to give me my bird's eye view, and I'm going to be able to see absolutely everything. I can see 5 years worth of price action on one chart, for example. Okay, so I can also use my 4-hour time frame too. 4 hours are going to be amazing, and it's also going to be my bread and butter time frame too. So if I'm on the daily time frame here, I know that price is always going to be trying to chase new areas of resistances or supports above current price. Okay, why? Because if I'm on the stock market, I know that people are working hard within the company, generating revenue, generating items, okay, and giving those items to the public, okay, in order for people to buy, which will generate more revenue, okay. And when the company generates more revenue, earnings reports beats, you're going to see these financials down here where you can see surprise, estimated. So it'll be a report that estimates how much money a company will make. And if they beat it, then that means that they beat their earnings. That means that they beat the reports that they thought were going to happen, the estimates. Okay. If they beat the estimates, a lot of the times price can move in either a positive or negative direction sometimes too. But once a company has shown that it's profitable, especially when it's paying out dividends, which is something to where the more shares that you have, the more money that you get paid out in dividends, then it's going to go ahead and show you that, okay, this company is potentially profitable. And as you can see here on the daily time frame from just 5 years ago, price was at pretty much $2 a share. Okay, $10 a share. Price is now at $178 a share. Okay, if you know the old Nvidia prices, then if you know, you know. But Nvidia had a squish, so the numbers got smaller. It used to be a lot bigger than this. But yeah, so you always know that price is trying to hunt an area of resistance above current price. Okay, always know that. So price is trying to hunt areas of resistances above current price, especially all-time highs. Okay, all-time highs is definitely a level that's trying to get hit and destroyed, so then price can continue upward. Okay, and then price can continue trying to make some more money. Okay, or the company can make some more money due to the fact that their share value is going to be increased. Okay, so instead of a certain person being a billionaire, you know, they could be a trillionaire depending on the stock value. So that's why I want it to go up. So here's how you know price is going to reverse. Okay, one, it's like we talked about with Model A. when price decides to come across areas of resistances, even if it's way in the past, you're going to see here on this blue line, price reversed at this area one time here. Okay. Once. Okay. Twice. 3 times. 4 times. Okay. 4 times. 1, 2, 3, 4. 4 times price decided to short at this blue line area here. Okay. And if I'm going to trade a breakout, this is why I don't trade the first candlestick personally. I like to wait for a 4-hour candlestick. So I'm going to wait for a whole new 4-hour candlestick to be above the zone for me to trade that personally. Or I would wait for break and retest. I would just wait for the resistance to be broken completely. And if it turns to support, then I'll take it up. Okay. That's also how you trade break and retest too. Okay. So, you know, price is going to be trying to break this area that one day. So even if price is below current price, I can see that, okay, price has this area of support created right here. Areas of support are going to be important because it's going to show you where price pretty much already wants to retest and bounce from. So areas of support below current price are going to be really important. But so are areas of resistances. Okay, heavy areas of resistances can also show you, especially with support, can show you and be like, okay, this price area can go ahead and be a decent area to buy. Okay, so check out this area right here. Okay, so if I put this area of resistance here underneath the circle, I could check that this area of resistance decided to get broken here. Okay, price got broken here. But once I got up, price decided to turn this area of resistance here, got broken, and turn into support here. Okay. So resistance broken, turned into support. Tried to hold it here once, got broken down, and then came up and did it again. And then price decided to bounce up. Okay. So you can wait for price to either come down to areas of support like here and see if price wants to bounce up. Okay. So either that, or you're going to wait for price to come in contact to an area of resistance. So price can either bounce down there. Okay. Or price can go ahead and bounce on the candles on top of it. Okay, maybe at these areas of resistances here. Okay, and just wait for price to go ahead and react because we know that resistance can be broken, turn into support. Okay, or price can go ahead and bounce at an area of support that was already there. Okay, so you can use that in order to make trades. Okay, make it extremely simple. Don't make it too hard whenever you're catching your reversals and your sweeps. All right. So either play a support mirror, resistance mirror, however you want to trade. That's all the formations of reversals. Stay prayed to God. Keep grinding. I'm gonna catch you in the next one. Peace.
Let's go ahead and talk about crypto wallets. So I want to go ahead and break down the difference between hot wallets and cold wallets, as well as keeping your crypto secure by making sure you guys lock down your seed phrase. So let's jump into exactly how we can secure our cryptocurrency. Inshallah, if God wills. Boom. Let's talk about how to secure your crypto like a pro. So if it's not your keys, it's not going to be your coins. I want you guys to understand the difference between ownership and just keeping your keys on a broker that if they get shut down or something like that, you won't have access to your crypto, or they could even limit how much crypto you could send, withdraw, deposit, etc. And that's not what you want. The whole reason we're trading crypto in the first place is so we can have some freedom over our money, inshallah. So let's talk about it. So hot versus cold wallets. So the vital distinction, understanding where your private keys live is going to be step 1. Understanding where your private keys live is going to be step number 1. So the hot wallet is going to be online. Apps on your phone or your computer, for example, Coinbase or MetaMask, keys are on a device connected to the internet. Convenient, but can be hackable. If people guess your Google or hack into your 2FA or multi-factor authentication, etc., then they're going to be able to have access to your crypto. Not what you want, because then they're going to have access to your money. So let's talk about what a cold wallet is. So a cold wallet could be like a USB drive, a little block device, etc. And it's going to be a physical device, and it's a hardware wallet that stores keys offline. And it never touches the internet, and it only signs transactions. So what you can do is buy your crypto on a hot wallet and then transfer it to a offline cold wallet. So it's kind of going to be like cash, but cryptocurrency. So you guys are going to be able to transfer it to hot wallets and transfer it to your bank if you ever need to, etc. So a cold wallet is pretty much going to be like cash, but for crypto. And a hot wallet is going to be like the online live store where you can purchase and store cryptocurrency as well too, but it comes with limitations. Let's continue on. So the seed phrase, also known as the recovery phrase, make sure you guys keep this safe. I don't care if you guys put it inside of a notebook, if you guys write down the keys on a piece of paper. A lot of the times it's going to be a 12 to 24 key word phrase, okay? And it's going to be random words like this. So for instance, like which, collapse, practice, feed, etc. And then 24, some brokers only do 12, okay? So when you create a wallet, you get 12 or 24 random words, and this is going to be the key to your vault, pretty much. If you lose the words, okay, then you cannot get access to your vault. Once again, if you lose the words, you're not going to be able to gain access to your vault. So never type it in on a computer unless it's somewhere where you feel it's secure and safe. Try not to take photos of it because people can hack into your iCloud. I'm not too sure about Google. I haven't had a Samsung phone in a few years, but I'm sure there's going to be ways that people could access your photos too. And try to write it down on like a piece of paper, multiple piece of paper if you can. Store it somewhere, you know, in case paper gets burned, lost, wet, etc. And try and just store it, password protect it. If you do store it online, there's going to be ways to password protect your documents. You guys can put it inside of a WinRAR file. WinRAR is going to look like the stack of books. It's going to be an icon. And you should be able to put a .text file, .txt. And you could put it inside the WinRAR and then password protect it. And then you could upload it somewhere, wherever you want, because only you know the password at the end of the day. So keep these words secure and safe. Please, for the love of God, do not lose these words. And there's going to be a lot of phishing scams and stuff like that too. You're going to see online like, hey, I lost my account, and it's going to be a bunch of random words like this. They want you to log in, buy crypto, and they're going to try and take your money. So never try and take people's money. Never log into somebody else's wallet. Okay, be righteous, be focused on God, and be focused on your bag. Stay in your bag. Don't try and scam. Don't try and do little weird stuff trying to get some money real quick. Stop it. Okay, be genuine, work hard, and most importantly, pray every day. So keep these words secure, and you guys can also keep these words for your kids, your family down the line, etc. Just as long as you keep it secure. Stuff happens in life though. Once again, papers could get wet, fires, etc. A lot of stuff goes down. But if you write it down like some metal, keep it with you, and upload it to multiple sources with a password protected form, then you could have your money secure in a nice way. Let's continue on. So hardware wallets, okay, the standard. Boom. Physical security. To be a pro, you must move significant funds off exchanges such as Coinbase, okay? And how it works. The device generates keys internally, and the keys never leave the chip at all. And you must physically press buttons on the device to approve any outgoing money. So hackers cannot press the buttons remotely. You got to have the actual cold device in front of you. Now, you can't be running your mouth telling everyone on the block like, yo, I got 10,000, I got $1 million on my crypto wallet right now. You know what I'm saying? That's not playing a good game. Still, you got to be secure. Just like if you have cash, you know, you got to worry about little security things. And for verification, you must physically press buttons on the device to approve anything. Okay, so unless somebody actually has it or rob you, God forbid, okay, keep it safe, keep it locked away, keep it inside of a safe, even if you got to, and just keep it secure. And some popular brands are going to go ahead and be Trezor, there's Ledger, Cold Card, and Bitbox. There's going to be some other ones as well too, and they pretty much just look like little USB devices. Now, let me go ahead and tell you guys about something. May God bless his soul. There is a guy who lost his hardware wallet, and he had a bunch of cryptocurrency on it. And he spent millions of dollars clearing a trash excavation site trying to look for it because he accidentally threw it away. So it just like cash, you got to take care of it. There's been times where I've had cash inside of my coat pocket and I accidentally put it inside of the washing machine. And thank God you could wash cash, so it was okay. But like little things like that, like you got to just be on top of it if you're going to have a cold wallet. So if you're lazy, if you're not consistent with your things, you know what I'm saying, things like that might got to change. Pray on it, get better, improve, and just understand that the hardware wallet and cold wallets, you got to take care of them. It's going to be secure, but you got to keep it secure yourself in real life. All right. And the passphrase, the 25th word, the hidden wallet, advanced security feature supported by most hardware wallets. So the seed phrase plus the passphrase equals a totally new wallet. So if someone finds your 24 words, God forbid, they see wallet A, okay, and it's going to be more of a decoy, okay, a dummy, a fake, but your real money is going to be in your wallet B, which requires the extra word that you memorize. So if you forget the passphrase, then the funds are going to be lost forever. No recovery, there's no support you can go run to like, hey, I lost my money. Like, no, you want to play cryptocurrency, you want to invest in a cryptocurrency, you got to have the responsibility of pretty much being your own bank. Okay, you control when you send your transactions, you control how you store your transactions, and be on top of your stuff. Okay, just like if you're your own bank, you could choose between cash, digital currency, etc., whatever you want. Okay, same thing with cryptocurrency. You can go hot wallets, cold wallets, find your sauce, do your thing, and do what feels right for you. Okay, if it feels right in your stomach, then that's just what it needs to be. Okay, so fire and flood protection. So paper burns. Psh. Writing your seed phrase on paper is going to be risky. Houses burn down, pipes burst, stuff could get wet. So you could use things like steel plates. Use the center punch, if you guys have ever seen that, kind of like the things that look like Braille. So you could use a center punch, or you could use tiles to record your seed words on a stainless steel or titanium surface. This way that if anything happens, such as a disaster, God forbid, as long as you don't lose it, it's going to go ahead and be indestructible for the most part. It can survive house fires up to 2,500 degrees Fahrenheit and corrosion, and as well as any water and things like that. And it's just a one-time cost, kind of like a safe if you wanted to keep your cash, jewelry, etc. safe. So it's a small price to pay to secure your life savings absolutely forever. So keep that in mind. There's going to be multiple things you could do, multiple ways you guys are going to be able to keep your money secure and safe. But keep your money to yourself. Okay, evil eye is going to be a very real thing in the world, sadly. So don't be running around telling everyone on the block where you have your cold wallet, where you have your phrase, etc. Okay, keep it just between you and your family, inshallah. So as far as the security checklist, right, let's ask ourselves, do we buy a hardware wallet? Okay, because if not, you could go ahead and invest into a Treasure, Ledger. There's going to be multiple ones you could check out. Hop on Amazon, eBay, the internet. There's going to be some hardware wallets you could check out. Okay, if God wills. And write the seed phrase on steel. Try not to do it digitally just in case you ever get hacked, God forbid. And never type the seed phrase into a computer or a browser unless it's password protected. If it's password protected, okay. And try to use the extra passphrase for extreme large amounts in case somebody ever gets your 24 words. And always do a small test transaction first. Okay, you want to do a small test transaction first. So that's going to go ahead and be it. I love you guys so much. Stay prayed up to God. Keep grinding. Don't ever give up, even when things get hard. Pray to God every single day. Try to work out if you guys are feeling any type of anxiety or anything like that about your money. Keep it secure and don't be overly boastful. Okay, spend moderately, and catch you guys in the next one. Read Quran and listen to God. It's the easiest way to be successful. Catch you guys in the next one. Peace.
Class, let's learn. Today we're going to be talking about Mono Zero, Zcash, and the evolution of the unlinkable value, and the quest for digital anonymity. And this class is going to explore cryptographic foundations and real-world implications of the leading privacy-focused cryptocurrencies. Let's jump into it. So the transparency trade-off in cryptography. Traditional cryptocurrencies like Bitcoin operate on a transparent public ledger, also known as the blockchain. And while this offers unprecedented security and verification, it fundamentally compromises financial privacy. So let's talk about anonymity versus pseudo-anonymity. Bitcoin transactions are pseudo-anonymous, meaning that they're linked to public wallet addresses, With enough data, these addresses can be de-anonymized and linked back to real-world identities, especially when funds move through centralized exchanges, which have know your customer rules, also known as the KYC laws. So this is how big scammers get caught and things like that too. So when people will get off and finesse millions of dollars worth of Bitcoin, etc., and stuff like that, especially if they do any type of withdrawal to any type of bank account or Cash App or anything like that, it can be traced. Okay, so as far as the whole decentralized section and the space to where everything is anonymous, things with enough tracking, and since everything is on the blockchain, which is pretty much going to be the history of every single transaction that happens on the cryptocurrency market, things can definitely be tracked back. So keep that in mind. So sophisticated chain analysis firms can map the flow of the funds, inferring balances, spending habits, and commercial relationships. And this compromises business secrets and personal financial health. So if certain coins can be tainted or flawed due to their history, for example, association of illicit activity, for example, then their value acceptance can be diminished, which is a key failure of fungibility. And fungibility is where all units of a currency should be perfectly interchangeable. So let's say for analogy purposes, right, let's talk about the glass vault. So imagine a Bitcoin has a glass vault, right, the blockchain, and it's where everyone can see exactly how many coins are in every single box. All right, and let's say the box refers to the addresses. And one of these routine boxes, even if they don't know the owner's name initially. So that's kind of just how it is. Things can still be traced and tracked with enough data, but for the most part, it's not going to be as vulnerable as far as the sensitive information exposed. Like, you're not going to see your last 4 digits of your card number and stuff like that. It'll be your Bitcoin address, which can't really do anything for you. If somebody gets it, if they see the address of the transaction that was done, it'll just show how much the transaction was for, the fees in the transaction, etc., and stuff like that. But it can't really trace you back to your own personal wallet, but it will have an address for the transaction. So mandatory privacy by default, the Monero protocol. So Monero launched in 2014, and its design is to completely fungible and private by default, which makes all the transactions appear the same to external observers, and it achieves this trio of mandatory privacy features. So let's start off with the ring signatures. So this hides the sender, and the actual spender is mixed with several non-spenders, and that's the ring, making it computational and feasible to determine which key is actually signed to the transaction, and the transaction is proven valid, but the source is going to be obfuscated. Okay, so keep that in mind as well too. So ring signatures hide the sender. Now let's jump into stealth addresses. Stealth addresses hide the receiver for every single transaction, and for every transaction, the sender generates a unique one-time destination address on the blockchain for the receiver. And the receiver can scan the blockchain and identify the funds belonging to them without revealing their true public address. And let's jump into ring confidential transactions, right? Referring to ring CT. And this hides the amount. And ring CT uses the Pedersen commitments and zero knowledge proofs to cryptographically verify that the inputs and outputs of a transaction balance, right? Which is going to refer to the fact that no new coins were created without revealing the actual value of a transaction. And Monero's core philosophy is that privacy shouldn't be optional, all right? Should be secure, and people should be having high conviction between sending money from one person to another. They shouldn't feel like they are vulnerable within sending information. And Monero's core philosophy not only thinks that privacy shouldn't be an optional factor, but it should be non-negotiable. And it's a feature that's baked into the protocol, guaranteeing a high level of fungibility for all the XML units. So let's talk about selective disclosure via ZK snarks. So Zcash, it introduced a groundbreaking cryptographic tool called ZK snarks, and that stands for zero knowledge, succinct, non-interactive argument of knowledge to the mainstream. And this allows a user to prove that they know a piece of information, like ownership of funds, without revealing the information itself. So what is a ZK snark in the first place? I know it's a crazy name. So it's a proof system that verifies the validity of a transaction without needing to see the addresses, the amounts, or any other identifying data. And this allows for shielded transactions where the public blockchain only records that a valid transfer occurred, just to make sure that, if someone says, yeah, I sent you your million, and they can actually go check to see if it happened, so you can't get robbed in finesse. You can actually see if the transaction occurred. So don't be foolish. And let's talk about optional privacy. Unlike Monero, Zcash offers both transparent T addresses like Bitcoin and shielded Z addresses. Okay. So it offers both of those type of transactions. And this optionality is often cited for compliance purposes. And compliance is pretty much going to be government laws, things having to be in place so people can send, buy, and sell cryptocurrency. And it's often cited for, once again, compliance and law purposes, which allows users to selectively disclose information if required by a regulator or auditor. So companies, a lot of the times, have to have privacy laws, so all your information can't just be exposed. So viewing keys and memos. Zcash provides mechanisms, like viewing keys, that allows a Z address owner to reveal the transaction data to an authorized third party. And this controlled transparency is a key differentiator from Monero's absolute privacy. So let's jump to an example here, guys. So using ZK snarks, a company could prove to an auditor that it holds a minimum balance, let's say for over $1 million in a ZEC wallet, without revealing the exact balance or any other transaction history. And they prove to meet the condition, but nothing more. So comparing Monero's mixing versus the Zcash zero knowledge. So Monero's approach, let's talk about the mixing here. Okay, so the mechanism involved in Monero's approach. Okay, it's using rigged signatures, and rigged signatures obfuscate the sender by creating plausible deniability among a group of signers. Okay, and they're going to be in the ring. And the pros of it: it's simpler to implement, and it relies on time-tested cryptography. So once again, ring signatures obfuscate the sender by creating plausible deniability among a group of signers. Okay, making it a hidden circle. Okay, it's a lot simpler to implement, relies on time-tested cryptography, and it's absolutely mandatory for all users, ensuring network-wide privacy, so everyone can be safe who's trading within the circle. So, and some cons of it: transaction sizes become larger, and that could also lead onto the blockchain network and make people have potentially slower transaction verification times due to the complexity of ring verification. So it would just take a little longer for you to receive your money within your wallet if you were to receive money, or if you send somebody to somebody, it would take a little longer for the funds to actually be spendable in their wallet. And that's okay. So Zcash's approach, right? This is going to be a different approach to it. So Zcash, the mechanism of it. So ZK snarks prove the validity of a transaction script without revealing any of the underlying inputs or outputs. So the pro of this: it's a higher level of cryptographic anonymity, okay, and it's zero knowledge, okay. So it's pretty much when the transactions are done, can't be tracked as easily, okay. So that's going to be a big pro of it, especially for people who want to use cryptocurrency for just certain other purposes. Okay? And smaller transaction sizes compared to Monero, so it's going to mean faster processing. Okay, so you're going to get your money faster. Good thing. And let's talk about the cons though. So it requires a complex initial setup known as the trusted setup. And though newer versions aim to minimize this, privacy is going to be optional, leading to less adoption of shielded transactions. Okay. So Zcash's original trusted setup was controversial, and the initial parameters, if compromised, could allow someone to counterfeit ZEC. And Monero's design avoids the centralized point of trust because privacy is not optional within the Monero world. So yes, it's a little slower, a little clunkier, not as quick, but safer. So beyond Monero and Zcash, let's talk about the layer 2 protocol innovation. So the quest for digital privacy is not limited to the coins. New innovations are integrated privacy into existing chains and layer 2 solutions. Let's talk about layer 2 privacy solutions. So Tornado Cash Mixers. They use smart contracts and ZK snarks on Ethereum to break the on-chain link between source and destination addresses. And CoinJoin and CoinSwap. And there are going to be protocols where multiple users combine their transaction inputs and inputs into a single large transaction, making it impossible to map individual transfers deterministically. And advanced zero knowledge. ZK snarks, right? It's a newer version of ZKPs that removes the need for a trusted setup. It's trustless, making them more decentralized and mathematically pure, though computationally more intensive. But we got to remember, just like I just talked about on the last slide, security is going to be optional. So the encryption, right? So the homomorphic encryption, right, also known as the HE, it allows computation to be performed on encrypted data without decrypting it first. And this is still highly theoretical for fast decentralized currency. So ZK snarks, once again, a lot quicker, but still raises a lot of concerns due to the fact that privacy is going to be optional. Keep that in mind. So regulatory focuses, right? Laws, governments got to have their piece of the pie and got to make sure things are safe too. Anti-money laundering companies and governments, the SEC, etc., got to make sure cryptocurrencies are being managed within a safe way so people aren't just getting rug pulled on, getting scammed and getting their money duplicated, etc. So regulators globally are increasing scrutinizing protocols that offer strong privacy, viewing them as potential tools for money laundering, right? And the future balance will be between innovation and compliance, likely favoring optional, audible private solutions like Zcash's viewing keys, okay? So as long as certain government entities get behind it, the anti-money laundering entity, SEC, etc., are all monitoring it, then we could have a pretty safe, decentralized world. Although, even though it's being monitored by regulators, it's truly decentralized. Okay, let me know in the comments below. So let's talk about adoption, compliance, and the fungibility imperative. So primary use cases. So journalism and activism, right? Used to protect donations to whistleblowers or political dissidents from oppressive regimes. Okay, so journalism is being implemented, trying to spread the worldwide spread of cryptocurrency. Okay, spreading how people can do their transactions and just making it more known to the government. And the government itself has been buying cryptocurrency recently as of 2025, and TradingView has now implemented as of October 10th, 2025. You can actually start seeing some cryptocurrency news being linked. So government's really adapting it. Its future's looking strong as far as the cryptocurrency space. So let's talk about some privacy. All right. So e-commerce privacy. Preventing competitors or data miners from tracking suppliers, sales volume, or customer bases. Extremely important for privacy, and know your customer laws are going to be extremely important to implement on brokers where we put our cards in order to buy some cryptocurrency. And salary protection. Individuals who don't want their employer's treasury balance or personal wages publicly visible. Super duper important for anyone who wants to stay safe or stay anonymous. Okay? You don't got to flex and pop it on everyone if you don't want to. So corporate secrets. Hiding internal fund transfers and merger acquisition activity until legally required disclosures. Okay, so pretty much not exposing deals until things are fully done. So some key challenges: exchange delisting. Many major regulated exchanges, let's say Coinbase or Binance, for example, refuse to list privacy coins due to compliance pressures, limited liquidity, and adoption. And there's going to be some regulatory classification. The lack of transparency often leads to classification as high risk by financial authorities, creating friction with traditional banking rails. And when things are classified as high risk, people aren't going to feel as safe to invest into it, and leading to less liquidity, since now it's going to be, once again, investing into it. And let's talk about the scalability and computation. The advanced cryptographically required, especially for ZK snarks, can increase transaction processing time and costs, though this is actively improving as laws get passed, governments start to analyze cryptocurrencies, regulate things, consumer sentiments start coming out, and things just start getting talked about. And the ultimate success of privacy coins depends on their ability to prove that the financial privacy is a fundamental human right necessary for a free society, and while demonstrating that the tools exist to meet legitimate law enforcement needs. So they're trying to keep everything safe because, once again, a lot of big scammers and stuff like that within the cryptocurrency world, but able to get caught, people are able to return money and stuff like that too. And the cryptocurrency world just really progresses over time. There's been some things I've talked about in previous other lessons too, where there's been instances where, let's say, like a certain amount of Bitcoin Cash, right, got hacked, and people were able to reverse the transactions, giving all their money back, right? And certain things like that just being implemented just to keep the safety protocol of everyone's money flow. Things just get better as people start to, one, come up with more scams, and as people come up with more scams, people can come up with a stronger defense in order to fight it. So thank God for everything getting more secure, locked down, so we can have a safe crypto trading environment. And privacy isn't about hiding that bad deeds, right? It's about protecting individuals with autonomy in a financial system where every transaction can be linked and analyzed. So Monero, XMR, it's absolute, and it forces mandatory privacy rights through the ring signatures, stealth addresses, and ring 16. And it favors fungibility above absolutely everything, regardless of the transaction time. So it doesn't care about that. It doesn't care how slow a transaction time is, as long as it's safe, making sure that it's locked down, and it's mandating privacy. Let's talk about Zcash, right? The SECC. So optional privacy using Zk snarks, offering the highest cryptographic guarantee with control disclosure. All right, viewing the keys and the future of everything. Moving toward layer 2 and modular privacy solutions that integrate ZKPs across multiple blockchains. All right, guys. So let me know what you guys think about the future of cryptocurrency. Stay prayed up to God. Keep grinding. Head over to stackmode.net to learn how to trade, how to invest, and how to grow your business. Peace. All right, this is going to be the beginning guide to just reading the crypto chart extremely easily and efficiently. Okay, so we're going to go ahead and understand two things. Okay, one, higher time frames is going to be everything. It's going to be our bread and butter. Our daily time frame and our 4-hour time frame is what's going to get us our profitable trades. Okay, we're going to need to be able to see everything on the market. We're not going to be able to tunnel vision on the smaller time frames. And we also need to put market with a logical perspective. Okay, so we have to add odd logic to the market. Okay, and we have to understand that everything is from left to right. Okay, so the fact that it's a left to right chart is going to go ahead and explain areas like resistance, for example. Okay, so take this whole area where price decided to create a top and then fall in a downwards direction. Okay, say this area here, and then the price decided to fall downward. Okay, so that's going to be due to the fact that price started way over here to the left. Okay, so when it first came out, let's say Bitcoin, for example, okay, price was relatively really low. Okay, and then we could see price over time started to start coming up. The reason why price decided to sell heavily downward here is because people got in way over here. Okay, they're up a lot of money. Okay, so they're trying to take some profit. So that's the reason why resistance gets created. So if you ever see sharp areas where market decides to fall down, okay, say an area like this or an area like this, okay, and then you see price falling in a downwards direction, okay, you can go ahead and see that, okay, it's just people selling because this is a left to right chart. So applying logic to everything is really going to help us break it down, really understand what we're looking at, and putting everything into the perspective that we need to put it in. Okay, and then after that, price isn't going to always a lot of times crash down to 0, and it's going to make what's called a higher low. Okay, so when price is making higher lows, so this low, okay, was created here. So then this low above it is then higher than the previous low. Okay, once you start seeing price make new higher lows, okay, you know you're going in an uptrend. Okay, price is going in an upwards direction. So the only reason price goes down is because people are selling. Okay, that's it. So if you ever see price going in a downwards direction, that just means people are selling. That's it. And price is going to try and find a bottom, okay, and create a new higher low in order to bounce or create a new lower low. Okay, so for instance, price had this ultimate low right here. Okay, I'm going to go ahead and zoom in. Okay, I can see price decided to bounce at this area of support right here. Okay, you can see price create a support and then bounce in an upwards direction. Okay, and then we can go ahead and see here on the daily time frame, price decided to then make support right here too. Okay, price decided to make support right here too. So create a support right here, down here, and also create a support up here too. Okay, creating a higher low. So here's the original low, and then here's the higher low. Okay. And whenever you start seeing that, that's how you know price is trending in a upwards direction. Okay. So we got this low, this low, this low. Okay. This low, this one. Okay, and it just keeps going up in an upwards direction. Okay, then up here. Okay, and then price continues to go up. Okay. So analyze your chart. Okay, whenever you see higher lows getting made, you know price is going in an upwards direction. Okay. And whenever you see lower highs getting made, then you know price is going in a downwards direction. Okay. Say I have this high up here. Okay, it's a super high. Then I have an even lower high right here. Okay, look at my 4-hour time frame. Okay. Actually, no, I'll stop my daily here. Just because it's 2021. Anyways, the price started at resistance here. Okay, and then we made a lower high right here. Okay, and then an even lower high over here. So these are called lower highs. Okay, LH. So this high here, okay, this low is lower than this high. Okay, this low is lower than this high. Okay, lower highs. So that's how it works. And that's how you know if you're in a downtrend or if you're in an uptrend market. Okay, and once again, support is going to be an area where price decides to bounce within an upwards direction from. And support is going to be an area where price decides to bounce in a downwards direction from. Okay. Okay, so down here, it's going to go ahead and be support. Why? Because I can see it's an area where price decided to stop falling down from and then bounced. Okay, so anywhere price decides to create a low, bounce, that's going to be support. And anywhere price decides to create a high and fall down is going to be resistance. Okay, so putting these two together in a trading aspect is going to be really, really nice. So let's go over two things. So we know that price cannot go in an upwards direction until it passes an area of resistance or an area of support above current price. Okay. And also, support can be broken and turn into support. Or support can be broken and turn into resistance. Okay. Support can be broken, turn into resistance. Okay. So keep that in mind. Support, price broke down right here, and then turn into resistance. And then price decided to fall in a downwards direction. Okay. So take your time and really analyze everything. And also know that resistance can be broken, turn into support. Okay. So take your time and put it all into perspective. Okay. So resistances can also mirror each other in short at the same place, or supports can mirror each other and bounce at the same place. Okay. That's going to be the models you're going to be looking for when it comes to trading. Okay. So I'm always going to start off on my daily time frame. Okay. The daily time frame is going to be my bread and butter. It's going to give me my eyes to absolutely everything, and it's going to help me see what I need to see. Okay. So boom, let's go. So all-time highs, right? Let's go and talk about all-time highs. All-time highs is the maximum height that price has reached. Okay, I like to go ahead and always put a level at all-time highs. Okay, just because I know that one day, inshallah, price is trying to break this price and go to a higher price. Why? Because I know that price is trying to always break resistances in order to continue in upward direction. And the reason why that's true is because people are investing into these tokens. So it's increasing the share price. People are believing in these tokens. Okay, certain projects are coming out. So more people are going to be investing into it, whether it be the ones who are already investing, putting more money into it, or new traders coming in since they see other people already believe in it and have some good returns from it as well too. So still starting off on the daily here. Like I told you, supports can mirror and resistances can mirror. Okay, so I'm going to go ahead and put a zone at the very top of all-time highs. Okay, right here, all-time highs. Okay. Price hasn't broken this high yet. Okay. So until price decides to try and come down to this major area of support, we'll see if it wants to hold. Okay. So if price breaks past this major area of support, then we could try maybe this area of support. Okay. or this area of support. Okay. Go to my 4-hour time frame, make sure everything looks how it needs to look. I like this too over here. I can see that price has a whole another low over here. Okay. Boom, I see that price has an area of support over here too, which price decided to mirror over here and do the same exact thing. Support and mirror, do the same exact thing. Okay, just make it simple. So once again, you do have the area of resistance up here too. Okay, also known as all-time highs. So we know that one day price is going to be chasing that area in order to break, okay, invalidate that level and go to a completely new and higher price. So I could either wait for price to come down to this area of support, okay, and then I'm going to be on my 4-hour time frame and wait for a close. So I'm never going to take the first candle that touches my lines, okay, whether it be a candlestick. Say I'm trying to play for reversal at this blue line down here, the first blue line at this area of support right here that matches with this area of support. Okay, say I'm trying to play at the same areas right here, right? If price gives me one wick and then breaks down, that's completely my fault. What I'm going to be waiting for is multiple candlesticks on the 4-hour time frame, okay, to be formed above the blue line. Okay, so I'm never going to take the first candlestick that's going to associate with whatever zone I'm looking for, whether it be resistance or support. Okay, I'm going to wait for the candlestick to form. Okay, make sure the traction is there, make sure people actually want to buy right there, and then go ahead and get in. Okay, so having a long-term mindset is really going to help you be a lot more patient. It's going to help you reformulate your plans, your strategies, and your ideas, and really just have a nice, healthy perspective of everything overall. Okay. And you know where you can intentionally, if you take profit out if you wanted for certain things too. So let's say you are in for a long, price decided to bounce at this area of support right here. Okay, price could easily try and come up to this area of resistance up here too. Okay. So let's go over another example here. So Ethereum. So let's check out Ethereum here. Once again, we're going to start off on our daily time frame. Let's go and let's get the full overview of everything. Okay, I can see that 2021 Ethereum was doing well. Okay, so I'm going to go and put a line at the previous highs. Okay, so we have this high in 2021, and then the high as of 2025 in August for Ethereum has been created. Okay, so here's how the spot dips. So we can see market dumping right now. Okay, and you're going to already see that, okay, this is going to be a good sign. You're going to see one candlestick already bounce from a certain area. Then you're going to see, here's going to be the sign where you know, like, okay, this might actually go somewhere. Okay, the second candlestick is going to be the opposite color. Okay, the second candlestick is the opposite color, especially on the 4-hour or the daily or something. Okay, and then you know, like, okay, that's going to be a pretty safe area to go ahead and play. Okay, it's going to have verification. Okay, it's going to show you that there's multiple closes in price action. Okay, wanting to go ahead and be fulfilled there. Okay, so you can also just pay attention to certain supports too, and just see if price wants to go in a bullish area. And a lot of the reasons why I'm focused on upside and bullish scenarios is due to the fact that, once again, this is a left to right chart. Okay, so let's check this out for Solana here. So Solana came in contact with this support right here and this support right here, and then with this support down here. Okay, so I'm gonna go ahead and go to my 4-hour time frame to check it out. So we have one area of support. If we can see, price dumped past it. 2 areas of support. Okay, and then price decided to dump past it. Okay, and then another area of support right here. Okay, so we're trying to see if price wants to come down to these areas, but price ignored these 2 areas of support right here and just decided to bounce at this low right here. Okay, so let me go ahead and put this line down and then go to my daily time frame. See if I see anything to my left that's going to give me some significance to this. Okay. So price is sweeping heavily from there. So this is just going to be a new level of support here. Okay. So even if price were to go to the downtrend here, if you saw any areas of support or resistance be broken and do the opposite, then that's how you know it's a trend. So price broke through all the reversal lines, and then price just broke and retest, like I call it inverse break and retest, off one of the support lines, or support mirrored off one of the lines over here. Okay, support, support. Okay, support mirror. And then once you see that, you're gonna be like, okay, I'm gonna be able to put some profitable trades together. Okay, it's about just having the consistency, the discipline behind the certain setups that you're marking every single day. So let's go XRP. So I'm gonna for my daily here. I can see price decided to break below this price of action right here. Okay, price created heavy support right here. Okay, and then price broke below it. Price below it again, and then it broke below it again. Okay, so that's 4 different times. So 1, 2, 3, 4. So say for instance you're a breakout trader, right? If you're a breakout trader and you try and just take it off the first candle handle hastily, you'll just lose money. Okay, so this is why it's really important to wait for a close, so you avoid candlesticks like this. Okay, where it's gonna wick in between your entry, the type of setups that you want, and then it's going to go ahead and just reverse the opposite direction that you don't want. Okay, and that might frustrate you. So in order to avoid that type of loss, you could literally just wait for closes, and a lot of the time if you get a close above your current zone, you'll be good. Okay, so let's go and let's pull up Doge here. Okay, even same thing for Doge. Okay, if I go to my 4-hour, I can see that price decides to have multiple 4-hour candlesticks close here, and I can see we're curling up to this area of resistance here, and I can see that break and retest is being validated. So I have an area of support over here to the left. Okay, support got broken, and then price decided to pull it down and turn the area of resistance over there into support, and you can see price decided to quick break and retest right here too. Okay, and now price wants to stay near the same area and go up, okay, based off of the inversion. Okay, so resistance broken, turn it to support, so then price can go ahead and keep that ample levels value and continue an upward trend without dropping back to 0 every single time. So let's check out Link USD. So even this is going to be an example too. Okay, so with Link USD, we have the all-time highs up here being 53. Okay, so even if I'm waiting for a pullback, okay, so once again, below current price, you can either wait for A, resistance below current price to turn into support, like it's kind of done here. Area of resistance, broken. And even right here with like one of the first projects here, okay. So you can go ahead and see that the Link USD project broke out of this level here, came down, and then created an area of support at this area here. Okay. Now if I get on my daily time frame here, another candlestick, and we'll see if we want to continue to close for a sweep up. Okay. We also have some more area of resistance too to the left. Okay. Which is also going to go ahead and validate this trade even more. Okay. So over here, area strong areas of resistance, resistance broken, then price created a new resistance after the breakout, and then price decided to come all the way down, turn resistance to support, and then bounce in an upwards direction. Okay. So let's go over Crow USD, for example, too. Okay. So even if I just wanted to play till this resistance up here, for example, okay, could be daily time frame, could zoom out. Okay, entry could be at this area of resistance here, okay, or it could be this area of support here. Okay, so this would be the entry areas that are going to be valid for us to go ahead and get in. Okay, so you could try this area of resistance here, area of support here, or this area of support here. Okay. And we can go down even further to this area of support too. Okay. And you're going to be just wanting bounces at these levels. Okay, and if price is showing you the bounces that you need to see, showing you daily closes, then a lot of the times you're going to go ahead and begin to get into the trade. Okay, take the whole sweep up. Okay, and whenever you do hit take profit, which let's go on and talk about take profit. So if you're a long trader expecting to make money by things going in upwards direction, okay, which a lot of the time companies are backed to promote things going in the upwards direction, so the market is trying to remain bullish a lot of the times. That's why when dips do happen, they're quickly bought up and market is right back to normal. Okay, so say I do have a area of resistance above here. Okay, instead of predicting a certain low too, okay, if that didn't want to be done, you could also wait till the resistance be broken and turn it to support, and then you could take it up to the next level. Okay, so trend trading too is also going to be a really good way to make sure you're preserving your capital. Okay, not just necessarily losing any type of money for no reason. Okay, so trading with the trend is going to ensure consistency, your flow, and you're always going to be knowing what's going on. Okay, you're never going to be panicking when it comes to certain things happen in the market just because you have a good grasp of knowledge of what's happening. Okay. So even here too, check out this area of support here. Okay. And price side today. To pretty much mirror the same thing. Okay. So the area of resistance over there. Got broken here. Turned into support. Okay, support got broken. Then price came up. And the support was able to be mirrored. And then we'll try and bounce again. Okay. Take some off maybe. The area of resistance above current price. And then next area here. And then next area here. And it can also be an area of support above current price too, since support can be broken and turned into resistance. So same thing to the upside. Okay, support can run into, or yeah, price can run into an area of support above current price and turn that into an area of resistance. And we'll go over Bitcoin here. So I'm going to zoom all the way out. It's going to be one of the things I like to do too. Zooming all the way out is going to help me give me eyes I need to succeed. Okay, let me zoom in. I can see that this is pretty much at all-time highs. Okay, so when something is at all-time highs, nothing else can pretty much be done but sell. Okay, there's no other levels above for the most part. Okay, so just, yeah, if you're waiting on a trade, just go grind something else. Okay, don't sit there waiting on the chart all day. Set your alerts and go work on something else. Okay. All right. So yeah, so that'll be the full guide there. And Stackmode.net for all trading education. Separate to gun. Keep grinding. Peace. Hey class, this is going to be the full masterclass on how you can turn your money into more money by just investing virtually. Let's go and let's jump straight into it. So, building the financial foundation. So before committing any capital to the market, okay, make sure you guys are humble, okay? Humble yourselves. Before you invest even $1 into the market, understand that the market is not a place where you can have ego, okay? If you don't accept your loss into the market, if you don't accept the fact when you're just not correct, you can destroy all of your capital that you've been working hard for. Okay, I don't care how much capital you're investing into, 4 figures, 5 figures, 6 figures, doesn't matter. Okay, the more capital you're investing into is not going to make you a better trader. Okay, so also try and have a steady income. Okay, so don't think you're just going to come into the market and just turn nothing into something and professionally just trade forever. It can happen for some people, but it's really stressful, really anxiety driven. So try and have a steady income. Okay, work on your business. Okay, and then come into the market and invest. Okay, so stay prayed up to God. Make sure you guys are worshiping God and be humble. Okay, have some humility before you come into the market and have a steady income. Now, before committing any capital to the market, a successful investor must ensure their personal financial structure is stable. And this initial phase dictates your risk tolerance and emotional resilience. Okay, there's going to be times where the market's going to be trying to break you down. Okay, it's going to be trying to beat you up. It's going to make you think that you're not meant for this. Okay, especially on certain things like options, which we're going to talk about in this, for example. But you guys got this. Okay, invest your money, take your time, and buy at the right times. Okay, if you want to learn how to buy at the right times, head over to stackmode.net and I'll teach you how to read the charts. I also have tons of free videos on my channel. So, establish a solid budget and have a roadmap. So, detail your income and your expenses. Okay, know how much you make and know how much you are going to lose in bills, and then go ahead and have a leftover amount of that, whatever that is. Okay, because you want to have some spending money just in case, because you know life happens. Put some of that away, and then whatever's left of that, you could go ahead and invest. Okay, and only invest money that you genuinely do not need for daily life or near long-term goals. So pay your bills, get your groceries. Okay, take care of whoever needs to be taken care of, wife, kids, whatever. Do your thing. Okay, and then you can go ahead and invest. And this way you can invest stress-free. Okay, if you lose money, you're not going to be tripping. That's not money that you completely need entirely. You're going to be fine. Okay, and try and have a safety net too. This is going to be paramount. Try and have 3 to 6 months or 6 to 12 months for higher job instability, as certain recessions and stuff like that come into play, as the economy just becomes unstable in certain time periods. And you can have a bunch of living expenses saved up in a high yield savings account, or you can have it put in the stock market. Okay, stock market. I don't really recommend a high yield savings account though, because it's interest. Interest is wrong, so I don't really recommend a high yield savings account. But you guys can put it in a stock, put it in an ETF, and that's going to go ahead and make you guys some money. Okay, and this prevents you from being forced to sell investments during a market downturn just to pay your rent. So, and eliminate high interest debt. Okay, high interest credit card or personal loan debt often carries an effective return of 20% or more. Mathematically paying off this debt is usually the best guaranteed return and you can achieve before investing. Attack and eliminate consumer debt first. Okay, so try and eliminate your debt before you guys invest too. It's also just going to give you guys a bunch of mental health back. Okay, so if you have a credit card balance of $5,000 at 22% APR, then you must generate a new 22% return, okay, just to break even. And paying off the debt is a guaranteed 22%, okay, will significantly de-risk your financial future. So just pay off the debt so then you guys don't gain any interest, which is going to lead you to have to make more income in the future, just eating into your investing profit. So pay off your debt. It's logical. And core investor principles and account types. Successful investing is less about timing the market and it's more about time in the market and adopting disciplined habits. So timeless principles. Be patient, okay? Don't think you're going to be getting rich overnight. And in certain cases where you do make a lot of currency overnight, okay, that doesn't mean you just blow it, okay? Don't go blow it. You need to go ahead and put yourself on a withdrawal schedule, okay? Before I start telling you guys how to make money, this is what to do with the money. Once you make the money, okay, let's say you make $500, take 50% of that and put it away. So 50% is 500, is going to be 250, okay? Once you have that, this is going to be the amount that you can go ahead and put into your bank account, or you can go ahead and reinvest that into certain things like dividend ETFs we're going to talk about, okay? Or you can use it to pay off debt or pay your bills, etc. And diversification. Never put all of your capital into a single stock, sector, or asset class. And do not keep all of your eggs in one basket, okay? So try and have a diversified portfolio, okay? We're going to talk about the different types of diversification, but don't just put all your eggs in one basket. And DCA, dollar cost averaging. Invest a fixed amount of money at regular intervals, okay? So for example, $500 every month, okay? And this smooths out the entry price and removes emotional buying from just buying huge leaps at one time or another, okay? You're going to set yourself on a consistent schedule, take care of your bills, and keep stacking up. Okay, it's going to be in stack mode. It's going to require sacrifice. If you want to get to where you want to be, it's going to require sacrifice. Stay down. Don't buy anything you don't need to be buying. Pay your bills, get some groceries, and that's it. No extras. Okay, and your brokerage account. Okay, this is what is going to be used for really just playing options, okay? Playing options, futures, or Forex, any type of short-term trading, okay? I would recommend a taxable account. And it offers maximum flexibility. You can have an infinite amount of money invested into it. And after tax and profits are taxed as capital gains when you sell, okay? There's also going to be some benefits though for long-term benefits if you hold for over a year. And retirement accounts, okay? They're tax advantage. So 401ks or Roth IRAs, they're incredible tools for retirement savings, and the tax benefits, either upfront tax reduction or tax-free growth, are critical to maximize long-term returns. And as far as Roth IRA, contributions are after tax, but all growth and withdrawals in retirement are 100% tax-free. So that's going to be the difference between that, and you can go ahead and use, once again, brokerage taxable accounts in order to invest into certain amounts. Okay, so you can go ahead and use that into just invest into your day trade or swing traders. But if you want a retirement account, then you can put that into your IRA. But you think about the IRA though, is that you can only invest a certain amount. It's going to be capped for a lot of the time. So I think it's around like $7,000 and $8,000 in 2025 this year. So yeah, it really depends. But taxable accounts, you can deposit an unlimited amount, make unlimited income. So depends up to you. So strategy 1, investing in shares in good companies. So the essence of value investing and buying a piece of a profitable business at a fair price and holding it for a long term. This is arguably the most stable path for beginners after index funds. Okay, so shares give you a piece of the pie. Okay, so say a company is the pie, say I open Stackmode, okay, on the stock market, and you want to own a piece of the pie, okay, you're going to be able to have jurisdiction and a vote in who runs Stackmode company, okay, and as Stackmode company increases on the stock market, you make money too, okay. So that's going to be the point of people investing into shares. As the share price increases within an upward direction, people make money. Okay, so let's go and let's talk about the economic moat concept. So what is a moat? It's a sustainable competitive advantage that protects a company's long-term profit and market share from competing firms. And the wider the moat, the safer the investment. Okay. And the value of service increases as more people use it. Okay, so the value of a service increases as more people use it. So the more companies putting a smile on people's faces, more people are going to use it. More people using a company's service or buying products equals more money. More money, a lot of the time, equals a higher value share price on the stock market. Because since this generates so much money, it's going to be a valuable company. And valuable companies are normally highly priced on the stock market. And this makes it extremely incredibly hard for competitors to challenge, especially once they have a high stock price compared to the other ones. And intangible assets, brands, patents, and regulatory licenses. And think of pharmaceutical patents or university recognized global brand names, and these cannot easily be replicated. So, analyzing growth versus value. Companies are often categorized by their investment profile, and beginners should be aware of the trade-offs involved in each style. So, growth investing, right? The focus. So, rapid revenue and earnings expansion. And these companies often reinvest all profits back into the business to fuel future growth, okay, making it a money powerhouse. And valuation. They typically have high price to earnings ratios, which means that the company is making good profit year after year and being able to most likely pay their employees good money. So, and they typically have high price to earnings ratios because investors are paying a premium for expected future cash flows, but they carry higher risk. And let's talk about value investing. Value investing is buying mature, established companies that appear to be trading below their intrinsic value, often found in older, slower growing sectors. And they have lower price to earning ratios and often pay dividends. Okay. And the expectation is that the stock market will eventually recognize the company's true value, leading to stock appreciation. Okay, just like the dividend, for example, SCHD. Okay, for Schwab, for example. And you can go ahead and start with broad market ETFs, VU. You could do SCHD. Okay, and as you learn the market, okay, it's going to be a good way to just grow your profit over time and chill. Okay, but come on with a full plan and know what you're going to do before you just start investing. So, to build passive income with dividend ETFs. Okay, a dividend is a portion of a company's earnings that get paid out to its shareholders. So after the company decides to go live on the stock market, okay, or the New York Stock Exchange, see, okay, it decides to go ahead and pay money to whoever owns the shares. Okay, and due to the fact that it's supporting the people who supported them. Okay, so it's pretty much putting the money back in the cycle. And dividend-focused exchange-traded funds offer a powerful, diversified way to generate income. So what are dividend ETFs in the first place? So dividend ETFs provide diversification and stability. An ETF holds a basket of multiple stocks, let's say for example 50 to 100 plus. The dividend ETF specifically targets companies with a history of paying and increased dividends, reducing the risk of relying on a single company. And dividends are typically paid quarterly. The ETF collects the dividends from all underlying stocks and distributes them to the ETF shareholders. And as far as dividend reinvestment plans, okay, this is the key to compounding. So having a plan with it automatically uses the cash dividend to buy more shares of the ETF, and this increases your share count, leading to larger dividends next time, creating a powerful compounding effect. So you could look for ETFs focused on dividend aristocrats and companies that have increased dividends for 25 or consecutive years, right? Focus on high yield, stable sectors like utilities or consumer staples that pay out dividends, and make sure you don't see too many splits. Okay, split is when they're going to be paying out less dividends. Okay, so we're going to be wanting to look for an increase of dividend payouts, not a split to where they're going to be paying less dividends. That means that they can't afford to keep up with the amount that they're paying. So you could buy Bitcoin as well too. So Bitcoin, until it expires, until it's all fully mined up, it's pretty much just going to be virtual diamonds and virtual gold. Okay. It does have a limited resource. It's going to go away at some point in time. And Bitcoin is introduced to the world to the decentralized digital scarcity. So a decentralized world is a world where no middlemen are involved, like the banks we were talking about. It's peer-to-peer transactions, and everything's done via autonomous contracts called the smart contracts. Okay, and the whole Web3 decentralized space has been broken down on my channel multiple times. So if you want to learn more about that, you can check it out. So buying Bitcoin is also going to be a really, really good solid way to make some currency due to the fact that one, has some value behind it. It's virtual diamond and gold. And two, it really helps society. People are able to trade money within a quick way all across the world, okay, due to the fact that Bitcoin exists and they get something out of it. So it's while a potential long-term asset, it carries significantly higher volatility. Sometimes it can go downwards in the downwards direction, okay, causing you to lose your money, but no risk, and different risk factors compared to equities. So the HODL mentality. Okay, HODL stands up for hold on for dear life. This reflects the need for extreme patience. Okay, so you cannot sell early. If you put yourself in a trade, okay, and if you marked it out and the trade's working out, don't just sell early, taking your profit. Okay, let it ride out. Try and hold a trade for some years. Okay, and see how much progress it's gonna make. Okay, especially something on Bitcoin. Like, it's not something ideally that you want to be scalped. And given the volatility, most the time I would say try and keep your account with like the remaining amount of money that you have. So even after you bought your stocks and stuff like that, your crypto should be your final portfolio that you invest in. And unlike stocks and a brokerage, you're responsible for the security of your crypto assets. Okay, so use good brokers and use brokers that are going to be safe and keep your money secure. And you could directly buy cryptocurrency with your card, okay, like Coinbase, Kraken, or whatever. Okay, and then you can go ahead and send it to another wallet if you would like. So stock options. Okay. It's going to be a great place to make some income, but it's also going to be a great place to lose some income. Okay, so you have to really be technically advanced. Make sure you're studying. So stock options are advanced. They're leveraged financial derivatives, and as a beginner, make sure you guys are mastering and studying the charts before you even touch options. Okay, if you're struggling with options, head over to stackmode.net. I'll teach you guys how to trade it. Okay, options is not something that you want to be playing around with without the information first. Take your time. So the contract. Okay, an option is a contract giving the buyer the right, but not the obligation to buy or sell an asset at a specific price, also known as the strike price, on or a specific date. Okay, so if you think price is going to go in the upwards direction, then you would buy what's called a calls contract. If you think price is going to go in the downwards direction, okay, then you go ahead and buy a puts contract. Okay, so if price went from $32 a share and you think it's going to go to $40 a share, and it did, and you have the right contract, you would make a lot of money. Okay, if you think price is going to go down to $20 a share, and price is at $25 a share and it goes down, and you're in a $20 a share contract, or $21 a share, $22 a share, anything, anything under that, and take profit's going to be 20. Okay, so anything under 25 would go ahead and be an ideal contract, and that would go ahead and work. And it gives you the right to pretty much get paid based off directional bias. And options allow you to control $100 worth of shares for a small fraction of the cost, and this magnifies profits, but critically it magnifies losses just as quickly. And the intrinsic value of the option decays over time. Okay, meaning the contract is constantly losing value as it approaches expiration. So, eighth wonder. So compounding is going to be the process of generating earnings on both your initial investment and on the accumulated earnings from previous periods. And it's the engine of long-term wealth creation. Put your money in a loop. Okay, when you get some money from your business, invest it. And then when you make money from that, invest that. Okay, put your money in a loop. Your money should be like a tornado, a big whirlwind. Okay, and that's going to cause exponential growth, inshallah. And the returns generated in the last years of an investment journey are vastly larger than the returns in the early years. Even if the dollar amount invested remains the same, the accumulated interest is doing the heavy lifting. And time is the key multiplier. Time is going to go on anyways, as long as you're on Earth. So just let your money make some money. A person who invests $5,000 per year per 10 years, okay, so let's say they have 50K, starting at the age of 25, will have significantly more money at 65 than a person who invests $5,000 a year for 30 years, okay? For a total investment, it's going to go ahead and be $150,000, okay? So, invest, okay? Get into stack mode, take your time, put money away, and just keep grinding, okay? You guys got it, okay? And don't let your emotions get to you, okay? This is why God's gonna be really important, staying humble, okay? Because sometimes you can have a lot of fear, especially as a beginner trader, and don't panic. Don't sell when it's not time to sell, okay? And don't buy when it's not time to buy, okay? That's being greedy and being fearful. Once again, being emotional can destroy it all within your trading assets. And buying into an asset just because everyone else is making money, okay, during a speculative bubble, for example, this usually results in buying at the peak at all-time highs. Make sure you please know how to read the charts. It's a left to right charts, and it's called trading for a reason. When you're losing, somebody's winning. When you're winning, somebody's losing. Stick to your fundamental analysis and plan allocation. Okay. And as far as the IPS, the investment policy statement, write down your goals. Okay. Write down what you want to achieve. Write down how you're going to achieve it. Okay. And write down how you're going to break it down. I recommend you guys have 2 accounts. Okay. 1 account for your long term, and then another account if you want to go ahead and day trade, swing trade, whatever. Okay, up to you. Okay, they have 2 different types of tax benefits. Your long-term account, I recommend you guys holding a trade for over a year. Okay, so you get the long-term tax benefits. And then if you're gonna have a day trade account, just use that and then pay your short-term tax. Okay. So get ready. Okay, fund your emergencies, pay your bills, clear your debt, and then you're gonna be ready to trade. Okay. And then you can go ahead and do a Roth IRA and a brokerage account if you want, okay? And go ahead and set up your initial long-term investments and start saving money through there. And stay the course, okay? Check your portfolio quarterly not daily. Ignore the market noise and volatility and let compounding work its magic over decades over time. And the biggest risk is the risk of not investing at all. So start today. Okay. Stay praying to God. Keep grinding. I'll catch you guys in the next one. Peace. Okay, so let's talk about how to research stocks. The best stocks to go ahead and invest in are going to be the ones that have some future value. So anything where people are going to be helped within the future, and anything that's going to put a smile on people's face, ideally, is going to be a good stock. Okay, so anything that's helping the most people, it's going to be something that's going to be the most valuable. So this is going to be a step-by-step guide to analyzing certain stocks that are going to be profitable. Let's go and let's jump into it. So why does research matter in the first place? Okay, so this goes further than speculation. So researching a stock is the cornerstone of successful investing in the first place. It allows you to move beyond speculation and base your decisions on a company's real value rather than on market hype, such as like Instagram hype, Twitter hype, or anything like that, or a rumor. Okay, and a disciplined research process helps you understand what you own, okay, and how you're going to manage your risk. So managing your risk is pretty much going to mean how much money you're going to be saving, okay, how you're distributing your money, okay, and how much money you're going to be risking per trade. Okay, so that's what managing your risk is going to mean. And it's going to identify true long-term opportunities by, once again, making sure we're investing in companies that have future value invested into it. So anything that's putting a smile on people's faces, anything that's helping people, inshallah, year after year, should go ahead and be beating earnings, okay, because it's going to be making money. Okay, anything that's putting a smile on people's faces, for the most part, is going to be making money. Okay, and then when companies are making money, stock value decides to go up. And since as shareholders, we're pretty much going to be company holders, at the bottom value here, we're going to be in. Let's say we get in right here, and then we could go ahead and exit at the top, right? Because we went ahead and got in before price decided to pump up super duper hard, because we did our research before, for example. So informed decisions are going to help us out. Research gives you the data needed to assess a company's health and future potential, reducing reliance on guesswork. And without research, you're simply gambling. So risk management. By understanding a company's fundamentals, you can identify potential red flags and avoid overvalue or unstable investments. It helps you quantify your risk exposure. And proper analysis helps you find stocks that are undervalued by the market, providing the opportunity for long-term growth and capital appreciation. So depending on whatever time period you're in, okay, let's say as of 2025, AI is super duper popular. Okay, so a lot of companies dealing with AI when it comes to chips, like NVIDIA, for example, are going to go ahead and be extremely popular. Okay, so whatever time you're watching this in, okay, relate it to the current sector. Okay, whatever is popular within your current sector, see what companies are advancing the future forward, and go ahead and invest into that. Make sure you're doing your TA, your technical analysis, and read the charts. Okay, try and buy certain areas that are going to involve dips, and make sure there's some resistance above current price, so you know price is something to hunt for. And keep your risk management in place. By understanding a company's fundamentals in the first place, you can identify potential red flags and avoid overvalued or unstable investments. Even if a chart is looking pretty good, if a company's fundamentals aren't good, then the company just won't work out, or a lot of the times the trades won't work out how you want them to. And it's going to help you quantify your risk exposure. So, identifying the value. Proper analysis is going to help you find stocks that are undervalued. Once again, okay, so finding undervalued stocks is going to mean that, okay, I'm going to be able to catch this low, and I'm going to be able to catch the whole sweep up into the highs before it starts getting popular, okay? But be careful when you're doing this. Don't invest into things that don't have any value, okay? And don't invest in any meme coins or any meme stocks, okay? A lot of the times, things like that are not undervalued. They're valued low for a reason, and they only burst a couple times a season due to just certain events that most likely won't happen again. So, a guiding compass. So in volatile market conditions, your research is going to serve as a compass, and it allows you to stay the course and avoid making emotional, fear-driven decisions within the market that could plummet your account entirely. Okay, so make sure you do your research and understand why you're getting into the trade. Make sure the technicals and the fundamentals behind the trade makes sense. So, fundamental analysis, let's talk about core financials. So, fundamental analysis is the process of measuring a company's intrinsic value by examining its financials. Okay, so you're going to see if the company is making money or if it's losing money. Okay, and you can also determine if it's profitable regarding its economic factors. So if a company is like, you know what, we're banned in all countries besides this country, that's an economic factor that could potentially drive the price in a downwards direction due to the fact that that's less sales being available, since that's less volume available to clients, since countries are being banned. Okay, and it's going to help you determine if a stock is a good long-term investment by looking at a company's financial health and not just its current price. And key financial metrics. So let's take a look at the PE ratio, a common valuation metric that compares a company's share price to its earnings per share. A high PE, and that means price to earnings. Okay, price to earnings, PE, price to earnings ratio can indicate a stock whether or not it's overvalued or has a high growth expectation, while the low price to earnings value may suggest that it's undervalued. Okay. And EPS stands for earnings per share, and it's a company's profit allocated to each outstanding share. And rising EPS is a sign of profitable and a growing business. It's a key indicator of a company's profitability. And revenue growth. It measures how quickly a company's sales are affecting the company's revenue, okay, in an increasing manner. And consistent revenue growth is a sign of a healthy and expanding business, indicating strong demand for its product or services. And ROE stands for return on equity, also known as ROE. And it's a measure of financial performance calculated by dividing net income by shareholders' equity. Okay. So ROE reveals how much of a profit a company generates with the money shareholders have invested. And a high ROE generally indicates efficient management. And this ratio indicates how much debt a company is using to finance its assets relative to the value of shareholders. Okay, and that's going to be called the debt to equity ratio. Okay, so the debt to equity ratio is going to indicate how much of a debt a company is using to finance its assets relative to the value of shareholders' equity. Okay. And a high D ratio can indicate high financial risk. So charting the course, technical analysis, also known as TA, it's reading the charts. Okay, study the charts, understand the charts before you even put a dollar into the market. Okay, understand support. Support is going to be a low area where buyers are going to step in, price is going to potentially push in an upwards direction from there, and resistance is going to be an area where sellers step in and price should head in a downwards direction from there. And technical analysis is the study of past market data. This is a left to right chart we're going to be reading, so anything that happened to the left is going to be relevant to the right. So it's the study of past market data, primarily price and volume, to forecast the future price movements. It's based on the idea that market prices reflect all relative information and that trends and patterns tend to repeat, which is extremely true. And while it's not a standalone solution, it can help you with the timing with your entry and exit points. Okay, so once again, understand how to read areas of support and resistance, and head over to Stackmode.net if you don't understand yet. So as far as reading the price chart, you can use the candlestick charts on like TradingView, your broker or whatever, to visualize certain stock prices movements. Okay, see where the current price is and make sure that you're either buying at a price below current price, catching a sweep up, or if you buy, let's say for instance, you buy at a resistance breakout area. Okay, either wait for a 4-hour close or wait for that resistance to be broken and turn it to support. Okay, have a strict criteria that you play, and if you figure out certain things that help you out, like moving averages, RSI, MACD, and certain things like that, that can help you read the trend if it helps you personally. So qualitative analysis, the intelligible factors. Okay, intangible. Qualitative analysis involves evaluating a company's intangible factors that are not found on a financial statement. This is more often subjective, but it's just as critical to understanding a company's long-term potential, and this is where you assess the business as a living entity, not just as a set of numbers. So check out its management teams, okay, and see if there's any. I'm going to go ahead and add this too, okay. investors. Investors slash collaborators. Okay, so check out the management team. Assess the leadership experience. Okay, see the vision of the company, and check out the company's track record. Sometimes a company could just be gifted a lot of money, but then not be putting in enough work, and then over time, the company starts to go down and plummet. So make sure it has a strong ethical management team with a proven history of execution that can navigate a company through difficult times, and look for past successes and how have they handled previous challenges. So competitive advantage, also known as moat. And it's what makes the company difficult to compete with. Okay. What gives this company the competitive advantage over other companies? Say brokers, for example. Okay, Robinhood, okay, Hood versus like Charles Schwab. Okay. So Robinhood, they have like a card, for example. Okay, Robinhood has a card. They also have instant transfer, so you can connect your debit card to instant transfer instead of waiting for a couple of days. It's easy to operate, has a cool UI. Okay, a lot of advantages over Schwab, and that's why Robinhood is just starting to blow up. Okay, so for example, like that, how is the stock beating the other stocks? What's the point of this company, and how is it helping people better than other companies? So this moat could be a powerful brand like Apple, for example. Okay, a unique patent and economies of scale like Walmart, or network effects like Facebook. And the wider the moat, the more durable the business. Okay, so Apple, they have Face ID, they have unique phones. Walmart's an extremely big retail store. They sell absolutely everything. Okay, compared to like Kroger, sells more stuff than that. And they also have like car repair and stuff like that too, and oil changes, etc. And Facebook is also connected with Instagram. So it's trying to just be, more than a certain social media. So industry trends in market position. And is the company in a growing industry? That's going to be a big thing. Okay, is the company growing? Okay, if the company isn't growing or it's not in a growing industry, kind of just forget about it. Okay, is it a leader or is it a follower? And is the company in a declining industry that may struggle no matter how well that is managed, while a leader in a growing market has a tailwind at its back? So Robinhood, trading is becoming exceedingly popular. Okay, crypto laws are getting passed, so brokers that host cryptocurrency are starting to go up on the stock market as of like 2025, for example, due to the fact that it's in a growing industry. Okay, same thing with AI stocks, for example, past couple of years as of 2025. Okay, so whatever time frame or year that you're in, play and do your analysis based off of that. So reading financial statements, we'll restart. So financial statements here. So they're the ultimate source of truth about a company's performance. And you must know how to read and interpret the three main statements to truly understand a business's health. So income statement. So the income statement, it shows a company's revenues, expenses, and net profit over a period. Okay, so it's going to show you pretty much the time over a quarter or year. And the balance sheet, it provides a snapshot of a company's financial position at a single point in time. And it lists its assets, liabilities, and shareholder equity. And it tells you what the company owns and owes. And a healthy balance sheet shows more assets than liabilities. And cash flow statements. It details how a company generates and uses cash. And it's often considered the most important statement, as cash is the lifeblood of a business, and it can reveal if a company's profiles or profits are real, or just accounting entries. And pay attention to cash from operations, which should ideally be positive and growing over time. So, valuation methods, and what's it worth in the first place? So once you've done your research, you've got to determine if the stock's current price is fair, undervalued, or overvalued. And this is where you use valuation methods to track everything. So check out the price to earnings ratio, and as discussed, it's a simple comparison tool to value a company against its peers or its own historical average. Okay, so you can normally check at the bottom of your broker, trading view, and stuff like that. You can go ahead and see um, the company's earnings, and you can see whether or not the earnings are going to be positive and they're being beat, companies making money, okay, or if the earnings aren't being met to their expectations, okay, and the company is not making money consistently, okay. So that's going to go ahead and determine a lot of the future growth. And earnings rates can change. The company could drop a really good product, and then the earnings just start being positive, and then the company could take a huge turnaround. Okay, so it really just depends. So let's talk about some red flags. So your research isn't complete until you look for potential problems in a trade. Okay, see what can go wrong. Okay, see what any type of weak points the stock has. And a single red flag can negate all other positive indicators. And check out if there's any insider selling. So while it's not always a negative, a significant amount of insider selling, okay, and that means executives are selling off their stock, that can be a signal that the company's leadership lacks confidence in its future. So if you start seeing that shareholders, okay, people who own the company, okay, and stuff like that start selling their shares within large flows, okay, which means like all together and stuff like that, that could indicate that they might mean that the future, or at least briefly, the future may not be too strong, okay, but not every time. They could also be taking profits, okay, and high debt. So a company with high debt load and low cash flow may be at risk during an economic downturn, causing it to crash significantly harder than certain other things. And other stocks too, like let's say Apple, for example. Apple goes through a lot of stuff with their iPhones, okay, causing their stock to crash and go down sometimes, okay, and that's because of legal and regulatory issues. Same thing with like Tesla, for example, okay, sometimes Tesla's going through legal stuff and regulatory issues, and that can make price decide to go down. So check for any ongoing or past lawsuits. A lot of the times TradingView will update you with the current news, see if there's any fines going on, okay, because if the company's owed a large amount of money, that could mean that they have to pay a larger back, which means their investment time could be a bad time to invest, okay? Or regulatory actions that could impact the company's reputation or profitability. And the frequent share dilution. If a company is frequently issuing new shares, it can dilute the value of your existing shares. So putting it all together. So a truly comprehensive stock analysis combines all of these approaches into a single cohesive view. Fundamental analysis tells you the what, okay, see what sector you're getting invested in, okay, see how it's going to affect the future, and see how it helps people, okay. The company can help people, okay, it's in a good sector, it has a place in the future, then the stock can go ahead and be decent, okay. So Robinhood is giving people easy access in order to trade cryptocurrencies, okay. That's definitely putting a smile on people's faces, okay. It's also providing things like credit cards, okay, so it's providing funding, okay. That's also something else that's putting a smile on people's faces, okay. So that's what Robinhood, as of recently, has just been blasting. Okay, certain stocks like Palantir are trying to innovate technology using AI, for example. Okay, so AI is trying to advance the future forward by having things being done autonomously. So AI stocks, as of 2025, have been a popular option as well. So investing in the future, getting ahead of the curve, is going to be a good way to make some money. So qualitative analysis, it explains the why and the competitive advantages and management that will drive the future of the company and drive the future performance. A technical analysis tells you the when and the best time to enter or exit a trade based on market momentum. And by using this holistic approach, you can make confident, data-driven decisions that will serve you well over the long term. And remember, the goal is to not predict the future, but to understand the present and make informed decisions based on facts, not on speculation. Okay, so do some strong research, make sure you're buying at clean, crispy levels, and then go ahead and take your trade based off of certain things that you believe in. Okay, so that's going to go ahead and be that. All right, so we're going to go ahead and talk about the bear market. Okay, so pretty much whenever cryptocurrency starts heading in a downtrend, okay, sometimes that's going to induce panicking. Okay, it can induce a couple of emotions, such as like panic selling. Okay, certain things, whether you want to feel like you might want to dump your entire portfolio, okay, because of how many negative trades that you've taken within a certain bear market cycle, right? Or if your portfolio's down, okay, but we don't want to do that, okay? Let's not think of the market that way. Let's think of the market logically, okay? So just like we always cover and talk about, there's benefits to making sure that these markets go in upwards direction, okay? Cryptocurrency included. This is something that governments hold, many people hold, hedge funds hold, and just people with large quantities of money hold, okay? So cryptocurrency, it's not going to be something that's going to be useless, okay? It's going to be something that's going to be instructing and providing power back to us, the people, okay? So it's something that people are investing into due to the fact that people can easily send money from one person to the other, okay, without having any bank intermediaries in the middle of it. Okay, so if you want to send a wire transfer, for example, okay, from $1 million from one person to another person in China, a lot of times that transaction might not easily go through, okay, without being first approved by the bank. Cryptocurrency removes the whole bank in the middle, okay, and works on its whole blockchain system, okay, letting people make their transactions on their own accord. So if someone wants to sell $1 million in cryptocurrency to a person in China, they can go ahead and do that and easily and instantly using the decentralized space. Okay, so let's go and let's jump into it. So cryptocurrency has many uses. If you see market going in a downtrend, all it is people selling as well too. Okay, just like we see this chart right here. Okay, this is a left to right chart. So if people got in at this low down here, okay, and market starts going in upwards direction, of course, when market decides to fall down and correct, okay, people call it a bear market, but of course it's going to fall down and correct though. People got in way back here and they're going to go ahead and take profit. So when people are taking profit, getting their money out, that's going to cause the shares to fall down. Okay, so all the crypto supply will fall in a downwards direction the more people sell. Okay, so whenever we see market going in a downwards direction or a bear market, okay, that just means markets going in a downwards direction, which also means people are just selling. Okay, but these are going to be opportunities where markets also going to go on discount. Okay, so if something is $50 right now, okay, and it's something that you want, and then it goes on sale, and you see it on sale for $20, okay, you might even get two of those things, okay, due to the fact that it's on sale now. Okay, so think of crypto market dumps like that. Okay, think of things going on sale. Okay, market has to go up in order to come down. It can't just go up in a straight line forever. Okay, it has to work in a staircase formation. People have to buy, people have to sell. Hence why it's called trading. Okay, when you're winning, somebody's losing. When you're losing, somebody's winning. Okay, so let's cover the mindset and really just understand how we can prepare for when market's going into downtrends. Okay, so let's define the bear market and root causes. So bear market is generally defined as a decline of 20% or more, okay, from the recent highs, marked by widespread pessimism, low confidence, and a sustained decline in prices and trading volume. Okay, and key definitions. So the 20% rule. So why subjective? A 20% drop from the all-time highs signals market distress. And in crypto, drops of 70 to 85% on certain things like meme coins and stuff like that can be common during major bear cycles. So that's why you don't really play meme coins and things like that. It's not really worth it since they just don't have enough value, okay? And they can easily just go ahead and fall in opposite directions without much of a backbone behind it, okay? Versus something like Bitcoin, where that's a lot less likely to happen. And the more actually it dips, the more people are gonna buy, okay? People are putting in $300 million orders plus, etc., okay? Anytime Bitcoin dips down. Okay, so it's way different. So it's going to be sometimes too where certain cryptos go cold, okay, and they start consolidating. So what consolidating means that it starts going in a sideways direction, okay, not much price action up or down, and you want to stay away from those. Okay, so you want to trade something that goes in upwards direction year after year and is getting percentage year gain, okay, making your money more money, making it a stable investment. So watch what cryptos we invest in, okay, and primary catalyst, right? Let's talk about it. So some macroeconomic factors. So global inflation that can affect crypto prices, interest rate hikes by central banks, and traditional asset market declines often correlate with crypto downturns. Okay. Excessive leverage cleansing. Okay. Overly aggressive market buying. Okay, with borrowed funds. So there's going to be times where people can trade Bitcoin with borrowed funds, right? With something called leverage. So just like, futures, there's going to be things called crypto futures. Okay. And on crypto futures, you can trade with the same leveraged amount. Okay. And any leverage amount, depending on the broker, goes up to like 500x and stuff like that. Okay. And sometimes when market decides to go down, okay, it creates instability. And bear markets, meaning markets going in a downwards direction, it purifies the market by liquidating these highly leveraged positions. Since the more leverage that you're playing with, the smaller that your stop loss is going to be. Okay, meaning that your trade has to close at a certain area automatically versus if you're playing with no leverage. Okay. So regulatory uncertainty. So major government crackdowns or unclear legal frameworks in key jurisdiction can trigger broad market fear and lack of trust within certain cryptocurrency markets. Okay, so we saw in 2022 COVID area during the SEC, okay, the government exchange for securities, okay, they were having some problems with the crypto sphere, but since then things have been passed, things have been regulated, and as we can see, crypto is now shooting into new highs constantly with tons of optimistic future ahead of it. Okay, and let's talk about project failure and exploits. So the collapse of large projects like major stablecoins or exchanges lead to contagion and a severe loss of investor trust. Okay, so if you see certain things like certain exchanges fall down or certain brokers where a lot of people invest in to shut down randomly, that could put some fear into the market. More fear into the market, less people are going to be investing. Okay, but that's just things that could happen. But just like a bank, banks have random maintenance where you can't pull out your money. Okay, so anything has its cons, anything has its pros. Okay, only thing's perfect is God. Sometimes things are going to shut down, just is what it is. So psychological game, right? Conquering FUD. So investment success during a bear market is going to be 80% psychology. Okay, really 80%. I'll say like 90% plus. Okay. Because you can have really the best levels on the screen, okay, and I've done some tests with certain students, okay, you can give somebody the best levels, but they don't close where they need to close, okay, due to the fact that their analogy or how they process it in their head might be completely different, okay, so trading is really going to be psychology and how you look at the market, okay, so mistake number one, okay, so mistake number one that people make, this is the main reason why people will remain unprofitable, okay, their stop losses are going to be too tight, okay, way too tight, okay, causing them to panic sell, okay. So selling assets at low prices locks in permanent losses. And the single best way to lose money in a bear market is to sell everything when despair is the highest, okay. Sometimes you got to sit and you got to hold through certain periods expecting price to sweep up. Now, I'm not saying hold every single trade, just certain past the worst dump of all time or past your stop loss. But if you have a calculated trade that you have planned and it starts going in the red, it's part of the game, okay? And the game is really about who can survive when market's in drawdown or your account is in drawdown, okay? And who can't, okay? Because whoever's going to sell all the positions when market's in drawdown for a loss, their account is never going to grow, okay? You have to be able to sit there and stomach through it. There's times I've had tons of time. This is why time is going to be one of the biggest factors in trading. This is why crypto is really amazing. Okay, well, when you're trading cryptocurrency, you have time. Okay, cryptocurrency, as soon as you buy, you can hold it forever until the end of time. So you have time. So if you sell, okay, that's going to be on you. Okay, there's no time running behind you. As soon as you buy some spot cryptocurrency, okay, when you just buy crypto on a normal broker, okay, and you can just buy and hold without any leverage, okay, and no leverage buying cryptocurrency, just being the normal way, it's called spot. So when you do that, okay, you can decide like, okay, I'm going to sell in a couple of years. Okay, it's not as easy to do that with other instruments. Okay, other instruments can be time gated, such as like futures, for example. Okay, futures, each contracts, they have expiration dates. Okay, so things can be a little bit different. So let's talk about tactic number one, right? The zoom out. Okay, we got to zoom out. We got to get the whole long-term perspective. This is why we use our higher time frames. Okay, time frames we're going to be using. Okay, some great notes here. Time frames that we focus on. Weekly. Okay, we're going to use our weekly time frame. We want to see everything on the larger, higher time frame scale. Okay, after we check out our weekly, maybe for take profits. Okay, and take profit is where we close the trade out. Okay, say you got it at an area of support. Okay, and you close in an area of resistance above current price, you can go ahead and do that. Okay, so you're going to have the weekly. gonna have the daily, okay? And then you're gonna have your 4-hour time frame, okay? Then you're gonna have your 4-hour time frame. Okay. So using those time frames all together is really, really gonna help you put your trade into perspective and be like, okay, this is the type of setup I want to be taking from now on. Okay. And these are the type of trades that I just take. Okay. So that's what you want to focus on. Okay. Weekly, daily, and the 4-hour. So let's talk about zooming out. So the HODL view. So we're going to focus on the long-term vision, okay, of 3 to 5 years plus. And all major crypto bear markets have been followed by new explosive bull market cycles. Okay. Look at the monthly or the yearly charts. Okay. Not the 5-minute charts. Okay. Tactic number 2. Okay. Reduce obsession. Okay. We should be grinding in real life, stacking up some bread. Okay. Putting some money away. Okay. And just growing our capital in the real life so we have more money to come put into the markets. Okay. But constantly checking P&L, seeing how much money you're up and down. It's not what we want to do. Okay. Focus on the charts. Okay. You could look at the charts, see where it's at, but even that, don't turn it into unhealthy obsession. Okay. Take your time, check your charts out maybe once a day, a couple times a week. Okay. But don't sit there, stock on the position every minute. Okay. Constantly checking the price feeds lead to anxiety and they lead to impulsive behavior. So set clear rules and limits and then step away from the daily chart fluctuations. So it's really about a battle of just you versus you at a certain point. So quote for perspective, right? Be fearful when others are greedy and greedy when others are fearful. Okay. So when everyone is scared, price is going in downwards direction. As soon as it starts making a curl on your weekly or daily, you can go ahead and get in, buy that, and then you buy the low where everyone's fearful. And then by the time it's at all-time highs, that's when you're going to start seeing the post like, oh, everyone, and then everyone's going to start buying at all-time highs. Okay. It happens constantly every single cycle. So when we know how to sit through the bear market cycles and buy certain dips, we're going to be able to prepare and be a lot further ahead than other people due to the fact that we can analyze something so simple. Okay. So accumulation through DCA. So let's talk about DCA. So DCA stands for dollar cost averaging. Okay. So DCA, it's dollar cost averaging. What is that? Okay. It's one of the most powerful tools for risk mitigation and capital deployment in volatile bear markets. And it needs the need to time the bottom. Okay. And let's talk about the DCA mechanism. So fixed schedule. So investing a fixed dollar amount, let's say, for example, $100. Okay. At regular intervals, let's say weekly or monthly. Okay. That's going to be DCA. Okay. When you're just regularly putting away a certain amount of money, okay, that you can. Okay. Pay your bills, get some groceries, and then you can invest. If you're going to say you're going to invest $1,000 in Bitcoin a month, okay, then go ahead and do that. Okay, if you can do more, then do more. But DCA means just take a percentage of your money, okay, break it down and put it into some cryptocurrency or whatever investment. Okay, I don't care if you get $10, okay, go ahead and break it down, put 7 of it into crypto. Okay, just having that type of stack mode mindset is going to help you grow your currency and help you stack way, way, way faster. Okay, and your portfolio will flip in no time. And shalom. So reducing the timing risk. So, and also keep yourself broke. Okay. So if you keep yourself broke, it's a strategy I notice a lot of people do. Okay. It's something I definitely do. Okay. I don't keep any money in my checking account. Okay. After I pay my bills, I get my big lump of groceries. Okay. I do what I need to do. Okay. I buy what I want to buy. And then from there, every dollar that I have the rest, okay, I'm going to pay my credit card. Okay. And then after that, I'm just going to invest. That's all I do. I put every single dollar into investments and I just keep myself broke. Okay, I paid my rent. I got groceries, so I'm not going to starve, thank God. Okay, and I did everything I need to do. So I'm good. So I can keep myself broke and I'm going to survive. Okay, so keeping yourself broke, whole time you got money stacked away in investments, is going to be a really, 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 really good thing to do. Okay, just changing the whole mindset. Just, you know what? I don't need to go get this coffee today. I'm going to bring some coffee from home. I'm going to take this money and I'm going to invest. Okay, so it's something personally my wife really helped me out with. Okay, just changing the whole mindset of everything. Okay, changing the whole mindset of everything and really understanding like, okay, you know what, let's not eat out today. Let's stay down, groceries, and the rest of this money is investment money. Okay, because this stuff, it adds up quick. It's easy to spend $40 on a DoorDash meal, $50 on a DoorDash meal for 2 people. okay, quickly, okay? But $50 worth of groceries, it really goes a long way, okay? So it goes a much further way, okay? So it's about just staying down, making the right decisions, and then we can go ahead and ball later. Yeah. So the compounding effect, right? So this strategy becomes exponentially more effective when asset prices are depressed, okay? As your fixed investment buys a larger portion of the supply, okay? So when market is in a downtrend, okay, and market's about to make that curl in the upwards direction, okay, and then we have cash to just stack and throw in there, and you buy, okay, even if you don't have all the cash in the world to buy at the low, as it curls up, you can keep adding, okay, and that you hit your trade, okay, and it's just about mindset. Then from there, take that capital, and then you can go ahead and deploy more cash into there and just keep stacking your wins over time. Nice. So thriving the strategy. All right, so let's talk about some fundamentals there. So bear markets separate speculative noise from real technology. Okay, so this is the time to ignore hype, okay, and focus exclusively on fundamental analysis and your technical analysis. Okay, so when market's in a heavy downtrend, let's say there's a speech from a president or something like that that has dropped the market. Okay, we want to be looking once again on our weekly and daily time frames primarily. Okay, and we're going to be looking for that V curl up. Okay, we want market to make an area of support. Okay, and then we want to see market start to curl up, either after a couple of days from the daily or a couple of weeks from the weekly. Preferably, weekly curls are going to be really nice. Okay, because that means price really wants to reverse. Okay, if you start seeing 2 weeks in a row, price action, price filling in the V. Okay, a lot of the times that's going to be the setup you would like to take. Okay. So, and we're going to ask ourselves too, if something is going down, why is it going down? Okay, was there any bad news behind it? Okay, did something happen? Okay, and let's think about utilities and use cases. So does the token or protocol solve a genuine, tangible problem? So we'll talk about Solana, for example. Okay, Solana, you need it to trade meme coins. Okay, so that point alone, Solana has value. Okay, if people want to create their own cryptocurrency coin, okay, they gotta generate some Solana first if they want to make their own meme coin. Okay, but then we'll take something like a random meme coin that's just a joke. Okay, it doesn't have any community behind it, no nothing. Okay, just a random meme coin. If it goes down to zero, okay, a lot of people wouldn't be surprised. Okay, because does it solve any genuine, tangible problems? But then you're gonna have something like Ethereum, for example. And Ethereum was created due to the fact that Bitcoin is limited. Okay, so one day Bitcoin will be gone. So people still want to trade cryptocurrency, so that Ethereum was created. Okay, so Ethereum has its purpose there. And instead of using power to create it, like Bitcoin's using power to create it, Ethereum is created using computers and smart contracts. So it's a lot more power efficient for the earth and it's healthier. Yeah, so Ethereum actually has real uses compared to certain other things like random just joke meme coins. Okay. So because if something has a real use and it dips down, people are going to be hounding to buy that dip. Okay, the second something valuable dips, people are hounding, buying tons of it. Okay, the second Bitcoin dips, people putting in hundreds of millions of dollars worth of orders, whether it be governments, BlackRock, any type of companies, anybody. Okay. So talk about the cryptocurrencies team. So is the development team public, experienced, and actively building during the bear market? Okay, and you could check certain GitHub commits too. So certain cryptocurrency coins, okay, even though they're dipping down, they're working on tons of stuff on the back end, okay, looking to progress the future forward. And the community and governance behind it. So does the project have a vibrant, resilient community and a clear decentralized government model? Okay, so just like Bitcoin has tons of community behind it. You got companies such as MicroStrategy, also known as MSTR, okay, big representative of Bitcoin, okay, things like that. Okay, and also have, once again, governments, US government, other governments, etc., participating in buying Bitcoin and other tokens as well too. So the tokenomics of everything. Okay, so analyze the supply schedule, vesting periods, inflation and deflation mechanics, and allocation of the team versus the public. Okay, and blue chip versus speculative asset, right? So blue chip cryptocurrencies, they're going to be our big heavy hitters. Okay, our Bitcoins, our Ethereums, XRPs, etc. Okay, and these assets, they have the deepest liquidity. Okay, and liquidity is going to equal money. Okay, and money equals the amount of people. Okay, the more money something has, the more people are trading it. The more people are trading it, the higher liquidity it has. Okay, so liquidity is going to mean money. So they have the highest and deepest liquidity and have proven recovery patterns over multiple cycles. For example, Bitcoin's 80% drop in 2018, followed by new all-time highs. Okay, so people, once again, if something's a valuable resource and it dips down, people are going to be hounding and fiending and hungry to buy the dips, because I know I definitely am. Okay, I just bought some Bitcoin today. Okay, so speculative meme coins. So assets with high returns during the bull run are often the first to lose all liquidity in a bear market, okay, making them highly dangerous accumulation targets. So focus on protocols with established ecosystems. Okay, for example, layer 1 networks and major DeFi apps. Okay, so let's get assets with high returns. Okay, during the bull run, the first to lose all liquidity in a bear market. Okay, so focus on protocols with established ecosystems, things that have been around for a couple of years, okay, and has some value. Something you can sleep on your investment. So that's one thing we want to think about in trading, you know? So sometimes we hop on the markets, we think about money, 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 money. You know, that's the right mindset. We're trying to run up a bag, but sometimes we got to play it safe. So the safest trades, a lot of the times, what people don't know, the safest trades, a lot of the times, is what's going to make you the money. Okay, focusing on discipline, being as safe as you possibly can with your money inside of your account. A lot of the times, that'll lead you to running up that big bag. Okay. So people are going to claim that market's going into a bear market when all it's doing is going in a downwards direction. Okay. People who think that market's going to run up infinitely, going up, 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 up forever, it's extremely unreasonable. Okay, market's going to obviously fall down, correct, even if it's a hard correction. You have to understand that there's people who've been invested in years, months, and many more days before you even thought about it or even got in. Okay, so we have to think about those players and how long they've been waiting to close. Okay, so that's why quote unquote bear markets happen. Okay, markets just selling off due to the fact that there's too much supply. Okay, people who got in way in the beginning of time are holding so much of it, they're like, all right, I'm going to take my money and do something with it. Okay, and hence, and then a succession of everyone doing it at the same time, okay, leads to a bear market, leading price to go in a downwards direction. So staking, okay, so we'll talk about this in a second. But understand that the goal is really to increase your total asset count while the prices are low. So this is why I really promote the V, okay? So market, it's gonna fall by itself, okay? Market's gonna do its thing, and the left side of the V is gonna be market falling. Now, once market makes a bottom of the V is when we wanna look for a setup, okay? Look on the weekly or the daily, look for the bottom of the V, and then catch the rest of the V gap fill, okay? That's what you're gonna be looking for. Okay, catching the rest of the V gap fill. So you want to buy something at a low ideally and catch a sweep up. Okay, buy something at a low and catch a sweep up. Okay, because if you buy something a lot of the times, okay, especially if you like an options trade, if you buy something at super all-time highs, okay, you can expect to get pulled back on. Okay, but understand that, yeah, certain positioning, it really does matter. Okay, especially if you're gonna buy certain things that you're not expecting to hold for years and years, especially if you're trading something like leverage crypto. Okay, then we want to go ahead and think about that. Okay, so yield farming. Okay, so providing liquidity to decentralized exchanges to earn trading fees and governance token. Okay, so that's going to be one of the things that some people do too. Okay, and that's going to be something that's just involved, but we don't really have to worry about that. Okay, as well as staking and then stablecoin allocation too, allows you to earn low risk, low yield while maintaining purchasing power for potential market dips. Okay, so there's going to be certain things you can do. Yield farming, you can pretty much kind of like the bank, get APYs, annual percentage yields on your money. Okay, if you invest in a certain cryptocurrencies. Okay, so you can do that. That's a potential option. I don't really recommend that buying spot or just buying normally in a normal broker. is going to be just a lot safer too. Like certain of these yield farm coins can go down and then you're not going to get certain of your returns that you expect back. But some of them do provide nasty returns like 40% per year and things like that on your money. So yeah, that's some things in the cryptocurrency space. So, okay, and then but market will always recover. So even if market decides to go in a downtrend, okay, if something's a valuable asset, it's putting a smile on people's faces. Inshallah, if God wills, it'll hit a sweep back up. Okay, so following every 70%, right, major drawdown in Bitcoin, for example, people were thinking, oh, it's the end of the coin, it's the end, like it's over. And Bitcoin has not only recovered, but has gone on to achieve significantly higher all-time highs every single time. Okay, and the bear market is not the end. It's simply just the consolidation phase where people are just getting a opportunity to buy in. Okay, so it's just an opportunity. So bear markets are an opportunity. Hence why a large amount of millionaires were made in the 2008 recession, for example. Okay, how were millionaires getting made in one of the worst times for people? Okay, but it was really just the worst time for people who weren't investing. Okay, if you were investing during that time, you would have been able to make some really, really, really great money. So yeah. So this is why we take advantage of any dips now. Okay, any dips, we're gonna go ahead and buy the lows, and then you can catch the whole sweep back up. So the bear market, it's just not the end. Okay, it's not the end. Especially if something is valuable, inshallah, you could expect to sweep up. So essential risk management and security. Okay, so self-custody is key. So let's talk about some crypto things right now. So let's talk about keeping our crypto safe. Okay, so keeping your crypto safe is gonna regard in a couple of things. So if you keep your crypto in a broker like Cash App or Coinbase, Kraken, or things like that, okay, they're safe, but if these brokers happen to shut down, then you lose access to your cryptocurrency, okay, or something like that. Okay, so you're not going to have access to certain things. Okay, so what you can do eventually, okay, you can keep it on a broker like these for now as you stack up, but I advise once you get past like 4 figures to the 5 figures range, then go ahead and move you can still buy on these exchanges, is what they're still useful for. But after that, I recommend moving your coins to what's called a cold wallet. Okay, so you could either use it's going to be a hardware wallet where you can actually physically plug it into a computer and then you can get access to your crypto. So those can be destroyed. That's the only bad thing about that. So again, we talked about certain things like the guy clearing the landfill, okay, looking for his cryptocurrency. Okay, so things like that are going to come into play. So you can actually just use a seed phrase. There's going to be certain things like Phantom, okay, Phantom on the Apple App Store. It's really, really good. It's just going to be like a ghost icon, okay, with like some eyes. And there it's going to be backed up by a seed phrase. And the seed phrase is going to be a 12 to 24 word seed phrase. And you can go ahead and just either write it down on pieces of paper, email it to yourself with a secure key, and just keep the code, spread it out somewhere. Okay. So you can do things like that. Okay. So cool. So now we're gonna be good. Okay. So we're gonna focus on bear markets, and we're gonna be waiting for curls. Okay. We're not gonna think of bear markets as bad. We're going to eyeball them. We're going to see opportunity in that. Okay, we're going to see the good in it. All right. So cool. So that's going to go ahead and be that. So if you lost all your money, you're at zero. It's happened to pretty much almost every single trader before. Okay, and I don't want it to happen to you again. Okay, it's going to be important to lower your ego, humble yourself, and this is why it's really important to get with God. Okay, it's really going to help us build consistency, waking up, praying every single day. Okay, let's wake up, let's work out every day. Okay, and let's transmute this pain, and let's work harder, whether at work and or your business. Okay, so you should either be having one job and working on your business, or you could have 2 jobs. Okay, and then on the weekends work on your business. Okay, do what you need to do to grind, run it back up, don't stop. Keep pushing. No matter in any situation, you have to keep pushing. You can't stop. You can't let things get to you. You can't let things break you down within your mental. Okay, if you say you want this, if you say you want to be a profitable trader, if you say you want to put your family in a better position, we got to lock in. We can't be getting broken down. We got to bounce back, inshallah, if God wills. Okay, so here's going to be the full guide to financial and psychological recovery. We got to keep pushing forward underneath any circumstance. We can't stop. We can't let our emotions break us down. That's all just the devil. Okay, the devil doesn't want you to progress, but God wants you to progress. Alhamdulillah. Okay, so turn to God. Okay, wake up every day, pray, get yourself right, lower your ego. This is why you're blowing up your account. Why can't you just accept the fact that you're losing? Okay, if you lost a trade, get off the charts. Why are you trading over and over and over and over and over again? There's no point to that. It's time to transmute all of that pain. Okay, put it into more work, put it into your business, set your alerts at your key levels, and go work on your work and your business. Okay, why are you sitting there trading over and over again? Why are you sitting there taking 10 trades in a day, blowing up your account? How do you expect to progress? Okay, take one trade, risk management, and have some long-term investments. Okay, invest in shares. Okay, cryptocurrency, some long-term investments so you don't have to sit there trying to day trade every single day. The reason why you guys are also blowing up your account so quickly is because you're trying to day trade. All the money you've been losing trying to day trade, one, you could have put it into mentorship. Stackmode on net, the first call is even free. Okay, so I give you guys a free first call. And on top of that, there's just no reason to be blowing up your account in the first place, okay? Because all that money you've spent trying to day trade, trying to make profit, you could have been putting in long-term investments, and your profit would most likely still be positive today, and you'd still have a large majority of it. And so you'd be up and you'd still have your money, okay? So focus on long-term trading too, okay? It's not just all about day trading, 0 DTE, futures, etc. Don't let that prop firm mindset destroy you. All right, let's go. So the immediate aftermath, the psychological toll, losing a significant amount of money in trading is more than just a financial event. It's a deep psychological blow, and you may experience a range of emotions, including shock, denial, regret, shame, and even a profound sense of failure. And it's crucial to understand that these feelings are normal and a part of the grieving process for your financial loss. Acknowledging this emotional state is the first critical step towards healing and recovery. So acknowledging the pain. Do not suppress your feelings. Allow yourself to process the loss without judgment. And this is a necessary emotional release that has to happen. And combat cognitive bias. Your mind might trick you into a get it back quick, okay? Get it back quick, okay? So pretty much if you lost some money, let's say you lost $200, okay? You might think, okay, I'm gonna go ahead and risk even more money so this way I can go ahead and get my $200 back and I can go ahead and end up profitable on the day. No, man, you lost. If you lost, you lost. You get off for the day. You plot out an even cleaner setup. You come back with even more logistical analysis and more of a good reason to put on a good trade. And until then, you're gonna wait. I don't care if it takes days, weeks, or months, okay? You wait for a good setup. Don't just come on here and burn your money trying to fiend for money, okay? Wait days, weeks, and months. It takes a long time to get profitable, okay? But it can happen now if you just plant yourself in the right positions, okay? Invest in things that have future value. Invest in things that put smiles on people's faces, okay? Some stocks just go up in a straight line year after year after year after year after year. You just have to do your research, okay? So don't get tricked within the get it back quick mindset, especially day traders. Day traders, you gotta control your emotions. You gotta think more long term. Even if you make some profit off a day trade, think about how you're gonna reinvest that back into a long-term play. And recognize that this is a cognitive bias, specifically the recency bias and loss aversion. And this resists the urge to jump back in. So conduct a brutally honest financial audit. So before you can rebuild, you must understand the full extent of the damage. This is not about self-blame, but about creating a clear picture of your current financial reality. And these detailed audit will be your map for the road ahead. So identify the full loss. Tally up every dollar lost. And this includes not only the principal, but also any fees, interest borrowed on funds, or opportunity cost. And categorize your remaining assets. List every single asset you still have, from checking account balance to the value of a car or your home, okay? Be meticulous. And document your debts. Don't run from your debt, okay? Don't run from your debt. You know you gotta pay it off, okay? Certain things that you might have piling off. I pray that you guys don't have any debt, but if you do, let's tackle that. Let's pay it off. Let's stay down. Let's get in stack mode. Okay, stay down, stack mode. Okay, get in stack mode for the rest of your life. Okay, only spending 50% of our income, keeping the other 50% in the stash. This way, after we pay taxes, we're still gonna have money left over in the stash, inshallah. So document your debts, create a comprehensive list of all your liabilities, credit card debt, personal loans, mortgages, etc. And after a $50,000 loss, for example, a trader might discover they only have $500 in their checking account and $2,000 in their savings account. They also find they have a $10K credit card debt occur trying to recover the loss. Okay, so while they were just trying to make up for the money lost in cash, they were just spending money on their credit card debt. Okay, something that's happened to me, and I don't want you guys to go through that. It can be extremely daunting, extremely frustrating, and scary when you start seeing your debt pile up like that. So be financially responsible before you start trading, and don't trade with any money that you can't lose. So their audit reveals a negative net worth, but it also provides a clear starting point for a new financial plan. So focus exclusively on earning and saving. Stack mode. Okay, stack mode is about being a God-fearing, righteous individual. Okay, and it's about staying down. Okay, saving up your money, because we got people that's protecting and provide for. We can't be spending all of our money on stupid stuff. We got to be investing smart, growing our money, and making sure our money is always making us more money. Money is going to be a tool. Okay, don't use money just to consume. Use money as a tool in order to generate some more money. This way you can work, okay, less. Okay, so as you get older, you're not going to be able to work the same, but you still got to be generating some money. Inshallah, still going to be people that need help. Still might be family that need you. Still might be people to take care of. So your money needs to always be making you money. So use it as a tool and set up your investments. So for now, all trading activity must cease. Okay, if you go broke, if you lose all of your money, trading is stop. Okay, pause it. Your number one priority is to rebuild your financial foundation with stable, reliable income. And this is a period of accumulation, not speculation. So work on increasing your income. So every avenue that you can explore, whether it's working harder at your business, okay, trying to get monetized on certain things, okay, creating certain programs, lots of things you could do to generate wealth. Especially with AI, it's extremely simple to just choose a niche and jump straight into it and just work hard. Okay, so this can mean working more hours, okay, freelancing, certain businesses. Just do what you need to do to generate some more income. So create a strict budget. So develop no frills budget that prioritizes essential living expenses. So stack mode, right? So when you're in stack mode, you got to really be staying down. When you get older, you can't work 16, 18 hours a day. Okay, you're going to be too old, but you got to be using money as a tool still. You still got to be investing. You still have to be generating income. Okay, so this is why investing is going to be so important, inshallah. So while you're healthy, okay, invest your money, so then when you get older and you can't work as long hours, you're still going to be able to survive. You're not going to be down bad. Okay, I don't want you guys to be broke, okay, with no options and just nothing to really just say that you did on this earth. Okay, so please save your money and get in stack mode. It's important. So every dollar should go towards building an emergency fund and paying down high interest debt. And eliminate high interest debt. So use strategies like the debt snowball or debt avalanche to aggressively pay down credit cards and personal loans. And this is a guaranteed return on investment. So a deep dive into education and risk management. So once your foundation is stable, okay, you started clearing your debt, you got your money back on track, it's time to re-educate yourself. Your previous approach failed, so a complete overhaul is necessary. Okay, lower your ego and you have to completely change everything. Restart your mindset, restart how you think about everything, restart how you approach the charts in life. Okay, completely overhaul your mindset. Quit things that you used to do. Okay, start doing some new things. Okay, and this step is about replacing reckless habits with a structured, disciplined methodology. Okay, so here's a market study. So dive into the market history, economic cycles, and different trading philosophies. You can go ahead and read books. I have so many videos too. Okay, and you can go ahead and check out how to balance your account. Okay, do your research. Okay, I also have an ebook as well too, free course, many free videos. Please just do your research before you hop onto the charts, trying to throw some money at it or trying to make some money. Okay, because you might just end up losing some money, and that's really gonna hurt. So do your research first, please. Master your risk management. This is a non-negotiable. Learn to calculate your position sizing, set your stop losses. That's an area where the price is gonna go ahead and close out your trade automatically if it hits that certain area. Okay, causing you to only lose a certain amount of money, and never risk more than 1 to 2%, especially when you're a new trader. But as you get better, you can go ahead and bump that up to 1 to 10% of your account. And a well-defined plan is going to be your roadmap for everything. It must include your entry and exit criteria, your risk-to-reward ratios, and a detailed list of rules that you're never going to break. So instead of day trading with leverage, for example, a recovered trader decides to focus on a long-term swing trading strategy in a single sector they've studied for months. Their new rule is to never risk more than 1% of their account on a trade, ensuring that a string of losses won't wipe them out again. Okay, you're coming onto the market to make some money. Why are you coming into the market and going back to zero? it's not making sense. So you need to be focusing on the trades that are going to keep your account alive, and not the account, or not the trades that's just going to make your account money. Okay, money is not always everything. Focus on what's going to keep your account alive. Focus on the safety. Okay, and that inshallah will transpire to profitability. So conquer your emotional demons. Okay, trading is going to be 80% of psychology. I've seen it firsthand. You can give someone the best levels and they don't close at take profit because they think it might go further. Okay, so psychology is going to be extremely important, and your perspective. So your biggest opponent is not the market, but it's going to be your own emotions. Okay, and a lot of times it's going to be the devil trying to attack you. So just pray to God, and just understand that it's just evil trying to decept you. Okay, anything that you guys might want to do to tempt you to do anything bad, it's all just evil. Okay, don't do it, because when you're crying afterward, when you're sad afterward, that just means that the devil got you. Okay, so don't be weak, be strong. Okay, and keep your head on. So you must learn to separate your personal feelings from your trading decisions too. Okay, so even if you take a big loss, even if you just went down to zero, don't treat people bad. Okay, don't treat people bad around you. Don't talk to anyone bad. Don't get emotional. Okay, I know there's some times when you take a loss, you can't even speak to anybody. Okay, I've had those days. I've definitely had those days, but you can't let the trading loss affect your real life. Okay, you have a whole life that God has blessed you with. Okay, there's still grass outside, still fresh air, etc. Okay, so even if you lose all of your money to trading, don't get depressed, don't spiral, and just manage your expectations. And understand that trading is going to involve periods of drawdown. Okay, and especially when you're first starting, if you go down to zero, it's okay. Okay, many people fail with their businesses, have gone down to zero, failed businesses, and I wish you guys just know how much trial and error it takes to actually be successful. Okay, this is why God is important, so you don't go insane. Okay, it takes an extreme amount of trial and error. Okay, so winning every single trade, that's an illusion. Okay, in hindsight, kind of not really. You are gonna lose sometimes, but it depends what you're trading. You can win like 99% of your trades though. I can say that confidently. So focus on long-term probabilities of your edge, not the outcome of a single trade. So start a trading journal. Okay, document your trades on YouTube, Notion, Discord, whatever. Okay, coming out with the app, Stackmode app, where you guys can also track your profits and trades too. Okay, so document every single trade, your profit, your loss, your entry, your thought process, how you felt, and the outcome of it. This is going to help you identify recurring mistakes and any emotional triggers, and practice unwavering discipline. Stick to your plan no matter what, and do not chase trades, do not get greedy, and do not panic. Discipline is the bridge between your goals and your execution. So start with paper trading too. Okay, you can paper trade on TradingView. A lot of brokers too allow it. And don't jump back into the market with large sums of money. Wait. Okay, play with small percentages of your work check, your business check, whatever. Okay, pay your bills first, get some groceries, and then whatever you have left over, start investing with. Okay, let that grow over time. And by this whole time, while you're playing with small amounts of money, you're gaining info. Okay, so say your business, something like that blows up, when it's time for you to get into the big bucks, when it is time for you to throw it into the market, you're going to be well informed and you're going to be all good. Okay, so alhamdulillah. Okay, so it's a lot better being in this position versus being somebody who has a lot of money trying to come into the market with no education and then losing it. Okay, because that can hurt. And even if that has happened, it's fine. You can run it up again, inshallah. So start with the tiny account, scale it up. If you can't grow a small account to a big account, you can't grow a big account to a bigger account. That's just the truth. So increase your position size when your account grows through profitability. Okay, be disciplined and don't just keep adding more capital in your pocket whenever you're making bad decisions. Okay, you have to grow your account. Okay, let it grow through discipline. So losing money can be the most valuable lesson you'll ever learn. It's definitely taught me a whole bunch, got me closer to God, made me realize how unstable I was in certain emotional aspects. I realized I was extremely greedy. Okay, there'd be times I just wouldn't be satisfied with my profit. Okay, and that was leading me to spiral over and over and over and over again. Okay, leading me to take more trades than I need to, trying to chase more dollars, instead of just realizing if I would have just stayed disciplined, been consistent, then I would have gotten to the position of where I wanted to at the same pace anyways. So instead of trying to make $2,000 in one day, if you make $500 4 days separately, that's still the same amount. Okay, so just focus on the long-term vision. Okay, get rich slow, focus on the discipline, and confront your weaknesses. Okay, and rebuild your strength and your wisdom. Okay, God tells us to be reborn, and the journey back is not just about financial recovery, but it's all about personal transformation. And you're no longer the same trader who took on too much risk. You are a new, more disciplined, and more resilient individual. Okay, rebuild yourself back up and become a boss. Every boss has taken a major loss, and it's about bouncing back. Do you have that hustle in you? Okay, it's really gonna determine if you're built for this. Okay, if you have the hustle in you, you'll run it back up. All right, God got you. Don't give up. You got people to provide for. I love you so much. Head over to Stackmode.net for all trading and business education. Catch you in the next one. Peace. Hey class, today we're going to be talking about exactly what a hard fork is within the decentralized finance space. Let's go and let's jump into it. So, code consists in chains, and at its simplest, a fork in the blockchain technology refers to a change in the network protocol. This change usually involves updating the software used by nodes to validate transactions and blocks. A key distinction must be made between a simple software fork, and that's copying open source code, and a protocol fork, which changes the consensus rules. So, a software fork, code-based copy. So the definition of a software fork is it copies an open source code base, for example, Bitcoin Core, to start a new, often compatible project. And the impact of it does not affect the original blockchain's history or consensus rules. It creates a new independent project. And for an example, Litecoin. It was originally a fork of the Bitcoin code base, but now it operates on its own chain. Let's talk about a protocol fork. Consensus change. And the definitions of a protocol fork is it modifies the rules that govern which blocks and transactions are considered valid on a single blockchain. And the impact of it directly affect the chain's integrity, leading to a split in the network's block history. And the outcome of it is it requires all participating nodes to update their software to maintain network harmony. And the core difference lies in the shared history. A protocol fork shares the entire history up to the point of divergence. So, the critical distinction. Let's talk about soft forks versus hard forks. So, understanding the difference in compatibility is paramount to grasping blockchain evolution. And this dictates whether the upgrade creates one chain or two chains. So a hard fork, non-backward compatible. So as far as a rule change, it introduces new rules that are incompatible with the old software. And the mandate of it, all nodes must upgrade and old nodes will reject blocks created by new nodes. Okay, so all nodes must upgrade. The old nodes will reject blocks created by any new nodes. And the outcome, if the community is divided, which is going to be caused by lack of 100% adoption, the chain will then split permanently into two separate blockchain, A and B, each with its own currency. And as far as the hard fork, the non-backward compatible system, both chains share the same history up until the block of the fork. And let's talk about soft fork. Soft forks are going to be backwards compatible. And the rule change implemented into it is that it tightens existing rules, making a previously valid block invalid under the new rules. And mandate, only a majority of nodes need to upgrade, and old nodes will still accept blocks from new nodes because the new blocks satisfy the old and stricter new rules. And the outcome of it, the network effectively remains one chain, and the old chain slowly dies out as the new blocks are not recognized by the majority, forcing compliance into it. For an example, Bitcoin SegWit, and SegWit stands for Segregated Witness, and that was a classic soft fork implementation. So a lot of these things that we do know were actually fork implementations that just stuck around. So let's talk about this case study here. Bitcoin Cash, for example. Bitcoin Cash, also known as BCH, okay, the scaling schism. So the split that created Bitcoin Cash, BCH, on August 1st, 2017, it's the most famous example of a contentious hard fork rooted entirely in a debate over scalability. And the problem is Bitcoin block size. The original Bitcoin protocol restricted the block size to 1 megabyte, limiting transaction throughput to about 7 transactions per second. Okay, transaction per second can also be abbreviated as TPS, which leaded to high fees, also known as gas. So the term gas equals fees, leading to high fees and slow confirmation times. So that was way too slow. Okay, it wasn't quick enough, and it had to get quicker. So the division, the two scaling facilities, so core devs at Bitcoin, preferred off-chain solutions like SegWit, also known as the soft fork system, and Lightning Network. Okay, BCH proponents preferred on-chain scaling via an immediate increase in the block size limit. And the outcome, a permanent split occurred. Since changing the 1 megabyte limit was non-backwards compatible, the minority group implemented a hard fork to increase the limit to 8 megabytes, later to 32 megabytes. Okay, so as technology increases and technology gets more powerful, the whole decentralized space changes. And it results in 2 chains, Bitcoin, also known as BTC, and Bitcoin Cash, which is going to stand for BCH, and the technical impact between the two. The hard fork ensured that any node running old Bitcoin software would consider BCH blocks, which were greater than 1 megabyte and invalid, physically separating the 2 chains and their histories post-fork. So let's talk about case study number 2, the Ethereum Classic, the ETC, the ethical split. So the Ethereum fork that created Ethereum Classic, ETC, on July 20th, that occurred in 2016, it was not about scaling, but about philosophy and dealing with an economic exploit. So let's talk about the DAO incident here. So the DAO incident, which occurred in June 2016, and a decentralized autonomous organization, also known as a DAO, is built on Ethereum, and it suffered a hack/exploit. So people got into it, breached the database, and it drained roughly $50 million worth of Ethereum at the time, okay, worth of Ether, due to a vulnerability in its smart contract code. So the smart contracts are going to be the autonomous system that controls the whole decentralized system. So in a centralized system, banks control everything. They can confirm whether or not transactions go through or not, and they control the reserves. Within the whole smart contract decentralized blockchain system, everything is done autonomously on a smart contract system, kind of like a vending machine. So, but hackers were able to get into that due to the fact that the security system was a lot weaker about 10 years ago from these videos dropping, and it's only increasing as developers, AI, and coders notice more exploits and prevent them. Alhamdulillah, God is good. So, proposed solutions. The Ethereum community largely voted to implement a hard fork to roll back the chain history and return the stolen funds to their original owners. Okay, so they were able to roll back the history and roll back people's funds back to them. So extremely nice. God is good. So the principle of it, code is law. A minority group of community members rejected the fork on the basis of immutability and the code is law principle, arguing that interfering with the chain, even due to undo a theft, set a dangerous precedent. And we'll talk about the split. The majority moved to the chain, called Ethereum, ETH, and the minority remained on the original unforked chain, which was renamed Ethereum Classic, also known as ETC, preserving the hack history. So, this case illustrates that hard forks are not just technical. They often involve deep ethical and philosophical debates about decentralized governance and immutability. And once again, the decentralized space is going to involve no superpowers. Everything's going to be done by pretty much AI, computers, and smart contracts. So, why hard fork? Let's talk about the rationale and objectives of it. So while often continuous, hard forks are sometimes necessary for the survival or significant evolution of a decentralized protocol. They're generally triggered by 3 main factors. Let's talk about the first one. So they introduce new incompatible features, okay? And when major changes are needed that fundamentally alter the way transactions or blocks are structured, for example, changing the hashing algorithm, introducing a new scripting language, or integrating privacy features, the old software simply cannot interpret the new data structure. So number 2, fixing critical security bugs, extremely important to keep our money safe, okay? Inshallah. So if a critical vulnerability is found that could compromise the entire network, causing a catastrophic bug, a scheduled hard fork might be the fastest way to implement a necessary fix that prevents further exploitation, often involving a protocol reset so people can get their money back if anything was lost in the first place. And they reverse malicious transactions. Controversial, okay, but could be necessary in certain cases where, once again, people are trying to take people's money unfairly. And as seen with the Ethereum ETC, Ethereum Classic, a fork can be used to bail out a network after a significant loss of funds, effectively rewriting the history of the chain to reverse the malicious transfer. And this always raises governance questions because, people can just reset and roll back transactions. But if it's used in a responsible way, I can see how it could be safe. But then again, would this be centralized? Let me know in the comments below. So hard forks that are planned and implemented with full community backing, like Monaro's regular updates, are often called non-contentious hard forks. So implications for users, exchanges, and developers. A contentious hard fork like Bitcoin or Bitcoin Cash, it has massive downstream effects on the ecosystem, requiring coordination across various entities. And the user impact of it, free coins and confusion. So coin duplication. Holders of the original coin automatically receive an equal amount of the new coin on the new chain. So for example, Bitcoin holders got BCH. And wallet management. Users must ensure their wallets support coin splitting and replay protection to safely access the new coins without losing the old ones. And market volatility can also be a factor. The value of both coins often experiences extreme volatility immediately post-fork as markets decide which chain to support. And the impact of the ecosystem, let's talk about the exchanges and developers. So exchange listing. Exchanges, which is pretty much places where crypto tokens and stocks can be listed, exchanges must decide whether to list a new coin, requiring significant technical work to ensure stability and implement deposit, also known as withdrawal infrastructure, okay? And replay protection. Developers must implement measures to prevent a transaction valid on one chain from being replayed and validated on the other, and that's crucial for security purposes. And development resources. The talent pool is going to be split, potentially weakening the development resources and future progress of the original chain in the first place. So, hard forks, while disruptive, they represent the ultimate form of decentralized governance, and they're the mechanism by which communities can execute fundamental disagreement, allowing different ideological and technical visions to coexist. So, some key takeaways. A hard fork is a non-backwards compatible protocol that change based on the results, and it results in a permanent chain split unless 100% of the community upgrades. And they're often driven by three factors. 1, feature upgrades. 2, security fixes. And philosophical disagreements. Okay, for example, scaling or immutability. And some key examples of a hard fork are Bitcoin Cash, okay, over scalability, and Ethereum Classic over immutability, following the decentralized autonomous organizational hack. And they forced the entire ecosystem, users, developers, miners, exchanges to make a binary choice and adapt to a new reality and choose what's best for them. Stay prayed up to God, keep grinding, head over to stackmode.net for all trading education. I'll teach you how to trade cryptocurrency. Peace. All right, guys, it's Stackmode Cursor. Today we're going to be talking about the cover calls and the iron condor. We're going to understand how these market structures work. We're going to deconstruct the mechanics and the risk profile of the cover call. Appropriate market environments for deploying each strategy. Okay, let's go and let's jump straight into it. So, the cover call is perhaps the most fundamental income generating option strategy. It involves holding a long position in an asset, like 100 shares of stock, for example, and simultaneously selling a call option against that same stock. The term covered is the key, as your long stock position acts as the collateral. And the goal of it is to generate premium income, right? To generate some cash flow against a long stock position, essentially lowering your net cost basis in shares. And it performs best in neutral or slightly bullish markets in general. So let's talk about the two-part mechanics, right? It's a two-part trade. So leg one of the trade is, let's say you're long. So you would have to buy at least 100 shares of the underlying stock, okay? Whatever that you wanted. And then leg two, you would short. Then you could sell one call option contract, which represents 100 shares. So a call option contract represents 100 shares. Same thing with the put option. It represents 100 shares per contract against the long shares. So we'll talk about the strike price and expiration. So the call option is typically sold out of the money, meaning that the strike price is above the current strike price. So it usually has an expiration date between 30 and 60 days out, and this balances the maximum time decay benefits while minimizing the chance of early assignment. So the key concept of it, right, is capping the upside. So by selling the call, you're going to be granting someone else the right to buy your shares at the strike price in exchange for the premium. So you agree to cap your potential upside profit at that strike price if the stock rallies significantly.